Hello all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to start with something which is the most awaited thing for all of us. All those who are giving your exams in May 2025 or in September 2025 or November 25 as the case may be. I don't know as of now when I am recording the batch. So we are going to compile today 9 RTPs of ICAI which are all updated as per the latest Finance Act 2024. So earlier we used to compile around 6 to 7 RTPs. So this time we have improved ourselves and we have added 2 more RTPs, that is 9 RTPs including the latest one of May 2025. Believe me, this RTP compilation is going to be one of the most important video for you all. I am recording this again. First I have recorded in Hindi English. Now I am again recording for my dearest students who wants to learn in full English, especially from South India, in full English. So I request you all to share this video with as many friends of yours as possible. Now this video is going to be one of the most important video. It is going to be one of the most deciding video for you all. I'll be putting the videos in 3 parts. First, the video for compilation of 9 RTPs, then the video for compilation of 9 past papers, and then the video for compilation of 10 MTPs. MTPs I'll be putting slightly later because ICAI has not yet uploaded the MTPs for your exams. Believe me, if you do these 3 videos properly, along with that, the MCQ video which I have already uploaded in full English for you all, the 35 case scenario MCQ, I don't think so any other thing is required after that. No revision videos will be helpful after that. Believe me. These things will completely 100% cover almost all the important concepts that are relevant for your exams. So watch this video as many times as possible and share it with your friends also. So let us start without wasting any further time. The very first RTP May 2021. The first question over here is of non-resident taxation. There is a company by the name called as Lords INC which is engaged in providing some fees for technical services to an Indian company. There is an agreement between both of them and the agreement is approved by central government. Whenever such words are there in the exam, FTS, approved by central government, etc., agreement is there, then definitely the provisions of 115A or 44DA is applicable. 115A is applicable if the foreign company or non-resident does not have a P in India, and 44DA is applicable if the foreign company or non-resident has a permanent establishment in India. According to that, you have to answer the question, okay? Now, there are 2 parts of this question. Part 1. Part 1 says that examine the taxability. Also find whether the assessee is supposed to file the return if the assessee does not have a permanent establishment. See, so if the foreign company does not have a permanent establishment and if the foreign company is providing some fees for technical services and there is an agreement between both the party and it is approved by central government and there is no permanent establishment, therefore provisions of 115A are applicable. And as per provisions of 115A, this royalty of 3.2 crore will be taxable at 20% tax, 2% surcharge because the income is more than 1 crore for foreign company, surcharge of 2% will apply and 4% cess. Or compare with DTAA rate, whichever is lower. Now in this question DTAA rate is not given, so ignore DTAA. We will tax as per 115A only, 20% plus 2% surcharge plus 4% cess. I hope it is clear to all of you. Plus, is the assessee liable to file the income tax return? Before that, is the assessee going to get some deduction of expenses out of it because they have given us expense of 28 lakh rupees here? No, the assessee is not going to get deduction of any expense over here. Next, is the assessee liable to file the income tax return? No need to file the income tax return. Why, sir? Because the provision says that if the assessee earns only FTS income or royalty income and the TDS is deducted as per 115A, then there is no need to file the income tax return. So we are assuming that the TDS is deducted as per 115A, therefore no need to file the income tax return. Yes, if the TDS would have been deducted as per what? As per DTAA. If the DTAA rate would have been lower, 18%, 16%, 15% or 20%, then if the TDS would have been deducted as per DTAA, then the assessee had to file the income tax return. But in this case, the TDS is deducted. It is assumed that we are deducting TDS as per 115A and the assessee only earns this income, therefore no need to file the income tax return. This is what part 1 is all about. Part 2. Part 2 says that if the same company has a permanent establishment in India, then what will happen? Then you will compute income normally. You will compute income by making a proper books of accounts and P&L. How will you compute the income? The fees for technical service 3.2 crore, expense of 28 lakhs, you can take the deduction now because the assessee has a permanent establishment in India. 2 crore rupees, another fees for technical service, then again 21 lakh rupees expense you are incurring, then Some expenses which are not wholly and exclusively for the Indian branch, that is not allowed under 4040A. So if an expense is not wholly and exclusively incurred for Indian branch, it is not allowed. Further, if the permanent establishment, that is the branch in India, is making some payment to the HO and it is not in the nature of reimbursement, then it is not allowed. If it would have been in the nature of reimbursement, then it would have been allowed. If this payment by PE to HO is in the nature of reimbursement, then this would have been allowed. But because this is not in the nature of reimbursement, it will not be allowed. I hope it is clear to all of you. And last but not least, what are the other requirements? The other requirements are the assessee has to maintain books of accounts, assessee has to follow the income tax return, assessee has to conduct audit, and the tax rate in this case will be the normal tax rate. And what is the normal tax rate to a foreign company? It is 35% tax, 2% surcharge, and 4% cess, 2% surcharge because the income is more than 1 crore rupees. I hope it is clear to all of you. So this is what this question is all about. And in this manner, I am going to explain you each and every question in detail in this particular video in a very, very comprehensive and in a very, very short manner. We are not going to stretch the discussion for hours and hours and hours and hours for one question. All those things we have already done in class. We have already done all these things in our regular batch as well as in our exam oriented batch. But here the objective is to recap them in a very fast manner so that a day before exam you can again see this at least once before the exam, if not twice. Okay, so let us start with the second question. The second question is a very simple question on penalty. There is an LLP who has filed the return, and in the return the LLP has shown the income as 18 lakh rupees. While processing the return, the income was 22 lakhs. Later on, the assessment was done under regular assessment, the income was 35 lakhs. And then income escaping assessment was done under 147. At that time, income was 42 lakhs. Then last but not least, we have to compute the penalty and we have to assume that it is not a case of misreporting. It means the penalty will be 50% because it is not a case of misreporting. Now, what is the first time that the penalty will be imposed? The penalty will be imposed while doing the regular assessment. For computing the penalty, what is the first thing that we need to compute? Income assessed minus income processed. Income assessed is 35 lakhs. Income processed is 22 lakhs. 35 minus 22 comes to how much? 13 lakh rupees. 13 lakh rupees is your underreported income. Now, will you compute tax on 13 lakh rupees directly? Never ever do that. First compute tax on 35 lakhs, then compute tax on 22 lakhs, and then take the difference between the two. Okay, and then apply 50% penalty on you on that. Okay, first compute tax on 35, then compute tax on 22, then take the difference of the two, and then apply what? Then apply the 50% penalty. What is the tax rate, sir? Tax rate for LLP is 30% plus 4% cess. Now, what is the second time that penalty will be imposed? When the income is assessed under 147. So, income reassessed under 147 is 42 lakhs minus income previously assessed. What is income previously assessed? It is 35 lakhs. So, 42 minus 35 comes to how much? 7 lakh rupees. Now, this 7 lakh rupees, again, will you compute directly tax on 7 lakh? Never ever do that. Compute first tax on 42 lakhs, then compute tax on 35 lakhs, and then take the difference between the two. And whatever the tax comes, whatever the tax on underreported income comes, then on that you apply to 50% penalty. I hope it is clear to all of you. Don't make a mistake of computing tax directly. Now, the third question is of Indian company who is following some MAT provisions. So we need to find the book profit and the MAT liability. So the profit as per P&L account is 52 lakh rupees and they have given us the P&L account. We need to tell which all items will be added back or reduced from the book profit. First of all, the first item is provision for loss of subsidiary. This is added back in MAT, add back. Provision for doubtful debts, add back. Provision for income tax, add back. Next one, be very careful. Provision for gratuity based on actuarial valuation, do not add back. Sir, why sir? It is not added back. What is added back in MAT is provision for unascertain liability. And if an actuary makes an valuation, it is not an uncertain liability. It is an uncertain liability. Therefore, it will not be added back in MAT. But under the normal provision of the income tax law, when you will compute the income, in this question, they have not asked to compute normal tax. They have only asked to compute the book profit and MAT. But under the normal provision, this actuarial valuation would have been added back because there is a specific disallowance under section 47 to add back provision for gratuity. Even if it is made by an actuary, we have to add back under normal provision. But under MAT, we will not add back. Next, depreciation you will add back and other than revaluation you will reduce. Now, depreciation on account of revaluation is 80,000 and total depreciation is 3,08,000. Therefore, what is other than revaluation? Other than revaluation will be 2,28,000. 3,08,000 minus 80,000, 2,28,000 will be other than revaluation. That much depreciation you have to reduce. Next, interest you will not add back because interest, all these things are not added back under the normal provision. Under MAT, it is added back under the normal provision. Penalty, you will not add back. Then SEZ deduction, you will not reduce because on that MAT is applicable. Then share of income from AOP as a member, yes, that you will reduce. Why? Because the AOP has already paid tax at maximum marginal rate, and if the AOP has already paid tax at maximum marginal rate, then the share of income from AOP is exempt in the hands of member under section 86. I hope it is clear to all of you. And last but not least, long-term capital gains also you will not reduce because on long-term capital gains also you have to pay MAT liability. You have to pay tax on that. Then adjustment number 1 already done. Adjustment number 2, depreciation as per income tax rules. We will not do anything because that is relevant under the normal provision, not under the MAT liability. Then the total loss as per the books of accounts is 32 lakhs, out of which unabsorbed depreciation is 18 lakhs. Therefore, unabsorbed depreciation is 18 lakhs and total is 32. Therefore, 14 lakh is what? 14 lakh is business loss. It is loss as per books of accounts. Therefore, how much is allowed under MAT? It is loss or UVD, whichever is lower. Therefore, 14 lakhs will be allowed to you. 18 lakhs will not be allowed to you. I hope it is clear to all of you. And last but not least, provision for tax includes 65,000 interest payable. It doesn't matter. Even interest payable is disallowed under MAT. Therefore, if it is included in the provision for tax, it is good enough. We don't have to do anything in that. Then you will compute tax on that. What is your book profit? The book profit is 40,08,000. You will compute 15% book profit of the book profit. 15% of the book profit as tax and 4% as cess or charge will not apply because the total income is up to 1 crore rupees. That will be a MAT liability. Now there is one second part in this particular question which says that would your answer change if Ganga Limited is located in IFSC and derives income solely in the convertible foreign exchange? Yes, if the company is located in IFSC, then the MAT rate will be 9% instead of 15%. Apart from tax rate, no other changes will be there. The computation will remain same only the tax rate will change in this particular case. I hope it is clear to all of you. Next question number 4. It's on charitable trust exit tax. A trust which was set up in 2015 with an object of relief of poor. Later on, in 2017, they changed their object to provide education to the underprivileged, that is to poor people. So it is allowed to change the object from one object to another, it is allowed. But later on, they applied for registration in 2017 and the registration was granted in 2018. Now, this is a very important date for us. The registration was granted in 2018, very important words. Next one, in 2024, they made a mistake. They got merged with an entity which is not entitled for 12AB. So if you do such thing, if you merge with an entity which is not entitled for 12AB, then in that particular case, you will be liable for exit tax. In that case, exit tax will be computed on you. And how exit tax is computed? For that, we need to compute all the value, FMV of all the assets minus FMV of all the liability. And on that, 34.944% tax has to be imposed. So let us compute the FMV of all assets first, and then we will compute the FMV of all liability, and then we will apply the MMR, that is 34.944% tax in case of exit tax. Now, the first land is there. The first asset is land which is there in Surat. So ignore this particular land. Why, sir? Why we should ignore? Why we should not take this in the accredited income? No, this land will not come in the accredited income because this was purchased before the date of registration. Do you remember? Any asset and liability which has been purchased or which has been incurred before the date of registration shall not be taken in the accredited income. Be very careful. That is the reason I told you the date of registration is very important to us in this question. Second land, Baroda land, which is purchased on 21st of November 2018. Yes, this is purchased after the date of registration. Therefore, this has to be considered. Now, what is the value of this? It is stamp duty value on the valuation date. Valuation date means the date on which you merge with another entity. Stamp duty value on valuation date or market value, whichever is higher. Therefore, in this case, the higher value is 105 lakhs. You will take 105 lakhs as your valuation. For quoted share, you will take the average of the share price on this valuation date. So on 1st of April 2024, for quoted share, what is the average? The highest price is 280, the lowest price is 250. Therefore, the average will be 265. 265 into 3000, that will be the value of quoted shares. For preference shares, you will take the market value as per the merchant banker, etc., based on what? On 1st of April 2024. Now, from where I am saying all these things, I am not saying all these things from my mind. All these things are written under the provisions of Rule 17 CB, which talks about valuation in case of exit tax. Okay. Last but not least, the liability is 112 lakhs, out of which certain liabilities will not be part of accredited income. Corpus fund is not part of accredited income, so reduce that. Even provision for tax is not part of accredited income, reduce that. Even reserves and surplus is not part of accredited income, so reduce that. So reduce these three items, you will get what? You will get your liability. Then asset minus liability, you will get your accredited income. On that apply 34.944%. Sir, how did you get this 34.944%? 30% income tax, 12% surcharge, 4% cess. So this is what this first RTP is all about. Now you will say that in the first RTP only 4 questions are there. It's not like that. There were many other questions, but some of the questions have become redundant because it is a 4-year-old RTP. Obviously, in 4 years, lot of amendments have come. Like section 147 has changed 4 times in last 4 years. So the things have become redundant. The ICI will also not consider those questions. Or it might have been covered in some other RTP or in some other MTP or some other past paper. Believe me, not even a single question we have removed out of all the 9 RTPs. Everything is covered. Only those questions which has become redundant in May 2025 or later attempt, only those questions have been removed from here. Otherwise, nothing has been removed. I hope it is clear to all of you. Now let's go on to the next RTP, that is RTP November 2021. The first question in this RTP is a beautiful question, and first thing that I would like to say over here is we are going to solve this question as per AY 2021-22 and PY 2021 accordingly. Otherwise, this question will not make any sense. Okay, so accordingly, we need to understand that this question is for previous year 2021, assessment year 21-22. Now there are two companies over here, X Limited and Y Limited, and let me talk about both of them. First of all, X Limited is an Indian company engaged in generation of electricity. It was set up in 2018, and because it was set up in 2018, it is not eligible for 115 BAB. It cannot be eligible under 115 BAB because for 115 BAB, your company should be set up from 1st October 2019 to 31st March 2024. Therefore, it is not eligible for 115 BAB. Yes, you can go for 115 BAA. Now, on the date on which the company was set up, they have employed 500 new employees. All of them participate in the recognized provident fund. The payment was made by ECS. Out of the 500 employees, first 150 employees were paid emolument of 18,000. Next 150 employees were paid emolument of 22,000, and another 200 employees were paid emolument of 26,000. Now on 20th of September 2019, the company started claiming depreciation on WDV. Earlier it was claiming depreciation on SLM. We all know that if you are engaged in generation of electricity, you are eligible to go for either SLM option or WDV option. But from 2019 onward, the company has converted from SLM to WDV. I hope it is clear to all of you. Then the turnover of 1819 and 1920 was respectively 402 crore and 249 crore. Then on 1st October 2020, the company installed new plant and machinery and put to use the same immediately. The company has received dividend of 60 lakhs in the previous year 2021, and the company also paid dividend of 72 lakhs in the financial year 2021 in July 2021. Now let's talk about the second company. Second company is Y Limited. Y Limited is an Indian company. This is set up on 1st of October 2020, and it is engaged in business of printing of books. Be very careful. If you are engaged in printing of books, you are not eligible for 115 BAB. Again, you have to follow 115 BAA only. The date is not an issue over here. The company is set up on the proper time because it is set up between 1st of October 2019 to 31st March 2024. But the problem is with the nature of business. Do you know that there are certain businesses which are excluded from 115 BAB? One amongst them is printing books. If you are engaged in the business of printing of books, you are not eligible for 115 BAB. Now you have also purchased some plant and machinery for 2 crore rupees, and then you have put to use the same on the same day. Then you have also employed 200 employees whose emolument is 25,000 rupees. You paid them by account paycheck. All of them participate in the recognized provident fund. Now the question says that the gross total income as per the special provision, not as per the normal provision. Special provision means 115 BAA BAB. As per the special provision, the gross total income is given as 6.6 crore for X and 1 crore for Y. So they have directly computed the gross total income for us and they have given us. Now we all know that the first company will claim 115 BAA. BAB is not possible. BAB is not possible because of the date of setup. The second company also, BAB is not possible because of the nature of business. So both of them will compute as per 115 BAA only, not as per 115 BAB. I hope it is clear to all of you. Now let's see what the question has asked. Part 1. We have to compute the tax liability of X and Y. Assuming that if they desire to avail the beneficial tax rate, it means they have to follow the special provisions, that is 115 BAA BAB, and which is relevant over in this question, 115 BAA. So we need to compute the tax liability as per 115 BAA for X and Y. Let's compute for X first. For X, the gross total income is 6 crore 60 lakhs. Now, will X be eligible for 80 JJAA? The answer is yes. Why? Because the company was set up in 2018 and this is the third year of business. So 80 JJAA is allowed up to 3 years. 18, 19, 19, 20, 2021. This year is 2021. We are computing for PY 2021, AY 21, 22. Therefore, this year is third year of business. You are eligible for 80 JJAA. Now, 80 JJAA is eligible for whom? It is not eligible for employees whose emolument is more than 25,000. Therefore, the employee with emolument of 26,000 will not be eligible. Yes, rest of the two category of employees will be eligible. The employees with 18,000 emolument, 150 employees, and 22,000 emolument, 150 employees, they will be eligible for 80 JJAA. So let me compute 80 JJAA for these two category of employees. 18,000 into 12 into 150, 22,000 into 12 into 150 into 30%. This is my 80 JJAA deduction. Apart from that, I will also get 80M deduction under 115BAA. In 115BAA, I get 80JJAA. I don't get generally any chapter 60 deduction, but I get 80JJAA, I get 80M also, and I get 80LA also. These are the three deductions which are allowed under 115BAA. Therefore, 80M is also allowed. What is 80M? 80M is dividend income earned compared with dividend distributed up 1 month prior to the due date of filing of return. So how much dividend income you have earned? See on the board, the dividend income earned by you is 60 lakhs. And how much dividend you have distributed 1 month prior to the due date of filing of return? It is 72 lakhs. Therefore, whichever is lower will be allowed as deduction. Therefore, 60 lakhs will be allowed as deduction. 3 crore 84 lakhs will be your total income. On that, you will apply 22% tax as per 115BAA, 10% surcharge always and always under 115BAA, and 4% cess. This will be your total income and total tax. 96,64,510 after rounding off. Now, for Y Limited, the gross total income is 1 crore rupees, as you can see over here. Will Y Limited also get 80JJAA? No. Why, sir? Because Y Limited is set up on 1st October 2020, and we are computing for 2020-21 only. Current year computation we are doing, and because it is set up on 1st October 2020, the employees are employed for less than 240 days. Because the employees are employed for less than 240 days, they are not eligible for what? They are not eligible for 80JJAA, and 80M is not there only in case of Y. Sir, will we get additional depreciation in this? No. Additional depreciation is not allowed under special regime. It is only allowed under the normal provisions of the income tax law. It is not allowed under the special provisions of the income tax law. That's the reason we are not taking the additional depreciation. So for Y, it is very simple. 1 crore into 22% tax plus 10% surcharge plus 4% cess. That's it. That's the computation of Y. Let's talk about second part. Compute total income of X and Y under the regular provisions of the Act. How the things will change under the regular provision? Only one extra thing will come, that is additional depreciation. X has purchased a new plant and machinery of how much? 9 crore, and it is put to use on 1st October, because therefore it is put to use for more than 180 days. Similarly, Y has purchased plant and machinery of 2 crore, and it is put to use for again more than 180 days, because it is put to use on 1st October 2020. So both of them will get 20% additional depreciation. Apart from that, everything is same. Okay. So what is going to change now for X and Y both? For both of them, additional depreciation will come. For X, it is 9 crore into 20%, that is 1.8 crore. For Y, it is 2 crore into 20%, that is 40 lakhs. That's it. Rest of the things are same only. Therefore, X total income will come to 2 crore 4 lakhs, and Y total income will come to how much? Y total income will come to 60 lakh rupees. I hope it is clear to all of you. Let's go ahead with the third part. What is the third part? The third part talks about only X. It doesn't talk about Y. It said, would it be beneficial for X to go for special provision instead of what inserted by Finance Act 2019? For this purpose, you may assume that the book profit of X as per 115JB is 4.2 crore. See, X has two options. Either X can go for special provision or normal provision. If X goes for special provision under 115BAA, then X is not liable for MAT, because if you follow special provision under 115BAA, then the provisions of MAT are not applicable. But if X goes for what? If X goes for the normal provision, then X has to compute two tax. One tax as per the regular provision, one tax as per the MAT liability, and whichever is more beneficial, whichever is higher, he has to pay tax as per that. So if X goes for special provision, that tax we already have. How much is the tax as per special provision of X? As per special provision of X, the tax is already 96 lakhs. Now, if X does not follow special provision but follow the regular provision, how much is the total income of X? Total income of X is 2 crore 4 lakhs. So total income of 2 crore 4 lakhs into 30% tax. Why 30% tax? Because the turnover of last to last year is more than 400 crore rupees. You can check it over here. It is given in the question that the turnover of last to last year is 402 crore. Therefore, the tax liability will be how much? The tax liability in this case will be 30%. 30% tax, because the income is more than what? 1 crore, 7% surcharge, 4% cess. Therefore, the tax as per the normal provision will come to 68 lakhs. Now, what is the tax as per book profit? 4.2 crore into 15% tax plus 7% surcharge plus 4% cess. This is the tax as per the book profit. Therefore, whichever is higher will come to this, and 2 lakh rupees will become your MAT credit, because MAT is more, normal provision is less. Therefore, 2 lakhs will become MAT credit. Now, the question is which you should go for. Obviously, you should go for this, because if you go for this, you are going to pay 70 lakh tax, plus you will also get 2 lakh rupees MAT credit also, which you can use in future. But if you go with 115BAA, you have to outrightly pay 96 lakh rupees tax. What sense does it make to go for 115BAA? Don't go for 115BAA, go for the normal provision. I hope it is clear to all of you. Let's go ahead with the next question. Question number 2. We need to explain the tax consequence in the case of the following charitable trust. Each case is independent. In the first cases, there is a charitable trust with a main object of any other object of general public utility. Now we all know that if a charitable trust is registered with main object of general public utility, then it is eligible for exemption only if the commercial receipt is up to 20% of total receipts. If the commercial receipt exceeds 20% of total receipts, it is not eligible for exemption. Now in this case, the commercial receipts of the trust is 44 lakhs. You can check it over here, and the total receipt is 2 crore rupees. Therefore 44 lakhs divided by 2 crore is coming to 22%. Now because it exceeds 20% of total receipts, therefore it is not eligible for exemption under section 11 and 12 in this particular financial year. I hope it is clear to all of you. Let us move ahead with the second question. There is a trust which is paying an annual rent of 12 lakhs in 24-25 and 15 lakhs in 25-26. Now we all know that if a trust pays any expense, then if it wants a deduction of that, it is allowed only if TDS is deducted on that. If TDS is not deducted, then the expense will not be allowed. Now the trust has made a mistake. For 24-25 and 25-26, the trust has deducted the TDS in the current year properly, but it has paid in the next year. Therefore, for 24-25, because it is not paying in the current year up to the due date of filing of return, it is paying in Jan 26 together for 24-25 also and for 25-26 also. Therefore, for 24-25, it is late. It is late. Therefore, 30% of the expense of 24-25 will be disallowed in the current year, and it will be allowed in the year of payment, that is in 25-26. I hope it is clear to all of you. Yes, as far as 25-26 rent is considered, that is fine, because that is paid in 25-26 also, 25-26 only, so there is no issue in that. The issue is with the rent of 24-25. The rent of 24-25 is not paid on time. It is paid after the due date of filing of return of 24-25. Therefore, 30% will be disallowed in the current year, and it will be allowed in the subsequent year. I hope it is clear to all of you. And the third question over here is, a trust was there which is registered under 12AB. Now later on what? They have changed their object. Now we all know that they have changed their object to any other object of general public utility. Initially they were registered as relief of poor. So you can change the object. There is nothing wrong in changing the object. You can change the object, but whenever you change the object, you have to give a fresh application. If you don't give a fresh application, you are deemed to be exited from the trust provisions, and therefore exit tax provisions will apply on you. In this case, you have to make a fresh application within 30 days from the date of change. So if you don't make an application within 30 days from the date of change, from the 31st day, you will be liable for what? Exit tax under income tax law 115 TD 34.944%. I hope it is clear to all of you. Now the third question is a very beautiful case law which we have done in the class of Sunil Vishwa Ambarnath Tiwari 2060 Bombay High Court judgment in the chapter of profit link deduction. There is an assessee who was engaged in housing project, and therefore it is eligible for deduction under 80 IBA. Now there are certain expenses on which the assessee has not deducted TDS, therefore the AO has disallowed that expense. The expense was what? 60 lakh rupees, and the TDS was not deducted, therefore 30% was disallowed by the assessing officer. 30% of 60 lakhs comes to how much? 30% of 60 lakhs comes to 18 lakh rupees. Therefore 18 lakh rupees is disallowed by the assessing officer. Now the question is whether this 18 lakh rupees which is disallowed by the assessing officer, is that also eligible for 80 IBA deduction? Now the AO is increasing the income by 18 lakh rupees, so whether that increased income will also be eligible for 80 IBA deduction? And the Bombay High Court said yes, that is also eligible for what? 80 IBA deduction. So this is a good news given by Bombay High Court to the assessees. I hope it is clear to all of you. The next question is on beautiful chapter transfer pricing. Very important. Let me give you the scenario. First of all, what is happening in this question? L-Sciency is a foreign company situated in Switzerland. Delta Limited is an Indian company. Now ELS is giving a loan of 350 crore euros to what? To us, to Indian company, and we are paying interest of how much? 9%. Now if I convert this loan into Indian rupees, 350 crore into rupees is 88, 1 euro is 88 rupees, so it comes to 30,800 crore rupees loan. Now, so ELS is giving us how much loan? 30,800 crore loan ELS is giving us. And what is the book value of our asset? The book value of our asset as per the question is 60,000 crore. So if I divide the loan divided by book value of asset, it comes to more than 51%. So remember, if one entity finances at least 51% of the book value of the assets of the another entity, then both of them are deemed to be associated enterprise. So you have to write down this first in the part 1. Examine whether transfer pricing provisions will apply under this. So you have to write down this. Yes, both of them are deemed to be associated. Therefore, transfer pricing provisions are applicable. It is an international transaction. I hope it is clear to all of you. Now, second part, we need to now check. He is giving us loan at what rate? He is giving us loan at 9%. But to others, he is giving loan at what rate? He is giving loan at just 7%. Therefore, he is charging 2% extra. Therefore, that much extra we are paying him. Therefore, that much primary adjustment has to be made. Now, how to compute the primary adjustment? 30,800 crore is the loan, and how much extra we are giving him? 2%. So 2% of 30,800 will come to 616 crore. So 616 crore will be added back to my income. I hope it is clear to all of you. That much will be the transfer pricing adjustment that the assessee has to do. Third part says that elaborate on secondary adjustment if required to be made under the provisions of the act, assuming that Delta has made the primary adjustment suo moto. Assuming that Delta has made the primary adjustment suo moto, elaborate on secondary adjustment. Now it is very clear. If Delta has suo moto made a primary adjustment, then Delta has to bring back that money to India within 90 days from the due date of filing of return. If it does not bring back that money in India within 90 days from the due date of filing of return, he has to pay the interest on the secondary adjustment. Now, how to compute the interest rate? Interest rate will be computed as per LIBOR plus 3%, because the transaction is denominated in foreign currency. Therefore, you will not take SBI's MCLR, you will take LIBOR in this case. LIBOR plus 3% in this particular case. Okay, they have not given us any rate, so we have to just write theoretically, we don't have to compute anything. Plus interest will be computed including the 90 days period. Interest will be computed from 30th November till 31st March. Okay, I hope it is clear to all of you. Now last but not least, any additional tax assessee can pay and relieve himself in lieu of making the secondary adjustment? Yes, assessee can pay 20.9664% of additional tax of 616 crore, and then the assessee will not be liable for any secondary adjustment. So till the time the assessee does not pay this additional tax, the assessee has to pay the secondary adjustment interest. But once the assessee has paid this additional tax, then secondary adjustment will stop after that. I hope it is clear to all of you. Next question. Let's go ahead with the next question. Which is on non-resident taxation. Analyze the tax consequence. There is a non-resident, Mr. Hugh Grant, who is providing some technical services to an Indian company, and there is an agreement between both of them, and the agreement is approved by central government, and the foreign company does not have any place of business or profession in India. So it is a classic case of 115A. If a non-resident who provides technical services and to Indian company, and there is agreement which is approved by central government, and the non-resident does not have a PE, therefore the provisions of 115A will apply over here. And as per 115A, what is the tax rate? It is the tax rate as per 115A, 20% plus surcharge if applicable, plus cess, or DTAA, which is without surcharge and cess, whichever is lower. Now in first case, what is happening? Let's see, pay attention. India has no DTAA with country X. If India does not have a DTAA with country X, then how much tax that Mr. X will pay? Mr. X will pay, Mr. Hughes will pay 20% tax plus surcharge if applicable, if the income crosses the surcharge limit, plus cess. As per 115A, no deduction of any expense will be allowed. Yes, is the assessee liable to file the income tax return? It is very clearly written in the question that wherever TDS is applicable, it has been fully deducted, and the assessee only earns the technical service. Assessee does not earn any other income. Therefore, in this particular case, TDS is properly deducted and the assessee only earns the fees for FTS income, no other income. Therefore, and the TDS is also deducted as per 115A. See, when the relaxation from ROI is there, when the relaxation from return of income is there, the relaxation from return of income is there in those cases where the non-resident has paid tax as per 115A, then there is no need to file the income tax return. But if the non-resident is paid tax as per DTAA, then they have to file the return. So in part 1, the non-resident is paying tax as per 115A, therefore there is no need to what? File the income tax return, because the assessee only earns this income and the TDS is also deducted. Now, second case, India has a DTAA with country X and FTS is taxable as 8%. If FTS is taxable at 8%, then the tax will be as per 8%. Then the assessee will get the benefit of DTAA. Okay, no surcharge will apply, no cess will apply, because in DTAA rate, no surcharge and cess further is loaded on that. Flat rate is applicable in case of DTAA. But to take this advantage, assessee has to prove that he is a resident of country X. For that, he has to provide TRC and many other relevant information and documents. Only that he will get the advantage of this particular section. But is the assessee liable for ROI in this case? Absolutely yes, because the TDS is not deducted as per 115A now. It is deducted as per DTAA, and therefore if the TDS is deducted as per DTAA, you have to file the ROI. In the third case, India has a DTAA with country X and FTS is taxable at 20%. So now 25%, sorry. So now in this case, the tax rate will be 20%, because now the DTAA rate is higher, the income tax rate is lower. So the tax will be 20% plus surcharge, plus cess, surcharge if applicable, and cess, and the assessee has to pay tax as per that. Is the assessee liable to file the income tax return? No need to file the income tax return. Why? Because the tax is deducted as per the rates mentioned in 115A and not as per DTAA. So if the tax is deducted as per 115A, no need to file the income tax return. I hope it is clear to all of you. Last but not least, they are asking, will your answer change if the assessee has fixed place of profession in India? If the assessee has fixed place of profession in India, then definitely the answer will change. Provisions of 115A will not apply. Then 44DA will apply, and according to that, the assessee will make proper P&L, will claim deduction of all expenses, but certain expenses are not allowed, like an expense which is not wholly and exclusively for Indian branch, not allowed. An expense where the PE in India makes payment to HO and which is not in the nature of reimbursement, then it is not allowed. If it is in the nature of reimbursement, it is allowed. Then other requirements which the associate has to follow, they have to maintain books of account, they have to conduct audit, they have to file income tax return, and the tax rates will also be normal in this case. So this is what this RTP is all about. Now let's go ahead with the next RTP, that is RTP May 2022. The very first question over here is on chapter of capital gains slum sale. There is a company by the name called as Beta Limited, and it is transferring one of its units, Omega unit or unit Omega, to some other company for 600 crores. Okay, 600 crores or 600 lakhs as the case may be. Now we need to compute the slum sale capital gains. First of all, I would like to say one thing, that in case of slum sale, the slum sale still becomes long term after 36 months only. Generally, the Finance Act 2024 has made an amendment that all long term capital gains, all long term capital assets will become long term after 24 months. But under slum sale, they have not made the amendment yet. Slum sale will become long term after 36 months only. Be careful with that. Okay, I have written that in the note also. Now the first thing we need to do, we need to make the calculation. How will we make the calculation? Full value of consideration minus expenses on transfer minus your cost of acquisition. Now what is the cost of acquisition over here? How to compute cost of acquisition? First we will try to understand how to compute cost of acquisition, and then we will see how to compute the full value of consideration. Cost of acquisition in case of slum sale is nothing but net worth of the undertaking which is transferred. Now how to compute the net worth of the undertaking? It is all assets of the undertaking transferred minus all liabilities of the undertaking transferred. How to value the assets? Let's see. First of all, there are fixed assets. In fixed asset there is land and other machineries. For land we have to take the book value. For now we are first computing the cost of acquisition, then we will compute the full value of consideration. Be very careful. So for land we have to take the book value as per the cost of acquisition definition. For machinery, which is a depreciable asset, for depreciable asset we have to take the WDV as per the income tax law. Therefore we will be taking 155 lakhs for the purpose of computing the net worth, that is the cost of acquisition. For other assets, that is debtors, for debtors you are going to take the book value, that is 400 lakhs. For creditors you are going to take 45 lakhs, that is the book value only. You will get the cost of acquisition. Once cost of acquisition is done, the next step would be to find out the full value of consideration. In full value of consideration, we have to follow the rule 11 UAE, which says that you have to compute two FMV, FMV1 and FMV2, whichever is higher, that will be considered to be full value of consideration. So what is FMV1? FMV1 is the FMV of the assets transferred by unit Omega. So whatever assets are transferred by unit Omega, we have to take the asset, the valuation of that asset. And what is FMV2? FMV2 means whatever consideration we have received, we would have received monetary consideration or non-monetary consideration. Whatever consideration we have received, that will be FMV2. Now, how to compute FMV1? Again, I am saying FMV1 means the assets which we have transferred. So what have we transferred? We have transferred first of all fixed assets. What all fixed assets are there? First, land is there. For land, what will you take? Now, for the purpose of computing FMV1, for land, you will take the value as what? Value as stamp duty value and not the book value. Okay. Now for net worth, we were taking the value of land as book value. But for the purpose of FMV1, the value of land will be the stamp duty value of the land and not the book value. Similarly, for machinery, for net worth, we were taking what? We were taking the WDV as per income tax. But for the FMV1, we have to take the book value of the machinery, that is 230 lakhs. And for debtors also, we will take book value. For liabilities also, we will take book value 45 lakhs. After doing all those things, you will get FMV1. Now, FMV2 is very simple. Whatever you have received, what you have received in this slum sale, you have received 600 lakhs in this particular slum sale. That will be your FMV2. Now compare FMV1 and FMV2, whichever is higher, that will be your what? That will be your capital gains. That will be your full value of consideration. Then reduce from that what? Reduce from that the cost of acquisition, which we have already computed earlier. That will give you a long-term capital gains. So this is a long-term or short-term capital gains. This is a long-term capital gains because the unit was set up in 2010 and it is getting transferred in 2024-25. Therefore, it is getting transferred after 36 months. Therefore, it is a long-term capital gains. We are only computing capital gains. We are not computing tax because the question has not asked us to compute tax. The question said that you have to compute only the capital gains. I hope it is clear to all of you. So let's move on to the next question. Question number 2, which is a total income question. This company was set up on 15th of December 2022. It is engaged in manufacturing and sale of certain items and it commenced the business in Jan 2023. Now always whenever there is a total income question, always read the last line first, what exactly they want from us. They want total income, they want tax liability as per 115 BAB. So according to that, you need to answer the entire question. Now 115 BAB is relevant over here. Okay. Now the very first adjustment over here is they have given us the profit of 220 lakhs. Write down that, and then they have said that it is after debiting and crediting the following following items. Notice what is the first item they have debited? One-time license fees of 22 lakhs paid to APC company. Now license fee is not an expense, therefore you have to disallow that. License fee is a nothing but an intangible asset, therefore you will take 25% depreciation on that. You will take full 25% because the asset is put to use on 1st of June. If it would have been put to use for less than 180 days, you would have taken 12.5%. I hope it is clear to all of you. Now next 32,000 you have paid cash to a road transporter, goods transporter. So can you pay cash of 32,000 to a good transporter? The answer is yes. Generally you cannot pay cash of more than 10,000 to a person, but to goods transporter the limit is 35,000, therefore you can pay 35,000 in cash. Now the third adjustment is the most important adjustment of this particular question. You have earned some rent of 60,000 rupees per month from letting out of an office premise, and you have also paid municipal tax of 8,000 rupees. Now pay attention please, all of you. Whatever rent you have paid, 60,000 into 12, that is 7,20,000 rupees. First of all, you will reduce that from PGBP and you will show that rent as income from house property under income from house property, heads of income. Okay. First of all, we will do this. Second, 8,000 rupees house property municipal tax, which you are debiting to PNL, you will add back that. You will add back that to PGBP, but when you go to 115 BAB, you cannot claim the deduction of that, because remember, in 115 BAB, you don't get deduction of any expense against general income. Like house property is a general income, like dividend is a general income. Against that, you don't get any deduction of expense. Therefore, this deduction will not be allowed. Even 30% standard deduction won't be allowed to you under 115 BAB. Therefore, under 115 BAB, entire 7,20,000 rupees will be directly taxable in your hands under the income tax law at 22%. Okay. I hope it is clear to all of you. Next one, you are making some payment of 2 lakh rupees for Scientific Research Association as a donation. That is not allowed under 115 BAB. Similarly, 5 lakh rupees you have paid as a payment to contractor, but you have not deducted the TDS. Therefore, 30% of the 5 lakh will be what? Will be disallowed under the income tax law. Next one is also a good adjustment. 10,000 you have earned as a dividend from Gamma Limited. So this dividend of 10,000 you will reduce from PGBP and you will show under what? Under income from other source. Apart from that, you have also sold some shares. How many shares you have sold? You have sold 1,000 shares of rupees 100 each. You have purchased at 100 in 2017, but you sold for what? You sold for 280 rupees. Now, whatever is the profit as per books of accounts, whatever is the profit as per books of accounts, you have credited that to the books of accounts. So first of all, you have to reduce that profit from the PGBP. The sale price is 280. The cost of acquisition of the share is 100 into 1,000 share. Whatever profit is come, that is your accounting profit that you have to reduce from the books of accounts, and you have to show under long-term capital gains because you have purchased in 2017 and you are selling in 2025. Therefore, you have to show that as a long-term capital gains. Now, which long-term capital gains it is? It is a long-term capital gains covered under 112A. Why, sir? Because in the additional information they have given us, see the fair market value on 31st Jan 2018. Whenever this is given, it means it is a long-term capital gains covered under 112A. Therefore, now you will compute the long-term capital gains under 112A as per the grandfathering clause. What is your sale consideration? The sale consideration of the shares is 280 rupees. How will you determine the cost of acquisition? For that, you will apply the grandfathering clause because the shares were acquired before 1st Feb 2018 and the institute has also given us the information of FMV on 31st Jan 2018. Now, how to compute the cost of acquisition? Cost of acquisition, step number 1, actual cost. Actual cost is 100 rupees. Step number 2 is lower of sale consideration, that is 280 rupees or FMV on 31st Jan 2018, that is 110, whichever is lower, that will be compared with your actual cost, step number 1, and then whichever is higher, that will become your cost of acquisition. And then whatever amount will come, that will become your long-term capital gains. From that, 1,25,000 will be exempt and 12.5% will be the tax rate because these shares are sold on or after 23rd July 2024. 1,25,000 exempt, 12.5% will be the tax rate. I hope it is clear to all of you. Now, next adjustment is on next page, that is in this page only. Depreciation as per books of accounts is 2.2 lakhs. Therefore, that will be added back because that is accounting depreciation. Depreciation as per tax is 2.6 lakhs. That will be reduced because that is as per the income tax law. Apart from that, you have also purchased some machinery of 20 lakh rupees on 15th of November and it is put to use on the same date. This depreciation is not included in 2.6 lakh. So you have to claim depreciation on that, but you will get only normal depreciation. You will not get additional depreciation because the asset is because the asset is following 115 BAB. Plus, you will get only 50% of the normal depreciation because the asset is put to use for less than 180 days. Therefore, you will claim 7.5% only. You will not claim full 15%. I hope it is clear to all of you. And last but not least, the SSC is also eligible for 80 JJAA because they are employing some new employees in the business, and along with 115 BAB, you can follow 80 JJAA. Therefore, 80 JJAA will be allowed to whom? It will not be allowed to, first of all, I will tell you that. It will not be allowed to employees with 26,000 emolument. It will not be allowed to employees with 27,000 emolument, because the emolument per month has to be up to 25,000 rupees. If it is more than 25,000 rupees, you are not eligible for 80JJAA. Third, it is not allowed to this last employee also, because that employee is employed on 1st of September, and therefore it will not amount to 240 days in a year. The employee has to be employed for at least 240 days in a year if you want to claim the deduction under 80JJAA. Therefore, the only employee who will be eligible is the first category of employee. 51 employees into 12 months into 23,000 into 30%, that will be the deduction under 80JJAA, that will be eligible. Last but not least, you are going to compute the tax. So on this house property, you can see no deductions are allowed, as I have told you earlier. On this you will pay 22% tax. On business and profession income, that is your manufacturing business, on this you will pay 15% tax. On long term capital gains, 1,70,000, 1,25,000 will be exempt, and the balance will be subject to 12.5% tax. And on dividend income, you will be liable for tax of how much? Dividend income will be subject to what? 22% tax, because that is again a general income. This is how you are going to compute the tax, plus 10% surcharge always under 115 BAB, and 4% cess always under 115 BAB. I hope it is clear to all of you. Let's move ahead to the next question. Question number 3. What is this question? This question is on computation of MAT liability, but now they have given us what? They have given us other comprehensive income. So this is a question of MAT with Ind AS. Ind AS compliant companies, how will they compute the MAT? So for example, what is the net profit? What is the book profit of the company? The book profit of the company before making the Ind AS adjustments is 97.54. Now they have given us OCI that will now never be classified to the statement of profit and loss account. So something which will never be classified to the statement of profit and loss account, you have to adjust today itself, except few items which have been excluded from the definition. Again, I am saying something which will never be debited or credited to the P&L. You have to debit today, you have to credit today, and you have to add to the book profit. You have reduced from the book profit, except few items which the government has told you not to do it. Okay. Now the very first thing, deferred cost hedging, debit. This will never be classified to P&L. So debit that today, reduce that from the P&L today. Similarly, changes in the fair value of equity instrument. This will never be classified to the P&L, but don't debit this today, because this is an exception to this particular rule, which will never be classified to the P&L. So still you should not debit to P&L. This will be adjusted. This 7.4 lakhs will be adjusted in the year in which this equity instrument will be sold, not on accrual basis, not on fair value basis. Similarly, revaluation of fixed asset. By default, you should add back to the income, but you should ignore this, because this is also in the exception which says that the changes in the fair value of the asset, fixed assets, has to be adjusted in the year in which the assets are sold, not on fair value basis. Last two items are not in the exception. Therefore, these two items has to be added back to determine what? To determine your correct book profit. Apart from that, the assessee also has some losses, some depreciation. Generally, under book profit, you get deduction of lower of business loss or depreciation, whichever is lower. You don't get deduction of both of them. Either you will get deduction of business loss, or you will get deduction of depreciation, whichever is lower. But in this case, the assessee is approaching National Company Law Tribunal for resolution of the business. So in this case, there is an exception that if an assessee is approaching NCLT for resolution of the business, then both of them are allowed. Therefore, this is also allowed. Entire business loss of both the years and entire depreciation of both the years will also be allowed to the assessee. Last but not least, there is some transition amount of 68 lakhs. Generally, whatever is the transition amount, that is added to the book profit in 5 equal years. So you have to divide that by 5 and you have to add back. But certain things are never part of transition amount. Like capital reserve of 8 lakhs. It is never part of transition amount. You can go and check the definition of transition amount. Similarly, 6 lakhs, which is relating to translation difference in foreign operation. This will also never be part of never be part of what? Transition amount. Therefore, these two things you have to reduce. That these two amounts to 14 lakhs. Therefore, 68 lakhs minus 14 lakhs comes to 54 lakhs. Divide by 5. That will give you what? That will give you the answer of divide by 5, that will give you the transition amount that you have to add back to the book profit for next 5 years, including the current year. Then you have to compute the book profit. Book profit is 15% tax. MAT you have to compute, 4% cess you have to apply, and then you compute the provisions of tax as per the normal provision. The normal provision income they have already given us, it is 12.8 crore, and then you have to compute what is the MAT credit. I hope it is clear to all of you. Now next question is on charitable and religious trust. There is one institution who is engaged in educational purpose as well as hospital, which is registered, which is covered under 1023C. Therefore, it wants to claim exemption without registration. Now, they can claim exemption without registration provided the aggregate receipt from both of them is up to 5 crore. If the aggregate receipt from both of them is more than 5 crore, then they cannot claim exemption without registration. Then they have to get themselves approved first. Then only they can claim exemption. Now, in this case, the individual receipt is 3 crore each. Therefore, the aggregate receipt will be 6 crore. Hospital is 3 crore. Education is 3 crore. Aggregate receipt is 6 crore. Therefore, they are not eligible for exemption without registration. They have to get themselves registered. I hope it is clear to all of you. Next question. There is a trust who has made some excess application. Too much application they have made, because of which there is a loss. Now, can they carry forward that loss? Can they carry forward the excess application and set off that against the income of the next year? And the answer is no. That is not allowed to the trust. It is very clearly restricted to the trust. I hope it is clear to all of you. Next one. There is a trust who has taken a loan of 40 lakhs from SBI for purchase of building. Now, the trust has taken a loan and they have purchased the building also. Whether the trust will get the deduction of the purchase of building as an application? The answer is no. It is not allowed. When you take a loan and with the help of that loan money, if you purchase anything, that is not allowed as an application. However, when you repay that loan, at that time it will be allowed as an application. So out of that, only 5 lakh is repaid, therefore only 5 lakh will be allowed as deduction. That too, there is an amendment which is made by Finance Act 23 that you have to repay within 5 years. If you repay within 5 years, then only it is allowed as deduction. Otherwise, that is also not allowed as deduction. Next question is on section 194O, which is on TDS by e-commerce operator. There is an e-commerce operator by the name called as High Sale, and there is an e-commerce participant, that is a seller, resident seller, by the name called as Appy. How much goods have been sold through that e-commerce operator by Mr. Appy? 84 lakhs of goods are sold by Mr. Appy. But therefore, e-commerce operator will deduct TDS at the rate of 1% till 30th September, and from 1st October the rate has been reduced to 0.1%. But Mr. Appy has done one mistake. The seller has done one mistake. What is the mistake the seller has done? The seller has not given the PAN or Aadhaar. So if he is not giving the PAN or Aadhaar, in that case the return has to be filed at, the TDS has to be deducted at 0.1% or 5%, whichever is higher. Therefore, in this case the TDS will be deducted at 5%. Generally, if the buyer or if the recipient, if the payee does not give PAN, then you have to deduct TDS at 20%. But there are two exceptions where you will not deduct TDS at 20%, but you will deduct TDS only at 5%. One is 194O, this section, and one is 194Q. These two sections, the maximum TDS is 5% if the buyer, if the other person does not give what? If the other person does not give the PAN. So in this case also you will deduct TDS at 5%. Okay. I hope it is clear to all of you. Next question is a beautiful question on what? On non-resident taxation. There is a company by the name called as Trex Limited, which is a company incorporated in country T, and they have earned some incomes. We need to compute the tax and we need to say which incomes are taxable and at what rate it is taxable. First of all, this foreign company has given some services to Indian company in the nature of technical know-how. Indian company, and in return Indian company has given what? Indian company has not given money. In return, Indian company has given debentures of 30 lakh rupees. So foreign company has given us what? Some technical know-how. We have given them debenture of 30 lakh rupees. Is that taxable? Obviously yes, taxable. Consideration may be in cash, consideration may be in kind, it doesn't matter. But will this 30 lakhs be taxable as 115A? The answer is no. For 115A, the agreement has to be there between both the company and it has to be approved by central government. There is no presence of agreement between both of them and there is no approval by central government. Therefore, it cannot come under 115A. Therefore, it will be taxed at normal rate. What is the normal rate for a foreign company? It is 35% from Finance Act 2024. Earlier, it was 40%. Okay. Similarly, on this debenture, this foreign company will now earn interest. How much interest they have earned? They have earned interest of 2,85,000. Will this interest come under 115A? Again, it cannot come because this is not a loan given in foreign currency. It is a loan given in Indian currency. Therefore, this will not come under 115A. Otherwise, it would have come under 115A. It would have been taxed at 20%. But this is not a loan given in foreign currency. This is a loan given in Indian currency. Therefore, this will be taxed at what? Therefore, this will also be taxed at 35%. I hope it is clear to all of you. Then some dividend has been earned on GDR. So this will be taxable at 10% under 115AC. Then some dividend on equity shares have been earned on Indian companies. This will be taxable at 20% under 115A. Then some business income I will talk first. Business income of 8,50,000 is taxed, will be taxed at 35%. Then long-term capital gains of 1,32,000 on transfer of unlisted shares. It will be taxed at 12.5%. We are assuming that it is transferred on or after 23rd July, therefore it is 12%. If it is transferred before 23rd July, then it will be 10%. Now coming to the most important point, that is point number 4. Some royalty income is earned, some royalty income is received of 12,56,000 from Z Limited in pursuance of an agreement which is approved by central government. Now can this come under 115A? The answer is definitely yes. This amount can come under 115A because this is the royalty which is approved by central government and there is an agreement between both of them. So this will come under 115A. This will be taxed at 20% plus surcharge and cess if applicable. Cess always applicable, surcharge depends upon the total income. Now, you need to be very careful. The income of the assessee is not 1256. This is the amount received. Therefore, if this is the amount received, this will be after the TDS. And what will be the TDS in this case? It will be 20% tax plus 4% cess. 20.8% will be the TDS deducted by the Indian company MNO Limited. Therefore, the assessee has to gross up its income because this is not the final income. This is the net income received by the assessee. This is not the final income. This is not the gross income. Therefore, the assessee has to gross up the income. How will it gross up? TDS is 20.8%. Therefore, 12,56,470 will represent 79.2%. Therefore, 100% is how much? Gross multiply and gross up and take the final amount. Okay, it will come around somewhere around 15 lakh rupees. I hope it is clear to all of you. Now One last question in this RTP, very simple question. We need to compute the total income and tax of the assessee. Assessee is a resident, aged 52 years, and is earning income from India, country G, country M, and some other information is also given. You have to compute the tax as per the old regime. So it's a DTAA question, unilateral relief question, very simple question. So first of all, we will take everything in the Indian income, and then we'll compute the Indian average rate, and then we'll compute the foreign average rate. Okay. Then first of all, income from business in Pune, you will write down this. Then in profit from partnership firm in Mumbai, this is exempt. This will not be subject to tax. Then agriculture income, that will be taxable because foreign agriculture income is taxable. Agriculture income in India is exempt. Then brought forward business loss will be allowed as deduction against the business income in India. You will say it is not allowed in that country. In that country it is not allowed now, but India it is allowed now. So you have to take the deduction in India. Then dividend income you will multiply by 70 rupees dollar. Rental income you will take. Then municipal tax you will take. In that country it is not allowed, but in India it is definitely allowed. You can claim the deduction. Then you will compute GTI. After that you will take 80C deduction because you are following old regime. So therefore you can take 80C deduction. Then you will claim 80D deduction, but only 25,000 rupees, not 28,000 rupees, because you are not senior citizen. You are just 52 years old. And then you will compute the average rate in India. This is your total income. Total income is above 1 crore. Therefore you will apply surcharge of 15% also, because it is between 1 and 2 crore. And then you will apply cess and find the average rate in India. And then you will find the doubly tax income. Okay. Whatever is the doubly tax income, and then you will compare. It's a very simple question on DTAA, nothing great as such, you can see. Okay. Now let's go ahead with the next RTP, RTP November 2022. What they are asking in the first question, they are asking us to compute total income and tax payable by the firm, and the firm has opted for 35AD. 35AD, they have fulfilled all the conditions of 35AD. So it's a question on partnership firm, total income and tax liability, tax payable. So the partnership firm, which is engaged in the business of 3-star hotel, which started the business on 1st of April 2024. There are 2 partners in this particular question with equal profits, and the profit is 26 lakh rupees after deduction of the following items. So let us compute the tax total income and then tax liability of the firm. First of all, depreciation as per books of accounts will be added back. Then interest on capital of 15%. 15% is not allowed, only 12% is allowed. Therefore 3% you have to add back, make a backward calculation, add 3% back. Then you have taken some loan from Mr. Rajveer, a resident. The firm has taken loan from Rajveer, a resident, and the firm is making the payment of interest of 6 lakh rupees. But unfortunately, they have not deducted the TDS. Therefore, 30% expenditure, that is 30% of 6 lakhs, will be disallowed in this particular case. Okay. Now, after this, first, one thing I would like to say, in this question, there is no remuneration paid to the partner. Therefore, you don't have to compute any book profit, something like that. There is nothing to do all those things. Okay. Now, they have purchased some motor car for 7 lakh rupees for the purpose of the hotel. Therefore, this is a capital expenditure. Therefore, that will be eligible for deduction under 35AD. This 7 lakh is fully allowed as deduction under 35AD. Then they have incurred some 2 crore rupees further expense, out of which 1.5 crore is land. So land, goodwill and financial instruments are not allowed under 35AD. Therefore, this will not be allowed as deduction. But 50 lakhs building will be allowed as deduction. Apart from that, they have also installed some AC air conditions on 15th of May 2024 of 3,20,000. So that will also be allowed as deduction. I hope it is clear to all of you. And all the payments are made by account, paycheck or ECS. Therefore, it is allowed. Otherwise, if you make a payment of more than 10,000 to a person in a day, and if you make the payment by other than 4 modes, then it is not allowed as deduction. Therefore, this line is also very important. Now, if I take all this deduction, the firm is getting some loss. Now, if the firm is getting some loss, the question is, can this loss be set off against the profit of another 4-star hotel whose profit is 41,38,000? The answer is yes. A 35AD business loss can set off only against 35AD business. Therefore, the loss of this 3-star hotel can set off against the profit of this 41,38,000, another 4-star hotel, and then that will be your total income. Therefore, the total income in this case comes to 34,78,000. On this, you will apply 30% tax as per partnership firm, 4% cess, and that will be your tax liability. Now, the answer will not complete here, because if a partnership firm is claiming 35AD, then AMT is applicable, alternate minimum tax. Therefore, now I have to compute what? I have to compute alternate minimum tax. For that, I have to compute what? I have to compute adjusted total income. What is adjusted total income? See on the board. It is nothing but total income of 34,78,000 plus all the 35AD deduction. All these 3 deductions will be added back. 50 lakhs will be added back, 7 lakh will be added back, 3,20,000 will be added back. All of them are covered under 35AD. Therefore, you have to add back all those things. But you will claim depreciation on all 3 of them. On building, you will claim 10% depreciation, on motor car, and on air condition, you will claim 15% depreciation. That is something which is allowed to you. After doing this, whatever amount will come, that will be your adjusted total income. It is 88,45,000 rupees. On that, you will apply 18.5% tax, 4% cess. Surcharge will not be applicable because the income is less than 1 crore rupees. rupees, and then you will compare both the tax. Whichever is higher will be your tax liability, and if your MAT liability is more, then you will also get what? MAT credit, as you can see over here. I hope it is clear to all of you. Let's go ahead to the next question. Question number 2. This is a question on total income. This is an Indian company engaged in manufacturing, and always in case of total income, always read the last line first. The examiner wants us to compute total income and tax liability, that too as per 115BAA. Now, if you are following 115BAA, your tax rate is very straightforward. 22% tax, 10% surcharge, 4% cess. Therefore, the turnover of last year given to us is of no use. This is relevant only under the normal provision, not under the special provision. Okay, I hope it is clear to all of you. Now, coming to the discussion of adjustment by adjustment. Your profit is 9 crore 50 lakh rupees. Your first item is depreciation, so that is the depreciation as per books of accounts, so add back that. Second is donation to political party, not allowed under 115BAA. Third one is scientific research association donation. You are giving some donation to scientific research association, that is also not allowed under 115BAA. Next is you are receiving some dividend from a foreign company. So this dividend will be first reduced from PGBP, and dividend income will be shown under what? It will be shown under IFOS, income from other source. Next, you are earning some long-term capital gain on sale of equity shares on which STT is paid. Therefore, this long-term capital gains is 112A long-term capital gains. Therefore, you will reduce this from PGBP. You will show this under capital gains. On this, 1,25,000 will be exempt, and the balance will be subject to 12.5% tax. We are assuming that this long-term capital gains has arisen on and after 23rd July 2024. If it is arise before that, then you will be subject to 10% tax. If it is arise after 23rd July, then you will be subject to 12.5% tax. We are assuming after. That is the reason we are taking 12.5% in the solution. Okay. Now, next one is a very important adjustment for us. You have taken some loan for the purchase of machinery. Now, what is the amount of loan? It is 4 crore 20 lakh rupees. When have you taken the loan? On 1st of June. Therefore, what will be the total interest of the year? 4 crore 20 lakhs into 10% into 10 months divided by 12 months. Therefore, the total interest will be 35 lakhs. First of all, disallow this entire 35 lakhs. Disallow this entire 35 lakhs. I will disallow this entire 35 lakhs. Now, I have taken this loan for what? For the purpose of machinery. Now, when have I put to use the machinery? You can see on the board, just additional information to sub point 3. I have put the machinery on use from 1st of Jan. Therefore, from June to December, the machinery's interest, the loan's interest has to be capitalized to the machinery. From June to December, how many months are there? 7 months. Therefore, 7 months interest. First of all, what is the first treatment? Entire interest you will disallow first under PGBP. Then 7 month interest you will add to the cost of machinery, and then you will claim depreciation. And 3 months interest you will not take deduction. Why? Because it is unpaid. See, interest is outstanding. If it would have been paid till the due date of filing of return, I would have taken the deduction. So for capitalizing the interest, there is no need to make the payment. No, be very careful. The payment is only required to claim that as a revenue expense. If you want to capitalize the interest, there is no need to make the payment. You can take the deduction of depreciation without even making the payment. I hope it is clear to all of you. Next one, you are selling some plot of land to PQR, an Indian company. The entire shares are held by us. So PQR is a subsidiary we are holding. We are 100% holding. PQR is also our 100% subsidiary, and PQR is Indian company. And because the recipient is Indian company and there is a 100% relationship, this transfer is exempt transfer under section 47. Therefore, reduce from PGBP and exempt under section 47. Show as exempt under section 47. I hope it is clear to all of you. Next one is you are making some payment of 1 crore rupees to foreign technician for installation of machinery. So installation of machinery you will add back under PGBP, and you will add to the cost of the machinery. You will claim depreciation on that. I hope it is clear to all of you. Now the next adjustment is a beautiful adjustment. You have sold some goods of 22 lakh rupees credit sales, out of which 12 lakh rupees have become bad debts. Now how much is receivable? 10 lakh is receivable. Now the debtor has died. Now the debtor is died. How much I am supposed to receive from him? 10 lakh, and he is dead. Now somebody on his behalf has paid me 11 lakh rupees, and I have credited the entire 11 lakh rupees to the PNL, which is wrong. Why the hell you have credited entire 11 lakh to the PNL? This 10 lakh rupees is already included in the credit sale. You have already paid tax on this 10 lakh rupees. What is extra received by you is only 1 lakh rupees. You should pay tax on 1 lakh rupees. Therefore, entire 11 lakh rupees should not be credited to PNL. Therefore, only 1 lakh rupees should be taxable. Therefore, reduce 10 lakhs from the PGBP income. I hope it is clear to all of you. Then depreciation is 1 crore 50 lakhs to claim depreciation on that. Certain additions are made to the assets. Office building of 3 crore put to use from December. Therefore, claim 50%. That is, generally building is subject to 10% depreciation. But in this case, because it is put to use for less than 180 days, take 5%. Computer put to use from 11th May, take full 40%. And then on machinery, you will claim what? Normal depreciation. Additional depreciation you are not going to claim because we are following 115BAA. On machinery, how much, what will be the cost of machinery? See, 500 lakhs will be the basic cost of the machinery, plus 24.5 lakh rupees. You have to capitalize the interest from here, plus 100 lakhs. You have to capitalize what? You have to capitalize the foreign technician salary for installation of machinery. That will come to 624.5. On that, you will claim what? 50% depreciation. So why 50%? Because again, the machinery is put to use for less than 180 days. And last but not least, if you are following 115BAA, you are eligible for deduction under ATM because you have distributed dividend of 12 lakh rupees 1 month prior to the due date of filing of return. How much dividend you have earned? You can check it over here. You have earned a dividend of 15 lakh rupees here. And how much dividend you have distributed? You have distributed dividend of 12 lakh. Therefore, whichever is lower, 12 lakh will be allowed as deduction to you. So this is what this question is all about. And the last but not least, tax calculation I have already told you. For 112A, 2,75,000 will be taxable, 1,25,000 will be exempt, and balance will be subject to, out of 4 lakh, 1,25,000 exempt, 2,75,000 will be subject to 12.5% tax, and balance income will be subject to 22% tax. I hope it is clear to all of you. Then for 10% surcharge and 4% cess. Now let's move on to the next question. Question number 3. Mr. Rajesh is a resident unit holder of two entities. One is PQR. PQR is an AIF, Alternative Investment Fund, and one is Shipra. Shipra is a REIT, which is Real Estate Investment Trust, that is business trust. Okay. Now let me tell you one thing very clearly. Mr. Rajesh holds 10% units in both Shipra and PQR. Mr. Rajesh holds 10% units. Now whatever income Shipra will give Rajesh and PQR will give Rajesh, that will be taxable in the hands of Rajesh. But one thing you have to be very careful. In case of REIT, only the income which is actually paid, that will be taxable. But in case of PQR, that is AIF, even the income which is not actually paid but it is only accrued in the hands of AIF will also be taxable in the hands of Mr. Rajesh. So point I am trying to say, in case of business trust, income in the hands of unit holder is taxable on receipt basis. But in case of AIF, income in the hands of unit holder is taxable on the basis of accrual system. Okay. I hope it is clear to all of you. And in both the cases, they have distributed only 90%. They have not distributed entire 100%. So this will play some role in the question. Now, one last thing that I would like to say before we start with the question, we have to compute total income and tax payable in this question. Now, whenever they are using the word tax payable it means you need to compute the tax liability first, and then you need to reduce the TDS and advance tax and TCS credit if it is given in the question. So there is a difference between tax liability and tax payable. When the institute is asking you to compute tax liability, then only compute tax and leave it. But when they are asking tax payable, then you have to find out after TDS, TCS and advance tax credit, whatever amount is balance payable, that you have to compute. So like that, in this question, we have to compute tax payable. Okay, be very careful. Now let's start with the question. First of all, GPL is a SPV in which business trust holds 100% share. So GPL is a SPV. So from SPV, business trust is receiving dividend of 2 crore and the SPV is not opting for 115BAA. Therefore, this dividend will be exempt in the hands of Mr. Rajesh also, who is a unit holder. Because remember, if a business trust receives dividend and pass on to the investor, then it is exempt in the hands of investor if the SPV does not offer 115BAA. If the SPV offer 115BAA, then it is taxable. Therefore, this dividend income is exempt in the hands of Mr. Rajesh. Similarly, dividend after dividend, interest. SPV is giving interest of 3 crore rupees to the business trust. Out of that, how much is paid to the investor? How much is paid to the investor? Only 90% is paid to the investor. Out of which, how much Mr. Rajesh holds? Only 10%. Therefore, 3 crore, 90%, 2.7 crore. Of that 10%, 2.27 lakhs. 27 lakhs will be taxable in the hands of the Mr. Rajesh. I hope it is clear. And on that, REIT will deduct TDS at the rate of 10% because interest from SPV is exempt in the hands of REIT but taxable in the hands of investor. Therefore, and it is taxable on receipt basis, not accrual basis. Therefore, the TDS will also be deducted only on 90% of the income, not on the entire 100%. Third one, on STCG, on sale of properties, the REIT will pay tax. For Rajesh, it is exempt. Now coming to what? Now coming to the second part, that is income from PQR. Business income from AIF. On that, AIF pays tax and it is exempt in the hands of investor. So business income, AIF pays tax, investor don't have to pay any tax. Similarly, long-term capital loss. Long-term capital loss will be carried forward by Mr. Rajesh, that is the investor. Investor will carry forward. Why? Because the unit holders are holding the unit since 2022 and the law says that if the unit holders are holding the units for more than 12 months, then the losses will be given to the investor. In this case, this loss of 27 lakhs will be transferred to the investor. Whenever they will earn long-term capital gains, they will set off this long-term capital loss against that long-term capital gains. Last but not least, interest income from AIF. On that, investor will pay tax. On how much amount? Only 90% is distributed. So investor will pay tax on 90% or entire 100%? Entire 100%. That's what I was trying to say. Here the concept of accrual basis is applicable. Even if the AIF has distributed only 90%, the investor has to pay tax on entire 100%. Therefore, Mr. Rajesh will pay tax on how much? 5,20,000 because he holds 10% stake. And how much TDS will be deducted of Mr. Rajesh? 10% TDS will be deducted of Mr. Rajesh in this case, and in this case also 10% TDS will be deducted. Now we will compute the tax liability of Mr. Rajesh. Mr. Rajesh is following the new regime. You can see in the question. 32,20,000 is the total income. You will apply the new slab rates. 3 to 7, no tax. 3 to 7, 5%. Then 7 to 10, 10%. Then 10 to 12, 15%. Then 12 to 15, 20%. 15 to 32 lakhs. Above 15 lakh, it is 30% plus 4% cess. And this is your tax liability. But the question is not asking tax liability. The question is asking tax payable. So for tax payable, you have to reduce the 2 TDS which has been deducted by different entities. 2,70,000 you will deduct first. 52,000 you will deduct first. After that, whatever amount comes, that will become your tax liability, tax payable. I hope it is clear to all of you. Let's move on to the next question. Here we have to comment on whether the TDS or TCS is applicable in this case. Now there is one person by the name called as Mr. Devansh. He is an Indian citizen and he is a resident. He is a non-resident, sorry. He hardly comes to India for a few days every year, okay? So he's a non-resident. Now he's coming to India and he's booking some tour operator. He's booking some tour to Malaysia from Mumbai for 1 week. Now, whether 206C1G will be applicable to him. So remember, 206C1G is applicable if you book a foreign tour, okay? Overseas tour package and program. And up to 7 lakh, 5% TCS is applicable, and above 7 lakh, it is 20%. But remember, CBDT has given a relaxation that if a non-resident comes to India for a visit, then for him, if a non-resident comes to India for a visit, then for him, provisions of 206C1G is not applicable. Therefore, in this case, the provisions of 206C1G is not applicable to Mr. Devansh. I hope it is clear to all of you. Now, let's come to the next question. XYZ is incorporated in the current year. So, XYZ is incorporated in 2024-25, and XYZ is a buyer of goods. And White Ride is a seller of goods, and White Ride's last year turnover is 11 crore rupees. Last year turnover is 11 crore. Now, so whether the buyer will deduct TDS or the seller will collect TCS, that we need to answer in this particular question. So in this question, the buyer is not liable to deduct TDS because that buyer has been incorporated in the current year, and therefore the last year's turnover of buyer is 0 rupees. And because the last year turnover of buyer is 0, therefore buyer is not eligible for 194Q. Therefore, the seller is eligible for 206C1H. Now, when the seller will be liable to collect TCS? In 206C1H, TCS is applicable on receipt basis. Whenever the amount will be received in excess of 50 lakh rupees, at that time seller will collect TCS. So first 25 lakhs, no TCS. Next 30 lakhs, on 5 lakhs, 0.1% TCS will be applicable. The sale has been made on 15th of September, but the question says that the payment is made on the immediate following month. Suppose if you are selling on 15th of September, then the payment is made on 15th of October. That is 1 month after the date of sale. Therefore, TCS will be applicable on receipt basis, not on accrual basis. So, on this case, on 5 lakh rupees, 0.1% TCS will be applicable 1 month after the date of sale. That is on 15th of October. Then on this 15 lakh, 0.1% will be again applicable 1 month after the date of sale. That is on 15th of Jan. I hope it is clear to all of you. So this is what this question is all about. Next one. Mr. Ravi Prakash is a resident. He is 52 years. He has gifted a sum of 30 lakh rupees to his wife on the occasion of her birthday. We need to answer whether his wife, Mrs. Sudha, is liable to file the income tax return. Now, what is the income of Mrs. Sudha? Mrs. Sudha only has rental income of 25,000 rupees per month, which amounts to rent of 3 lakh rupees. If I reduce the standard deduction, that comes to 2.1 lakhs. So because of this reason, Mrs. Sudha is not liable to file the return because her income is below the basic exemption limit. But Mr. Ravi, that is the husband, has given 30 lakh rupees gift to the wife, and wife has done what with that money? Wife has purchased a car of 29,52,000 rupees with that money, which includes certain charges like RTO charges, insurance charges, extended warranty charges and accessory charges. Now remove all these things. Remove RTO, remove insurance, remove extended warranty, remove accessory charges. After that, the ex-showroom price of the car comes to 26,24,710 rupees. On this amount, the dealer will collect TCS. How much TCS is applicable on car under 206C1F? It is 1%. Therefore, dealer will collect TCS not on extended warranty, not on accessory charges, not on RTO charges, not on insurance charges. He will collect on 26,24,710. That is, he will collect 26,247 TCS from Mrs. Sudha. Now, Mrs. Sudha TCS is how much? 26,247. Therefore, remember, there is a provision under 139 which says that if your TDS or TCS is 25,000 rupees or more, if your TDS and TCS is 25,000 rupees or more, then you have to file the income tax return. Because of this reason, Mrs. Sudha has to file the income tax return. I hope it is clear to all of you. Now let's move on to the next question. The next question is on Dispute Resolution Committee. Mr. Vijay has furnished his return declaring a total income of 28 lakh rupees. Then he received an assessment order on 26th of November 2025 where AO has enhanced the income by how much? By 5 lakh rupees. Now he's agreed by the AO's order. So he is making an application before Dispute Resolution Committee. So he is making an application before what? Dispute Resolution Committee. There is no order of detention has been and no prosecution has been initiated. Just a small penalty under 271D has been levied for failure of certain provisions under 269SS. Now, the first question is Mr. Vijay can Mr. Vijay file an application before DRC? See, to file an application before DRC, you have to fulfill certain conditions. First of all, your total income as per return should be up to 50 lakh rupees. Is it up to 50 lakh rupees? The answer is yes. Similarly, the AO should not enhance your income more than 10 lakh rupees. Is the AO increasing the income by more than 10 lakh rupees? The answer is no. This condition is also fulfilled. Third condition, there should not be any detention order against you. There should not be any prosecution against you. Is there any detention or prosecution against you? The answer is yes. Can there be a penalty against me? Yes. Penalty, if it is initiated, that is okay. There is no restriction on imposition of penalty to go to DRC. Along with penalty, you can go to DRC also. Therefore, Mr. Vijay can file the application. Second question, what is the time limit? He has to file the application within 1 month from the date of receipt of assessment order. So, assessment order is received on 26th of Jan. He has to file an application by 25th of December 2025. I hope it is clear to all of you. If he is not happy with the order of the DRC, can he file an appeal? The answer is no. The order of the appeal is non-appealable. The order of DRC is not appealable. You cannot file an appeal against the order of DRC. It is not allowed to do that. Next, second part, would your answer be different if assessment order is based on information received under DTAA with country X? Yes, then he cannot opt for DRC. If the assessment is done by AO based on information received from foreign country under DTAA, then the assessee cannot go for DRC. I hope it is clear to all of you. Now the next question is a very simple question on DTAA. I'm not wasting my time on that. You can go through this question. It's a similar question what we have done earlier. If some different question of DTAA will come, I will definitely address with you. This is something which is very, very similar to what we have done earlier. And last question of this RTP is a very different kind of question. Let me explain you this. Matrix INC is incorporated in country X and it holds 26% stake in Indian company Pilu Limited. And Indian company has declared a dividend of 50 lakh rupees. Now, as per the DTAA between India and country X, which was entered on 1st of Jan 2021, the dividend will be taxable at 15%. So between India and country X, the dividend income will be taxable at 15%. Now later on, we entered into DTAA with country Y, which came later on 15th of May 2021. In that, we did a provision. In that, we put a clause where we have said that it will be taxed at 10%. Now both X and Y are member of OECD since 2018 and 2020, that is before entering into the treaty. Now, what is the problem over here? There is some disparity over here. The country with whom we are entering first, we are charging 15% tax, and the country with whom we are entering later, we are charging 10% tax. So country X will get aggrieved with us, will be unsatisfied, will be unhappy with us. So therefore, can we apply this 10% on country X also? Yes, we can apply this 10% on country X also, with whom we have done DTAA earlier, subject to some condition. What is that condition? First of all, the second treaty is entered into after the entry into force of the first treaty. Similarly, the second treaty is entered into between India and a state which is a member of OECD at the time of signing the treaty. So at the time of signing the treaty, were both the country part of OECD? Yes, one was part of OECD since 2018 and another was part of OECD since 2020. Third, India limits its rights of taxation to 10%, whatever it is. And fourth, India should separately notify that particular thing in the income tax law. If these four conditions are fulfilled, the country Y benefit can also be given to country X. Okay. Now, would your answer change if the country Y had become OECD member only in 2023? Yes. Then we cannot give the benefit to that particular country X because this condition number 2 will be violated. The second treaty is entered into between India and a state which is a member of OECD. It is not a member of OECD. Therefore, this benefit cannot be passed on. Now, I hope it is clear to all of you. Now let's move on to the next RTP, that is the fifth RTP in our order, that is May 2023 RTP. See how fast we have moved on to the fifth RTP. Can you imagine doing so many RTPs in such a short span of time? It is absolutely impossible. Now the very first question over here is, there is a partnership firm with 5 partners sharing profits and losses equally, and their case was selected for scrutiny. Now one of the partner has given, Mr. Raghav has given a loan of 50 lakh rupees to the firm. So I am the firm, you are partner, you are Raghav, I am firm, you are giving me 50 lakh rupees loan. Now the AO is asking me the source of income in the hands of Raghav. I am not able to explain the source of income in the hands of Raghav. So can the AO assess that particular 50 lakh rupees in my hands as deemed income? The question is, if a firm is receiving loan of 50 lakh rupees from partner, is the firm responsible to explain the source in the hands of partner? And the answer is yes. As per section 68, if I take loan from anybody, it is my duty to explain the source in the hands of the lender who is giving you the loan. If I'm not able to explain the source in the hands of the person who is giving me the loan, then it will be deemed income under section 68 cash credit, and that will be subject to 78% tax under 115 BBE. Check it please. How much tax will be imposed on me? 78% tax will be imposed on me, plus 60% tax, 25% surcharge, 4% cess. That makes the tax to 78%. I hope it is clear to all of you. So it is my duty to explain the source in the hands of the person who is giving me as per section 68. Now question number 2. There is a company A Limited who has taken a loan from a public financial institution, and there is an outstanding interest of 3.5 lakhs. So can I get the deduction of that outstanding interest? The answer is no. I have to make the payment as per 43B, actual payment. Now what the assessee has done? Assessee has converted this outstanding interest into a debenture. So conversion of an outstanding interest into a new loan or into a debenture or into any other security does not amount to actual payment. This is not actual payment. This cannot be called as an actual payment, and therefore this will not be allowed as a deduction. This will be disallowed under the income tax law. I hope it is clear to all of you. Now the third question talks about, we need to answer who all are liable to file the income tax return. Who is required to file the income tax return? First, Mr. Albert is there, whose total income is 2 lakh rupees. So a person whose total income is 2 lakh is not liable to file the income tax return. But wait. Albert is doing business and his turnover from business is 70 lakh rupees. Is he now liable to file the income tax return? And the answer is yes. Why? Because any person whose turnover is more than 60 lakh rupees in case of a business or more than 10 lakh rupees in case of a profession is liable to file the income tax return. Because of that logic, Albert is liable to file the income tax return. Question number 2. Ashish is 42 years old. His receipts from profession is 5 lakhs, but his profit from profession is how much? His profit from profession is 2.5 lakhs. Apart from that, he is also earning some FD interest of 4 lakh rupees and some saving bank interest of 5 lakh rupees. Therefore, his gross total income comes to how much? 7 lakh rupees. Therefore, is he liable to file the income tax return? Obviously, yes. If any individual HUF, AO, PVY whose gross total income is more than basic exemption limit, which is 3 lakh rupees, is liable to file the income tax return. I hope it is clear to all of you. Third case, a law firm. I will not read only ahead. A partnership firm or a company is always liable to file the income tax return irrespective of their total income or loss. Even if they are making profit or loss, it doesn't matter. They are always liable to file the return. Next question also, I will not read the question also. XYZ Private Limited, what they are doing, I am not interested. They are always liable to file the income tax return irrespective of their income, whether they are earning or whether they are not earning, whether they are profit, whether they are loss. I am not interested in that. They are liable to file the income tax return. And one last question, Mr. Valish is depositing 50 lakh rupees in his saving bank account. I am not interested in reading the question ahead. Why? Because if any person who deposits 50 lakh rupees or more in a saving bank account is liable to file the income tax return, and Mr. Valish is depositing how much? 50 lakh rupees in this case. Therefore, Mr. Valish is liable to file the income tax return. I hope it is clear to all of you. Now next question, question number 4. It's a beautiful question and dangerous question at the same time. Let me read the question first of all. ABC is a cooperative bank engaged in marketing of agricultural produce grown by its member. Therefore, ABC Cooperative Society is eligible for section 80P deduction under the income tax law. Okay. Therefore, the profit from the activity is 60 lakh rupees. How much they are earning from marketing of agricultural produce grown by its member? 60 lakh rupees. Apart from that, they have also employed 10 new employees with a salary of 20,000 per month on 1st of May 2024. Salary is paid by account paycheck, and the firm and the cooperative society is eligible for audit under 44AB. Apart from that, they are also earning interest on fixed deposit of 32 lakh rupees from various banks. Now, There are multiple parts in this question. Compute total income and tax liability for AY 25-26. This is the first part. Second part, advise whether it should opt for 115 BAD. This is the second part. So let us compute the first part first. When we are computing the total income and tax liability of a cooperative society, we need to make two calculations. Which two calculations, sir? First, normal calculation, we have to make regular tax and AMT. Regular tax and AMT? Yes. While computing the normal tax, see, we need to make broadly two calculations as per normal provision and as per 115 BAD. When we are doing as per normal calculation, we have to do two calculations as per regular and as per AMT. Now, as per regular, we have to compute the total income first. What is the gross total income? 60 lakh rupees is the income from PGBP and 32 lakh rupees is the income from fixed deposit. Total 92 lakh. Now, while computing the regular provision, you will first compute ATP. ATP, you will get deduction of 60 lakh rupees, which is agriculture produce marketing grown by its members, that you can claim 60 lakh as deduction. And while computing ATJJAA, you will get ATJJAA deduction because 10 employees are there, multiplied by 20,000 rupees per month into 10 months, into 11 months from 1st May to 31st March into 30%. That will be your ATJJAA deduction. So that will be your, you will get both the deduction over here. After claiming both the deduction, your total income will come, you apply your slab rates. What is the slab rate for cooperative society? Up to 10,000 10%, about 10,000 20%, about 20,000 30%. And then surcharge if applicable and cess. Okay. Now you will compute tax as per what? AMT. While computing AMT, you have to compute the adjusted total income. What is adjusted total income? It is total income plus certain things. Now, while adding that, do not add ATP because on ATP, AMT is not applicable. Do you remember? On ATP deduction, AMT is not applicable. Yes, but while computing the AMT, adjusted total income, you have to add back ATJJAA. On ATJJAA, AMT is applicable. Then you apply AMT 15%. Generally, AMT is 18.5%, but for cooperative society, AMT is only 15%. It is not 18.5%. I hope it is clear to all of you. This will be your, then you will apply the compute, the tax, and whichever is higher will become your tax number 1. Now you will compare that tax with 115 BAD. While computing 115 BAD, you will not claim ATP. ATP is not allowed. ATP is not allowed in 115 BAD. But yes, ATJJAA is allowed in 115 BAD. So you will take 60 lakhs as your PGBP, 32 lakhs FD. You will not claim ATP. You will claim ATJJAA. That will give you total income. 22% tax, 10% surcharge, 4% cess. That will be your final tax. Then compare this tax is better or normal tax is better. Whichever is better, you go for that. One more thing. While computing 115 BAD, AMT is not applicable. Therefore, in 115 BAD, you are going to do only one calculation. That is the normal tax calculation. Not as per AMT. Because assessee is opting for 115 BAD, AMT is not applicable. Now, there is second part of this question. What would be your answer if ABC Cooperative Society is a cooperative bank engaged in the business of banking? So if it is a bank, then how the answer will change? See, everything will remain same. If it is a bank, you will not get ATP. Remove ATP from everywhere if it is a bank. Okay, be very careful. Now, how will you compute the income now? If it is a bank, then again normal and 115 BAD. Again in normal two calculation, regular and AMT. And while computing the regular, you will claim ATJJAA. ATP is not allowed to banking industry. And while computing AMT, you will add back ATJJAA. Anyways, ATP was not disallowed under AMT. Then you will compute the tax as per applying the normal rates. Okay. And in 115 BAD also, you will not compute ATP. ATP is not covered. And in 115 BAD, you will get ATJJAA deduction is allowed under 115 BAD. Here also no AMT will apply. Rest everything will same. So if it is a cooperative bank, just remove ATP from everywhere. ATP is not applicable. You will only play with ATJJAA and ATP will be removed from everywhere. I hope it is clear to all of you. Now, moving ahead to the next question, question number 5. There is a LLP, Beta LLP, which is engaged in export of computer software through two units. Unit 1 is engaged in SEZ, therefore it is eligible for 10AA. Unit 2 is a DTAA unit, therefore it is not eligible for 10AA. This is the 5th year of business, therefore the assessee is eligible for 100% deduction under 10AA. Now, we need to compute what? We need to compute the total income and the tax liability of Beta LLP. So here also we need to compute tax as per normal provision first, and then we need to compute tax as per AMT, alternate minimum tax 115 JC. Then whichever is higher, that will be your total income and tax liability. Now, let's start with the normal provision. The profit of unit 1 is 710 lakhs, as you can see over here, and the profit of unit 2 is 840 lakhs. So I will write down that 710, 840. Now, under unit 1, 41 lakh is disallowed. So I will disallow that 41 lakh first. And under unit 2, 55 lakh is disallowed, so I will disallow that under unit 2. So that much I will disallow first and I will get to my profit. 1646 is my profit. Okay, this is my total income. From that, now I will claim 10AA deduction. For 10AA deduction, I want three things. That is, I want profit of unit 1. Unit 1 profit, I want profit from export multiplied by export turnover of unit 1 divided by total turnover of unit 1. Now I am not interested in unit 2. Only unit 1 is eligible for 10AA. Therefore, what is the profit of unit 1? The profit of unit 1 is 751, as you can see over here, correct? Out of that, I will remove two things. Which two things? Because profit shall not include duty drawback, profit on sale of import license. All these things are not part of profit. I hope it is clear to all of you. Therefore, I will remove duty drawback. I will remove the profit on sale of import license. If I remove these two, I will get my profit as 666. Now I will compute my export turnover. While computing the export turnover, you will not take two things. First of all, only that export turnover you will take which is received in India within 6 months from the end of the financial year. Second, export turnover will not include insurance, freight and other charges. Therefore, what is my export turnover? It is 1800 rupees. But out of which how much is received in India? Only 1600 is received in India. Therefore, I will take only 1600. But out of 1600 also, 180 is attributable to insurance and freight. So I cannot take that also. Therefore, 1600 minus 180. 1600 is my export turnover received in India, out of which 180 is my insurance and freight. Therefore, I have to reduce that. Therefore, my export turnover is 1420. What is my total turnover? My total turnover is very straightforward. My export turnover is 1800. My domestic turnover is 300. Out of that, my 300 is my insurance and freight. Therefore, my export turnover is 1800. My domestic turnover is 300. Out of that, 300 is my insurance and freight. Therefore, this 300 gone. Therefore, total turnover is only 1800. Therefore, I got my total turnover as how much? Total turnover is 1800. Therefore, finally, I got the relevant data. 666 is my profit multiplied by export turnover 1420 and 1800 is my total turnover. Therefore, into 100% deduction, 525.40 will be my deduction. Therefore, 525.40 will be my deduction and this is my total income. I hope it is clear to all of you. Now, I will compute tax as per first of all normal provision and then as per AMT. 30% tax, 12% surcharge since the income is more than 1 crore now. Therefore, 12% surcharge will impose and 4% cess will be applied. And then I will compute AMT. For computing AMT, what will I do? I will first take a total income plus 10AA. Total income plus 10AA. That will give me adjusted total income on that 18.5% tax, 12% surcharge, 4% cess, and then compare whichever is higher. The higher amount is coming as this particular amount is coming higher or this particular amount is coming higher. Whichever is coming higher, pay tax as per that. Okay. And if the AMT is higher, then there will be AMT credit. And if the normal provision is higher, then there will not be any AMT credit. I hope it is clear to all of you. Now let's move on to the next question. Question number 6. Let us read the last line. First of all, we are supposed to compute total income, tax liability, and we are supposed to compute total income as per 115BAA. Okay, so 115BAA, you have to keep it in mind. Okay. Now, assessee is a manufacturing assessee. Net profit is 930 lakhs. Very first adjustment, the opening stock and the closing stocks were overvalued by 10% and closing stock was undervalued by 10%. So opening stock is overvalued, closing stock is undervalued. So let's talk about opening stock. Opening stock is 60 lakhs and it is overvalued. It means it is 110%. Therefore, 10% is how much? Cross multiply, find out that. And if it is overvalued, it means you have taken over deduction. So add back opening stock, whatever is overvalued. Similarly, closing stock is undervalued. It means income is less. So add back again this 10%, cross multiply, add back this 10%. Okay, I hope it is clear to all of you. So the effect of both of them will be you have to add back to the net profit. Overvaluation of opening stock means what? Overvaluation of opening stock means you have taken more deduction. So add back to the profit. Undervaluation of closing stock is what? It means you have taken, you are showing less income. It means again you have to add back. Okay. Next one. You are making some payment of 65 lakhs on 15th of October to buy some know-how. Now, which is launched in November. Now, purchase of know-how is an intangible asset. Therefore, add back 65 lakhs and you claim 12.5% depreciation, 12.5% depreciation because it is used for less than 180 days. Okay. Third one is a very simple question on grandfathering. We have done multiple questions on grandfathering so far. One more time I will say, that is, you are selling some 2,200 shares of a listed company on which STT is paid at purchase and sale both. Therefore, it is covered in 112A. The profit is 2,97,000. So this is your accounting profit reduced from PGBP. But while computing the tax profit under LTCG under 112A, you have to follow grandfathering clause. How will you follow the grandfathering clause? Full value of consideration minus cost. What is cost? Cost is actual cost. Compare with lower of FMV on 31st Jan or sale consideration, whichever is lower. then you will compare that with actual cost, and then whichever is higher, that will be your cost. And then up to 1,25,000 rupees it will be exempt, and above 1,25,000 it will be taxable at 12.5%, because it is sold on 27 November, which is on or after 23rd July 2024. From before 23rd July it was 10%, from 23rd July it is 12.5%. I hope it is clear to all of you. Next is electricity charges of 8 lakh rupees which was unpaid. So can I get the deduction of electricity charges on an accrual basis? The answer is yes. Electricity charges is allowed on accrual basis. It is not covered in 43B. Therefore you can claim that as a deduction. Next, there's a loss of 2.25 lakh due to hedging of what? Import of raw material. So you are importing some raw material. For that you have entered into a hedging contract on which there is a loss of 2.2 lakh. So revenue loss, because it is for raw material, this loss is a revenue loss, therefore it is allowed as a deduction. Nothing to worry about it. Next one, depreciation as per books of accounts, you will add back. Next one, dividend from foreign company, you will reduce from PGBP and you will show under IFOS. I hope it is clear to all of you. Next one, you have received 32 lakhs from a company Zen Limited in the form of a non-compete fees. So non-compete fees is a part of what? Is a part of PGBP income. Therefore, let it be part of PGBP. Non-compete fees is always a PGBP income. Next, you have received some advance of 22 lakhs on sale of land, but the land did not get sold and therefore you have forfeited the advance. So now, if you have forfeited the advance on or after 1st April 2014, it is IFOS income. And if you forfeit before 2014, then the treatment was different. Now, on or after 1st April 2014, if you forfeit any advance in the process of negotiation of transfer of a capital asset and you did not transfer the capital asset, you forfeited the amount, it is income from other source. So you have to reduce from PGBP, you have to show under income from other source. Next adjustment, excess on sale of unlisted shares. So you will reduce this from PGBP and show that excess as a long-term capital gains. Why long-term, sir? See, the unlisted shares were purchased in 2017 for 80 lakh rupees. So it was purchased for 80 lakh rupees and you are selling at an excess of 18 lakhs. Therefore 80 lakhs you are selling at an excess of 18. Therefore the long-term capital gains will come to how much? 98 lakh rupees. This will be subject to 12.5% tax from 23rd July 2024. I hope it is clear to all of you. Next one, there is a loss of hedging contract on import of machinery now. So you are importing a machinery of 70 lakh rupees and there is a loss of 2 lakh rupees on hedging of that. So this loss will now be adjusted. First of all, you will disallow this loss to PGBP. It is not allowed under PGBP. It will be added to the cost of the asset. So 70 lakh is the cost of asset and you will add that to the cost of asset as per 43A. What is 43A? What does 43A says that? 43A says that when you import a asset and on which there is a foreign currency gain or loss, then on the date of payment, you have to adjust that loss in the WDV of the block of asset. Therefore 70 lakh is the actual cost of the asset. 2 lakh is what? 2 lakh is the value of the loss. 72 lakh will become actual cost. On this you will claim 7.5% depreciation because the asset is put to use for less than 180 days. It is put to use in November. You will not claim depreciation, additional depreciation, because additional depreciation is not allowed under 115BAA. Then normal depreciation of 35 lakhs you claim as a deduction. Adjustment number 2 we have already done, and last adjustment is adjustment number 3, which is on 80JJAA. So listen carefully. 59 employees you have hired, out of which 36 employees were hired on 1st June with an emolument of 15,000 per month. So they will be eligible for 80JJAA. Similarly, 18 employees were hired for 35,200. They will not be eligible for 80JJAA because the emolument is more than 25,000. Similarly, 5 employees were hired on 1st of November. They will also not be employed for. They will also not be eligible for 80JJAA because they are not employed for at least 240 days in the previous year. The employees have to be employed for at least 240 days in a previous year. Otherwise, they are not eligible for 80JJAA. Therefore, only 36 employees are eligible. But out of those 36 employees also, the salary of 10 employees are paid by bearer check. So that will also not be allowed. You have to make the payment by 4 modes: account pay check, account pay draft, ECS, and such as electronic mode. Therefore, only 26 employees are eligible for 80JJAA. 26 employees into 10 months into 15,000 into 30% will be eligible for 80JJAA. Wait. The 10 employees to whom you are paying salary by bearer check, they will also be disallowed under PGBP under 48(3) because you are making a payment of salary to them of more than 10,000 rupees in bearer check. That is not allowed. So 10 employees into 10 months into 15,000, that will be disallowed under 48(3). Now you will compute your total income and total tax. Total income is 10 crore 10 lakh. So you will compute your total income. So 112A is coming to 0. Why? Because 112A capital gains is coming to 55,000. So entire 55,000 will be exempt because up to 1.25 lakh it is exempt. Then 112 capital gains is coming to how much? 18 lakh rupees. On that 12.5%, and on balance income it is 22% tax, 10% surcharge, and 4% cess. I hope it is clear to all of you. Now question number 7 is exactly similar to what we have done in the first RTP, that is RTP first first question. You can go and compare with that question. That question and this question is exactly same, except the names. The names might have changed. Rest all the things are exactly same. That is the reason I'm not repeating that question here. Question number 8 is a very simple question. There is a fee and company engaged in providing scientific services to various non-resident clients. Such services are also provided to Zeta Inc., which guarantees 12% of the total loans of fee Inc. So if one entity provides 10% or more guarantee of the loan, then both of them are deemed to be associate enterprise. And if both of them are deemed to be associate enterprise, therefore transfer pricing provisions will apply in this case. Now, second part is, if the AO has made a primary adjustment of 310 lakh on 1/4/2024 and the same is also accepted by the assessee and the money is not brought to India up to 31st March 2025 and the transaction is denominated in Indian currency, what are the requirements as per the Income Tax Act? See, very simple. You have to apply the provisions of secondary adjustment over here. So if the AO has passed an order on 1/4/2024 where the primary adjustment is more than 1 crore rupees, then the assessee has to bring back the money within 90 days from the date of order. If the assessee does not bring back the money within 90 days from the date of order, then secondary adjustment will apply. Secondary adjustment will apply how? 310 crore, 310 lakhs will be deemed to be a loan. On that, the interest will be applied. How much interest will be applied? SBI's MCLR 9% plus 3.25%. That is 12.25% interest will be applied on you for financial year 24-25. There is one more option available with you, that if you don't want to pay that interest, you pay one-time additional tax of 20.9664. If you pay one-time additional tax of 20.9664, then you will not be eligible for what? You will not be liable for what? Secondary adjustment. I hope it is clear to all of you. And this last question is also a very, very simple DTAA question. We have done a similar question earlier. This is a total income question on DTAA. Similar question we have done. Income from sole proprietor in business, income from partnership firm in Mumbai is exempt, then agriculture income from country X, then brought forward loss you have to set off against the business in India, then 1,50,000 you can claim under 80C, then you can claim 25,000 under 80D, then you can claim what? Health insurance of your parents also you can claim up to 50,000 rupees, so on and so forth. Then you can claim 20,000 rupees on medical treatment of disability, so you can claim 75,000 flat deduction for your handicap dependent relative. So it's a very simple question on DTAA. You can go through it once, nothing great as such. Whenever a new or a unique question of DTAA will come, I will definitely address that to you all. Okay. Now let's move on to the next RTP November 2023. The very first question over here is a question on total income and tax liability. Assessee is a manufacturer. The profit of the assessee is 180 lakhs. Now what is the total income of the assessee? The total income and tax liability we have to compute, and we need to always see the last line, that whether we have to opt the special regime or not. So we have to follow as per 115BAA. Okay. So let's start the question. The very first adjustment over here is the assessee is paying some interest of 24 lakh rupees by giving debentures. So is it allowed? Can I convert my outstanding interest into a debenture and then I can say it amounts to actual payment? The answer is no, it is not allowed as deduction. As per section 43B, it is disallowed. Next is some tax assessment has been done and the demand has been raised of 5,80,000, which includes surcharge and cess also. So it doesn't matter, income tax is disallowed, surcharge is also disallowed, and cess is also disallowed. All of them will be disallowed under section 40 clause A. Next, provision for payment of gratuity as per actuarial valuation is disallowed under 40A7. So whatever provision you make for gratuity, that is disallowed. That is absolutely disallowed. Even if it is made by actuary, then also it is disallowed. However, if the gratuity is actually paid, which you can see in the last adjustment, whatever gratuity is actually paid, that is 105 lakhs, that will be allowed as deduction. You can take deduction of 105 lakhs. So you have to reduce 105 lakhs and you have to add back what? 180 lakhs. Next, directors are going to some foreign country for some opening of some new branch. So that is for business and profession. So if a director is going to foreign country for opening a new branch, that is obviously for business and profession, and therefore that will be allowed as deduction. This will be allowed as deduction. Next, you are paying some 82,000 rupees for purchase of raw material on 26th Jan, which is a public holiday because of Republic Day, and you are making the payment unfortunately in cash. So can you make the payment in cash on public holiday? Absolutely no. Holidays have nothing to do with under the income tax law. Even on public holiday, you have to make the payment by other than account pay. You have to make the payment by account paycheck, account pay draft, ECS, and electronic mode, if the payment is more than 10,000 rupees. Therefore, this 82,000 rupees will be disallowed. Next one is a foreign company which is in Japan. That foreign company is providing some online advertisement services to us. That foreign company does not have a P in India, and we are making a payment of 11 lakh rupees to that foreign company. Therefore, it is a classic case of what? It is a classic case of equalization levy. The Indian company should have deducted equalization levy, and if equalization levy is not deducted, the expenditure will be 100% disallowed. Next, 4.6 lakhs you are paying as a CSR expense. CSR is not allowed under section 37(1). Next, you are selling some land to an wholly owned subsidiary Indian company So if you sell anything to your wholly owned Indian subsidiary, it is 100% exempt. It is not subject to capital gains. Therefore, reduce from PGBP and show as exempt under capital gains. Next, you are giving some donation to Scientific Research Association, partly in kind, partly in online, partly in cash. Absolutely disallowed, entirely disallowed. Why? Because in 115BAA, donation is not allowed as a deduction. Therefore, this is fully disallowed under the income tax law. Next, you are earning some, you can see point number J and point number M together. You are earning a dividend of 36 lakh rupees. So you will reduce this dividend from, first of all, from PGBP, and you will show this dividend as income under IFRS. At the same time, you are distributing a dividend of 65 lakh rupees. Therefore, this 65 lakh rupees compared with the dividend received, whichever is lower, will be allowed as deduction under ATM. Under ATM, you can claim the deduction of dividend received or dividend distributed 1 month prior to the due date of filing of return. Whichever is lower will be allowed as deduction. I hope it is clear to all of you. Next adjustment is a very important adjustment for your exam. That is, the employer is contributing some amount to notified pension scheme. Now, how much is allowed to the employer? It was allowed to the extent of 10% of salary plus DA in terms earlier, but now Finance Act 2024 has made an amendment. The 10% percentage has been increased to 14%. So now 14% will be allowed. So company has contributed 60 lakh rupees towards the employees pension scheme. That amounts to 15% of salary and DA in terms, but only 14% is disallowed. Therefore, 1% you have to disallow. Okay. Then depreciation of 36 lakhs will be disallowed because that is as per books of accounts. Donation to political party not allowed under 115BAA. Normal depreciation you can claim under 115BAA. Additional depreciation you cannot claim under 115BAA. Brought forward UAD out of normal depreciation will be allowed under 115BAA, but UAD out of additional depreciation will not be allowed under 115BAA. Now this UAD is out of normal depreciation, therefore you can take the deduction of this. Okay, if it would have been out of additional depreciation, you cannot take the deduction. I hope it is clear to all of you. After that, you have to just compute tax, 22% tax, 10% surcharge and 4% cess. That's it. This is what this question is all about. Next question, beautiful question on TDS. Part 1 TDS and TCS both are included in this. Part 1 talks about very important aspect. Suppose I am a seller, you are a buyer. Listen carefully. I am a seller, you are a buyer. And if I am selling you coal, the Sasi is selling coal. If I am selling you coal, then I should collect TCS under 206C subsection 1, the first section of TCS. But if the buyer is a resident and buyer gives a declaration to the seller that he will be using the coal for manufacturing or power generation, he will not be using the coal for trading purpose, but for manufacturing and power generation he will be using, then the seller cannot collect TCS. Seller cannot collect TCS. 206C subsection 1 is not applicable in that case. But there is another catch in that. Then the buyer has to deduct TDS under 194Q subject to some conditions which they have to fulfill. But buyer has to deduct TDS. But in this case, the seller will not collect TCS because the seller is selling to a buyer who is using for manufacturing or power generation. But the buyer will also not deduct TDS. Right? The reason is the buyer has incorporated the business in the current year, and for applicability of 194Q, your last year's business turnover has to be more than 10 crore rupees. Only if the last year's business turnover is more than 10 crore rupees, then only it is allowed. Otherwise, it is not allowed. So therefore, because it is incorporated, it is incorporated in the current year. Therefore, the last year's business turnover is 0 rupees. Therefore, the provisions of 194Q are not applicable over here. Now, the one more question they are asking: would your answer change if delta was incorporated in the last year? Suppose delta was incorporated in the last year and the turnover was 10 crore. Again, the answer will not change. Again, 194Q will not apply, because for 194Q to apply, the last year business turnover has to be more than 10 crore rupees. Exact 10 crore is not sufficient. I hope it is clear to all of you. Next question is also a beautiful question. Sigma is a car manufacturer. It is selling some cars to the car dealers. So remember, whenever a car manufacturer sells car to the car dealer, then the provisions of 206C1F is not applicable to the seller. 206C1F is not applicable. Now you need to check, if the buyer's last year turnover is more than 10 crore, then the buyer will deduct TDS under 194Q. And if the buyer's turnover is not more than 10 crore, and if the seller's last year turnover is more than 10 crore, then seller will collect TCS under 206C1H. So in case of car, first follow 1F. If 1F is not possible, then 194Q. If 194Q is also not possible, then 1H will be applicable. So in this case, 1F is not applicable. Now, there are two buyers. Epsilon's last year's turnover is more than 10 crore. Therefore, in case of Epsilon will deduct TDS under 194Q in excess of 50 lakh rupees. In case of Omega's last year turnover is just 9 crore. But, so in that case, Sigma's last year turnover is 12 crore. Therefore, Sigma, that is the seller, will collect TCS under 206C1H. I hope it is clear to all of you. Now, coming to the third question. which is on case law. Beautiful case law it is. What is this question all about? This question is about there is an airline company and there are agents of the airline company. Now the question is when the airline company will deduct TDS on commission, whether they will deduct TDS on standard commission as well as supplementary commission or only the standard commission. So the court has said that the TDS will be deducted on both standard commission as well as supplementary commission under 194H at the rate of 2% from 1st October 2024, and before 1st October it was 5%. I hope it is clear to all of you. Next one is the assessee Mr. Ram. Mr. Ram has filed his return of income. Original return was filed for AY 21-22 on 28th of December 2021 and he has declared an income of 12 lakh rupees. And for AY 22-23 they are declaring a loss of 5 lakh rupees. Now Mr. Ram wants to file an updated return for the AY 22-23 and they want to declare the income of 7 lakh rupees. So earlier what was the income? Earlier the income was 5 lakh loss. Now he wants to declare positive 7 lakh. Can an updated return be filed? The answer is yes. If there was a loss in original return and if you want to increase that loss and show that as an income as a positive income, then you can file the updated return. If you want to show loss as a loss, then you cannot file updated return. If you want to increase the income, then you can file updated return. By when you can file? If you file within 12 months from the end of the relevant AY, you will be liable for 25% additional tax, and if you file after 12 months from the end of the relevant AY, then you will be liable to file, you will be liable to pay 50% additional tax. In this case, the assessee is filing on 30th November 2023, which is within 12 months from the end of the relevant AY. You can check it. Therefore, assessee will be liable for 25% additional tax. Okay. Now, next question: what would be the time limit for completion of assessment? See, in case of AY 21-22. Updated return is not filed. So in that case, the time limit to complete assessment is 12 months from the end of relevant AY. But in case of AY 22-23, updated return is filed. So in that case, it will be 12 months from the end of the financial year in which the updated return is furnished. So it will be end of the financial year of 23-24. From the end of 23-24, within 12 months, the assessee has to file the income tax return. Next question: there was a search in case of assessee by the assessing officer and some undisclosed income was found. Now the assessee wants to set off the loss and brought forward unabsorbed depreciation against this undisclosed income. So can a loss or unabsorbed depreciation be set off against the income determined under search and seizure? And the answer is no. That is not allowed as per section 79A. 79A disallows that. 79A does not allow such kind of set off against the income which is found in the search and seizure. Okay. I hope it is clear to all of you. Next one. Question number 6 is a beautiful question on case law which talks about determination of arm's length price. Now we all know that determination of arm's length price is a question of fact. Obviously, in determination of arm's length price, there is a lot of facts which are involved. Therefore, it is a question of fact. So, if anybody is aggrieved, can they go to High Court to challenge the arm's length price? That is the question. Because in High Court, you can only go if there is a question of law. You cannot take a question of fact in the High Court. Can I go to High Court by challenging what? By challenging the arm's length price. So, therefore, in this case, the court has held that yes, you can go to High Court by challenging the arm's length price. But High Court will not determine the arm's length price. High Court will not tell the department that find out the arm's length price, or High Court will not tell the department that go and check whether the uncontrolled price is correct or not, go and check whether the third party price is correct or not, go and check whether the data is correct or not. High Court will check whether the arm's length price is determined as per the provisions of income tax law or not. High Court will check the applicability of the income tax law. High Court will check the applicability of what? Whether the provisions of different provisions of 92C and its rules, whether they are applicable properly or not. Therefore, High Court has the power to check the arm's length price. Not the computation of arm's length price will be checked by High Court. High Court will only be involved in checking what? High Court will only be involved in checking the genuineness, whether the arm's length price has been determined as per the law or not. Only that will be checked. They will not sit and compute the arm's length price. Okay, this is what it is written over here. Now this is a very simple question, nothing great as such. There is a resident person of 45 years, 45 DTAA question, simple question. Basic salary 62,000. Assessee is following old regime. You can check over here. Therefore 62,000 salary, 10% of the basic will be considered as dearness allowance, and then 50,000 rupees standard deduction under old regime, and under new regime it is 75,000 rupees standard deduction. Then royalty of 9,80,000, 98,000 rupees will be expense, 2,80,000 rental income, 30% standard deduction, and then dividend income of 2,20,000 rupees. Further, the assessee has purchased some house in Bhopal of 23 lakhs on which 1% stamp duty is paid. So 1% stamp duty 23,000 will be allowed as deduction under 80C. Stamp duty paid for purchase of house is allowed under 80C. Then the assessee is paying some 26,000 health insurance. So 25,000 will be allowed because the assessee is not senior citizen. Then 50,000 is incurred as a health insurance on non-resident father who is not dependent on him. So a non-resident father, 50,000 will not be allowed. 50,000 is only allowed for resident fathers. Okay. Similarly, that's it. Then you have to follow the compute the tax of Mr. Raj and net tax liability, and then you have to follow the doubly tax income, apply the foreign country rate, whichever is lower, or Indian rate, whichever is lower, that will be allowed as what? That will be allowed as relief under section 91. And one last question has been removed by ICI because this is based on equalization levy under section 165A, and we all know that equalization levy, I have told you in the class also, equalization levy under 165A is not applicable from 1st August 2024, that is after the amendment made by Finance Act 2024. So it was applicable till 31st July, but from 1st August it is not applicable, but ICI has removed this completely from their study material. Therefore, we are not going to do any question on equalization levy under 165A. Yes, we will do the equalization levy under 165, that is the online advertisement one, but we are not going to do the 165A one. Okay. Then the last question over here is, there is a foreign company who has opened a branch in India for sale of LED lights. Now, they have opened a branch in India. Now, they are charging some profit of 40% on cost. Now, they are directly also selling some goods from there. So listen carefully. They are selling some goods from the Indian branch and some goods they are directly selling from their Germany branch. Okay, from their Germany directly they are selling some goods. So whether the goods that is directly sold from Germany, will that also be taxable in India? That is known as force of attraction. That is only taxable under UN model. Remember, that is given under Article 7 of DTAA. Go and check the Model Convention chapter. So if there is a force of attraction applicable, then the goods which are directly sold from the foreign country will also be covered in India. So that is only applicable in UN model. In UN model that will be taxable. In OECD model that will not be taxable. I hope it is clear to all of you. Now let's go on to the next RTP, that is RTP May 2024. Now in this question we need to compute lot of things because the question in the last line says a very dangerous thing. Compute total income tax liability in the most beneficial manner. In the most beneficial manner means we need to make three computation here. First computation will be comprising of two computation and then one separate computation. Let me explain you how. First, you have to compute the tax as per the normal provision. Under the normal provision, you have to compute the tax as per the normal provision as well as per the MAT, because they have given us the book profit also over here. So first you will compute normal provision tax, MAT tax, whichever is higher, that will be your tax number one. Then you will compute tax as per 115BAA or BAB as the case may be, special provision. And then you will compute the tax as per 115BAA BAB, and then you will compare with the first tax, and then whichever is lower, that will be the most beneficial one. So this is how you are going to make three computation over here. First we will do the calculation as per the normal provision. Okay, let's start. The SSE is a manufacturer, it is a company. It is selling some pharmaceutical product. The net profit is 900 lakhs. Therefore, the first adjustment is the SSC has purchased some know-how of 50 lakh rupees in November 2024. Therefore, this is not allowed as deduction. It is an intangible asset. Therefore, you have to add back this and you have to claim 12.5% depreciation because it is used for less than 180 days. Next, electricity charges of 7 lakh not paid. So it is allowed. Electricity charges are allowed on accrual basis. Electricity charges are not covered under 43B. Next, there is some loss of 4 lakh rupees on import of some raw material due to hedging contract. So raw material is a revenue item, therefore loss on import of raw material due to hedging is because of revenue item and therefore it is allowed as a revenue loss. You can claim that as a revenue loss. Okay. Next is a depreciation as per accounts 45 lakhs, you have to add it back. Next is a very important adjustment. There is a loss of 2 lakh rupees again due to hedging contract, but now due to import of machinery, that is because of import of asset. So first of all you will disallow this 2 lakh rupees because it is a capital loss and you will add back this 2 lakh rupees to the cost of asset. The cost of asset, the cost of machinery is 65 lakhs. You will add back this 2 lakh rupees to 65 lakhs. Therefore, the actual cost of the machinery will be 67 lakhs. And then you will claim 7.5% normal depreciation and 10% additional depreciation because the machinery is put to use for less than 180 days. Okay. I hope it is clear to all of you. Next one, why additional depreciation we are claiming? Because right now we are computing as per the normal provision, not as per 115BAA. Next one, you have received 20 lakh rupees as a non-compete fees. So that is a PGBP income. Let it be part of PGBP. Next one, you have received 20 lakh rupees as an advance, but you have forfeited that advance. So do you remember, if you forfeit any advance on or after 1st April 2014, then it is considered to be an income from other source. Therefore, you have to reduce this 20 lakhs from here and you have to show this 20 lakhs as income from other source. Next one is excess on sale of unlisted shares. How much it is? 15 lakhs. Now, what is the cost of the shares? You can see below in additional information, the cost of the share is 80 lakh rupees and the excess is 15 lakh rupees. So what you do is, first of all, reduce this excess from PGBP and then show 95 lakhs as long-term capital gains, 80 plus 15 as long-term capital gains under capital gains, and that will be subject to 12.5% tax because this is sold on after 23rd July. Last but not least, 35 lakhs is your normal depreciation. You can claim that. That's it. Now, what will be the tax rate of this company? The tax rate of this company will be 25% because the turnover of this company of last year is below 400 crore. It is 282 crore. Therefore, the tax rate will be how much? The tax rate will be 25%. Therefore, apply 25% tax on normal income, apply 12.5% tax on long-term capital gains, and then 7% surcharge because the income is more than 1 crore up to 10 crore, and then 4% cess. I hope it is clear to all of you. This is your normal tax. Now you have to compute the tax as per 115 JB. They have directly given us the book profit is 15 crore 20 lakh rupees. You can see in the question the book profit is given as 15 crore 20 lakh rupees. On that you will apply 15% MAT, 12% surcharge because the income is more than 10 crore and 4% cess. That's it. Now we have to compute the income as per 115 BAA or BAB. Let's see which section is applicable. 115 BAB is not applicable because the company was set up in 2015. For 115 BAB, for 115 BAB, the company should be set up between October 19 to March 24. Therefore, you can take 115 BAA. 115 BAA is available to everyone. And now in 115 BAA, nothing should be done. Just one change will be there. That is, this is your total income as per the normal provision. You have to just add back one thing, and that is what? That is your additional depreciation. That's it. Once you add back additional depreciation, no other change is required. Everything is same under 115 BAA and under the normal provision. Just add additional depreciation and then compute tax. On long-term capital gains 12.5%, on other income 22% tax, and then surcharge on the total tax of 10%. Always it is applicable, and 4% cess. I hope it is clear to all of you. And then compare whichever tax is coming lower, you should go for that. Okay. If normal tax is coming lower, go for that. If 115 BAA is coming lower, then that will be the most beneficial one for you. Now, the next question is a theory question. There is a Commissioner of Income Tax who has issued a notice to assessing officer for conducting the proceedings of 263, that is revisionary proceeding. Now, after issuing the notice, there was a survey conducted at assessee's place. Now, after the survey, try to understand the sequence of event. First, the commissioner has sent a notice to the assessing officer for conducting 263. Then survey has been conducted, and now after the survey, the commissioner is sending second notice, the content of which is different from the first notice. The content mentioned in the first notice is different. The grounds mentioned in the first notice is different. The ground mentioned in the second notice is different. Can the commissioner do so? And the answer is no. It is written over here. The commissioner does not have the power to change the content like this after the survey. I hope it is clear to all of you. Next one is a question on black money law. Now remember, black money law is applicable only if the assessee is resident in the current year, or if the assessee is not resident in the current year, then assessee has to be resident in the year in which the asset was acquired, or if the asset was or in the year in which the income was earned. Again, I am saying black money law is only applicable either you should be resident in the current year in which the AO has found the income. Suppose the AO has found the income in current year 23-24 or 24-25, then you should be resident in current year. So if you are not a resident in current year, you are not resident, then you should be resident in the year in which the income was found or in which the asset was acquired. So be very careful. Now there is an assessee over here who came to India in March 2013. Before that, he was outside India, and now then he went back out of India in March 2020. Therefore, from 2013 to 2020, he was in India, and in the current year, he is not in India. So in the current year, he is non-resident. But from 2013 to 20, he was in India. So whatever assets were acquired between this period and whatever income is earned during this period, that will be subject to tax under black money law. Let's see. First of all, he is acquiring some shares in United States company on 10 December. That will not be subject to tax because in 2012, the assessee was non-resident, and in the current year also he is non-resident. Therefore, this will not be subject to tax. Then he acquired one apartment in London in April 2014. So in 2014, he was resident in India. Therefore, this apartment will be subject to tax in India. Third, he has a business of manufacturing of leather goods that was started in 2020 April, and 2020 April, that is 2021, he was non-resident in India, and even today he is non-resident in India. Therefore, this will not be subject to tax. I hope it is clear to all of you. Next one, he has also taken some commission from various buyers from April 13 to March 2020. Now, April 13 to March 2020. Remember, I have told you in class that the undisclosed foreign asset is chargeable in the year in which the AO found the asset, but the undisclosed income is chargeable to the respective year to which it pertains. Now, therefore, commission will be chargeable to the respective year to which it pertains. Therefore, 2013's commission will not be subject to tax. Why? Because the black money law came in 2015. How can you charge in 2013? How can you open the assessment of 2013? That is not possible. Therefore, 2013-2014 commission cannot be subject to tax. 2015 to 2020 commission will be subject to tax in the respective year. 2015 15, 16, 16, 17, 17, 18, 18, 19, 19, 20. I hope it is clear to all of you. Is this clear? Next one is a beautiful question on DTAA. Be very careful, okay? In this question, it is not a question on unilateral relief. It is question on a bilateral relief. That is the reason, because it's a different kind of question. We are going to address this question. Mr. A is aged 50 years. He is working in a company Silver Limited since 2020. Now, assume Mr. Mahesh pays tax as per 115 BAC. It means he is paying tax as per what? As per the new regime. Therefore, let's start. Salary before deduction is 23 lakhs. New regime deduction is how much? 75,000 from Finance Act 2024. Then interest on self-occupied property not allowed. Under new regime, SOP interest is not allowed. Then fixed deposit, you can claim 1,60,000 as an income from other source. Now, he's earning some income from country A, but in dollars. So we have to convert that into rupees as per Rule 115. If you want to convert a foreign income into Indian income, you have to follow Rule 115. Now, he's earning some business income of $25,000. So business income will be converted as per TTBR on the last day of the financial year. Now, what is the TTBR on the last day of the financial year? You can check over here. It is 71 rupees. So you will convert this into 71 rupees into 25,000. Rental income will also be converted as per TTBR on the last day, but you have to compute the income from house property first. 4,500 is the rent minus municipal tax will be allowed as deduction minus 30% standard deduction. You have to claim all these things. Okay. I hope it is clear to all of you. After that, whatever income is coming, again, last day TTBR 71 rupees. Then dividend from foreign company will be considered to be, will be converted as per, not last day of the TTBR. For dividend income, the law says last day of the preceding month. So dividend is earned in March. So now for dividend, you will take the TTBR of February 28. Similarly, for short-term capital gains, you will take TTBR of the last day of the preceding month. The dividend, the short-term capital gain is earned on 28th of March. You will take TTBR of 28th Feb 2025. You will convert this and then you will compute the total income. The total income is coming to 54,11,290 rupees, and then you will compute tax as per the new regime. Then you will compute the tax as per new regime. Then you will apply some surcharge also, because the income is more than 150 lakh rupees and it is up to 1 crore. Because the income is more than 50 lakhs, it is up to 1 crore. You will apply the surcharge, 4% cess, and then you will find out the average rate in India. How will I find out the average rate in India? The average rate in India is very simple. What is the tax in India? 15 lakh 0502,515. This is the tax in India. What is the income in India? 54,11,290. If I divide this, the average rate in India comes to 27.77%. Now you will apply this on doubly taxed income. What is doubly taxed income? Let's see. The doubly taxed incomes are as follows. First of all, this amount is doubly taxed income. What is doubly taxed income? This house property is doubly taxed income. Then profits and gains is doubly taxed income. Then this capital gains is doubly taxed income. Then this dividend is doubly taxed income. If I total all of them, I will get 30,26,285. This is doubly taxed income. I will apply the average rate in India. Now I will compare with the tax paid in country A. How much tax is paid in country A? Let's check that also. It is written in the question. Income tax was paid by Mahesh on 25th of May 2025 for all incomes ended 31st March 2025 in country A. Rate of tax is 20% in respect of all incomes. Now, how much tax Mahesh has paid? On municipal property, municipal tax, Mahesh has paid tax on this amount. Because in country A, municipal tax is not allowed as deduction. Therefore, Mahesh has paid tax on 4,500. Mahesh has paid tax on Mahesh has paid tax on this also. Okay, on this also $25,000. Just compute it. 4,500 plus $25,000. Then Mahesh has paid tax on this $5,000. Just compute it. Then Mahesh has paid tax on this $10,000. How much it is coming? Mahesh has paid total of 45,500 income. On that, Mahesh has paid 20% tax. Now this will come the tax in foreign currency. Now if you want to convert if you want to convert a foreign tax into an Indian tax, then you have to apply Rule 128. And what does Rule 128 says? That you have to convert that into Indian rupees by taking TTBR of the preceding month last day. When it is paid in May 2025. So you have to take the preceding month last day, 30th April 2025 rate, and 30th April 2025 rate is 72 rupees. You can check in the question, and that amounts to 640,800. And then whichever is lower will be allowed as relief, and that much will be allowed as deduction out of 15,02,000, and balance you have to pay out of your pocket. I hope it is clear to all of you. The next question number 5 is on transfer pricing, arm's length price, determination of arm's length price as per advance pricing agreement and as per rollback provision. In this question, we need to answer for which of the following year the assessee can go for rollback. Let's check the question first. The assessee is engaged in a business of manufacturing of electronic goods across India and across Southeast Asia. The report was furnished for all the years on time. The company has applied for advance pricing agreement with on 15th of February, and the agreement was signed on 5th of May. The company has also applied for what? Rollback provision, and the agreement was signed on January 5th, 25th. January 2025. Now we need to answer for which all years we can go for rollback. Can we go for rollback for AY 1920? No, you can go for rollback only for the preceding 4 years, and 1920 go beyond 4 years. Can I go for rollback for 2021? No, even 2021 go beyond 4 years. So beyond 4 years you cannot go for rollback. Can I go for 21-22? The answer is yes, you can go for 21-22. Can I go for 22-23? The answer is yes, you can go for 22-23. But sir, in 22-23 the assessment is completed and the arm's length price has been announced. It doesn't matter, all those things doesn't matter. The AO should not reduce the arm's length price below the returned income. If it is below the returned income, then you cannot go for what? The rollback provision. If it is above the returned income, you can definitely go for what? Rollback provision. Next one is a very important point. For 23-24, the matter has been went to tribunal and tribunal has remanded back the case to assessing officer. Can I go for rollback? Absolutely, you can go for rollback. If the tribunal has remanded back the case to AO, you can definitely go for rollback. But if the tribunal has not remanded back the case to AO, but tribunal has itself closed the matter at its end, if itself has achieved finality, then the assessee does not have the power to go for rollback provision. And in case of the last case, the assessee has not filed the return on time on 29 December 2024. If you are filing the return, rollback is not possible. One of the important condition of rollback is if you want to roll back, you have to file the return of the rollback years on time. Otherwise, you cannot roll back in that particular case. I hope it is clear to all of you. Now let's start with the next RTP. This is a beautiful RTP and it's a very big RTP as well. Now pay attention. Very first question is similar to what we have done in the last RTP also. This is an Indian company engaged in manufacturing of certain products and we need to find out the total income of the company and we need to also find out the optimum income tax liability. So now we need to make multiple computation, 3 computation. First computation as per the normal provision, then as per MAT 115JB, then whichever is higher, then you will go for 115 BAA or BAB as the case may be. Okay, the way we have done in the past RTP. So the very first thing that we will do is we will compute as per the normal provision. Let's start. So Indian company, the net profit of the company is how much? It is 95,45,000. The very first adjustment over here is the company is paying 6 lakh rupees for public issue expenses. So public issue expenses are considered to be a capital expenditure. Therefore, that is not allowed. Now, even though the public issue could not be materialized due to SEBI, still it is not allowed because the intention of the company was to raise money. The intention of the company was to do public issue. Therefore, the expenditure is considered to be capital expenditure. It is not allowed as an expense. Okay. Next one, you are purchasing goods of worth 5 lakh rupees from a micro enterprise. Now there is an amendment under 43B which says that if you purchase anything from micro enterprise or small enterprise, then you have to make the payment within the time specified in the MSME Act. So if you pay within the time specified in MSME Act, then it is allowed on accrual basis. If you pay after the time specified in MSME Act, then it is allowed in the year of payment. Okay. Now what is the time specified under the MSME Act? If there is an agreement between both the party, that is the buyer and the seller, then the payment has to be made within the agreed period or 45 days, whichever is earlier. Now there is an agreement between both of them that they will make the payment in 25 days. Therefore, the payment has to be made in 25 days. It has to be made in 25 days. If it is paid in 25 days, it is allowed on accrual basis. If it is paid after 25 days, then it is allowed on payment basis. Now let's see when the payment is made. The purchase was made on 25th of Feb and the payment is made on 29th of March. Therefore, it is beyond 25 days. It is beyond the time limit specified in MSME Act. Therefore, it will be allowed on payment basis. Therefore, it will be allowed in the year of payment. But fortunately, what is happening over here? The year of payment itself is falling in the same financial year. Now, because the year of payment itself is falling in the same financial year, you don't have to worry. You will get the deduction of this particular amount. I hope it is clear to all of you. Next one, a pharma company giving freebies to medical practitioner. It is not allowed as per explanation to 37.1. Next one, depreciation as per the accounts, as per books of accounts will be disallowed. Next one, you are purchasing some one-time license fee. Now, you are purchasing that on 17th of September. Now, that will be disallowed under the income tax law and 25% additional 25% depreciation will be allowed because the asset is used for more than 180 days. Next is you are purchasing some warehouse you have purchased some warehouse for storage of sugar. Now this is a classic case of 35AD and from that you have earned a profit of 17 lakh rupees. Now this profit is obviously credited to the PNL. So you have to reduce this profit from the PNL and you have to show that profit of 17 lakhs separately because that cannot be merged with your existing business. 35AD business has to be computed separately. Next, you are receiving some power subsidy of 5,30,000. So this will be taxable. Power subsidy is taxable in the year in which it is received. So in the current year, if it is received, then it is taxable in the current year itself. Next one is a very routine adjustment, grandfathering clause. You have sold some shares on which STT was paid. The shares are listed. Therefore, it's a case of 112A and the shares are long-term capital asset. Therefore, this 4,80,000 from sale of shares will be reduced from PGBP and for the purpose of computing capital gains, you have to follow the grandfathering clause and compute the capital gains. We have done this lot of time. Okay. Then you have taken a working capital loan. Working capital loan, and now you are going to the bank. You have taken the loan from a Punjab National Bank. Now you are going to the bank for settlement of that particular loan. Now when you went to the bank for settlement of the loan, the bank has waived that loan. 6 lakh rupees is waived in the form of principal, and 2 lakh rupees is waived in the form of outstanding interest. So what is the treatment of this? Now the principal which is waived will be considered to be deemed income because it's a remission and cessation of a trading liability. Working capital loan is a trading liability, therefore it is a remission and cessation of a trading liability. But interest which is waived will not be considered to be taxable as your income. Why? Because the interest was not allowed as deduction earlier, because interest is not allowed on accrual basis. If interest was not paid earlier, then it would have not been allowed earlier. So now on writing of that interest, on waiving of that interest, that should not be chargeable as income also. Last but not least, few additional informations are given over here. 50 new additional employees are hired on a regular basis on 1st of July 2024. 23,000 is the emolument of those employees, though they participate in the recognized provident fund, and the payment is made by account paycheck. So you can claim 80 JJAA 23,000 rupees into 50 employees into 9 months from 1st July to 31st March into 30%. That will be your deduction under 80 JJAA. Next is company has invested 40 lakh rupees in the warehouse for storage of sugar. Now this is related to 3580 business, but out of that 40 lakh rupees investment, 25 lakh is land. So land is not eligible for deduction. Only building will be eligible for deduction. Therefore only 15 lakh will be allowed as deduction. So out of 40 lakhs, only 15 lakh will be allowed as deduction. Now, what was the profit from storage of sugar? It was 17 lakh. And what is the expenditure? 15. Therefore, 2 lakh is the profit from 3580 business. I hope it is clear to all of you. Then depreciation is 9,20,000 rupees. And then the turnover of last year is 395 crore. Now, because the turnover of last year is up to 400 crore, therefore your tax will be 25%. Now you will compute your tax. Okay. I hope it is clear to all of you. This will complete your first part. Now, 112A will be subject to 12.5% tax. The 1,25,000 is exempt, and above 1,25,000 you will be subject to 12.5% tax. Now we will also compute now book profit. Book profit is 99,50,000 directly given in the question. On that 15% tax, 4% cess surcharge will not be imposed because the income is less than 1 crore rupees. Now we will follow the special tax regime. We will follow 115BAA. Sir, why are we not following 115BAB? 115BAB is not followed because 115BAB is only allowed to those associates who are engaged only in manufacturing. Now this associate along with manufacturing is also doing point number F. It is also engaged in warehousing of sugar. Therefore, it is not eligible for 115BAB. Therefore, it will be eligible for only 115BAA. So in 115BAA, how the things will differ? The things will differ in the following manner. Whatever is the total income as per your normal provision, you just have to add back 3580 business. 3580 deduction is not allowed under 115BAA, but yes, you can claim depreciation of 10% on that particular building which you are purchasing. So what is the building you are purchasing? 15 lakh. So 15 lakh deduction you have to disallow that under 115BAA, but on that you will claim 10% depreciation. After that, again the same rule. The 112A will be chargeable at 12.5% after 1,25,000 rupees, and balance income will be subject to 22% tax, 10% surcharge, and 4% cess. And then you compare your tax whether this is beneficial or that. Whichever is more beneficial, you go for that. Okay. So let's go ahead with the next question. This is also a beautiful question. This is a partnership firm in which there are 3 working partners and 1 non-working partner, and this is the details given of the partnership firm. We need to do 2 things. First, the firm do not want to get its books of accounts audited, and the firm is asking us to compute total income. So we will try to follow what? 4480 for the firm. But the problem is the turnover of the firm is 2 crore 80 lakhs. Can a firm with a turnover of 2 crore 80 lakh follow 4480? Yes. If a firm's turnover is more than 2 crore but up to 3 crore, they can also follow 4480 if the cash receipt is up to 5% of the turnover. Now what is the cash receipt of the turnover? 10,50,000 over here you can see on the board. This is cash receipt. This 2 lakh rupees is also cash receipt. What is the turnover of the firm? The turnover of the firm is 2 crore 80 lakh rupees. Therefore, this cash receipt divided by this turnover will come to less than 5%. Now, because it is coming to less than 5%, therefore, the firm is eligible for 4480. Now, because the firm is eligible for 4480, let's compute the income. Out of 2 crore 80 lakh rupees, 12,50,000 rupees is cash. Therefore, that will be subject to 8% deemed income, and balance 267 lakh will be subject to 6% deemed income. I hope it is clear to all of you. So this is how I am going to compute the deemed income. 12,50,000 will be subject to 8% because it is received in cash, and balance is received by online mode. Therefore, that will be 6% from that. From what this is what 4480 deemed income is all about. Now from this I will compute what? I will reduce my brought forward loss also, because from deemed income you can reduce the business loss It is allowed to reduce business loss from the deemed income. After that, I will compute my capital gains. For capital gains, I am selling some plot of land. For how much? Plot of land is sold for 57 lakh rupees. It is assumed that it is sold on or after 23rd July. Therefore, indexation will not be available even though it is long term. Okay, the date of transfer is not given in the question. We are assuming it is transferred on or after 23rd July. Now, the transfer of plot of land is 57 lakh. What is the cost of acquisition of the plot? The cost of acquisition of the plot is 12 lakh rupees. Therefore, 57 minus 12 will come to 45 lakh rupees. This will be subject to 45 lakh rupees will be subject to long term capital gain. Therefore, the total income is 61 lakh 30,000 rupees. This is part 1 of the question. Let's go ahead with the part 2 of the question. What does the part 2 of the question says that? Part 2 says that 2 lakh rupees cash which you have received now, instead of that, if it is 4 lakh, then what will happen? Now, if this 2 lakh rupees, instead of that 2 lakh, if it is 4 lakh, then my total cash receipts will be 14.5 lakh instead of 12.5 lakhs. So if my total cash receipt is 14.5 lakhs, divide my total turnover is 280 lakhs, it is going to be more than 5%. Now, because it is more than 5%, now I cannot follow 4480 because my turnover is more than 2 crore. If your turnover is more than 2 crore and up to 3 crore, and if you want to follow 4480, then your cash receipt has to be within 5%. If it crosses 5%, you cannot follow 4480. Now I have to compute the income as per the P&L account. Now, what is the net profit of the assessee? It is 8,65,000. You can see over here. Then they have paid some interest of 15% to the partner. 15% not allowed. Only 12% is allowed. Therefore, 30,000, that is 3%, will be disallowed. I hope it is clear to all of you. Then to all the partners, they are paying a salary. They are paying a remuneration of how much? They are paying a remuneration of 60,000 rupees each to each of the partners. So there are 4 partners. To all of them, they are paying 60,000 rupees per month remuneration. So 60,000 into 12 months into 4 partners. That comes to 28.8 lakhs. So this will also be what? Disallowed. This will not be allowed because this is the actual remuneration which is debited to the P&L. Then they are paying some 12,000 rupees cash to clerk. So if you make a payment of more than 10,000 in cash to a person in a day, that is also disallowed. You can see over here on the board, 12,000 is paid to cash in clerk which is debited to P&L. So that will also be disallowed over here. So I will disallow that also. Then there is some profit on sale of land which is also credited to P&L. So that also I will reduce from here. Ultimately, the book profit is coming negative. So if the book profit is negative, then what is your answer? If the book profit is negative, then you get a deduction of maximum 3 lakh rupees. You will get maximum how much? Maximum 3 lakh rupees. So 5,81,000 is my profit, book profit. From that, I will get remuneration deduction of 3 lakh rupees, and then 8,81,000 rupees is my what? Is my business loss. I have to reduce my business loss also over here, and then I will get 8,81,000 rupees as my what? As my business loss. Now this business loss, I will do what? I will set off this business loss against my capital gains, and I can set off this against my capital gains. Definitely business loss can be set off against what? Capital gains income. That's what I am doing. Therefore the income over here is 36,19,000 rupees. I hope it is clear to all of you. Let's move on to the next question. The next question is on business trust and its unit holder. There is a business trust by the name called as Beta Limited, and there is a unit holder by the name called as Mr. Arpan. Okay, Mr. Arpan holds 70% of the units of the business trust, and the SPV of the business trust is H Limited. Now we need to compute what? Total income in the hands of business trust as well as total income in the hands of Mr. Arpan according to the income tax law. Let's start with the first one. First, interest from SPV H Limited, 12 crore rupees. Okay, now interest from SPV is exempt in the hands of business trust and it is taxable in the hands of investor. So Mr. Arpan, he will be paying tax on that. On how much amount he will pay tax? He will pay tax on 70% of 12 crore. 70% of 12 crore comes to 8.4 crore. Why 70%? Because Mr. Arpan is holding 70% stake in the business trust. Second, dividend income is always exempt in the hands of business trust. In the hands of investor, it depends upon whether the SPV has followed 115BAA or not. In this question, SPV is opting for 115BAA. Now, because the SPV is opting for 115BAA, the investor has to pay tax on that. So on this also 2 crore into 70%, that is 1 crore 40 lakh, investor will pay tax. If SPV would have not opted for 115BAA, then investor would have also been exempt from dividend. Okay, then short-term capital gains on the transfer of property, certain developmental property, business trust will pay tax at MMR, investor it is exempt. Similarly, interest from unlisted companies debentures, business trust will pay tax at MMR, investor it is exempt. And last but not least, rental from property, business trust it is exempt, for investor it is taxable, and it is taxable, 70% will be taxable. Therefore 1 crore 40 lakh, this also will be taxable. Now one very important amendment made by Finance Act 2023 last year. Now how much REIT is distributing to the unit holder? The REIT is distributing to the unit holder 20 crore rupees. So if whatever is distributed over and above, see what I am circling, whatever is distributed over and above what is taxable or what is exempt in the above 5 points, whatever is distributed over and above these 5 things, that will be taxable in the hands of the investor under income from other source. So let's see how much is distributed over and above 20 crore rupees. Over and above, how much is distributed over and above the above 5 points? Let's see. The 20 crore rupees is the total distribution. First 12 crore is distributed, then 2 crore is distributed, then 1.2 crore is distributed, then 12 lakh is distributed, then 2 crore is distributed. The 5 items total is 17.32. Therefore, what is over and above distributed to the unit holder? 2.68 crores. This 2.68 crore is taxable in the hands of the unit holder under 56(2). Section 56 subsection 2 clause 13. It is taxable, clause 12, sorry. It is taxable in the hands of the investor under 56 to 12. Now, Mr. Arpan will pay tax on how much? Mr. Arpan will pay tax on 70% of that. 70% of that comes to how much? 70% of that will come to how much? Will come to 37,60,000 rupees. So this is how we are going to compute this particular answer. I hope it is clear to all of you. The next question is a very simple theoretical question. There is a case law. This question is based on a case law of a Supreme Court. ABC is a telecom company. It has entered into an agreement with its distributor to sell its prepaid products. Now, what is the agreement between both of them? Suppose I am a telecom company and you are my distributor. So there is an agreement between both of us that I am selling you some prepaid coupons, etc. for the purpose of recharge of telecom, recharge of telephones, mobile phones, and you can sell that at a MRP, and MRP or less than MRP or more than MRP. What you can sell at any price, but I will be giving you at a discount. Suppose I am giving you at a discounted price of 70. Now you can sell at 80, you can sell at 90, you can sell at 100, whatever price you wish to. The difference amount will be yours. Okay. Now the question is, the difference which you are keeping with you, is that a commission for which TDS under 194H will be applicable? The court has said no, this is not a commission. Why? Because as a telecom company, I would not be under knowledge. I would not be knowing that which distributor is selling which coupons to which customer at what price. I don't have the data of that. To some customer you might be selling at 80, to some customer you might be selling at 90, to some customer you might be selling at 110. That is absolutely at your discretion. Therefore, I am not having the knowledge at what price you are selling it. Therefore, I cannot do what? I cannot deduct TDS on that amount on which I am not aware only of the amount on which I am supposed to deduct the TDS. Therefore, TDS is not applicable in this particular case. I hope it is clear to all of you. Let's go ahead with the next question, which is on survey. The assessing officer has surveyed a sports complex at 9:30 p.m. in the night, and the complex is open for business hours every day from 5 a.m. to 10 p.m. Now the assessee is saying that the owner cannot, the AO cannot enter after sunset and late in the night. The AO is saying that. Let's see whether the contention of the AO is correct or not. Okay. Further, the AO wanted to take away the books of accounts and cash kept at the premise. Is the action of the assessing officer correct? So there are two things that we need to answer. First of all, can the AO do a survey in the night at 9:30 p.m.? The answer is obviously yes. See, generally under 133 it is very clearly written that the survey can be done after sunrise but before sunset. If the AO wants to enter any business premise, he can enter after sunrise but before sunset. But there is an exception to this rule where the business hours is in night. If the business hours is in night, then the AO can enter in the night also. Obviously, the business hours of this assessee is in the night. The business hours is from 5 a.m. to 5:10 p.m. and the AO is entering exactly during the business hours. Therefore, it is valid. But one more thing, before doing the survey, the AO has to take what? The approval from higher authority like Principal Director General, Principal Commissioner, Principal Chief Commissioner and Chief Commissioner. If he has not taken the approval, then he cannot do the survey. Okay. This is the first thing that we need to answer. Second thing that we need to answer, can he impound books of accounts? Yes, he can impound books of accounts with him, but if he wants to impound the books of accounts for more than 15 days, then he has to take an approval from higher authority. Plus, can he take the cash with him? He cannot take the cash with him. Under section 133A, that is for the purpose of survey, he cannot take the cash with him. That is absolutely not allowed for him to take the cash. He cannot take anything apart from the books of accounts and documents. He cannot take any valuable item with him. I hope it is clear to all of you. Next one is a small section or small question on different kinds of penalty that can be imposed on the assessee. First is there is an eligible investment fund covered under section 9A and they have to file some statement. So they have to file the statement within 90 days from the end of the financial year. Now he has filed the statement on what? The trust has filed the statement on 31st of July 2025, which is beyond 90 days from the end of the financial year. 90 days ends on 29th of June and they are filing on 31st of July. Therefore, they will be liable for a penalty of 5 lakh rupees under section 271 FAB. Check. They will be liable for a penalty of 5 lakh rupees under section 271 FAB. Next one, Meena Caterers. Meena Caterers is receiving 1 lakh in cash and Meena Caterers is receiving 9 lakh by account paycheck. So now, is that fine, or will there be any penalty? It is absolutely fine. You can receive below 2 lakh rupees in cash. You cannot receive 2 lakh or more in cash. So Meena Caterer is absolutely correct. They are receiving 1 lakh only in cash and 9 lakh is received by account paycheck. Therefore, no penalty can be imposed on Meena Caterers. Third one, the premises of a company Tip Limited was searched and undisclosed income of 18 crore was determined. The company did not admit the undisclosed income. Company did not admit the undisclosed income under section 132 statement. If they would have admitted that, then the penalty would have been only 30% of undisclosed income under section 271 AAB. But because they have not admitted the undisclosed income under 132 subsection 4, therefore the penalty over here will be 60% of undisclosed income under section 271 AAB. But fortunately, this penalty is not much relevant from 1st of September 2024. That is from the date on which the new search and seizure block assessment has been introduced. I hope it is clear to all of you. Now, the next question is one of the most beautiful question on DTAA. Believe me, if you do only this question on DTAA, that is much more than sufficient for your exam. Let us read. This one question covers every kind of aspects of DTAA. This is a resident. Mr. Ram Prakash is a resident. His age is 58 years and he is earning income from India and two more countries, country X and Y. India does not have DTAA with country X and Y. Therefore, you need to find out the unilateral relief. Now, first of all, we need to compute the income in India. While computing the income in India, we will take everything. First of all, gross rental. So 2,50,000 plus 2,50,000, 5 lakh is the gross rental. From that, he will take 30% standard deduction. Then loss from country X and Y, you can set off against the business from India and business from country X and Y. So you can take the total of these three business, 2,80,000, 3,40,000, 1,80,000, minus 1,20,000, minus 1,30,000, you can set off that loss in India. Okay, that is all allowed. Then STCG, you can take under income from capital gain. Then 37 lakh is long-term capital gain on sale of residential property in India. And then you are purchasing another residential property in India in the name of your wife. In the name of wife, it is allowed. It is allowed. So you are selling one property, you are purchasing another property. Therefore, that will also be exempt under section 54. Therefore, the net long-term capital gains will be only 12 lakh rupees. Then agriculture income in country X is taxable, country Y is taxable, country X is country India. India's agriculture income is exempt. Okay. Now, PPF not allowed as deduction because the SSC is following. If you see the last line, 115 BAC, that is one new regime. If you are following new regime, then PPF will not be allowed as what? Will not be allowed as deduction under 80C. I hope it is clear to all of you. After doing all these things, you will get your total income as 37 lakh rupees. Now you will compute tax. Now be very careful. While computing the tax, don't compute tax on 37 lakhs. You have to compute tax as per the partial integration scheme because the SSC is earning some exempt agriculture income in India. Therefore, you have to compute tax on 37 lakhs plus 5.2 lakh first. So first you will compute tax on agriculture income plus your total income. So you will compute tax on 42.2 lakhs first. How will you compute tax on 42.2 lakhs? On 12 lakhs long-term capital gains, flat 12.5% tax, and on balance you will apply the slab rates. Okay. Then step number 2, you will compute tax on agriculture income plus basic exemption limit. What you will compute? You will compute tax on agriculture income plus basic exemption limit. Then you will take the difference between the two. Difference between step 1 and step 2. That will become your final tax. On that you will apply cess, and then that will be your final tax liability in India. From that you will get some relief after some time. Now let's find out the average rate in India. The average rate in India will be 7,42,560 is the tax in India and the income in India is 37 lakhs. So therefore the average rate in India is 20.07%. Now one problem is there in this question. This problem has never ever arisen in any question apart from this question. That is, in country Y you have a flat rate of 27%, but in country X we don't know the average rate. In country X they have given us the slab rates. So for country X we need to find out the average rate first. Without knowing the average rate of country X, I cannot compute the doubly tax income. I cannot compute the relief. Therefore let's start with the average rate of country X. In country X, what is the first income that you are earning? You are earning a rental of 2,50,000 rupees. So on that, will you get any deduction? No deductions are allowed in country X or in country Y against the house property income. Whether this loss is allowed in country X, this loss is not allowed in country X, you can check it over here. Therefore, I cannot set off this loss in country X. Now I am computing the total income of country X and then I will apply the slab rates of country X and then I will find out the average rate of country X first. Similarly, this business income you will take in country X, this short-term capital gains you will take in country X, and this agriculture income is exempt in country X. As you can see over here, in country X, agriculture income is exempt, therefore that will not be subject to tax. So in country X, only three incomes are there. rental property without any deduction of house property expenses, then 2,80,000 business income and STCG from sale of vacant land. So 16,10,000 is the total income of country X. This is computed as per country X. So now I will apply the slab rates of country X. Up to 3 lakhs no tax, above 3 lakhs 15%, above 6 lakhs 22%. That will give me 2,67,000. So therefore now I will get the average rate of country X. The way we already have the average rate of country Y, which is 27%. For country X we have computed to be 16.596%. This is the average rate of country X. Okay, now after that it's a normal question. For country X you will find the doubly tax income, then this rate or average rate in India, whichever is lower, that will be the relief. For country Y also, the average rate in India or the average rate in country Y, which is 27%, whichever is lower, that will apply that you will apply on the doubly tax income, that will be exempt under the income tax law. I hope it is clear to all of you. Let's go ahead with the next question. Question number 8. There is a company by the name called as the Peter Inc. company, which is incorporated in United States. Now the global assets of the company is 50 crore. The Indian assets are 25 crore. The turnover of the company is 90 crore. Now because of this the company is failing the ABOI test. Why? Because the Indian assets are exactly 50% of the global assets. The Indian assets have to be less than 50% of the total assets. If the Indian assets are exactly 50% of the total assets, you are violating the conditions of ABOI test and therefore you become resident in India. Apart from that, there is one more reason why you are resident in India. That is, out of 10 board meetings, 4 board meetings are held in India. The key management and commercial decisions are mainly taken in India only. Therefore, this company is what? This company is a resident company. At the same time, this company is also a foreign company. Now the question is, if a foreign company becomes resident in India because of POEM, because the place of effective management of this company is India. So if a foreign company becomes resident in India because of a POEM, so if I make a payment of professional fees to this company, whether I will deduct TDS as per 194J or I will deduct TDS as per 195. So on that day, there is a CBDT notification which was issued in 2018, which says that if the foreign company is a resident as well as a foreign company, then you have to deduct TDS as if it is a foreign company. Therefore, you have to consider 195 and not 194J. You have to deduct TDS as per section 195 and not as per 194J. And one last question in this RTP is, B Limited is an Indian company located in SEZ in which TQR Inc. a company holding 30% stake. Therefore, B Limited and TQR are deemed to be associate enterprise because the holding period is 30%. Now, B Limited sold 90,000 goods at rupees 10 to TQR, whereas to others it is selling at 12 per unit. So to associate enterprise you are selling at lesser price, to outsiders you are selling at more price. Therefore the differential amount has to be added back to the arm's length price. So therefore $2 per unit into 90,000 pieces into 85 rupees per dollar, that will be added back to the arm's length price. Similarly, to associate enterprise, you are paying 15,000 guarantee fee. To outsiders, you are paying only 12,000 guarantee fee. Therefore, $3,000 has to be added back. $3,000 into 85, that will be added back over here. Similarly, to associate enterprise, you are paying some amount of $18,000. To outsiders, you are paying some amount of $16,000. Therefore, this $2,000 will also be added back into 85 rupees. This will also be added back over here. And therefore, whatever income is added back over here, that will increase your arm's length price. Now, the last question over here is, if this amount is increased by assessing officer, can I claim deduction under 10AA on this increased amount? And the answer is no. As per the proviso to 92C subsection 4, first proviso to 92C subsection 4, if an arm's length price is increased by assessing officer, then on that increased arm's length price, you cannot claim deduction under 10AA or chapter 6A. I hope it is clear to all of you. So let us go ahead with our last RTP, that is RTP May 2025. After that, we will be done with 9 RTPs, including the latest one, that is May 2025 RTP. Now, the very first question over here is question number 14. Before that, there are 13 questions which are your MCQ case scenarios of May 2025. If time permits, I am not making any commitment. If time permits, I will discuss those MCQs also later on. But right now, my objective is to discuss the descriptive questions with you all. Now, the very first question over here is on total income question. Let's see what exactly they want in this particular question. If you read the last line, they are asking total income and tax liability of a company as per 115BAA. So we need to solve this question as per 115BAA. Let us start the question now. The very first thing is the assessee is a private company. It is a domestic company. It is engaged in manufacturing and the profit of the company is 1 crore 7 lakh rupees. Now, what is credited to PNL? The first item which is credited to PNL is rent from a vacant land. Now, rent from a vacant land is considered to be an income from other source. Okay. So you have to reduce from here and you have to show under what? Income from other source. Now, next one, rent received from a commercial property, 5,30,000 rupees. Now, this rent which is from a commercial property, this is an income from house property. You have to reduce from PGBP and you have to show under income from house property and in income from house property you will take 30% standard deduction. Sir, in 115BAA we get standard deduction? The answer is yes. In 115BAA you will get the standard deduction, but in 115BAB you do not get the standard deduction of house property. Be very careful. Next one is interest on income tax refund reduced from here, show us in the income from other source. Next one is profit on sale of plot 8 lakh rupees. Now the profit is 8 lakh rupees on sale of plot, so this will go under capital gain. So reduce from here and find out the capital gains of this particular asset. Now what is the capital gains of this particular asset? The capital gains will be as follows. Pay attention please all of you. Now if you see over here, the plot was purchased for 50 lakhs in 23 Jan and it is sold in March 25 for 58 lakh rupees. Therefore it is a long-term capital gains, and now because it is a long-term capital gains, LTCG of 8 lakhs will be subject to tax at 12.5% because it is sold on or after 23rd July. Okay, indexation will not be available from 23rd July to domestic companies. So therefore 8 lakh rupees will go under long-term capital gains. 12.5% will be the tax rate. Then dividend of 6 lakh rupees you have received from what? A foreign company. So this will be reduced from here and this will go to income from other source. Now to earn this dividend you have raised some loan from a bank. Now on that you have paid an interest of 1,50,000 rupees. So can I get the deduction of this interest against my dividend income? Yes, you can get the deduction of interest against dividend income only to the extent of 20% of the dividend. Therefore the dividend is 6 lakhs. Now in IFOS I will get 20% deduction. Therefore I will get a deduction of 1.2 lakh rupees in IFOS. I hope it is clear to all of you. Now what is the statement? What is debited to the statement of PNN? Now we have to add back this depreciation chart to the statement of PN because that is accounts depreciation. Donation to Swachh Bharat Abhiyan, it is not allowed under 115BAA. It is not allowed under chapter 6A also in 115BAA. So therefore this will be added back. Then actual contribution to pension scheme. Now how much contribution to pension scheme is allowed to employer? Only 14% is allowed from Finance Act 2024. Earlier it was 10% of basic salary plus DA in terms. Now it is up to 14%. Now what is the salary in this question? If you see this question properly, it is written over here, the salary for the purpose of 80CCD, the salary that is salary and dearness allowance is 10 lakh rupees. So 14% of that will amount to 1,40,000 will be allowed. But only 1,40,000 will be allowed. But you are paying how much? You are contributing 1,90,000. Therefore 50,000 will be disallowed over here. I hope it is clear to all of you. Next one, you are making a payment of 68,000 to a transporter. By how? By account pay check. No TDS has been deducted. You have not deducted any TDS of that transporter. The transporter has furnished PAN to you. The transporter has also given a declaration that he is coming under 44AE. Therefore, it means that the transporter does not own more than 10 goods carriage at any time during the previous year. If all these conditions are fulfilled, then there is no need to deduct TDS under section 194C. 194C, there is a relaxation for you when the transporter does not own more than 10 goods carriage and he gives a declaration and PAN that he does not own more than 10 goods carriage. Therefore, there is no need to deduct TDS. Okay. Next, bonus to employees is allowed on a payment basis, not on accrual basis. You have to make the payment as per 43B till the due date of filing of return. You are making the payment on 18 December 2025, which is beyond due date of filing of return. Therefore, this will not be allowed as deduction. I hope it is clear to all of you. Next one, income tax disallowed. Interest on income tax is also disallowed. Next one, donation to Scientific Research Association, not allowed under 115BAA, therefore add back. And the last one, which we have already done along with the dividend income. Next one is you have some income tax depreciation of 18 lakh rupees. So take that 18 lakh rupees as deduction. But in that you have made some mistake. Let's see whether you have made a mistake or not. You have considered printer and scanner as computer. So are printer and scanner considered to be a computer? The answer is yes. That is absolutely correct. Computer and its accessories and its peripherals are considered to be same as computer. Therefore, this 40% you have correctly classified. But is EPBX also considered to be computer? The answer is no. EPBX cannot be called as computer. It is called as telephone. Therefore, it is subject to 15% depreciation. So here you have made a mistake. Mistake of how much? You have claimed 40%. You should have claimed only 15%. Therefore, 25% of the depreciation I have to add back. What is 25% of 5 lakh rupees? 25% of 5 lakh rupees comes to 1,25,000 rupees. That much I have to add it back over here. Then additional depreciation will not be allowed under 115BAA. So forget about it. Then last year provision for audit fee. Last year you have made a provision for audit fee of 1 lakh rupees, but you have not deducted the TDS in the last year. Therefore, 30% of last year would have been disallowed in the last year. Therefore, in the current year, you have paid the TDS, you have paid the tax also. You have deducted the TDS, you have paid the TDS in the current year. Therefore, in the current year, you will be getting the deduction of that particular TDS which you have paid in the current year. Therefore, 30,000 will be allowed as deduction in the current year. Similarly, last year, you have provided in books of accounts a bill of 90,000 rupees for purchase of raw material. So 90,000 rupees you have taken deduction in the last year on an accrual basis. But in the current year, you are making 45,000 rupees payment in cash on 20th August. That is not allowed. that will be considered to be deemed income under section 40A3A. If you make a provision of an expense in 1 year and make the payment of that expense in cash in the next year in excess of 10,000 rupees to a person in a day, then in the next year it is considered to be a deemed income. Next is you are issuing shares, you are a closely held company. Be very careful. The SSC is a private company, it's a closely held company, and it is issuing shares at a price lower than at a price higher than the FMV. The FMV of the share is 60 rupees and you are selling the shares as 100 rupees. So earlier in such cases, income from other source was applicable in the hands of company under section 56(2) clause 7b. But from Finance Act 2024, with effect from 1st April 2024, this section has been discontinued. Therefore, nothing has to be done for this particular section. I hope it is clear to all of you. Now, next one is done. And the last one is you have declared an interim dividend of 5,20,000 in September 2024. So you will get deduction under ATM of this 4.8 lakh rupees. 4.8 lakh rupees. Why, sir? Because the declaration is 5.2 lakhs, but the earning of dividend is only 4.2 lakhs. You can check it over here. What is the dividend earned? That is 6 lakhs minus 1.2 lakhs. Only 4.8 lakhs is the dividend income. Income is 4.8 and distribution is 5.2. Therefore, it will be restricted to 4.8 only. Then you will compute the tax on long-term capital gains. You will 12.5%, and on other income you will compute tax at 22% plus surcharge of 10% and cess of 4%. I hope it is clear to all of you. Now let's move on to the next question. That is the question on charitable trust. There is a trust registered under 12AB which derives income of 500 lakhs during the financial year. Now the trust wants to give donation of what? 200 lakhs to another trust, ABC Educational Trust. Regarding this, we need to answer a few questions. So the trust wants to give donation of 200 lakhs. Regarding this, we need to answer a few questions. Very first question. How much amount paid by the trust will be considered as an application? First, if this is given as a general donation, not as a corpus. So if you give a donation as a general donation, then it is allowed as a deduction. If you give donation as a corpus donation, then it is not allowed as a deduction. Therefore, if you give the donation as a general deduction, 85% of that will be allowed as deduction. So 85% of 200 lakhs will be allowed as deduction. Second part, if you give that as a corpus donation, then it is not allowed as a deduction, because we all know that if you give a donation as a corpus donation, then it is not allowed as a deduction to the charitable trust. Now second part, part B. Would your answer change? If it is paid out of the accumulation of XYZ Limited, then nothing will be allowed. You have to give donation from the current year income. If you give donation from the accumulation of the last years, then it is not allowed. Then even in the first case, it will not be allowed. In second case, anyways, it is never allowed. For corpus donation, it is never allowed. But if you give out of accumulation, then even general donation will not be allowed to the SSC. Apart from that, 30% tax will be imposed on the SSC under section 115 BBI for violating the provisions of the income tax law. So 30% income tax will also be imposed on the SSC. I hope it is clear to all of you. Next, also examine the conditions with which ABC requires to satisfy for not including the amount received from XYZ with a specific directions for forming part of the corpus trust. So see, if you are receiving any corpus donation, then what all conditions you have to fulfill if you want to make that corpus donation exempt. See, once you receive, there are 3 steps over here. Once you receive the corpus donation, it will become exempt only if you invest that corpus donation in the mode specified in 11.5. For example, I received 100 crore today. So if I want to exempt 100 crore, I have to invest in the mode specified in 11.5. This is the first thing. Once I invest in the mode specified in the 11.5, it is exempt. Second step, once I withdraw that money later on and purchase and use for the purpose of corpus, I have to withdraw that money now from the 11.5 modes and I have to use it for the purpose of corpus. At that point of time, it will not be allowed as application. Third step, when you deposit back that particular amount in the corpus, when you deposit back that amount in the 11.5 mode within 5 years, if you deposit back in the 11.5 mode, then it is allowed as an application. And if you violate any of the conditions over here, it will be subject to tax. And here also provisions of 115 BBI are applicable and you will be subject to 30% flat tax. I hope it is clear to all of you. Next question. Next question is Mr. Amit is an Indian resident. He has purchased some virtual digital assets like cryptocurrencies and NFT. Now let us try to see what he has purchased and what he has sold and how much tax will be imposed on him. First of all, he has purchased one Bitcoin of 60 lakh rupees and his friend has given him one NFT of 5 lakh rupees. His friend has given him as a birthday gift 5 lakh rupees NFT, and then he has bought one NFT for 10 lakh rupees. His friend has brought this NFT for 4.5 lakh rupees. Now due to financial need, he is selling one by one. I will try to compute. He is selling half Bitcoin. So half Bitcoin if he is selling, and expense on transfer is 0.1%. So how much capital gains will be imposed on this? See, he is selling half Bitcoin for 28 lakhs. Therefore, sale consideration is 28 lakhs. Now, what is the value of full Bitcoin? The value of full Bitcoin is 60 lakhs. So what will be the value of half Bitcoin? It will be 30 lakhs. Therefore 28 lakhs minus 30 lakhs will be 2 lakh loss. So I will not get the deduction of expense on transfer. No. In case of transfer of virtual digital asset, you don't get the deduction of any expense except cost of acquisition. Cost of acquisition is the only expense which will be allowed. Apart from that, no other expense will be allowed. Even expense on transfer will not be allowed. Now, sir, here 2 lakh rupees loss is coming. What has to be done with this? This will be lapsed. This cannot be set off against any income. This cannot be set off against other gain of virtual digital assets also. Again, I am saying this cannot be set off against other gains of virtual digital asset also. This is completely scrapped. This is completely lapsed. Okay. Now, this is the first thing. Second, income. He has got a gift from his friend of 5 lakh rupees. You can check over here. So, therefore, that gift will also be what? That gift will also be what? That gift will also be subject to what? Income. That gift will also be subject to income tax. Further, he has received other income of 6.5 lakh. So, that will also be other income. And last but not least, what will be his income? Last income will be the NFT which he has received from his friend. He is selling that NFT for how much? He is selling that NFT for around 6.5 lakh rupees. Okay. So for 6.5 lakhs, he is selling that NFT. Therefore, I have to compute capital gains for that NFT also. Now, which NFT he is selling? He is selling that NFT which he is received from his friend as gift. So he is selling for 6.5 lakhs. What will be the cost of acquisition? The cost of acquisition will be the FMV which we have taken earlier under income from other source. Okay, because on 5 lakh rupees you have already paid tax under income from other source, as you can see over here. Therefore, this will become your cost of acquisition. Therefore, 1.5 lakhs will be your capital gains. That will be subject to flat 30% tax. Okay, now I'll tell you, this 2 lakh rupees loss is lapsed. This 1.5 lakh rupees is subject to flat 30% tax, and this 5 lakhs and this 6.5 lakhs will be subject to what? Slab rates. Okay. Now, the question is asking us to compute tax payable. Whenever I have told you earlier also, whenever they are asking tax payable, we need to also compute the TDS and TCS which has been deducted in our case. Now, when somebody has, pay attention please all of you, when somebody has purchased Bitcoin and NFT from us, they would have deducted our TDS. Yes or no? Under 194S. So, we are selling Bitcoin of how much? 28 lakhs. So the buyer would have deducted TDS of 1%. We are selling NFT of how much? 6.5 lakhs. So the buyer would have deducted our TDS. So that credit we will get. Therefore, this 1% and this 1% will be reduced from your total tax liability, and only then you will get what? Only then you will get your tax payable under the income tax law. I hope it is clear to all of you. Now let's go ahead with the next question. Question number 18. There is a person, Mr. Vivek, who is a non-resident partner in a partnership firm, Messrs. Pal and Company. So Messrs. Pal and Company, it is a partnership firm in India in which Mr. Vivek is a partner, and he has contributed 50 lakh in the firm, and the firm is paying him 10% capital, interest on capital, and the firm is also paying him profit share every year. Okay. So there is a Indian firm in which there is a foreign partner. The Indian firm is paying him share of profit. The Indian firm is paying him interest on capital. Okay. Apart from that, there is also Mr. Vivek's friend. His name is Vikas. Mr. Vivek's friend Vikas is also a non-resident, and Mr. Vikas is providing the firm fees for technical services for projects in India. Okay. So Mr. Vikas is paying some fees for technical services for projects in India of 5 lakh rupees. Now both Mr. Vivek and Mr. Vikas are resident of country X. Now there are multiple questions over here. As a tax consultant, first we need to advise, is the firm liable to deduct TDS on interest on capital and share of profit first? Then, is the firm liable to deduct TDS on FTS? These are the two questions that we need to answer. Assuming that India has no DTAA with country X, in case tax is not deductible, is there any other related requirement? So, I'll be telling you one by one for everything. First of all, the firm is paying interest on capital to the partner. So, TDS under 194A is not applicable. Why? Because 194A is only applicable to resident partners. It is not applicable to non-resident partners. But the interest which is paid to non-resident partners, the TDS will be applicable under section 195. Under section 195, the TDS has to be deducted, and the TDS has to be deducted at the rates in force, and the rates in force is 30%. Okay. So for interest on capital, the firm has to deduct TDS at the rate of 30%. Now for share of profit, there is no need to deduct any TDS. There is no need to deduct any TDS for share of profit. Why? Because the share of profit is exempt in the hands of the partner. Therefore, there is no question of deducting TDS. But yes, there is a related requirement which is asked over here. The firm has to fill what? Form 15CA and 15CB. Form 15CA and 15CB is mandatory irrespective of whether the income is chargeable to tax or not. You have to fulfill this certain procedural requirements under the income tax law. Now, the third thing, you are also paying Mr. Vikas some fees for technical services. So whether this fees for technical services is accrued in India, the answer is yes, because it is related to project in India. Therefore, it is accrued in India, it is taxable in India. Now the question is whether TDS will be deducted. The answer is yes. Now the question is, it is taxable under which section? It is not taxable under 115A. because again there is no agreement between both of them which is approved by central government. 115A is only applicable only if there is an agreement between two parties which is approved by central government. Therefore, this is not covered under 115A. I hope it is clear to all of you. So this will go under the general provision, but it is taxable, it is accrued in India. Therefore, TDS will be deducted at 30%, which is the normal rate for a non-resident. So 30% TDS will be deducted in this case. Okay. Now, there is part 2 over here. If India has a DTAA with country X, suppose India has a DTAA with country X, and the DTAA says that 10% is the tax in case of FTS. How much we are deducting? We are deducting 30%. But if the DTAA says that 10% is the tax, what is the remedy available to Mr. in case of Mrs. Pal? India has deducted TDS at the requisite rate provided under the Income Tax Act. So now listen carefully. How much TDS we have deducted? 30%. If DTAA says that it is only 10%, then what is the remedy? See, if the TDS is borne by the payer, that is if the TDS is borne by Mrs. Pal and Company, that is the firm, then there is a provision of section 239A which is applicable in this case. So what is 239A? 239A says that if the payer has borne the TDS and if the payer has paid extra TDS, in this case the payer should have deducted TDS at 10%, but the payer has deducted mistakenly at 30%. So whatever extra TDS, if payer has borne the TDS, then the payer can make an application as per 239A to the assessing officer within 30 days, and the AO will give him the refund of that particular extra 20%. But that is only possible if payer has borne the TDS. If payee has borne the TDS, it means if Mr. Vikas has borne the TDS, it means the non-resident has borne the TDS, then the relevant person who should get that particular TDS is the Mr. Vikas only. Then Mr. Vikas deserves to get that TDS in his bank account. I hope it is clear to all of you. Now, coming to the next question, which is a very simple question but a beautiful question. Mr. Bhuvan is a purchaser. Be very careful. What is Bhuvan doing? Bhuvan is purchasing certain raw material, and Srinivas is what? Selling certain raw material. Now, how much raw material you have purchased? You have purchased 3,20,000 rupees raw material through cash. Now, that is a mistake you have done. So, if the buyer is purchasing goods of, or if the buyer is making a payment of more than 10,000 rupees other than account pay, check, account pay, draft, ECS and such other electronic mode, then in the hands of buyer, this will be disallowed under 40A3. Similarly, for seller also, 3,20,000 is the invoice made on 27th of March. So, if the transaction is of 2 lakh rupees or more on a particular day. So is the transaction of 2 lakh rupees or more? The answer is yes, on 27th of March. Then the seller cannot receive even single rupee in cash. Now the seller is receiving 3,20,000 in cash. Therefore 269 ST will be applicable for seller, and the penalty under 271 DA will be applicable in the hands of seller of 3,20,000 rupees. Now the second part of this question is, will there be any detriment? Second part, what will your answer be different if the cash purchase are effected by Bhuvan on 2 different dates? So if this 3,20,000 is not on 27th March, say it is on 27th and 28th, 1,80,000, 1,40,000, then what will happen? Even then in case of Bhuvan, 40A3 will apply, because the limit in 40A3 is very small limit of 10,000 rupees. In excess of 10,000 rupees, if you pay in a day, then it is disallowed. But yes, in case of seller, now the provision of 269 ST will not apply, because you are doing 2 different transactions of less than 2 lakh rupees on 2 different dates, and therefore now you can receive cash amount of 1,80,000 and 1,40,000, because you are not doing on one single day, you are doing on 2 different days. I hope it is clear to all of you. Let's move on to the next question, which is a beautiful question on DTAA. Mrs. Sudha, age 61 years. Let's read the last question, what they exactly want from us. They want a total income of Sudha, net tax liability of Sudha after taking account the FTC. And Sudha is opting out of default regime. It means Sudha is following the old regime. So according to old regime, you have to solve this question. Let's read the question now. Sudha is 61 years, so she is a resident, she stays in Calcutta. She is resident as well as senior citizen. Now she performs in India some classical dance and country M also. So first, normal computation you will do. You will include everything, every income in India. You will compute total income in India. You will compute tax in India, and you will compute average tax rate in India. Let's do that first. First of all, Sudha is earning some 10 lakh rupees from concerts in India. So that will go to the income from PGBP. Then she is earning some country M. From country M, she is earning some income of $12,245. So I have to convert that into rupees as per rule 115. So for this, what rate I will take? I will take the rate on 31st March 2025 as the conversion rate. So what is the conversion rate of country M? Country M dollar on 31st March 2025 is 80 rupees. So I will convert as per 80 rupees this particular amount. Okay. Now the TDS of 2,500 is deducted. That will be helpful later on while taking the FTC. Now similarly, she is also earning $10,000 from country N. So now I have to convert that also into rupees. So for that also I have to take the rate on 31st March 2025. So 10,000 into country N, 31st March rate is 79 rupees. So I will take that also over here. Apart from that, she is earning income of interest from bank FD of 4 lakh rupees. Therefore, this will be subject to 80 TTB. 80 TTB, 50,000 standard deduction you will get from this, and 25,000 rupees from saving bank account you are earning. This will be your total income, gross total income. From that, now you will claim what? 50,000 rupees medical insurance for yourself and your for husband, because you are a resident senior citizen. Therefore, you are eligible for a higher limit of 50,000 rupees. So you will get total of 50,000 rupees deduction under 80D because you are resident senior citizen. And last but not least, you will get 80C deduction of PPF 1.5 lakhs, and you are also purchasing 5-year fixed deposit in the name of son, but that is not allowed. Fixed deposit of 5 years is allowed only if you purchase in your name. Only it is allowed. Otherwise, if you purchase in the name of your son, then that is not allowed. So this 3 years, this 3 lakh rupees will not be allowed as deduction. So after that, you will compute your tax. You will compute your tax. There is no special income in this. You will compute tax as per old regime, not as per new regime. Then whatever is the tax divided by total income, you will get Indian average rate. And therefore, the Indian average rate is coming to 24.489%. You can check in what? You can check in the solution given by the ICAI. Now, we need to compute the FTC. Now, for FTC, we are earning income from two countries. One, we are earning income from country N. Another, we are earning income from country M. With country N, we have a DTAA. With country M, we don't have a DTAA. So, accordingly, we need to answer. Okay? Accordingly, we need to answer. With country M, we don't have DTAA. With country N, we have DTAA. So let's talk about one by one both the countries. Let's talk about the relief from country M first. In country M, how much tax you have paid? You have paid tax of $2,500 in country M. Okay. Now I have to convert that into rupees. As per the rule 28 of FTC, rule 28 says that you have to convert that into rupees as per what? As per last day of the TTBR of the last month in which the tax was paid. The tax was paid in October 2024. And what is the last day of the previous month? Last day of the previous month will be 30th September. So I have to convert this 2,500 CMD into as per 30th September rate. So this is which country? For country M. Check on the board. 30th September rate is 80 rupees. So I have to convert this as into 80 rupees. Okay. Now let's compute the what? Let's compute the FTC of country M. For country M, I have to compute two FTC, whichever is lower will be allowed. The average rate as per India or tax paid in foreign country, whichever is lower will be allowed. Now, this is the doubly taxed income. You can check on the board. Okay, you can check in the calculation given by the ICI. Multiply by Indian average rate. Indian average rate is 24.489%, which I have told you earlier only. Compare with what? The tax paid in the foreign country. Tax paid in foreign country is $2,500 into 80 rupees as per rule 128, which I have shown you. Whichever is lower will be allowed as FTC to you. Similarly, for country N also you have to do the same thing. This is the Indian average rate 24.489 into doubly tax income 7,90,000. And what is the tax paid in country N? In country N, you have earned income of $10,000, out of which 10% you have paid as a tax. Therefore, $1,000 you have paid as a tax. When you have paid? On 25th of March. Again, to convert that, you have to take the TTBR of the preceding month last day. What is the preceding month last day for country N? For country N, preceding month last day is 28th Feb, and on 28th Feb, the rate was 78 rupees. And therefore, as per 78 rupees, 78 into 1,000, that will be 78,000. Whichever is lower will be allowed as FTC. After that, you will get your tax liability. I hope it is clear to all of you. So this is what this beautiful question is all about. Let's go ahead with the next question. Question number 21. Mr. Manan, who remained in country X, returned to India permanently in the last year on 1st February 2024. So he was in country X, he came to India last year in 2024. So in the current year, he is staying in India for how many days? For all 365 days. Therefore, he is resident. Is he ordinary? He is not ordinary because he came last year only to India. It is not possible for him to become ordinary resident, because to become an ordinary resident, he should be resident in at least 2 years out of last 10 years, and he should be in India for 730 days. That is not possible for him. Therefore, he is resident, but he is not an ordinary resident. He is a non-ordinary resident. Now, for resident and ordinary resident, which incomes are taxable? Only incomes which are accrued in India and only incomes which are received in India. Therefore, incomes which are accrued in India, received in India are taxable, and one more income is taxable for R and NOR, and that income is business income which is accrued outside India, but business is controlled from India or profession is set up in India. Those incomes are also taxable. Apart from that, all other incomes are not taxable. Therefore, he is earning some rental income from country X. That will not be taxable over here because he is earning in country X and it is received also in country X. Therefore, house property income will not be taxable in India. India. Apart from that, he is earning some business income from India. Yes, business income from India will be taxable in India, definitely. And apart from that, he has transferred some land in Indore. Now, when he has purchased that land, he has purchased that land in 18th of May 2022. Now, this part is the most important part of the question. And he has sold on 23rd December 2024, Mr. Sarthak, for 80 lakh rupees. Now, he's purchased the land for how much? 30 lakh rupees. He's selling the land for how much? 80 lakh rupees. Now, he's selling after how many months? He's selling after 24 months. Therefore, the long-term capital gains will be 50 lakh rupees. Now, he has two options. Either he can take indexation or he may not take indexation. Why, sir? Because the asset, because Mr. Sarthak is a resident. Is his name Manan? Sorry, not Sarthak, Manan. His name is Manan. Manan is a resident. Second, Manan has purchased immobile property, land and building before 23rd July. Manan is selling immobile property after 23rd July. And Manan is selling a property which is a long-term capital asset. Therefore, he has two options. He can take with indexation, without indexation. If he takes indexation, then he has to pay 20% tax. If he do not take indexation, then he has to pay 12.5% tax. So remember, all these RTPs which they have made now, latest RTP, all the latest RTP questions are based on generally the latest amendments made by the Finance Act 2024. So in this case, on this 50 lakh rupees, if you take indexation, then obviously the gain will reduce. If you do not take indexation, then the gain will be 12.5 lakhs. According to that, the total income will also change. But this business income will remain same, 12 lakh 50. So on long-term capital gains, you see whether whichever is more beneficial, you have to go for that. But on business income, you will be applying what? The slab rates only. I hope it is clear to all of you. Now, all these exchange rates are of no use. This indexation will be useful to you to claim the indexation in respect of what? Long-term capital gains. I hope it is clear to all of you. Then you compute the tax liability of Manan. This is a very, very simple question, but it was based on amendment. Now, one last question, question number 22 over here, that will complete all our 9 RTP compilation in full English. Now, Triveni Cement Limited is an Indian company. Its head office is at Chennai. Now, which furnish the following information of certain entities and the transaction undertaken with these entities. First of all, there is a company Drift Inc. which is in Japan, which is wholly owned foreign subsidiary of the Indian company TCL. Therefore, both of them are deemed to be associated. So, if one entity is a wholly owned subsidiary of another, then both of them are deemed to be associated. Now, it is currently paying $3 million to TCL. So, Drift is paying how much $1 million to TCL? 3 million. So, to us, they are paying 3 million royalty. But to others, they are paying 4 million royalty. So, to associate enterprise, they are paying less royalty. To others, they are paying more royalty. Therefore, the differential amount has to be added back. 1 million is nothing but 10 lakh dollars. Okay. So, 10 lakh dollars into 82 will come to 820 lakhs. This much will be added back to the income of the assessee. Now, the second question. There is another entity, Swift Dubai, and there is another entity, Indian company TCL. Okay. Now, TCL has borrowed a loan of 220 crore from Swift. And the book value of the assets of the TCL, you can check over here, is 330 lakhs. So how much loan we have taken? 220 crore. And what is the book value of our asset? It is 330 crores. So how much Swift is financing us? Swift is financing us 66.67%. Now, if one enterprise finances another enterprise at least 51% of the book value of the assets, then both of them are deemed to be associated. Therefore, Taylor and Swift are deemed to be associated. Now, very important point. How much interest we are paying to Swift? We are paying interest of 17.6 crore to Swift, which is 8%. How much interest we are paying to others? We are paying to others only how much? Only 7%. Okay. So only 7% we are paying. So to our associate enterprise, we are paying interest of 17.6 crore. That is 8%. To others, we are paying 7%. Therefore, 7% will amount to how much? It will amount to only 15.4 crore. So 15.4 crore is the correct arm's length price. But we are paying how much? 17.6 crore. Therefore, excess 2.2 crore has to be added back. So this will be added back to the income statement. I hope it is clear to all of you. And the third one, TCL supply goods to Truewords. So TCL supply goods to Truewords Limited. Now, the paid up capital of Truewords is 92 crores and our stake is 22 crore. So, if the other company's total paid up capital is 92 crore and our stake is 22 crore. Therefore, that amounts to how much percentage? 23.91%. So, that is less than 26%. Therefore, it is not possible that both of them are deemed to be associate enterprise. They are not associate enterprise. Therefore, transfer pricing provisions are not applicable in this case. I hope it is clear to all of you. So, this is what this compilation is all about. Today, I am going to compile the 9 exam papers of ICAI till November 2024. And we are going to compile them in a very comprehensive manner in around less than 3 hours or somewhere around 3 hours. So without wasting any further time, let's start with the compilation of the past papers of ICAI. Again, I am saying, believe me, these compilations are more important than anything available on the YouTube on my channel. Nothing can be more important than these compilations. You go through these compilations again and again and you'll be through with direct tax. Nothing can come beyond this in the CA final direct tax exams. And I'm taking an extra effort for you all. That is, I'm recording in Hindi also, and I'm also recording in full English for you all, so that the students who don't understand Hindi properly and who are more comfortable with full English can get the advantage of this particular compilation from my side. Okay. We have done all of them in our regular batch, in our exam oriented batch, in our practical question batch. We have done all these things, but the objective over here is to do it very fast so that on the day before examination, you are able to revise it very fast. So let us start with our first paper, that is Jan 2021. And the very first question over here is on total income question. And what is given over here? The last line of the question is you have to compute total income and tax payable. Compute total income and tax payable as per the provisions of the Income Tax Act. You are not supposed to follow 115BAA. You are supposed to follow what? Just total income and tax payable as per the normal provision. Let us start. The assessee is a manufacturer. The net profit of the assessee is 75 lakh rupees. Now the very first adjustment is till last year, that is till 23-24. The assessee used to make one mistake. What mistake? They used to include the interest cost in the closing stock. Now, which is not correct. As per ICDS, it is not correct. As per accounting standards, it is not correct. Till last year, company used to include the interest cost in the closing stock. But from the current year onwards, the company has changed that policy. Now, whatever mistakes they have done, they have rectified. If everything is rectified, nothing has to be done by us because the company itself has rectified in the current year. And if it is rectified, then no effect will come in our question. Okay. Second, provision for gratuity as per actuary is disallowed as per section 48(7). But whenever it is paid, whatever amount is paid, that is 1,20,000 is paid, will be allowed as deduction. Therefore, 5 lakh you will add back and 1,20,000 you will reduce. This will be the effect of this adjustment. We have done this adjustment a lot of time earlier also. Next, you are debiting some one-time franchise fee, which is paid to Mr. Robert. You have on 16th of August 2024, TDS etc. has been deducted. Now, franchise fee is nothing but what? It's an intangible asset. Therefore, you have to add back the intangible asset. You cannot debit the intangible asset. You have to claim depreciation on that 25%. So you will add back the one-time franchise fee, 20 lakh rupees, and you will reduce 25% depreciation. That is what? Whole year depreciation, because the franchise fee is used for more than 180 days in the previous year. Next one, there is some loss, cash lost due to theft when it was withdrawn from the bank. Okay, so cash lost by theft is nothing but a revenue loss. So you can claim that as a deduction under the income tax law. Okay. Next, you are on 1st December 2024, you have paid a royalty of 3 lakh rupees to Mr. Roger, a non-resident, on which you have deducted the TDS also, but you failed to deposit the TDS. You have deducted the TDS, but unfortunately you have not paid the TDS. But Mr. Roger, the non-resident, has included that in his income and has filed the return, etc. Still, do you remember that if I do not deduct TDS, I do not pay TDS, but the other person includes that in the income tax return, pays the tax, files the return, etc., then I am not assessee in default. Then I cannot be called as assessee in default. But in that case also, the expenditure will be disallowed in the current year and it will be allowed as deduction in the subsequent year only. In the current year, it cannot be allowed as deduction, and 100% expenditure will be disallowed because you are making payment to a non-resident. I hope it is clear to all of you. Now, coming to the next paragraph. Now, this is further information. Further information means it has not been given effect in the P&L. Okay. Till point number 5, everything was part of P&L. Either it was debited or credited in the P&L. But from here onwards, it's an independent discussion. First of all, you are selling some plot of land to a domestic company. Now, this is the same routine adjustment, 100% holding subsidiary. If transfers assets within themselves, then it is not taxable. It is exempt under section 47. The only condition is the recipient company has to be an Indian company. So here also it is same thing is happening. 100% holding subsidiaries transferring something to each other. The recipient is Indian company. Therefore, this is exempt under section 47. Okay. Now, you will not reduce this from P&L because this is extra information. Okay. Don't reduce this from P&L. If it would have been credited to P&L, we would have reduced from P&L. Now this amount is not credited to P&L, therefore don't reduce it from the P&L. Directly go to capital gains and write a note and say that this is exempt. Next, there is a private limited company by the name called as Manu Textile Limited. Now you have taken a loan from that particular company in which you have 16% voting rights. So a private company is nothing but a closely held company, and I hold 16% voting rights in that company. And if such company gives me a loan, that is deemed dividend in my hand under 222E. But the deemed dividend cannot be more than the accumulated profits. The accumulated profits are 2 lakh. Therefore, the deemed dividend will be restricted to 2 lakh rupees. This 2 lakh rupees will go to income from other source. I hope it is clear to all of you. Next, you have purchased a motor car for the purpose of business on 23rd of August 2019. The WDV of that motor car today is 12,80,000. You have not considered that depreciation in the P&L account. Now, do you remember that? If you purchase a motor vehicle from 23rd August 2019 to 31st March 2020 and put to use between that period, then you will get 15% extra depreciation. So in this case, you will get 30% depreciation instead of what? Instead of 15% depreciation. I hope it is clear to all of you. And last but not least, you have hired some employees, therefore you are eligible for 80JJAA. Now you are eligible for 80JJAA only if the number of employees, the strength of the employee increases. Now just see, at the beginning of the year, there were 480 employees. Then you hired 120 employees more. Then you removed 70 employees. Eventually at the end, there are 530 employees. So is the strength of the company increasing? The strength is increasing. Definitely increasing. Therefore, you are eligible for 80JJAA. Now, to claim 80JJAA, there are a lot of conditions you have to fulfill. First of all, the strength should increase. Second, the employee should participate in recognized provident fund. Are they participating in recognized provident fund? Yes, they are participating in recognized provident fund. Third, their emolument should not be more than 25,000 rupees. Is the emolument up to 25,000 rupees? Yes, it is just 15,000 rupees. Next, they should be recruited for at least 240 days in a previous year. So they are recruited on 1st July. So therefore 240 days will happen. Plus they should be paid the emolument by online modes. Yes, they are paid the emolument by account paycheck. Therefore it is online mode. Now the last thing is on how many employees you are going to get the deduction. So ICI has taken two views. First view ICI has taken is take the deduction on entire 120 employees which are hired. First, this is the first answer given by ICI. So 120 into 15,000 rupees into 9 months into 30%. Okay. Now the second answer given by the ICI is take the deduction only on the incremental employees. What is the incremental employees? You are hiring 120, you are firing 70. Therefore the incremental employees only 50. Take deduction on 50 employees. So that is the second answer given by ICI. Both the answers are correct. Nothing wrong in that. Last but not least, the turnover of the company of last year is 450 crore. Therefore, the tax rate of the company will be coming to how much? It will be 30%. I hope it is clear to all of you. Now let's move on to the next question. Question number 2. It's a beautiful question on non-resident taxation. First of all, there is a foreign company, Vioni Inc., which is incorporated in Japan. Now the company is foreign company. First of all, we need to find out its residential status, whether it is resident or non-resident. According to that, the answers will change completely. So Vioni is a foreign company which is incorporated in Japan. Now they are coming to India. In India for 3 times. Its shareholders met in India for 3 times. Now what is the reason they are meeting to India? Are they meeting for key management and commercial decision? No, they are meeting in India for modification of the rights of the shares, and they are meeting in India for what? Sale of company. Now if you are meeting in India for these purposes, the CBDT circular says that, the CBDT circular of POEM says that if you are coming to India for modification of the rights of the share, or if you are coming to India for sale of the company, that does not amount to what? Place of effective management. Therefore the place of effective management is not in India, it is outside India. Therefore the assessee is what? The assessee is a non-resident. According to that, you have to answer the entire question. Now the very first point over here is based on Vodafone case law. Dividend is declared by Miyani Inc. Miyani Inc. is also a Japan-based company. Okay. So how much? And Miyani Inc. holds 70% of the total assets in India. Now Miyani is giving dividend to whom? Dividend to us. Who are we? We are Vioni. We are Vioni, and we are receiving dividend from another foreign company. And that another foreign company holds 70% assets in India. So whether that dividend will be taxable in my hand? The answer is no. It is not taxable. Why, sir? Go and see the chapter of Vodafone case law in our book. Just take an example of Vodafone case law. CGP was located in Mauritius and HTIL was located in Hong Kong. Now, if CGP holds substantial assets in India, that does not mean that if CGP declares dividend to HTIL, then it is taxable in the hands of dividend. Such transactions are not taxable. It is exempt as per the CBDT circular of 2015. Therefore, only if you sell the shares of CGP, then it is taxable. If CGP declares dividend, then that dividend is not taxable in the hands of the foreign company or the non-resident. I hope it is clear to all of you. Go and check the Vodafone case law. Next one, Vioni Inc. is providing some technical services to Government of India. Vioni Inc. is providing some technical services to Government of India, and the Government of India is paying him what? Paying him FTS of 4,54,000 rupees. How much FTS is paid? 4,54,000 rupees. But the services which are given by Vioni Inc., those are utilized outside India. Does it matter? It doesn't matter. Still, it is accrued in India. If royalty, FTS or interest is payable by government, listen carefully. If royalty, FTS or interest is paid by government, then it is taxable in the hands of the non-resident, irrespective of where it is utilized. Whether it is utilized in India or whether it is utilized outside India, it doesn't matter. Yes, if the royalty, FTS and interest is paid by resident, then it matters. Then it has to be utilized in India. Otherwise, it won't be taxable. I hope it is clear to all of you. Therefore, in this case, it is taxable. One more important catch over here is it is received by VONE. This 4,54,000 is received by VONE. And what rate royalty is taxable? Royalty is taxable at generally 20% plus 4% cess, that is 20.8%. So this amount is after deducting the TDS because this is received. Therefore, this amount is 79.2%. Therefore, 100% is how much? We are making an assumption that we are not making any assumption. Sorry for that. Okay, I make that mistake again and again. Some people will have doubt. So there is no mention about agreement which is approved by central government. No, agreement which has approved by central government is not applicable to government. Government cannot approve its own agreement. That is only applicable for resident, not applicable for government. Therefore, in this case, this will come under 115A, and if it comes under 115A, this amount is received. Therefore, this will be 79.2%. 100% is how much? Third one, interest is received from unit located in IFSC in respect of money borrowed by MSSO. So, if any non-resident is giving loan to a unit of IFSC on or after 1st September 2019, then that interest is exempt in the hands of the non-resident. Therefore, here VONE INC is giving loan on or after 1st September 2019 to an unit of IFSC, and unit of IFSC is paying interest to whom? To the non-resident VONE INC. So, in the hands of VONE INC, it is exempt under the income tax law. And the next one is nothing but your grandfathering clause. Whenever 31st Jan 2018 will come, 100% is a grandfathering clause. The sale consideration is 89 rupees. What will be the cost of acquisition? The cost of acquisition will be the actual cost, that is 64 rupees. Compare with lower of 89 or 70, whichever is lower, and then compare with actual cost, whichever is higher. Okay, up to 1,25,000 will be exempt, and after that it will be taxable at 12.5%. Why 12.5%? Because you are selling on 26th of August 2024, which is on or after 23rd July 2024. I hope it is clear to all of you. Now, coming to the third question, which is on charitable trust. There is a charitable trust which is following accrual system registered under 12AB. Let's compute the income of the charitable trust. We need to compute the total income and the tax liability of the charitable trust. Let's start. First of all, gross receipt. How much is the gross receipt? 24,41,000. Start taking in the calculator. Then voluntary contribution, including anonymous donation. Don't take anonymous donation. Anonymous donations are separately taxable. So exclude anonymous donation. So the total donation is 520, out of which anonymous donation is 1,85,000. Therefore, take 3,35,000. Voluntary donations are taxable. Then dividend from Indian company taxable. Income from mutual fund taxable. And last one, agriculture income is not taxable. Now, these four things are taxable in the hands of the trust. Wait, take these four things. Don't take 5,20,000, take only 3,35,000. Now let's talk about anonymous donation. How much is anonymous donation? It is 1,85,000. Now out of 1,85,000, how much anonymous donation is exempt? As per 115 BBC, out of 1,85,000, the exemption will be higher of 1 lakh rupees or 5% of total donation, whichever is higher. So 1 lakh or 5% of 5,20,000, whichever is higher, will come to 1 lakh only. Therefore, out of this 1 lakh will be exempt, and 85,000 will be taxable at how much? At 30%. So 85,000 will be flat taxable at 30%. And remaining with this 1 lakh rupees, listen carefully, this is the catch. This 1 lakh rupees now you will add to the normal income statement. So the four items which you have taken in the calculator, in that you will take this 1 lakh rupees also. So this is how you treat the exempt anonymous donation. The taxable anonymous donation will be taxed at 30%. The exempt anonymous donation will be added to the income statement. Add that to the income statement, and then 85,000 will be added at the end, and it will be taxable at 30%. And this 1 lakh will be treated like a voluntary donation. Add that to the normal income statement. Take the total, then take 15% flat exemption, and then take all the application. First of all, you are applying the money. You are setting aside the money for the next 4 years. So you can accumulate the money for 5 years, and you can take the exemption. So you can take the exemption of this 2,54,000 rupees. Second, you are making payment to one of the trustee of 1,47,000. The market value is 2,50,000. So you cannot pay more to trustee, but you can pay less to trustee. You are not paying more to trustee. The market value is 2,50,000. You are paying only 1,47,000. Therefore, this 1,47,000 will also be allowed as deduction. Then during the year, you can make the payment to. You have made the payment to some foreign teachers. Then that can also be claimed as an application, and other expenses that can also be claimed as application. After that, your total income is coming to how much? 8,9,54,850 rupees. Out of that, 85,000 will be taxed at flat 30%, and remaining 869,850 will be taxable at slab rates. Slab rates, trusts are always chargeable at slab rates. I can follow old regime, new regime, whichever I want to follow. But this paper is a very old paper of 2021. So in that time, the new regime was not there, only old regime was there. Therefore, this question I'm solving as per old regime. In exam, you can do both of them. Okay. So therefore, the remaining 869, you will apply what? You will apply your slab rates as per old regime in my question. You can follow new regime also if you want. Okay. I hope it is clear to all of you. Now, coming to the next question, which is a very simple question on DTAA. I'm not wasting much time in that. The only thing that I would like to say in this, the assessee is a resident, age is 65 years. Therefore, assessee will be eligible for what? First of all, 80 TTB of 50,000 rupees. Second, assessee is earning some royalty on books. Therefore, assessee will also be eligible for 80 QQB. I hope it is clear to all of you. Let's move on to the next question, that is on TDS. We need to explain whether the TDS will be deducted in the following case or not. First of all, there is a company by the name called as Mexcel Limited, which is engaged in business of manufacturing. Now, it is taking some bank guarantee from a bank, and for that, it is paying some commission to the bank. So, if I am taking some bank guarantee from the bank and if I am paying some commission to the bank, then TDS is not applicable on the commission paid to the bank on bank guarantee as per CBDT circular. Therefore, no TDS if paid to bank as a bank guarantee commission. I hope it is clear to all of you. Now, the second question has two views over here. There is a non-resident, Mr. Monty, which is providing some web-based lecture to a study card, a trust registered in India. So the non-resident is outside India and study card is a registered trust in India. So the non-resident is providing some web-based lecture to us and we are paying them 98,000 rupees as a fee for that. Now whether TDS will be deducted or not. So in that we have to take two views over here. If we assume that the web-based lecture which is provided by the non-resident, it is in the nature of FTS, fees for technical service, then TDS will be deducted, because for fees of technical services, there is no need to have a permanent establishment or business connection in India. But if we assume that this is not FTS, it's a normal business income earned by that non-resident Mr. Monty, then there has to be a PA in India to make it taxable. So if there is no PA in India, then it cannot be taxed in India. Therefore, TDS will also not be applicable in that particular case. So everything will depend upon whether the non-resident has a PA in India or it does not have a PA in India. So if it is FTS, then there is no need to have PE, deduct TDS. It is taxable. If it is not FTS, it is normal business income, then it cannot be taxed without a permanent establishment in India. Next one. Mr. Nitin is an individual resident whose last year turnover is 97 lakh. 97 lakh is the last year turnover. And it is making some payment for contract. That is for repair of his office building of 65 lakh rupees. So if I am an individual and if my last year turnover is less than is up to 1 crore rupees, it is less than equal to 1 crore rupees, 194C will not be applicable to me. So if 194C is not applicable, can I apply 194M? Yes, I can apply 194M in this case because 194C is not applicable and the payment is also more than 50 lakh rupees. Therefore, 194M will apply over here. That is 2% TDS will be attracted on the amount of 65 lakh rupees. I hope it is clear to all of you. Next one, if an airline company makes a payment of 10 lakh rupees to Airport Authority of India, the TDS is deducted under which section? So as per this, the TDS is deducted under 194C as per the Supreme Court judgment of Japan Airlines Limited. So if an airline company is making some payment to Airport Authority of India, TDS is deducted under 194C at the rate of 2% or 1% as the case may be. Next one is a transfer pricing question. Vihan Limited is an Indian company and Yuan Limited is a foreign company. Now, Vihan has given a loan of how much? Has given a loan of 6 crore rupees to whom? To Yuan, and the book value of assets of the Yuan is 4 crore rupees. So I am giving you a loan of 6 crore and your book value of asset is 4 crore. It means I am financing you 150% of your book value of assets. Okay. Therefore, we both are deemed to be associate enterprise. We both are what? Deemed to be associate enterprise. Because to become associate enterprise, there is a need of only 51% of the book value of the other company should be financed by me. If I finance 51% of the book value of your company, then we both are deemed to be associate enterprise. Then they have put 2 points over here to confuse us. They are saying that the market value has changed. It doesn't matter. We don't compare market value, we compare book value. Then they say that the entire loan along with interest is paid on 31st of August 2023. It doesn't matter. Whether you pay the loan or whether you don't pay the loan, it doesn't matter. It doesn't matter. It doesn't matter. What matters is your loan should be outstanding at any point of time in the entire year. If it is 51%, then we both are deemed to be associate enterprise. If at any point, even if on a single day in the entire year, I am financing you 51% of the total book value of the assets, then we both are deemed to be associate enterprise. Now, so that is the first part of the question. Would Vihan and Yuan be treated as associate enterprise? Yes, definitely yes. Why? Because of the 51%. Now, whether the transfer pricing will apply over here? Yes, transfer pricing will apply. Now, Vihan is selling some units of 7,400 per unit, whereas to others, the same units are sold for 9,000 rupees or 9,500. To unrelated party, it is sold for 9,000 and 9,500. So how many samples we have? We have two samples. To a source enterprise, we are selling at 7,400. To outsiders, we are selling at 9,000 and 9,500, which is higher than the amount received from a source enterprise. Therefore, transfer pricing will apply over here. Now, can I follow range concept? No, range concept is followed only if there are at least 6 items. If there are less than 6 items, you have to take arithmetic mean of this. Now, what is arithmetic mean of 9,500 and 9,000? It is 9250. Therefore, this will become your arm's length price. Okay. In this also, you have to check this 9250 and compare this with actual price 7,400. If there is at least a gap of 3%, if there is at least a gap of 3%, transfer pricing will apply in this case, and your arm's length price will be 9250 rupees. Now, how much income will be added? So 9250 will be arm's length price. Your actual price is 7,400. Take a difference of both of them into 20,000 medical equipment. That will come to somewhere around 3.7 crore. That will become your primary adjustment. And what has to be done with that primary adjustment? What has to be done in respect of such transfer price by the income tax authorities? You have to bring back that money in India within 90 days. Within 90 days from where? From the due date of filing of return, or if the department is increasing the amount, then within 90 days from the date on which the AO has passed the order. If you don't bring back that money in India within 90 days, then there will be secondary adjustment. There will be interest on you. Then one more option is there, that I can pay one time additional tax of 20.9664, and then the secondary adjustment will be closed after that. So all these options which we have done earlier also, you have to mention all these things over here. I hope it is clear to all of you. Now, question number 5 is a question on case law. Let's see, the first case law over here is, the High Court has passed an order. Now in the order, the High Court has made some apparent mistake. The question is, can High Court recall its own order to rectify its apparent mistake? The answer is yes. If the High Court passes an order in which there is an apparent mistake, the High Court has an authority to call the order and rectify its own mistake. This is what it is given in the first question. Second question is based on Ace Builders Limited. That is, if there is a short-term capital in the block of asset, can I save that short-term capital gains by investing in 54EC bonds? Because 54EC says that the asset has to be long-term capital asset. Absolutely correct. The nature of asset is important. The nature of gain is not important. If I purchase a building 10 years back, in a block of asset, the 10 years old building will be called as a long-term asset. The gain will be called as short-term, but the asset is not short-term. The asset is long-term. Therefore, I can take the advantage of 54EC over here. I hope it is clear to all of you. Next one. What is the next point over here? You have to compute the income and the tax payable of what? Of a cooperative society. So we have to compute the income and tax payable of a cooperative society. Let's start over here. Let's start computing the income and the tax payable of cooperative society. A cooperative society is engaged in providing credit facility to its member. So if a cooperative society is engaged in providing credit facility to its member, it is eligible for provisions of ATP. ATP is eligible to the cooperative society. Now, ATP deduction is available under Chapter 6A, profit link deduction. First, interest received from other cooperative society. Yes, it is deductible under ATP. Second, interest received from members. Yes, that is also deductible under ATP. Rent received, no, that is not deductible under ATP, but this rent is taxable, but on that you will get 30% standard deduction, the way everybody gets. Income from agency business, that is also taxable. Income from interest received from deposit idle funds of members, yes, that is also available as a deduction under ATP. Expenses on agency, yes, you can claim that as an expense, and the losses of earlier year, you can claim that also as a deduction. Okay. After that, you will compute the total income, gross total income, and from that you will take 50,000 rupees as a general deduction. We all know that consumer cooperative society gets a deduction of 1 lakh rupees and a normal cooperative society gets a deduction of 50,000 against the PGBP income. So this 50,000 is available against what? It is available against the agency business. Okay, against the agency business you can claim 50,000 deduction in Chapter 6A under ATP. After that you will compute the tax of the trust, okay, or tax of the cooperative society. What is the tax of the cooperative society? It is nothing but slab rate. Up to 10,000 10%, about 10,000 20%, about 20,000 30%, then apply surcharge if applicable and cess. I know that the cooperative society is also eligible for 115 BAD, BAE, but I am not considering all those things over here. If in the exam they ask us to compute as per 115 BAD, BAE, which we have done also in RTP session, go and check that, in which there was ATP, there was ATJJAA also. We have computed as per normal provision, as per AMT also, as per 115 BAD also. We have done all those things in one of the question. You can go and check that question. I hope it is clear to all of you. And one last question in this particular paper is, the AO has initiated a penalty proceeding under 270A. Now, is there any way that I can get escape from this penalty under 270A? Okay. Yes, there is a possibility that you can get escape from this penalty of 270A. You can get escape from the prosecution at 276C. The provisions of 270AA has to be fulfilled. In 270AA, what are you supposed to do? First of all, you have to make an application to the assessing officer within 1 month. Then you have to pay the tax and interest as per the notice of demand within 30 days. And then you should not appeal against this order. Against this order of 147, you should not appeal. Then the AO will AO will what? AO will give you immunity from penalty under 270A. But this immunity is only available for under-reporting cases. It is not available for misreporting cases of 200%. You will not get immunity from all these cases of 200% which are given over here. I hope it is clear to all of you. So let's go ahead with the next paper, that is July 2021. The very first question is on total income. That is, they have asked us to compute total income. Only total income, no tax liability. Ignore MAT, ignore 115 BAA. Okay, let us start with the question. The assessee is a manufacturer of iron and steel. The profit is 1000 lakh. The first adjustment is depreciation as per books of accounts that you will add back. Okay. The second adjustment is you have paid some 50 lakh rupees to a scientific research association, and this scientific research association, if you make any payment to a scientific research association, that is allowed as a deduction under the income tax law. And related to this point, there is one adjustment which is given in the last line, which is given over here in point number F, that the recognition which was granted to the scientific research association, which was withdrawn later on. So will that impact your deduction? Suppose if I make you a donation of 1 lakh rupees as a scientific research donation, and later on if your approval is withdrawn, will that affect my donation? And the answer is no, it will still be allowed to you. Don't worry about it. Okay. Now the next one is the most important adjustment of this particular question. The assessee has taken a loan of 350 lakh rupees on 1st of May 2024 for 8%. Therefore the total interest of the entire year will come to 350 lakhs into 8% into 11 months. That will come to 25.67 lakhs. Now this loan is taken for the purpose of purchasing a plant and machinery. Now listen carefully. You have paid the interest on 1st of November 2025. Therefore, first of all, let me give you step by step the treatment. 350 lakhs into 8% into 11 divided by 12, that will be 25.67 lakhs. First of all, add back that entirely. Entire disallow entirely. Okay. Now out of that, when have you purchased the machinery? You have purchased the machinery. You can come below on the next line, on the next paragraph, that is additions over here. You have purchased the machinery of 500 lakhs and you have put to use from 1st of Feb. So from May till 31st of Jan, the machinery was not put to use. So from May to 31st of Jan, which is 9 months, 9 months interest will be capitalized and 2 months interest can be allowed as a revenue expense. Therefore, first of all, capitalize 9 month interest and claim depreciation on that. What about 2 months interest? 2 months interest will not be allowed as deduction. Why? It cannot be allowed as deduction. It cannot be allowed as a revenue expense because you have not paid up to the due date of filing of return. You can check in adjustment number 3 over here. You are paying this after the due date of filing of return. So therefore, this 2 months interest will be disallowed in your hands, and this 9 months interest will be capitalized to the cost of asset. So to sir, for capitalizing, is it not necessary to pay the interest on time? No. For capitalizing the interest, it is not necessary to pay the interest on time. The 43B is only applicable for revenue expense. It is not applicable for capitalization of the expense. I hope it is clear to all of you. Similarly, next adjustment, you are paying some 100 lakh rupees to foreign technician for installation of the machinery without deduction of TDS. So first of all, disallow that. It cannot be allowed as a PGBP expense. You have to capitalize this 100 lakhs to the cost of the machinery. So you will add back this 100 lakhs to the cost of machinery, claim depreciation and additional depreciation on the same. Again, no TDS is required to be deducted for capitalization. TDS is required to be deducted on revenue expense, not on capitalization of the expense. Next one, you are incurring some general expenses for bringing water in the factory, so that is allowed as a normal business expense. Next, donation, you are giving 10 lakhs to a political party, so that will be disallowed under PGBP, and under 80 GGB you can claim because you are following the normal regime. If you would follow 115 BAA BAB, then it will not be allowed. In 115 BAA BAB, 80 GGB is not allowed. Plus, we are making an assumption that it is allowed only if it is paid other than cash. If it is paid in cash, then it will not be allowed as deduction. Next one, you are purchasing some coal etc. of 25 lakh rupees. Unfortunately, invoice is not available, but you have indirect evidences like indirect evidences of general inward report, that is GIR. You also have the payment evidence. Online payment has been made. You have that evidence also. So is this sufficient to claim deduction? Yes, it is sufficient to claim deduction. There is no need to have invoice. GIR or online payment evidence is sufficient enough to claim the deduction. Next adjustment we have done earlier also. There was a party that is Mrs. A company engineer, to whom we have sold some goods of 20 lakh rupees. See on the board. So we have sold some goods of 20 lakh rupees. Then out of that 10 lakh has become bad debt. So how much is recoverable now? Now the debtor is only 10 lakh. Now the assessee is dead. It means the debtor is dead. Now the debtor has died. Due to his demise, we could only collect 7 lakh rupees. So after how much we were supposed to collect? The outstanding amount was 10 lakh. But how much we have collected? Only 7 lakh. Now unfortunately we have credited that 7 lakh to the statement of P&L account, which is absolutely correct. Why the hell you have to credit that that to P&L account once again. Is that 10 lakh not included in this 20 lakh? Definitely it is included in this 20 lakh. Now you want to again credit that to 7 lakh to the P&L account. Why do you want to do that? That is wrong. So first of all, reduce this 7 lakh from the P&L, otherwise it will lead to double taxation. Now how much you are supposed to recover after the demise? 10 lakh rupees. But how much you have recovered? Only 7 lakh. So 3 lakh rupees have now become bad debt. So reduce that 3 lakh also. So and write off this debt 10 lakh rupees. Okay. I hope it is clear to all of you. Last but not least, there are some opening WDV of the assets on 1/4/2024. We have to claim depreciation on that. On factory building, you will claim 10%. On computer, 40%. On office appliance, 15%. Tractor, be very careful. Tractor, it is 15%, but this tractor is not normal tractor. It is used within the factory. It is like a forklift truck, and therefore if it is purchased in the current year, then you can also claim additional depreciation on the same. I'm not talking about additional depreciation on the opening WDV, but if it is purchased in the current year, you can claim additional depreciation also on the same, because it's not a motor vehicle, it's a forklift truck which is used within the factory. Next, plant and machinery, 15%. Then some additions are made. Factory building, put to use from 1st November, therefore claim 50%, that is 5% of 5%, not 10%. Computer, put to use from 1st of May, 40%. Now tractor, put to use on 1st of August, so claim 15% normal depreciation, additional depreciation 20%. Another tractor, put to use on what? On 1st of Feb, claim 7.5% normal depreciation and additional depreciation of 10%. Okay, I hope it is clear to all of you. And last but not least, plant and machinery of 500 lakhs, on which you will capitalize foreign technician salary for installation of machinery, 100 lakhs, and 21 lakh rupees the interest capitalization, total 621 lakhs. Machinery is put to use from 1st of Feb, therefore only 50% depreciation will be allowed, and additional depreciation will also be only 50%, 7.5% and 10%, as the case may be. Last but not least, you have incurred some expenses on obtaining ISO 9000 certificate, and you have shown that as an asset. So expense incurred for ISO 9001 certificate is considered to be a revenue expense. It is not considered to be a capital expenditure. This is what this question is all about. I hope it is clear to all of you. Let's go on to the next question. Question number 2 has 2 parts. The first part is talking about 3 different issues. There are 3 issues covered in this particular part. There is a partnership firm by the name called as AN Company. The return was filed by the SSE and the case was selected for the scrutiny. And now the AO has raised 3 questions over here. Question number 1. Can you get the deduction of bad debts if you cannot prove the bad debts? So if you cannot prove the bad debts, can you still claim the deduction of bad debt? The answer is yes. It is not necessary to establish the fact that the debt has become bad. It is not necessary to prove that the debt has become bad. The only condition to claim bad debts under section 36 of section 1 clause 7 is you have to write off that in the books of accounts. If you write off that in the books of accounts, you can claim the deduction as bad debt. So this is the first issue which is covered over here. The second issue is you have incurred some repairs and maintenance which are booked on estimated basis. Can you claim the repairs and maintenance on estimated basis? See, the repairs and maintenance of plant, machinery and furniture is given under section 31, and it says that if it is a current repair, then it is allowed. If it is not a current repair, then it is not allowed. So it all depends upon whether you are able to prove that whether it is current repair or not. If you are able to prove to the AO that it is current repair, it is allowed. If you are not able to prove to the AO that it is current repair, then it won't be allowed to you as a deduction. Then the third issue is the most important issue of this particular question, that is, can a partnership firm become a partner in a partnership firm? For example, there is a partnership firm and in which there are a lot of partners. Can a partnership firm become a partner in the partnership firm? On this issue, the Supreme Court of India has held that the partnership firm cannot become a partner in the partnership firm. Why? Because a partnership firm is not considered to be a legal partner. Partnership firm is not considered to be a legal entity in India and across the world. What is partnership firm? Yeah, there is a partnership firm and there are partners. Is there management and ownership different from each other? No. The partners itself are controlling the entire firm. The firm is controlled by the partners only. There is no legal entity, separate entity between partnership firm and partners. Therefore, partnership firm is not considered to be a legal entity, a legal person, and someone who is not considered to be a legal person cannot become a partner in a partnership firm. Yes, a company can become a partner in a partnership firm because company is a legal entity, but a partnership firm cannot become a partner in another firm. Therefore, the AO has treated the partnership firm as what? As AOP, and all the provisions of AOP has applied on the assessee rather than the partnership firm. I hope it is clear to all of you. Let's move on to the next question. It's a beautiful question on DTAA. Let me read the question first of all and give you a brief idea about what exactly is happening in this question. There is a person, Mr. Ram, who is a citizen of USA. He is residing in USA since 2008. He is a non-resident since 2008-9 assessment year. Now he works for a US company, ex-INC. Now he came to India in the last year on 10th of Jan 2024 to visit his aged parents. Now he could return back to USA only by 31st of Jan 2025. So he stayed back in India for almost a year. Okay. Now till the time time he was in India, he was doing work from home in India because he is working in a US company. So when he came to India to visit his aged parents, he took a permission from the company to work from home in India. Okay. Now, first thing we need to understand what is the residential status of this person. To understand the residential status of this person, we need to understand for how many days he is residing in India. He is residing in India for 306 days. How? From 1st April 2024 to 31st of Jan 2025. He is staying in India. Therefore, he is staying in India for 306 days. Therefore, he is a resident in India. Is he an ordinary resident or not ordinary? Not ordinary. Obviously not ordinary, because in the last 10 years, he was not staying in India. In the last 7 years, his 730 days stay is not possible because he came in India after 15-20 years on what? On 10th of Jan 2024. Therefore, 730 days, all those criteria cannot be fulfilled. Therefore, he is resident and not ordinary resident. Now, please tell me, all of you, what is the residential? What is the criteria for taxability for resident and not ordinary resident? A resident and not ordinary resident will be liable for two incomes in India. One, if an income is accrued in India, or if an income is received in India, and one more income, if a business income is accrued outside India but it is controlled from India, then that income is also taxable in the hands of R and NOR. So therefore, the very first income which will be taxable in India will be his salary income for 10 months from April 24 to Jan 25, when he was staying in India, when he was doing work from home in India. At that time, he was rendering the services in India. Therefore, that salary is accrued in India. Now, how much salary is earning every month? In every month, he is earning $6,250. These are all figure in dollars. I have to convert that into rupees. How to convert a foreign income into Indian income? You have to convert a foreign income into Indian income as per Rule 115. Sir, one more thing I would like to ask, sir. Will he not get an exemption under Section 10(6), sir? If a foreign enterprise send a foreign citizen for some work in India, then the remuneration given to that employee is exempt. Yes, it is exempt, but only if the foreign employees come to India up to 90 days. Now, this person, Mr. Ram, is not coming to India for 90 days. He is coming for 10 months. Therefore, his income will not be exempt under Section 10(6). Otherwise, if he would have come for 90 days, his salary would have been exempted in India. But in this case, the salary would not be exempt. I hope it is clear to all of you. Now, coming back to discussion, how to convert this dollar into rupees. You have to apply Rule 115. What is Rule 115? Rule 115 says that the salary income has to be converted as per TTBR of the last day of the preceding month. So, therefore, if you see the TTBR, everywhere it is 72 only. Therefore, it is good for us. If it would have been different every month, then we need to make multiple calculation. Now, because it is 72 for the entire year, it is same only for the entire year. We don't have to do multiple calculation. Do one single calculation. $6250 into how many months? Into 10 months. Into what? Into 72. That will be your gross salary. From that, you claim 75,000 standard deduction, because the SSC is following new regime as per 115 BAC subsection 1A. Therefore, 75,000 standard deduction you can claim, and that will be your net salary. Okay. Now, apart from that, he is also earning some interest from a fixed deposit in USA. Will that be taxable in India? That will not be taxable in India, because for NOR, if an income is accrued outside India and if it is received outside India, then it is not taxable. This interest is accrued outside India. It is received outside India. Therefore, this interest will not be taxable. Therefore, the only income which will be taxable is salary income. That is 44,25,000. On that, you will apply the tax rates, new tax rates as per 115 BAC. That is a new regime, and the tax will come to 10,58,200. Now, from this tax, this is an Indian tax. From this tax, he will get some DTAA relief. How much DTAA relief he is going to get? As per Article 2 of DTAA, between India and USA, the taxes covered for credit are federal income tax paid by Internal Revenue Code. Internal Revenue Code is the law of the United States, but excluding Social Security tax. So you are going to get credit only on what? Only on the federal tax. You are not going to get credit on Social Security tax. You are not going to get credit on state tax. Now, how much credit will be available? Credit will be the tax paid in foreign country or tax paid in India, whichever is lower. Okay. Now, there are two assumptions taken by ICI over here. First assumption they have taken over here is that federal tax does not include Social Security tax. It means this 1600 does not include this 420. The second assumption taken by ICI, the federal tax includes this 420. If this includes 420, then we have to reduce 420 from everywhere. Okay. So according to both the assumptions, we need to solve this question. What is the first assumption? Federal tax does not include Social Security tax. If federal tax does not include Social Security tax, it means you will get the credit of entire 1600. Now every month you are paying $1,600 as tax. How to convert that into rupees? Now you have to apply Rule 128. Remember, to convert FTC, foreign tax credit, you need to apply 128, and to convert foreign income, you have to apply Rule 115. This rule also says the same thing. You have to take the TTBR of the last day of the preceding month. What is the TTBR of the last day of the preceding month? It is 72. Therefore, Therefore 1600 into 72 into 10 months. That will be the amount of tax which will be allowed as credit. Compare with Indian tax, whichever is lower. Whichever is lower will be allowed as deduction. And in this case, Indian tax is coming lower. Therefore, this will be allowed as credit, and therefore your tax liability in this case will be 0 rupees. And if your tax liability is 0, and if you are filing a late return in this case, you are filing the return on 21st of August, you should file the return by 31st of July. Even though you are filing a late return, you will not be liable for any interest over here under 234A because your tax liability is nil. Now the second assumption is if the federal tax includes social security tax. If the federal tax includes social security tax, then from 1600 you have to reduce 420. Then 1600 minus 420, whatever answer will come, multiplied by 10 into 72, that will be your amount of tax. Now this is the foreign tax. What is the Indian tax? Indian tax is 1058. Therefore you will get a credit of how much? 849,600. The balance you have to pay out of your pocket, and if you have to pay out of your pocket, you also have to pay the interest at the rate of 1% because now there is some payable which is coming, and if you are filing a late return, then you have to pay the interest on that 1% interest for the month of August because you are dealing by 1 month. I hope it is clear to all of you. Last but not least, if you want the FTC, that is the tax which is paid in the foreign country, you have to fill a form. Some form number 67 etc. is there by the end of the relevant assessment year, stating the statement of income, what is the income earned in the foreign country and what is the nature of that income, amount of tax deducted and paid in the foreign country. All those details have to be given to the government of India by 31st of March 2026. I hope it is clear to all of you. Let's move on to the next question. That is question number 3, which is on investment fund. Now there is an investment fund which is AIF, in which there are 20 resident unit holders. All of them are holding 5 units each. So if there are 20 unit holders, all of them are holding 5 units each, it means the total units are 100. 100 is the total number of units which is issued by the fund. Now out of which out of 20 unit holders, 16 unit holders are holding units for more than 12 months and 4 unit holders are holding units for less than 12 months. It means 80% of the unit holders are holding units for more than 12 months, because out of 20, if 16 unit holders are holding units for more than 12 months, it means 80% of the unit holders are holding units for more than 12 months and 20% of the unit holders are holding units for less than 12 months. Okay, so this is the breakup which I have done over here. Now pay attention please all of you. The very first point, business income. Who will pay tax on business income? On business income, the AIF will pay tax, the fund will pay tax, and for investor it is exempt. Long-term capital loss. Who will set off long-term capital loss? First, fund will set off the loss. If the fund does not have a long-term capital gains, then the fund will transfer that loss to the investor, but only to those investors who hold the units for more than 12 months. The losses cannot be given, the capital loss cannot be given to the investors if it is for less than 12 months. So how many unit holders are holding the units for more than 12 months? 80% of the units holders are holding the units for more than 12 months. So therefore, out of this 30 lakh rupees, 80% will be passed on to the unit holders. That is to those 80% unit holders who are holding the units for more than 12 months. Therefore, out of 30 lakh, 24 lakhs will be passed on to the investor. Third, other source, the fund will not pay tax, the investor will pay tax on the other source. Last line they are asking, will your answer change? What will be your implication if the fund distribute only 80% of its income to the unit holder? It doesn't matter. In AIF, there is a concept of deemed credit. It means if an AIF earns 100 rupees and if an AIF distributes 100 rupees, then also 100 rupees is taxable. And if an AIF fund earns 100 rupees and distribute only 80 rupees, then also entire 100 rupees is taxable in the hands of unit holders. So there is a concept of deemed credit over here. So the answer will not change. Last question over here is in this particular paper is on TDS. So there is an infrastructure debt fund which is making some payment of interest to a foreign company, a non-resident. So if an infrastructure debt fund is making some payment to the foreign company, a non-resident, then the infrastructure debt fund will deduct TDS under section 194 ILB at the rate of 5% plus 4% cess, and the deduction of expenses will not be allowed to the non-resident. It is grossly taxable. Entire 4.5 lakhs will be taxable at 5.2%, including the cess. If the other person is located in an NJA, it is located in notified jurisdictional area, then in that case, the infrastructure debt fund has to deduct TDS at 31.2%, 30% tax plus 4% cess as per section 94A. There is a stricter TDS provision for people who are staying in NJA. I hope it is clear to all of you. Next question. On 17th of June 2024, a commission of 40,000 is retained by consignee. If a consignee retains a commission, whether a TDS under 194H, which is for commission, is applicable for retention of commission also? The answer is yes. TDS under 194H is also applicable for retention of commission. Therefore, if the consignee is retaining the commission, on that also TDS will be applicable under 194H. The TDS over here will be 5%. Up to 30th September, the TDS rate is 5%. After 30th September, from 1st October, the amendment has come that it will become 2%. But this is before 30th September, so we are taking 5%. Plus the threshold is also crossing. The threshold under 194H is 15,000. You are making a payment of 40,000. Therefore, TDS of 5% is applicable. Next, an employee is there who joined in 2021 and resigned in 2025. So in 4 years, he resigned from the company and he has withdrawn 80,000 from his employee provident fund account and he has given PAN to the company. So if an employee joins the company and if he retires, if he leaves the company within 5 years, then if he withdraws the PF, then that PF is taxable in his hand. If he withdraws after 5 years, then it is not taxable. But if he withdraws within 5 years, then it is taxable. And if it is taxable, the company will deduct TDS under 194A. If it is taxable, only then the company will deduct TDS under 194A. That too, if the amount paid is more than or equal to 50,000 rupees. So in this case, the employee is retiring within 5 years. The amount paid is more than or equal to 50,000 rupees. Therefore, the company will deduct TDS at the rate of 10%. Next one, if I am purchasing a flat for 48 lakh rupees, on that I am paying some 22 lakh rupees for car parking and 1 lakh rupees for club membership fees. For determining whether TDS is applicable or not, should I aggregate everything and check whether 50 lakh is crossing or not, or I should only check 48 lakhs? The answer is you should aggregate everything. You should aggregate the consideration. The consideration will include car parking fee also, membership fee also, other charges also in relation to transfer of property. If everything total is crossing 50 lakh or more, you have to deduct TDS at the rate of 1%. So this is what this question is all about. So let's move on to the next paper now, December 2021. First of all, you will ask me what kind of attempt is this, sir? Jan 21, July 21, December 21. So in the year 2021, there was COVID. Because of that, the ICI used to conduct exams randomly whenever there was no COVID. Because in May 2021, there was a COVID. Therefore, they have not conducted in May. Instead of that, they have conducted in July and they have conducted in December 21. So that is the reason you will find out such kind of attempts over here. Now, let's come to the question number one. Question number one, year over year is about total income. We need to compute total income and tax payable, and we need to compute total income and tax payable as per what? As per 115 BAB. Okay, so according to that, you need to answer this particular paper. Assessee is a manufacturer engaged in leather manufacturing. Remember, if an assessee is engaged in leather manufacturing, if an assessee is engaged in footwear manufacturing or apparel manufacturing, then in 80 JJAA you have to employ the employees only for 150 days instead of 240 days. Generally, if you want 80 JJAA deduction, you have to employ for 240 days. But in these three cases, in these three business, only 150 days is sufficient. So let's start with the first adjustment. The net profit is 1 crore 20 lakh. The opening stock is overvalued by 10%. So if the opening stock is overvalued by 10%, therefore 55 lakhs is 110%. Therefore 10% is how much? Cross multiply and add back that much amount. Okay. Similarly, closing stock is overvalued. It is undervalued by 10%. So if closing stock is 54 lakhs, it is undervalued by 10%. It means closing stock is 90%. Therefore, do backward calculation, find out that 10% amount and again add back. If the opening stock is what? If the opening stock is overvalued, it means you have claimed more deduction, so add back. If the closing stock is undervalued, you are showing less income, again add back. So in both the case, you have to add back only. I hope it is clear to all of you. Now next adjustment, you are paying 10 lakh rupees to a foreign person, non-resident, to a non-resident person, Mr. John, a citizen of USA. You are not deducting his TDS. What he has done for you, he has procured order for you outside India. So if a non-resident is procuring order outside India for me, then that his income is not accrued in India. And if his income is not accrued in India, the question of deducting TDS does not arise. Therefore, if I have not deducted the TDS, I am absolutely fine. I am not doing anything wrong. Therefore, this expenditure should be allowed to me even without deduction of TDS. I hope it is clear to all of you. Next, you are paying your employee Raj 45,000 rupees in cash. Can you pay your employee 45,000 rupees in cash? The answer is no. Generally, you cannot pay more than 10,000 rupees to a person in a day in cash. But if you are paying for retirement benefit, then it is allowed. As per Rule 6DD, for retirement benefit, you can pay to the employees up to 50,000 in cash, up to 50,000 for VRS, for pension, for gratuity, etc. You can pay up to 50,000 rupees in cash. The limit has been enhanced from 10,000 to 50,000 for retirement benefits. Next one is the grandfathering clause. Whenever 31st Jan 2018 will come, always remember it's a grandfathering clause. I have spoken about grandfathering clause already in so many adjustments, so I'm not speaking much about this. I don't want to do repetition of the same concept again and again. Next one, you are deriving some STCG from a capital asset which is non-depreciable. Let's assume that it is land. So non-depreciable capital asset, that is, suppose let's say it is land. So STCG you will remove from PGBP and then you will show under capital gains this 75,000, and this will be subject to how much tax? This will be subject to 22% tax under 115 BAB, because normal STCG, see, 111 STCG will be subject to 15 or 20% tax, but other than 111 STCG will be subject to normal rates, and the normal rate under 115 BAB is how much? It is 22%. Therefore, this will be subject to 22%. If it would have been a part of block of asset, then it would have been taxed at 15%. But this is not a part of block of asset, therefore 15% will not be applicable over here. Okay. Next one is you are earning some profit on sale of land. Same adjustment again and again, 100% holding subsidiary, selling some assets. The recipient is Indian company, then it is exempt under the income tax law. So reduce from here and show under capital gains as exempt under section 47. I hope it is clear to you. Now next adjustment, adjustment number 7. You are receiving some dividend of 50,000 rupees from a domestic company. So first of all, you will reduce the dividend from here from PGBP and you will show under IFRS. But when you show under IFRS, you have to gross up. Why, sir? Why gross up? Because this is received. This is not the dividend income. 50,000 is received by you. Therefore, the company, domestic company who is paying you the dividend would have deducted TDS at the rate of 10% under section 194. Therefore, this 50,000 is 90% of the actual amount. Therefore, actual amount is how much? 55,555. So you have to show 55,555 as your income. Okay. I hope it is clear to all of you. Then you are paying 20,000 for inauguration of a new branch. So that is allowed as a revenue expense. There is nothing wrong in that. Then you are paying some penalty to the government for failure to complete the project on time. So there is some delay in your project of 4 months, so you have to pay 5,000 rupees per month as a penalty, and total 20,000 rupees has to be paid. So that is also allowed as penalty, as allowed as deduction, because this is compensatory in nature. Which penalty is not allowed? Penal penalties are not allowed, but this is not penal in nature. This is compensatory in nature. Therefore, this will be allowed as deduction. Okay. Next, VRS is allowed as deduction, but it is not fully allowed. You have debited the full VRS to the PNL account, but only 4/5, only 1/5 will be allowed in the current year. Only 1 lakh will be allowed in the current year. Therefore, 4/5 you have to disallow. 4 lakh you have to add back. I hope it is clear to all of you. Next one is a very beautiful adjustment. There is a non-resident who has given you some deposit, and you are using that deposit for what? For manufacturing in India. So if a non-resident is giving you some money in the form of loan or deposit, and you are using that money in India for the manufacturing in India, for the business in India, then the income of the non-resident is deemed to accrue or rise in India as per section 915. And if the income of the non-resident, then the interest of the non-resident is deemed to accrue or rise in India, you have to deduct TDS. And if you have not deducted the TDS, then this interest of 75,000 will be disallowed in your hands. Okay. I hope it is clear to all of you. Now I will discuss point number 2 first, and then I will come to point number 1. You are paying 1,20,000 for National Fund for Rural Development. That is allowed under 115 BAB. Don't worry. 35 CCA deduction is there, which is allowed under 115 BAB also. And last but not least, you are having some additional employees. You are hiring some additional employees over here, on which you are going to get what? 115 BAB deduction. So sorry, on which you are going to get 80 JJAA deduction. First of all, you are hiring 39 employees on 1st of June 2024, and the emolument is 15,000 per month. All of them participate in the recognized provident fund. But out of that 39 employees, 9 employees are being settled by bearer check. So therefore, the employees to whom you are paying by bearer check, those will not be covered under 80 JJAA. To claim deduction under 80 JJAA, you have to make the payment by 4 modes: not bearer check, not cross check, not cash. Therefore, only 30 employees will be eligible out of 39. So 30 employees deduction will be computed how? 30 into 15,000 per month into 10 months from June to March into 30%. Okay. Now, apart from that, 14 more employees have been hired on 1st of July, but their emolument is 45,700. So they will not be eligible because the emolument is more than 25,000. Then 3 more employees have been joined. This is very important point. 3 employees have been joined on 1st of November, whose emolument is 22,000. They will also be eligible. Why, sir? From 1st of November, if you compute till 31st of March, it amounts to somewhere around 151 days. So in case of leather manufacturing business, because the associate is engaged in leather manufacturing business, in case of leather manufacturing business, even 150 days is sufficient. Therefore, this associate, this 3 employees will also be eligible for 80 JJAA. So 3 employees into 5 months, from November to March, it is 5 months, into 22,000 into 30%. Now, last but not least, the most important point, the 9 employees to whom you are paying the salary by what? You are paying the salary by bearer check. So for them, you also have to make a disallowance under 48(3) under PGBP. Because under PGBP also, if you make a payment to an employee for more than 10,000 rupees in a day in cash or in bearer check, then that is also not allowed. For these 9 employees, you have to do a PGBP disallowance also. I hope it is clear to all of you. After that, you will compute the tax for 112A. For 112A, it is 12.5% tax after 23rd July, subject to 1.25 lakh exemption. And for 75,000 for non-depreciable assets, short-term capital gains, 22%. For dividend also 22%, and for your business income it is 15% under 115 BAB. Then you will apply 10% surcharge, 4% cess, and then you will reduce your dividend income, TDS on dividend, because the question is not asking TDS liability, the question is asking TDS payable, tax payable. Therefore, whenever they will ask you tax payable, you have to reduce TDS, you have to reduce advance tax, you have to reduce TCS from here. I hope it is clear to all of you. So this is what this question is all about. So let's go ahead with the next question. Question number 2. There are multiple parts. There are 2-3 parts in this question. First part is there is Samay Impex Limited, which is an amalgamating company, and Delhi Impex Limited, which is an amalgamated company. Now the profit of amalgamated company is 175 lakhs before setting of the losses, but after taking the depreciation of 15% on 160 lakhs. We need to compute the income of Delhi Impex Limited. So what is the total income of Delhi Impex Limited? First of all, the profit of the Delhi Impex Limited is 175 lakhs. I will write down over here. Now, is the amalgamated company allowed to carry forward the losses of amalgamating company? Yes. Certain losses are allowed. Speculative losses are not allowed. Normal business loss is allowed. Unabsorbed depreciation is also allowed. Unabsorbed carry forward of scientific research losses are also allowed. unabsorbed carry forward of family planning losses are allowed, so, but speculative loss is not allowed. Therefore, first is speculative losses of 5 lakh. Will this be allowed against the income of the amalgamated company? These are the losses of amalgamating company. I want to carry forward to the amalgamated company. This will not be allowed as deduction. Unabsorbed depreciation, yes. Unabsorbed capital expenditure of scientific research, yes, that is also allowed. And business loss is also allowed. So I am reducing these three first of all. Okay. I hope it is clear to all of you. Now the company has done one mistake while computing the depreciation. While computing the depreciation, the company has taken 15% depreciation on what? On 160 lakhs, which is the purchase price of the plant and machinery by Delhi Impact. Now remember, in case of amalgamation, if I am purchasing some machinery on amalgamation from you, I cannot claim depreciation on purchase price. I will my actual cost will be the WDV in the hands of the amalgamating company. Therefore, of 160 lakhs, this is the purchase price. I cannot claim depreciation on 160 lakhs. What is 15% of 160 lakhs? 15% of 160 lakhs is 24 lakhs. So this 24 lakhs will not be allowed. So I am adding back. And what is the WDV in the hands of the amalgamating company? The WDV in the hands of the amalgamating company was 100 lakhs. So I will get deduction on 100 lakh rupees. On 100 lakhs, 15% is going to be 15 lakhs. Therefore, my ultimate answer will come to 39 lakhs. So I will add back the wrong depreciation taken, 24 lakhs, and I will reduce the correct depreciation, that is 15 lakh rupees, which is on the WDV of the block of asset. Okay. I hope it is clear to all of you. Next one is a very simple question on what? On compulsory acquisition. The government has compulsorily acquired my land in October 2024 and they have paid me in Jan 2024 20 lakh rupees. Now, what is the cost of acquisition of the land? It was purchased in 2003. Then I filed a compensation for additional compensation. I got 18 lakh rupees, and then the expenses on transfer is 30 lakh rupees, and the enhanced compensation which I received later on is 1 lakh rupees. Now let's see. The expense on enhanced compensation is 1 lakh rupees. Now let's do the computation. The capital gains has arisen on after 23rd July. Therefore, indexation benefit will not be available. First of all, I am computing the capital gains of the original capital gains and then enhanced capital gains. The original capital gains full value of consideration is 20 lakh rupees. Minus expenses on transfer is 30,000. 1970 will be my net consideration. 12 lakh is my cost of acquisition. The asset is long term. 7 lakh 70 will be my long term capital gains. Sir, will I not get indexation? See, you have both the options. But in the question, they have not asked us to compute tax rates. If they ask us to compute tax rates, I will go for both the options. Sir, which both the options? See, let's assume that he is a resident. Now he has purchased immobile property before 23rd July and he is selling the immobile property after 23rd July. So now he has both the option. He can take this capital gains with 12.5% tax, or he can take indexation with 20% tax. Both the options are available. But in this question, they have not asked us to compute tax. That is the reason we are not doing that. They have only asked us to compute capital gains, and the capital gains is definitely 7,70,000. Now later on, when I filed case for enhanced compensation, I got 18 lakh rupees. So enhanced compensation will be chargeable in the year in which enhanced compensation is received. Minus I have incurred 1 lakh rupees to earn that enhanced compensation. So that much amount will be reduced from my enhanced compensation. Therefore, answer will come to 17 lakh rupees. I hope it is clear to all of you. Is it clear? Let's move on to the next question. The next question is a beautiful question on transfer pricing. There is a foreign company Alpha Inc. and there is an Indian company Alpha Limited. Now Alpha Inc. has given a loan to Alpha Limited of how much? Of $1,50,000. So Alpha Inc. has given a loan to Alpha Limited of $1,50,000. Now, if I convert that into rupees, $1,50,000 into what is the dollar rate? Over here in this question, it is 55. It comes to 82.5 lakh. So in rupee, Alpha Inc. has given me how much loan? 82.5 lakh. And what is my book value of asset? My book value of asset is 120 lakh. Therefore, out of 120 lakh book value of asset, 82.5 is financed by Alpha Inc., which amounts to 68.75%. Therefore, both of us are deemed to be associate enterprise. If one enterprise finances 51% of the book value of the asset of another enterprise, then both of them are deemed to be associate enterprise. By that logic, we both are associate enterprise. Now coming back to India. India, Alpha Limited, Singapore, Alpha Inc. Now we are providing them some software backup support services. So we are exporting them services. Now we need to find out the arm's length price as per the transactional net margin method. Now in transactional net margin method, we need to find out the margin. First, we need to find out the margin with associate enterprise. Then we need to find out the margin with third party, that is uncontrolled price. And then you have to apply that margin on your cost. And then you need to find out what your arm's length price. Now I am providing export. I am doing export. So my objective is sales. Sales is my objective. My objective is not purchase. I am doing export. Okay. So how will I compute the net margin as per with associate enterprise? In that case, you have to follow the rule of net profit upon operating cost. Remember, I have told you in class, when you do export, take denominator as cost. When you do import, take denominator as sales. You have to be very careful, otherwise your entire answers will go wrong. When you do export, I am again saying you take denominator as cost. When you do import, you take denominator as sales. In this case, I am doing export, so therefore I am taking the numerator as profit, denominator as cost. Now what is the profit in case of associate enterprise? The services are given for 85 rupees and the cost is 80 rupees. Therefore the profit is 5 rupees, cost is 80 rupees. I am taking denominator as cost because I am doing export. Therefore 6.25% is the arm's length, is the margin with respect to associate enterprise. What is the margin with respect to third party? The margin with respect to third party is as follows. Pay attention please. The total cost with respect to uncontrolled transaction, it is 500 plus 100. This is my total cost, so I will take in the denominator total cost. And what is the operating profit? It is 100. Therefore this is 16.67%. Now it's very simple. You have to apply the 16.67% on the cost with respect to your alpha I and C, and then you will get the arm's length price, and then compare that arm's length price with what? With your actual price, and then you try to identify how much will be added back to your income statement. I hope it is clear to all of you. Let's move on to the next question. Question number 3A, which is a question on charitable trust exit tax, accredited income. Now, what has happened in this question? A trust was formed in 2006 and it was registered in 2011. Now, remember, it was formed in 2006 and registered in 2011. So, whatever assets and liabilities which are purchased between 2006 to 2011 will not be part of what? Accredited income. Do you remember that? All assets and liabilities which are purchased or incurred before registration shall not be part of accredited income. Now, the trust got resolved on 29th of December 2024. So, now we need to compute the accredited income of the trust. What is accredited income? As per rule 17 CB, it is aggregate of all assets minus aggregate of all liabilities. Now let's see what is the first asset. The first asset over here is land and building of 12 lakh rupees. To purchase this land and building, you have taken a loan from bank of 9 lakh rupees. It means 3/4 of the land is financed through a loan. Okay, 3/4 out of 12 lakh. If 9 lakh is financed through loan, it means 75% of the land is financed through loan. Okay, now, and it is also written in point number 4 in the adjustment, land is acquired out of agriculture income. Therefore, out of agriculture income, 1/4 is acquired, because 3/4 is acquired through what? Through loan. Therefore, 1/4 is acquired through agriculture income. Now, the law says that whatever asset is acquired out of agriculture income, they should also not form part of accredited income. So whatever portion of land which is acquired out of agriculture income, how much portion? 1/4 portion of the land is acquired out of agriculture income. That should also not be part of what? Accredited income. Now, how to value the land as per rule 17 CB? It is stamp duty value or market value, whichever is higher. Now in this question, we don't have stamp duty value, we only have market value. Therefore, market value is 50 lakh rupees. But out of this, 1/4 is acquired through agriculture income and 3/4 is acquired through loan. Therefore, only 3/4 of the land should be taken over here. That is 37.5 lakh should be taken. That is the portion from which the portion of the land which is acquired from the loan, and not the portion of the land which is acquired out of agriculture income. I hope it is clear to all of you. Beautiful discussion. This is the place where most of the students always ask me doubt. Next one is for equity shares, you will take the market value. For quoted equity shares, you will take the market value. The market value is 18 lakhs over here. You can check over here. It is 18 lakhs. So take that. Now for cash, you will take the book value. For bank balance, you will take the book value. For liabilities, you will take the book value. You will take this 9 lakh rupees in the liability. This 1 lakh rupees you will not take in the liability, because this is also taken before the registration. So whatever assets and liabilities which are incurred before registration, that shall not form part of what? Accredited income. I hope it is clear to all of you. Now, one last thing is the most important thing. Investment in equity shares, unquoted shares. For unquoted shares, you need to value the unquoted share company. You need to value Z Limited. How to value Z Limited? Take all the assets of Z Limited, 60 lakhs plus 30 lakhs, 90 lakhs is the total assets of the Z Limited. Reduce the liability of Z Limited, 35 lakhs is the liability of Z Limited. Therefore, the net asset of the Z Limited is 55 lakhs. Out of which, this is the total value of Z Limited. Out of which, how much we acquired in that? We acquired 15% of that. Sir, how did you get 15%? See, total 1,50,000 we have invested in Z Limited, and the equity capital of Z Limited is 1 lakh equity shares into 10, that is 10 lakh. So out of 10 lakh, 1,50,000 is acquired by us. Therefore, we hold 15% of that. So whatever is the amount, that will be our stake. But from that also, while computing the accredited income, you will take only 50% of the total assets. Why, sir? Because 50% of the unquoted shares were acquired in 2007-8 when the trust was not registered. Therefore, out of the total value of unquoted shares, only 50% will be taken over here. Last but not least, for dissolution, there is a special benefit that if the trust is dissolved and if the assets are distributed to another trust within 12 months from the date of dissolution, then that much amount should be reduced from your accredited income. So the trust is dissolved, and within 12 months, within the specified time, the trust is distributing 8 lakh rupees assets to another trust. Therefore, that much will be reduced from the cost of asset, from the accredited income, and the balance will be chargeable at 34.944%. Now, the next question is a very simple question on DTAA, very basic question. We have done so many questions like that earlier also. I'm not wasting my time to discuss such kind of silly questions over here. Okay. Let's move on to the next question. Next question is on TDS and TCS. There is one person by the name called as Mr. Z, who is a resident. He is a seller. Now he's selling some unique t-shirts, etc. through an e-commerce operator, abc.com. Therefore, abc.com e-commerce operator has to deduct TDS under section 194O at the rate of 0.1% from 1st October 2024. Before that, it was 1%. Now, the abc.com, that is the e-commerce operator, will deduct TDS always on the entire amount, gross amount. That is not after commission, deduction of commission, that is before the commission. And the TDS will be deducted on credit or payment, whichever is earlier. So total 60 lakhs of goods are sold through abc.com. First 20 lakh is sold on 31st December. So on that 0.1% TDS will be deducted on the gross amount. Then 15 lakh 0.1%. Then 10 lakh rupees is directly paid by the customer to what? To the seller. Customer did not pay to abc.com. The customer directly paid to what? To the seller. So in that case, it is said that if the customer directly paid to the seller, then in that case, this is deemed to be credited by the e-commerce operator, and therefore the TDS will be deducted on this 10 lakh rupees also. And the balance amount TDS will be deducted on 31st March because the balance amount was released on 31st of March, on which TDS will be deducted on 31st of March. I hope it is clear to all of you. Now, next one is also a very good question on TCS now. Raghav Motors is a dealer in car, Ford cars and Maruti cars. The last year turnover of Raghav Motors is 9.8 crore from sale of cars, and from sale of spare parts and service station it is 60 lakhs. Therefore, the total turnover of the Raghav Limited last year is 10.4 crore, which is more than 10 crore. Now remember, whenever you sell a car as a dealer, the first priority has to be given to section 206C1F. If the car is of more than 10 lakh rupees, you have to collect TCS under 1F. Okay. Now the first car is Maruti car. The value of the car is 37 lakhs. Therefore TCS will be collected under 1F. The second car is also Maruti car. The value is more than 10 lakhs. Therefore under 1F. The third car is 8 lakh. The value is less than 10 lakh. Therefore 1F will not apply. The fourth car is again more than 10 lakh. So 1F will apply. So in the first car, second car and the fourth car, 1F will apply. The dealer will collect TCS at the rate of 1% of the entire amount. But in case of the second car, that is Ford car, that is 8 lakh rupees. In this, if 1F does not apply, then you need to check 1H. 1H has to be checked. For a 1H, you need to fulfill the conditions of 1H. First of all, Raghav Motors last year turnover is more than 10 crore. The answer is yes. Is the car covered in 1F? It is not covered in 1F. Therefore, now you need to check whether it is covered under 1H or not. But for 1H, the ICI has taken two views over here. First view, for 1H, one of the primary condition is that your total sale should exceed 50 lakh rupees. Is it exceeding 50 lakh rupees? The ICI is saying no, because this car sale is only 8 lakh rupees. 1H will not apply. The second opinion taken by the ICI is, while computing the threshold of 50 lakhs, take all the cars, whether they are covered in 1H or whether they are not covered in 1H. All the cars have to be considered. So if I consider all the cars, then definitely my threshold exceeds 50 lakh rupees, and in that case you have to collect TCS on what? On the 8 lakh rupees. I hope it is clear to all of you. Now next question number B. It's a beautiful question. The Mr. Ashish is a non-resident and he is a person of Indian origin. Therefore, he is an NRI, and we have to apply chapter 12A, which is an optional chapter for here. But the ICI has told that you have to compute your tax payable or refundable as per the special provision. Therefore, we will apply chapter 12A and we will apply chapter 12A, and according to that, we will compute the tax. Okay. Now the very first thing over here is he is earning some long-term capital gains from certain specified foreign exchange asset on 31st of August 2024. What is the long-term capital asset? What is the long-term capital gains? It is 8,50,000 plus he has incurred some expenses on that 30,000. So this 8,20,000 rupees will be subject to what? Tax under chapter 12A. Now in chapter 12A, there is a specific exemption given under 115F that if you invest the money again in a net consideration in new specified asset within 6 months, you will be exempt from this capital gains. So they have invested some 1,80,000 rupees in the public limited shares check, but they have invested on 31st of December 2025. That is very late. That is after 12 months almost. So therefore this exemption will not be allowed to you. Okay. I hope it is clear to all of you. Therefore this 8,20,000 will be subject to 12.5% tax, because with effect from 23rd July 2024, the long-term capital gains under chapter 12A has also become 12.5% tax. Then interest on deposits held with private company. Now private companies deposits are not covered in chapter 12A. Therefore this 2,93,000 will be subject to what? Slab rates. Now interest on government security. Now government security is covered in chapter 12A, but only if it is purchased in forex. Now the question is very silent, so ICI has taken two views. First view, assume that it is purchased in forex. If it is purchased in forex, then this will be subject to what? This government interest will be subject to 20% tax. If it is not purchased in forex, it is purchased in INR, then the provisions of chapter 12A will not apply. In that case, you have to apply slab rate on this particular amount. Then 111A, short-term capital gains will be subject to 15% tax before 23rd July and after 23rd July. 20% tax. The date of sale is not given, so you can assume whatever you want to. Okay, we have assumed it is after 23rd July, therefore it will be subject to 20% tax. Last but not least, 1,50,000 is invested in the notified savings certificate, that is NSC. So you can claim the deduction of NSC if you are following old regime. If you are following new regime, then you cannot claim the deduction of NSC also. Okay. Last but not least, they have asked us to compute tax payable. So therefore, you have to deduct TDS also to compute tax payable. Okay. So compute tax payable, you need to reduce TDS, TCS, and advance tax credit. I hope it is clear to all of you. Now the next question is based on some case laws. Very simple case laws. First case law: can a CIT revise an intimation under 143 under section 264? Now, see, technically speaking, CIT does not have the power to revise an intimation under 264. CIT can only revise an order of an AO under section 264. But Unfortunately, there is a High Court judgment which says that, which is a contradictory judgment which says that CIT also has the power to revise what intimation under 143(1) under section 264. So you can go according to this. Okay. Now there is an assessee firm who has taken some transport services from a transporter, but the truck is not owned by the transporter. The transporter has himself taken the truck from somebody else, and now you are making the payment to that particular transporter who has taken the truck from somebody else. It means he is subcontracting you. So whether the TDS under 194C will also be applicable on subcontracting, the answer is yes. 194C is very clear that 194C is applicable on contract as well as subcontract. It doesn't matter whether the truck is owned by the transporter or it is not owned by the transporter. Even if it is not owned by the transporter, you have to deduct the TDS under 194C. I hope it is clear to all of you. Next one, the AO has passed an order and you have a remedy to file an appeal to CIT appeal. Can you escape that remedy and directly go to High Court to file a writ petition? The answer is no. Writ petition is your fundamental right. I agree to that. But that is only available if there is no remedy in the law. So if there is a remedy in the law, then you should go according to the remedy in the law. AO has passed an order, you have an authority to go to CIT appeal, then you should go to CIT appeal. You cannot directly go to what? High Court to file a writ petition. So this is what the assessee has done wrong, and therefore in this case the assessee is not correct. I hope it is clear to all of you. Now the next question is on equalization levy covered under section 165A, which is applicable to e-commerce operator, but ICI has removed this particular equalization levy from your syllabus. Therefore we are not going to discuss the questions based on this for your exams of May 2025 and onwards. Okay. Now the last question over here is, there is a company by the name called as Highway Drive Limited, which is a wholly owned subsidiary of another Indian company, Highway Roads Limited. Both of them are Indian company and they are eligible for 80IA. Now what they are doing? In 80IA, you have to develop some infrastructure facility, so you get deduction of 100% of your profits. But the assessee is doing some other income and disclosing that as 80IA. You are doing some other activity, but showing that as 80IA, this is nothing but tax evasion. Therefore, in this case, whether the GAR will apply, GAR does not apply in case of tax evasion. The GAR will never apply in case of tax evasion cases. Okay. Next one, the Highway Limited, they are related party. Now one entity is eligible for 80IA, another is not eligible for 80IA. Now they are selling the product between them at a lower and higher price by adjusting the price to benefit themselves. In such cases, domestic transfer pricing is applicable under section 92BA. Because domestic transfer pricing is applicable, therefore, because a specific anti-avoidance rule is applicable, therefore in this case also GAR will not be applicable. Now the last question in this particular paper is the AO empowered to the AO is empowered to provisionally attach your property? Yes, absolutely. He can provisionally attach your property. Can the AO revoke the provision attachment? Can he remove the provision attachment by saying the assessee that if you furnish a bank guarantee, I will remove? Then, if yes, from whom, to what extent and to the what value? Can he invoke such bank guarantee? So I will explain you each and everything in detail by looking at the solution. First of all, the AO can buy an order in writing. The AO can pass an order in writing and revoke provisional attachment. He can revoke provisional attachment. Why? First he attached your property. Now he is revoking the provisional attachment. He is giving your property back subject to condition. First, you have to furnish a guarantee. You have to furnish a guarantee from schedule bank of an amount not less than the fair market value of the asset. If you fulfill these three conditions, he will what? He will revoke your provisional attachment in lieu of what? In lieu of a guarantee. Now, can he invoke the bank guarantee? Can he go to bank and take the money from the bank and invoke the bank guarantee? Yes. If there is a notice of demand against you, which is served upon you, and you are not paying the demand within the time specified in the notice, which is generally 30 days. Or if you fail to renew the bank guarantee within 50 days from the expiry of the bank guarantee. Suppose the bank guarantee is expiring on 30th and you have not yet, on 15th also you have not renewed the bank guarantee. So on 16th of the month, the AO can go to the bank and can liquidate the bank guarantee. I hope it is clear to all of you. So this is what this beautiful paper is all about. It was a very lengthy paper. So let's go ahead with the next paper, that is May 2022 paper. The very first question over here is on total income. We are supposed to compute total income and tax payable, but we are opting for the 115BAA. So answer according to 115BAA. Okay. So we are not following the normal provision. The assessee is a manufacturer. Accordingly, you need to answer the question. The profit is 850 lakhs. Very first adjustment is depreciation that you will add back because that is as per books of accounts. Next adjustment, employer contribution and employee contribution. We all know that employer contribution has to be paid till the due date of filing of return as per 43B. But for employee contribution, there is a stricter time limit. You have to pay by the 15th of the following month. In this case, you are paying the employer contribution by 20th May. So that will be allowed because the employer contribution can be paid till the due date of filing of return. But employees contribution, if you are paying by 20th May for the month of March, that is wrong. For the month of March, employees contribution has to be paid by 15th of April. Therefore, employees contribution will be disallowed. Okay, I hope it is clear to all of you. Now, the penalty on GST is considered to be penal in nature. Therefore, that is disallowed. But interest on GST is considered to be compensatory in nature. Therefore, that will be allowed under the income tax law. Next one, you are incurring some 10 lakh rupees on a notified skill development covered under 80CCD. Now the provisions of 80CCD are not available for 115BAA. If you are following 115BAA or BAB, 80CCD is disallowed in that case. Next, there is an old machinery which was destructed and you received rupees 5 lakh rupees as a scrap. Now what is the treatment of that under income tax law? First of all, you will disallow this 20 lakh rupees because it is a capital loss not allowed as deduction. You have to disallow that, and then this 5 lakh rupees scrap also you have to reduce from your PGBP income, and then you have to go to the WDV of the block of asset, and then you have to adjust that 5 lakh rupees from the WDV of the block of asset. But fortunately in this question the WDV of the block of asset is not given, so we don't have to give any effect to that particular 5 lakh rupees. I hope it is clear to all of you. Next one, you are receiving a dividend of 15 lakh rupees from a foreign company, so you will reduce this 15 lakh rupees from here and you will show that 15 lakh rupees as income under IFOS, as what? As income from other source. Now you are also incurring 50,000 rupees as an expense, so you will add back this expense under PGBP, and under IFOS it will not be allowed, because under IFOS against dividend income there is only one expense that is allowed, and that is interest expense, and it is nowhere mentioned that this 50,000 is interest. Therefore we are disallowing this 50,000 rupees under what? Under IFOS. So the effect is very simple: reduce 15 lakh from PGBP and show 15 lakh in IFOS, and 50,000 will be disallowed under PGBP, and under IFOS there will not be any deduction of that. Next one is a very routine adjustment we have done so many times. 100% holding subsidiary, if they are transferring assets between them, then the capital gains are exempt, so you have to reduce from here, and then you have to write a note that it is 100% holding subsidiary, it is exempt. Therefore one more condition is there: the recipient, the receiver has to be an Indian company. If the receiver is an Indian company, then only this exemption is available, otherwise it is not available. Next one, normal depreciation, you have to reduce 92 lakhs because normal depreciation is allowed under income tax law. Additional depreciation won't be allowed because you are following 115BAA. Okay. Now next adjustment, it is in the last year you have purchased some plant and machinery last year of 20 lakh rupees on 10th of Jan 2024. Now, so in the last year you have used the machinery for less than 180 days. Therefore in the last year you would have got 50% of the additional depreciation. Can you claim the balance additional depreciation in the current year? The answer is no. Why? Generally you should get, but in this case you will not get, because you are not following, you are following 115BAA. Now because you are following 115BAA, the balance 50% additional depreciation of last year will not be allowed in the current year because you are following 115BAA. Similarly, in the last year you have provided provision for 7 lakh rupees for a subcontract. Now the tax for that was deducted and paid on 31st of December 2024. So in the last year the TDS was not deducted, the TDS was not paid, but in the current year the TDS is deducted and paid. Therefore in the last year 30% of 7 lakh would have been disallowed, and in the current year you can take 30% deduction under the income tax law. I hope it is clear to all of you. Okay, so in the last year 30% of the 7 lakh would have been disallowed, and in the current year you can claim 30% deduction. Last but not least, you have declared and distributed dividend of 20 lakh rupees on 31st of May 2000 on 15th of May 2025, which is 1 month before the due date of filing of return. Therefore, for this particular adjustment, you are going to get deduction of how much? Of 15 lakh rupees, not 14.5. Sorry, in the answer it is 15 lakh rupees. How, sir? Dividend received is 15 lakhs and dividend distributed is 20 lakhs, and therefore under ATM, whichever is lower, that will be allowed as deduction. Now you will compute your tax. How much tax will be there under 115BAA? It is 22% tax, 10% surcharge, and 4% cess. That's it. This is what this question is all about. Now let's move on to the next question, question number 2, which is on non-resident taxation. There is a foreign company BNB which is incorporated in country X. Now that company has appointed one agent in India, Mr. Lal Singh. Now what is that agent doing? That agent is habitually entering into a contract. The agent is delivering goods in India. So do you remember that if a non-resident or a foreign company has an agent in India who is habitually entering into a contract on behalf of the non-resident or is delivering goods on behalf of non-resident in India, then that amounts to what? Business connection in India. And in that case, the income of the non-resident is deemed to accrue or rise in India, even though there is no permanent establishment in India. Still that income is deemed to accrue or rise in India. So that is what this particular non-resident is doing in this particular case. Now the very first income that he has earned from here is, you can check over here, he has earned income from delivery of goods by Mr. Lal Singh. So the non-resident is earning some income from delivery of goods, and who is delivering the goods on behalf of the non-resident? It is Lal Singh. And who is Lal Singh? Lal Singh is the agent of the non-resident. Therefore this 2 crore rupees will be deemed to accrue or arise in India, and this will be subject to 35% tax in India, 35% tax, which is the normal tax for a foreign company. I hope it is clear to all of you. Now in the next point, the ICAI has taken 2 views. Fees for technical services 55 lakhs after deducting expenses of 6 lakhs rupees. So here ICAI has taken 2 views. If there is an agreement between both of them and the agreement is approved between both of them, then 115A will apply, and if 115A will apply, then the income will be 61 lakhs. You will not get deduction of 6 lakh rupees, okay? Because in 115A you don't get deduction of expenses of PGBP. So that 61 lakh rupees will be your gross income, and you will be subject to 20% tax plus surcharge if applicable and cess. Then the second view taken by the ICAI is, If there is no agreement between both of them, which is approved by central government, there is no agreement, there is no approval, then in that case 115 is not applicable, and 115 is not applicable, then 55 lakh rupees, that is net of expense, will be taxable at normal rate. 115 is not applicable, therefore normal tax rate of the foreign company will be applied, that is 35%. Okay, next one, long-term capital gain on unlisted debentures of White Limited, an Indian company. So the non-resident is transferring some unlisted debentures. Now we are assuming that the date of transfer is not given. We are assuming that it is transferred on after 23rd July. Therefore, this will be subject to 12.5% tax. Assuming date of transfer is not given in the question, we are assuming it is transferred on after 23rd July 2024. Now, last but not least, last point is given to confuse us. The Assassi BNB has paid some tax in his country. So what shall I do in that? If he has paid some tax in his country, can India give him DTAA credit? India cannot give DTAA credit to a non-resident. India will give DTAA credit only to our residents, not to foreign residents. This 50 lakh which he has paid in his country, he will take the credit of that in his country. India cannot give him any credit. Okay. So this last point is given to confuse us. That's it. There is no other reason to give this last particular point. Okay. Now let's move on to the next question. The next question is on charitable and religious trust. The very first question, in which there are 2 points over here. The first point is the trust has received some corpus donation of 5 lakh rupees. Now the trust is saying that since we have received the corpus donation, it is exempt. No, it is not exempt unconditionally. The corpus donation is exempt only if you deposit that money in the mode specified in 11.5. If you do not deposit the corpus donation in the mode specified in 11 subsection 5, then it is not exempt. So it is not directly exempt, it is exempt subject to condition. The second thing which the Assassi is saying that we have taken a loan of 20 lakh rupees from a nationalized bank, and with the help of that loan, we are doing some construction of the building. So we should get the deduction of that construction, not allowed. If you take a loan and incur an expense, if you take a loan and do an application, then that is not allowed as a deduction. It will be allowed when the loan will be repaid. I hope it is clear to all of you. So whenever you will repay this particular loan, and that particular year you are going to get the exemption of this amount. Only taking a loan and incurring an expense does not amount to application under income tax law. You have to repay the loan. Okay. Now the third one, the trust Smile Foundation is a not-for-profit organization, runs a secondary school. Now, they are receiving some voluntary contribution of 14 lakh rupees, of 30 lakh rupees, sorry, out of 14 lakh rupees and government grant of 60 lakh rupees respectively. Okay. So, I am a trust, I am a school, I am receiving voluntary contribution of 14 lakh rupees and government grant of 16 lakh rupees. So, now, can I claim, is the trust required to get an approval to claim exemption? And the question is, the answer is no. There is no need to get an approval. Why? Because there is a provision under section 1023C which says that if a trust is substantially financed by government, then there is no need to take any approval. We need to check over here, is the trust substantially financed by government over here? The answer is yes. What is the meaning of substantially financed by government? It means if the government grant exceeds 50% of the total grant. So if the government grant exceeds 50% of the total grant, the trust will be called as a substantially financed institution, and therefore there is no need to take an approval. Now, how much is the government grant? It is 16 lakhs. What is the total grant? It is 30 lakhs. Is it exceeding 50%? The answer is yes. Is it substantially financed by the government? The answer is yes. Therefore, there is no need to claim any what? There is no need to get any approval under section 1023C. You can directly claim the exemption. Next one, a trust wants to know whether it can claim exemption under section 11 and 1023C both. The answer is a big no. You cannot claim exemption under section 11 at the same time. You cannot claim 1023C also at the same time. You cannot claim both the exemption together as per section 11 subsection 7. You have to choose between both of them. Both of them together are not allowed at the same time. So let's move on to the next question. The next question is on TDS and TCS. The very first question over here is Mr. Rajat is 79-year-old. Just count the conditions with me. Rajat is 79-year-old. He is a resident individual. Condition number 2. Now he has a saving bank account and a fixed bank account, fixed deposit account in ABC Bank Limited, and he earns the following from the saving bank account. First of all, he earns interest of 75,100 from the saving account. Then he also earns pension from the employer in the same bank account, 55,000 rupees per month. So multiply by 12. And then you can take 50,000 rupees standard deduction because you are going to follow old regime here as it is mentioned over here. And there is an interest of on fixed deposit of 1,20,000 rupees. So now this is a classic case of section 194P where the Assassi is a specified senior citizen. Who is a specified senior citizen? Who is a resident individual whose age is 75 years or more, and he earns from a specified bank pension and he earns from the specified bank interest from fixed deposit or saving. In that case, the bank will deduct the TDS as per old regime, new regime, as the case may be, whatever Mr. Rajat will tell the bank. And accordingly, the bank will deduct the TDS as per the slab rates of the Assassi. So we have to compute the total income and tell the bank to deduct the TDS as per the slab rates. And then Mr. Rajat will not be liable to file the income tax return. So how the Mr. Rajat's income will be computed? 55,000 into 12 will be salary, minus 50,000 standard deduction in the old regime, then 75,000 interest on saving, 1,20,000 interest on fixed deposit. You will get your gross total income. From that you will claim what? You will claim 80 TTB 80 TTB, 50,000 standard deduction of 80 TTB, and then whatever income will come, you will compute tax as per old regime. Okay, and then the bank will deduct the TDS as per the old regime, and then the Mr. Rajat is not liable to file the income tax return. I hope it is clear to all of you. Now the next question is also a beautiful question. Mr. Aryan is a buyer and Mr. Varun is a seller. Now if you see the last year turnover of Aryan, the last year turnover of Aryan is 12 crore rupees. That is, the buyer's last year turnover is 12 crore and the seller's last year turnover is just 8 crore rupees. So if the buyer's last year turnover is more than 10 crore and if the seller's last year turnover is less than 10 crore, then the buyer is liable to deduct TDS under 194Q. Now the buyer is buying goods worth rupees 85 lakhs. Okay. Now in 194Q, you will deduct TDS once you purchase more than 50 lakh rupees. And then you will deduct TDS on payment or credit, whichever is earlier. Now, so you are not going to deduct TDS on entire 85 lakh rupees. Once it exceeds 50 lakhs, you will start to deduct TDS. So how you have purchased the goods of 85 lakh rupees. The PAN has etc. has been furnished, so there is no issue in PAN. On 25th of May, 30 lakhs goods are purchased. On this, you will not deduct TDS because it is within the limit of 50 lakhs. Then on 28th of June, you are purchasing another 25 lakhs. Now it is crossing 50 lakhs. How much is crossed? 5 lakhs have crossed above 50 lakhs. So on 5 lakhs, 0.1% TDS will be deducted now. Okay. Then on 10th of December, now this is the most important point of this question. On 10th of December, you are buying another goods of 20 lakh rupees. So on this, you will deduct 0.1% TDS. Okay. Now, out of this 20 lakh goods, you have returned 5 lakh goods because they were not good in quality. And the seller has also refunded the money. So out of 20 lakhs, 5 lakh rupees has been refunded to you. So now you can adjust this 5 lakh rupees against the future purchase from the same seller. Do you remember that? If the seller has refunded you the goods, refunded you the money for return of goods, then you can use that money. You can use that TDS against future purchase from the same seller. So how much he has refunded? 5 lakh rupees. On that, have you already paid the TDS? I have already paid the TDS of 0.1% on that amount. So that much TDS will be adjusted in future purchase. So next time when I will purchase, next time when I am purchasing is 10 lakh rupees. So on this 10 lakh, I will not deduct TDS. I will deduct now only TDS on 5 lakh rupees because I have to adjust the earlier TDS now. So on 10 lakh, instead of 10 lakh, now I will deduct TDS only on 5 lakh rupees. On what? On 20th of Feb 2025. I hope it is clear to all of you. Is it clear? Now, the next question is a very simple question on equalization levy. There is an Indian company over here and there is a London-based company, Shine Inc. This company does not have a permanent establishment in India. Okay. And we are paying what? We are paying 5 lakh rupees to this company for what? For online advertisement. So, we are Indian company. Shine Inc. is a foreign company. Shine Inc. does not have a P in India. Shine Inc. is providing us online advertisement. We are paying them 5 lakh rupees. Therefore, it's a classic case of equalization levy. We are paying them on which date? The services are provided on 15th of March. Therefore, we have to pay by 7th of April. Now, we have deducted on time, but we have paid late. See, instead of deducting and paying on 7th of April, we are paying on 15th of April. So, I am delaying by a few days. So, for every month, I have to pay interest of 1% per month or part thereof. So, there are 3 questions over here. What is the interest leviable to Sun Limited on delayed payment? So, interest leviable will be 1% per month or part thereof of the equalization levy. Now, 5 lakh is the total amount paid to what? Paid to Shine Inc. The equalization levy is 6%. Therefore, the equalization levy is 30,000 rupees. What is 1% of that? That is 300 rupees. That is the interest which I have to pay to what? To the government of India for delay payment of equalization levy. Now, what is the circumstances under which penalty cannot be imposed? So, generally, the penalty should also be imposed for late payment of equalization levy. But if you prove to the assessing officer that there is a reasonable cause for delay, there is a genuine reason for delay, then you need not have to what? Then you need not have to pay what? Penalty. Third one. If the AO imposes a penalty and he passes an order, what remedy you have and by what you can file an appeal? So if a AO passes an order of penalty against you, if the AO passes an order of penalty against you, you can file an appeal to the AO. You can file an appeal to the CIT appeal within 30 days from the date of receipt of the assessing officer's order. So whenever you will receive the order of the assessing officer within 30 days, you can make an appeal to the CIT appeal. Okay. The way you do under the income tax law. And the last question is a very, very simple question. This was a very simple paper. Huh? Those people were very fortunate who are giving exams in May 2022. Now, in this question, we need to answer whether it is a tax planning, tax management or tax evasion. So purchasing a Sukanya Samriddhi scheme to reduce your income. It is absolutely a tax planning. The government allows you to purchase Sukanya Samriddhi scheme as per 80C and therefore it is tax planning. Now, obtaining a declaration in Form 60 from the customers who do not provide PAN. So this is a kind of management. Therefore, this is a kind of compliance. It's a kind of procedural compliance. Therefore, it is tax management. Okay. Next one. You are purchasing a refrigerator for home. Okay. But you are showing that as it is in the office. The refrigerator is kept at home, but you are showing it as it is in office. So it's a clear case of tax evasion. Personal refrigerator is shown under business and you are claiming depreciation to reduce your profit. It's a case of tax evasion. And last but not least, you are paying 4 lakh to Mrs. D, who is the wife of the director. Okay. Although being a qualified professional, but is a housewife. Why are you doing so? Why are you paying 4 lakh rupees to a housewife? Okay. The purpose is to increase the income of D up to 5 lakhs so that she can claim what? Rebate up to 5 lakh rupees and the business can claim more expense. So without any genuine reason, you are paying excess money to the wife. Okay, wife is not contributing to the business also. You are paying excess money to the wife. You are increasing from 4 lakh to 5 lakh. It is absolutely a tax evasion case. Okay, it's a case of tax evasion. It's very simple. Whenever a question of tax planning, management or evasion come, it's a bonus for all of you. Okay. Last but not least, it's a theory question which you can go through at your end, not very important for exam. So this is what this paper is all about. Now let's move on to the next paper, that is November 2022 paper. In this question, what are we supposed to do in the very first question? Generally, first question is on total income only. So we are supposed to only compute total income, not as per 115 BAA, but as per the normal provision. We don't have to compute tax also in this question, only total income. Be very careful. Now, if you see the very first line, there are some important points in the first line. You need to be very careful. We have not seen such lines in our previous questions. The company is resident in India, first of all, and secondly, it is a company in which public are not substantially interested. It means it is a closely held company, and whenever a closely held company word will come in the examination, there can be multiple implications which can come in your examination. One is section 79 which can be applicable. Another is section 68 which can be applicable. Another is section 222 deemed dividend that can also be made applicable. Okay, so these sections can be made applicable. The very reason the ICI is writing a company in which public is not substantially interested is because to test these sections. Okay, what is section 79? It is about carry forward and set off of loss. What is section 68? It is talking about unexplained cash credit on which 78% tax is imposed. Now let's start with the question and then we will see what is the implication of section 79 and section 68 in this question. The first thing is the profit is 50,75,000. Write down that. Next is one-time license fees you are paying for franchise. This is nothing but an intangible asset. So add back this 12 lakh rupees and then claim 25% depreciation. You can assume in this question the ICI has made one weird assumption. You can assume that the depreciation under section 32 include this amount also. So now, so far what we have been doing, we are always in case of intangible asset, we are adding back the amount and then we are claiming depreciation. So in this question, the ICI has made a weird assumption and they have given an alternate answer also. The weird assumption is they are saying that add back this 12 lakh rupees and then do not reduce this 12 lakh rupees. The depreciation amount given below under section 32 may include this amount also. Therefore, there is no need to reduce. So you can give both the effect. You can reduce also. If you don't want to reduce, you can ignore that and you can write down a note on that. Okay. Next one, convertible debenture you are issuing. So you are incurring some expenses for convertible debentures. So that is allowed because issuing convertible debentures does not amount to fixed capital, does not amount to permanent capital in the business. Therefore, that will be allowed as a revenue expense. So don't worry. Okay. Next one is a very intelligent adjustment. You are paying 2,25,000 to a share broker and 1,20,000 to a commodity broker. Obviously, you are paying what? You are paying brokerage. Obviously, what else you will pay? You are paying commission and brokerage to these people. And now you have not deducted the TDS. Now in this, the ICI has taken two views. First, if the assessee is a trader, in commodity or trader in share, then the deduction of these expenses are allowed. If deduction of these expenses are allowed, now we need to ask ourselves whether TDS is applicable or not. So if first assumption, the assessee is a trader, therefore deduction is allowed. Now, if deduction is allowed in case of share broker, are we supposed to deduct TDS under 194H? No. For share broker commission, TDS under 194H is exempted. So for share broker, you can directly claim the deduction of 2,25,000. But for commodity broker, yes, TDS is applicable. So on 1,20,000 rupees, 194H is applicable. Therefore, if you have not deducted the TDS, 1,20,000 will be disallowed. Okay. I hope it is clear to all of you. Now. Second one. What is the second view? The second view is what? In this 1,20,000 will not disallowed, only 30% of 1,20,000 will be disallowed. Don't worry, because if you are paying to resident, only 30% is disallowed. The second view is suppose they are not traded in commodity or they are not traded in shares, then the deduction is not allowed under 36,115 and 36,116. See very clearly 36,115 and 36,116 says that the deduction of brokerage, deduction of STD, etc. all these expenses are allowed to trader and broker only if it is what? Only if you are a trader in security. If you are not a trader in security, then the question of deduction is not allowed only. Does not arise only. Next one. If an employer contributes to the national pension scheme of the employees, then how much deduction is allowed to the employer? It is 14% of basic salary plus DA in terms. It is amended by Finance Act 2024. Earlier it was 10% of basic salary plus DA in terms. Now it is 14% of basic salary plus DA in terms. You are paying how much? You are paying 15% of basic salary in DA in terms. Therefore, whatever amount will come, you have to disallow 1% out of it. Okay. You cannot give 15% of the basic and DA. You can only give 14% of basic and DA. I hope it is clear to all of you. Next one. You are a pharma company. And if you are a pharma company, you cannot give freebie to your medical practitioner. That is disallowed. That is bad in law. That will be disallowed under the income tax law. Next is you are incurring some 5,20,000 rupees on feasibility study for examining proposal for technological development of existing business. But the project did not work. It was abandoned without creating an asset. So you are planning to do some expansion in the business and the project did not work, and therefore your project was abandoned without creating a new asset. So it will be allowed as a revenue expense because new asset was not created. Therefore it can be claimed as a revenue expense. If new asset would have been created, we would have capitalized that expense. Okay. Next, depreciation you will add back. Next, employees provident fund, employer provident fund, same adjustment we have done in the previous paper also. I'll say once more. Employer provident fund you have to pay till the due date of filing of return. Employee provident fund you have to pay by 7th of the following month. Okay. Donation to Swachh Bharat Abhiyan will be disallowed under PGBP, but you can claim under Chapter 6A, but with an assumption that you are making the payment for other than cash. If you make the payment in cash, then it is not allowed. Industrial tariff concession from the central government, it is an income. From if any tariff concession from the central government, state government, body, agency, authority, it is an income. Therefore, it is a part of income as per section 224(18). Next one, the interest and the borrowing cost amounting to 6,85,000 and 5,65,000, though not meeting the criteria for recognition as cost, is included in the opening and the closing stock. So you cannot include the interest and the borrowing cost in the opening and the closing stock. So how much you have included in the opening stock? How much? 6,85,000. So that has to be added back. How much you have included in the closing stock? 5,65,000. So that has to be reduced. Whatever is debited in the P&L wrongly, add back. Whatever is credited in the P&L wrongly, reduce. I hope it is clear to all of you. Next one, you have some profit from warehouse. Which warehouse? Storage of sugar. So it's a case of 3580. How much profit is there? 10 lakh rupees. So first of all, reduce this profit from here. It will be separately computed. Against this profit, you have incurred some capital expense. See the last point, point number 4. 35 lakhs capital expenditure you have done, out of which 20 lakh is land. Therefore, only 15 lakhs will be allowed. Therefore, the profit is 10 lakh and the capital expenditure qualified for deduction under 3580 is 15 lakh. 5 lakh rupees loss. This cannot be set off against your normal business. This you have to carry forward under section 73A and set off against only 3580 business for infinite number of years. Next one is you have collected some GST of 14 lakh and then you remitted the GST to the central government within the due date. Okay. So first you collected and then you remitted. Then you find a case in the court. So the court has given you a refund of 5 lakh rupees, out of which you have given back to the customer only 3 lakh rupees. So when the government has given you refund of 5 lakh rupees, so you have to give entire 5 lakh rupees to the customer, because ultimately GST is collected from customer only. It is not your money. It is not your wealth. It is not your asset. It is customer's money. Therefore, 5 lakh you have received, only 3 lakh you have deposited back to the customer. Therefore, 2 lakh will be added back. Whenever you will deposit back that, whenever you will give back that 2 lakh rupees to the customer, at that time we will give you the deduction. Next one is the adjustment because of which that first line was given. You remember that in section 79 it is written that section 79 is applicable to closely held company, and one of the conditions for closely held company to carry forward the losses, your 51% of the shareholders should remain same on the year of loss and in the year in which you want to set off. So if the 51% shareholders are not same, you cannot carry forward the loss. So in this case, see, 55% of the shareholders have changed. So Mr. X, who was holding 55% shares, he sold the entire share. Therefore, his loss cannot be carried forward now. His loss will be lapsed under the income tax law. And the last but not least, the depreciation is 14 lakh 50,000 rupees. I hope it is clear to all of you. So this is what this question is all about. Let's move on to the next question. Question number 2, which is on a partnership firm, LLP. And in case of a partnership firm, first you have to always compute what? Book profit as per 40B for computing the remuneration allowable to the partners. Then you have to compute the total income, and then there can be an implication of AMT if there is a deduction of 10AA or profit link deduction or 3580 deduction. There can be an implication of AMT as well. So in this question, we have to compute all 3 of them. First book profit, then total income, and then AMT. So this is a LLP. LLP is engaged in what? The LLP is set up in SEZ. Therefore, it will be we need to compute what? 10AA deduction, and then later on we need to compute AMT also. Okay. Now it was set up in 2020. Therefore, this is a 5th year of business, and therefore it will be eligible for 100% deduction for the first 5 years. Now, what is the net profit of the LLP? It is 65 lakhs. First, I am going to compute the book profit. What is book profit? Book profit for the purpose of remuneration under 40B. So, how to compute book profit? Book profit is nothing but it is PGBP income only. All the provisions of section 28 to 44 you have to apply, and then whatever amount will come, that will be your book profit. So, let's start. 65 lakhs is your net profit after debiting and crediting the following items. First, profit on sale of import license. Shall I reduce while computing the book profit? No, no. Profit on sale of import license is part of section 28. It's a special charging section under PGBP. Do not reduce. Then remuneration to working partner. Yes, add back that. Interest to partner 16%. 16% not allowed. Only 12% allowed. Therefore, add back 4%. Okay. Donation to political party. No, that is not allowed under 40B. 40B only PGBP expenses and incomes have to be taken. Other than PGBP and expense, you have to add back. Okay. So add back this and take deduction under chapter 6 later on. Then depreciation. Yes, accounting depreciation you have to add back. Tax depreciation you have to reduce. Okay. Now. Payment of remuneration to working partners and interest on capital are authorized by deeds. Yes, it has to be authorized. So what about brought forward business loss? Shall I reduce this? No. While computing the PGBP, while computing the book profit, you only have to take the income and expenses and losses only from 28 to 44, and business loss is not allowed to set off under 28 to 44. Therefore, don't take this. This you will take while computing the total income. What about unabsorbed depreciation? Yes, unabsorbed depreciation you can take because unabsorbed depreciation is allowed under section 32 subsection 2. Therefore, it comes under section 28 to 44. Therefore, you have to adjust this. After doing all those things, you will get what? You will get your book profit. Okay. Now the book profit is 87 lakhs. So how to compute the remuneration? up to 6 lakhs. For first 6 lakh, it is 90% of book profit. So for first 6 lakhs, it is 5 lakh 40, and on balance above 6 lakhs, on balance 81 lakhs, it is 60% of book profit. Therefore, it will come to 48 lakh 60,000. Total 54 lakh will come as a remuneration, which is maximum allowable to the partners. How much remuneration you are giving to working partners? Actual remuneration is 50 lakhs. Whichever is lower, that will be allowed as deduction. Therefore, only 54 lakhs will be allowed as deduction. Therefore, your total income, business income, will come to 33 lakhs. Now, from this, you will reduce what? From this, you will reduce your business loss of 4 lakh rupees, and therefore, your total income will come to 29 lakh rupees. Okay. Now, from this, we will compute what? We will compute our 10AA deduction. This is the 5th year of business. Therefore, we will get 100% deduction. Now, what is the formula to get the deduction? Profit derived from export multiplied by export turnover divided by total turnover. Now, while taking the profit, ICI has taken two views. One of the view which has been taken by ICI is you should take the profit before the losses. Another view they have taken is you should take the profit after the losses. Obviously, the answers will change according to that, and both the answers are correct. If we are taking, suppose, the profit before the losses, say 33 lakhs. So from this, first of all, we have to remove this 9 lakh rupees. Which 9 lakh? This 9 lakh. Why, sir? Because it is very clearly written in 10AA that profit from sale of license shall not be part of profit for the purpose of 10AA. So in 10AA, you do not take the profit from sale of license or duty drawback or cash compensatory support. All these things are not taken as a part of profit. So if we are taking the first view, 33 lakhs, so remove 9 lakh, it will come to 24 lakh. If you are taking second view, remove 9 lakh, it will come to 29 minus 9, that will be 20 lakh. This will be your what? Profit. What is your export turnover? See, your export turnover is 45 crore rupees, but see, as per 10AA, it is very clearly written, you can take only that much export turnover which is received in India within 6 months on the end of the financial year in convertible foreign exchange. So out of the total turnover, total export turnover, how much is received in India up to 6 months? 38 crore is received in India up to 6 months. So you will take only 38 crore. Now wait. In that also, any kind of expenses like insurance, freight, telecommunication charges, those should not be part of export turnover. So are you incurring some telecommunication etc. charges? Yes. Out of 38 crore, 2 crore rupees is telecommunication, insurance, freight etc. These type of expenses which shall not be part of our export turnover. Therefore, out of 38 crore, reduce 2 crore further. Therefore, your export turnover will be only 36 crore. Okay. Now, what is your total turnover? Your total turnover is also 45 crores. Now, in total turnover, you will not take one thing, that is insurance, freight and other charges. Now, how much insurance, freight and other charges is there in 45 crore? It is 5 crore rupees. So, out of 45 crores of total turnover, 5 crore is expenses of insurance, freight, other charges and telecommunication charges. Therefore, this will be 40 crore. So, I got all the three amounts. Profit I got multiplied by export turnover 36 crore divide by total turnover 40 crore. So now I am computing my what? My computing 10AA. I am taking the first view. If I take the first view, it is 33 minus 9. Therefore, it will be 24 lakh into 36 crore divided by 40 crore. And therefore, my deduction will be 21 lakh 60,000. I can take another view also. In that case, it will be 20 lakh into 36 crore into 40 crore. So the answers will change slightly. Okay. Now, after doing all those things, I will get what? I will get the deduction of 10AA, and after that I will also claim the deduction of 80 GGC, the donation to political party. Now after that my total income will be 4,40,000. On that I will apply 31.2% tax, and this will be my tax liability. Now the answer will not complete. Now I also have to compute AMT. Okay. Now while computing the AMT, what am I supposed to do? Whatever is my total income, in that I will add 10AA. What is my 10AA? It is 21,60,000. So 4,40,000 plus 21,60,000. That will be my adjusted total income. On that I will apply 18.5% tax, 4% cess. And then I will compare this tax with this tax. Whichever is higher will be my tax liability. And if AMT is higher, I will also get AMT what? Credit. I hope it is clear to all of you. So this is what this beautiful question is all about. So let's go ahead with the next question. The next question number 3 is on taxation of trust. There is a trust by the name called as Fit Me Foundation. They have some questions which we need to answer. First of all, they have received a voluntary contribution of 125 lakhs with a specific direction. It means it's a corpus donation, and they have invested that in a private limited company share. So that is not allowed. You have to invest the mode. Whenever a corpus donation is received, you have to invest that donation in the mode specified in 11.5. Only then it will be exempt. So, and if you invest in a private company shares is not covered in section 11.5. Therefore, this amount will be taxable. You will not be eligible for exemption for this particular case. Okay. Next one, there's a trust who is receiving 125 lakhs. It received 95 lakhs from other contribution and 60 lakhs from providing yoga services. So providing yoga services is very much within the definition of charitable purpose. Therefore, the trust will be eligible for what? Exemption under section 11 and 12. Claim 15% exemption out of the total 125 lakhs, and balance you can apply and claim the deduction. I hope it is clear to all of you. Next, Mr. Nagraj is the founder of the trust of a charitable trust registered under 12 AB. Now it's a hospital. Now the son of Mr. Nagraj, that is the son of founder, was not well, and therefore he was admitted in the hospital. So can a son of a founder be admitted in the hospital? There is nothing wrong in admitting the son of a founder in the hospital, but the point is you should charge that son also equally as you charge to others. Now you are charging how much to the son of a founder? You are charging only 3 lakh rupees to the son of the founder, and how much you are charging to the others as a general fees? To others you are charging 5 lakh rupees. So you are charging less to the son of the founder, and the son of the founder is considered to be a specified person under section 13 subsection 3. Therefore, the amount which you are not charging less, the amount which you are not charging properly, that is 2 lakh rupees, will become deemed income of the trust, and that 2 lakh rupees will not be allowed as what? Deduction also to the trust. I hope it is clear to all of you. Next question is a beautiful question on what? On DTAA. Mr. Ritesh, it's a different kind of DTAA question. Whenever such beautiful questions will come, I will definitely discuss. But if a routine kind of DTAA question comes, I am not going to discuss them. Now this is a beautiful question. This is a resident individual aged 42 years. Now he is earning income from multiple places. First, he is earning from business in India. So you will write down this. Then he is earning income from royalty from country N. How much? 7,80,000. Now India has a DTAA with country N. You can see in additional information. As per the DTAA, India and country N, the royalty will be only taxable in the source state. Now which is source state? India is a resident state for Mr. Ritesh, and country N is the source state for Mr. Ritesh. Therefore, this royalty is only taxable in source state, that is in country N. Therefore, this royalty will not be subject to tax. Therefore, this is not taxed in India. So forget about this. Okay. Now let's talk about the third income. Interest from country Y. Now, how much interest is earned from country Y? $9,500. Okay. Now, where is this taxable? So, as per DTAA between India and country Y, you can check over here. It is taxed in both the states. That is in country Y also and in India also. And the credit will be given in respect of tax payable in the resident state. So, this interest will be chargeable in country Y also. This interest will be chargeable in India also. And India ultimately will give them what? DTAA credit, because India is a resident state. Therefore, now we need to convert this interest into rupees, because this is in dollar. Now we need to convert this into rupees as per rule 115. If you want to convert the foreign income into Indian income, you have to apply rule 115. Now interest has to be converted into rupees as per rule 115. So I should take which rate? Now here also I have to make one assumption. If I assume that it is interest other than security, then I have to convert as per the TTBR of the last day of the financial year. And if I consider this as interest on security, then I have to take TTBR of the last day of the preceding month. Okay. So for interest other than security, it is the last day of the financial year, and for interest on security, it is last day of the preceding month. So we are assuming interest other than security, and therefore we are taking what? Because it is not clarity. There is no clarity that what kind of interest it is. They are just writing interest. It is whether it is interest on security or interest other than security, that they have not mentioned. So we are assuming it is interest other than security. So if it is other than security, you have to take TTBR on the last day of the financial year. And therefore the TTBR on the last day of the financial year is 80 rupees. So you will convert this as per 80 rupees, 9,500 into 80 rupees. Okay. And whatever tax you have paid in the foreign country, you will get the credit in India. Last, agriculture income in country M, 1,09,000 rupees. So that will also be taxable in India. It is not taxable in the country M. Check. Agriculture income is exempt in country M. But in India, obviously world income is taxable for residents. Therefore, this will be taxable. So now after this, you will compute the tax of the Mr. Ritesh. So 4,85,000 is business income in India. Royalty for country N is not taxable because that is taxable in country N. Then country Y interest will be taxable and agriculture income will be taxable. We are following old regime in this question. Compute tax as per old regime. That will come to 2,27,448. Now whatever is the doubly tax income, we will get relief on that. Now, first one is an Indian income, therefore this is not doubly taxed. Second one is not taxed only in India, so therefore there is no question of doubly tax. Third one, yes, it is doubly taxed here and there. Fourth one is also not doubly taxed because it is only taxed in India. It is not taxed in foreign country. You can see point number 3, agriculture income is exempt in country M. Therefore only the third one is doubly taxed. Now how much tax you have paid in the foreign country and how much tax you have paid in India, whichever is lower, that will be allowed as deduction. Okay, that will be allowed as relief. Now let's see what is the average rate in India. 227,448 divided by 1354. Therefore the average rate in India is 16.798. And what is the doubly tax income? 7,60,000. So on 7,60,000, 16.798 is the tax paid in India. Therefore, this is the tax paid in India. Okay. Now, how much is the tax paid in foreign country? The tax paid in the foreign country is 10%. 10% amounts to $950. Now, how to convert the foreign tax into Indian rupees? As per rule 128. As per now, rule 128. To convert foreign income, rule 115. To convert foreign tax, rule 128. So, how to convert this? You have to take TTBR on the last day of the preceding month. When the tax is paid on 21st of Feb 2025. Therefore, the TTBR of the last day of the preceding month will be 31st Jan 2025. That will be 78 rupees. So, $950 into 78 rupees, that will be the amount of credit you are going to get. $950 into 78 rupees, 74,100. Whichever is lower will be allowed as what? Will be allowed as credit. You can take that much credit, and balance you have to pay out of your pocket. I hope it is clear to all of you. Let's move on to the next question. Question number 4, which is on TDS. In the very first question, there is an Indian company which is importing certain computer software from a non-resident company based in USA. Now, when you are purchasing computer software, you need to understand for what purpose you are purchasing that computer software. Now, if you are purchasing that computer software to resell in India, okay, to the end user or for your personal use, then in that case, it does not amount to royalty as per the Supreme Court judgment of Engineering Analysis Excellence Private Limited. So if you are purchasing a computer software for resale to end user, then it does not amount to royalty. And if it does not amount to royalty, you are not supposed to deduct TDS on that particular item. Okay, I hope it is clear to all of you. Now, the next one is there is a public sector company who has paid 20 crore rupees to an organization who was providing some services with relation to ATM networks. Okay. So I'm a bank. I'm providing some payment to organization which is providing us some services with respect to what? With respect to ATM services. Now, whether am I supposed to deduct TDS? See, 194H will not apply over here because there is a principal relationship over here. 194H is applicable only if there is a principal and agent relationship. So, if there is a principal and agent relationship, 194H will apply and the amount will be called as commission. But if there is a principal relationship, there is no need to deduct TDS under 194H. Even 194J is not applicable because there is no manual or human interference over here. So, because there is no manual or human interference over here, the question of professional fees does not arise. Therefore, even 194J is not applicable over here. Now, the third question is a very famous question on 194C, which we have discussed in the class also. Suppose I want to make a shirt. I want to stitch a shirt. So, I am going to a tailor to stitch a shirt. Now, the tailor asks me who will give the cloth. So, if I give the cloth or if my associated entity gives the cloth, listen carefully. If I give the cloth or if my associate entity gives the cloth, then I have to deduct the TDS. Okay. Now, the TDS will be deducted on how much amount? The TDS will be deducted on only the stitching charges. If you give me a breakup, this much is for stitching, this much is for cloth. But if you don't give me the breakup, and if you give me a consolidated invoice, then I will deduct TDS on the entire amount. Now, coming to this question. In this question, the cloth is provided by my closely related party, that is my associate entity. Therefore, TDS will definitely apply. Now, the question is on how much amount? The other person, that is the person who is stitching the shirt, they are providing me a consolidated invoice. Now, that is where they have made a mistake. Now, because they are providing a consolidated invoice, I have to deduct TDS on the full amount under 194C. I hope it is clear to all of you. And the last question over here on TDS, there is a Canadian citizen who is a non-resident sportsman. Therefore, 194E will apply, 115BBA will apply. So, whatever income they are earning from participating in matches, that will be subject to 20% tax plus 4% cess. Honorarium from writing an article relating to sports for sports magazine, that is also covered under 194E. That will also be subject to 20% tax plus 4% cess. I hope it is clear to all of you. Now, the next question is a beautiful question on what? On transfer pricing. In this question, we need to compute the arm's length price as per cost plus method. So, in cost plus method, what are we supposed to do? We are supposed to find out the cost with respect to associate enterprise, and on that we apply the arm's length margin of the third party, and then we will get our arm's length price. So, here MNO Limited is an Indian company and it is a subsidiary of a company MNO INC. Therefore, because MNO Limited and MNO INC are holding subsidiary, both of them are deemed to be associate enterprise. Therefore, transfer pricing will apply on them. Okay. Now, during the year, MNO has provided some services to MNO INC. Now, MNO also provides similar services to whom? To HTY, which is an unrelated party. Okay. So now we need to find out one by one lot of things. First of all, we will find out what is the margin of the unrelated party. What is the margin of the unrelated party? Now listen carefully. MNO works 9 hours per day for 18 days for MNO INC. Okay, listen carefully. MNO works 9 hours for 18 days to execute the project and 8 hours for 18 days to execute the project for HTY Limited. So let's find out the gross margin of HTY first. Because whatever will be the gross margin of HTY, that we will apply on the cost of MNO. Okay, listen carefully. Whatever is the gross margin of the third party, that we have to apply on the cost for which we are providing services to MNO INC. So what is the gross margin of HTY? Let's try to understand. How much is the cost of HTY? 8 hours per day for 18 days. And the cost is $120 direct cost, $210 indirect cost. So let's try to find out the cost of HTY. The cost of HTY will be direct cost $120 for 8 hours for 18 days. Indirect cost $210, 8 hours for 18 days. Therefore, the total cost is 47,520. But wait. This is only the direct cost. There is one more indirect cost also when we provide some services to HTY. What is that indirect cost when we provide services to HTY? Listen to the question carefully. Listen carefully. Warranty was provided to HTY for a period of 2 years. The cost of warranty is 1.5% of the direct cost. So this is an additional cost when we provide services to STY, which is 1.5% of the direct cost, which is called as warranty cost. So direct cost is 17,280. 1.5% of 17,280 comes to 259. So this is my total cost. And what is the billing amount to HTY? The billing amount to HTY is 92,000 rupees. Therefore, this is the cost. This is the billing amount, which is given in the question in the very first line. Differential amount will be called as what? It will be called as the margin. Now I will find out my gross margin to the third party, that is HTY. That is 44,240. 220.8 is your margin and 92,000 rupees is your what? Is your selling price. Therefore, your margin is how much? 92.55%. Now this margin I will apply on what? The cost of MNO INC. Okay, whatever services I am providing to MNO IC, whatever is the cost in that case, that I will apply this particular rate on that particular cost. So MNO I am providing how much services? MNO I am providing services 9 hours per day for 18 days. Okay. Let's see now. 9 hours per day, 9 hours per day for 18 days, 9 hours per day for 18 days, direct and indirect cost. Apart from that, there is some extra cost also of borrowing in respect of MNO. MNO INC, that is the foreign company, has given us a loan of 1,20,000 rupees at the rate of 4% per annum. So that also will be added over here. 1,20,000 at the rate of 4% per annum, divide by 12, because we are computing the monthly data. That is the reason I am dividing this by 12. So this is an additional cost when I am providing services to MNO INC. And this is my cost. And on this, I will apply the margin of HTY, and therefore I will get my arm's length price. Then I will compare this with my actual price. I hope it is clear to all of you. Is it clear? Now the next question, the first question over here, the point number 1 is on a very important case law which we have done in class, Pepsi Foods Limited, which is on tribunal, which is on ITAT. Now listen carefully, ITAT generally has to pass an order within 4 years from the end of the financial year in which the appeal is filed. Generally, this is a normal time limit to file to pass an order by ITAT. Now listen carefully, but if the assessee has taken a stay, then ITAT has to pass an order within 180 days. Within how many days? In case of stay, the order has to be passed within 180 days. Now, can it be extended beyond 180 days? Yes, it can be extended beyond 180 days only if the delay is not attributable to assessee. It means if the delay is because of the ITAT, it has to be extended beyond 180 days also, but then it has to be extended up to 365 days. The stay will be extended up to 365 days and the appeal order will also be passed up to 365 days. Can it be extended beyond 365 days? The income tax law says very clearly, no. The income tax law says that beyond 365 days, it cannot be extended. The stay cannot be extended. The stay has to be vacated after 365 days. Even if it is a mistake of the ITAT, even if it is not a mistake of the assessee, the stay cannot be extended beyond 365 days. Now here comes the Supreme Court in the case of Pepsi Foods Limited, which says that no, that is absolutely wrong. If the delay is because of the ITAT, if the delay is not attributable to the assessee, if the delay is attributable to the ITAT, then they have to extend the stay beyond 365 days also. That is what has been written in this particular case. Okay, I hope it is clear to all of you. Now the next one is a very simple case on board for advance ruling. An order is passed by the board for advance ruling. Now is this order which is passed by board for advance ruling, is it binding on the applicant? And the answer is no, it is not binding on the applicant. The applicant has an option to file an appeal to High Court within 60 days from the date of receipt of order. Now, in case of genuine reason, it can be further extended by another 30 days. Okay, so it is not a binding order. There is an option to appeal to High Court. Next one, there is a public sector company whose case is already pending before ITAT. Can it go for board for advance ruling remedy? And the answer is yes. See, generally you cannot go for board for advance ruling if your matter is already pending in front of ITAT or Income Tax Authority or High Court or Supreme Court. Okay, you cannot go to board for advance ruling remedy. But for public sector undertaking, there is a relaxation that in case of a public sector undertaking, if their case is pending in front of Income Tax Authority or ITAT, even in those cases, they can go for what? They can go for what? They can go for the board for advance ruling benefit. Okay, so that is the reason they are able to go for advance ruling benefit over here. Okay, now one last question over here is, in the following independent cases, we need to identify whether GAR is applicable or not. So there is one company which was making losses, so another company acquired that company to take the benefit of that loss. Is it allowed or not? Absolutely allowed. It is a case of tax planning. There is nothing wrong in that. So if there is one loss making company, another profit making company, and if the profit making company is acquiring the loss making company, that is absolutely allowed as per section 72A of the income tax law, and there is nothing wrong in that. Okay, now the second question, there is a company A Limited which is in India. There is another company C Limited which is also in India. Now instead of giving the loan directly to C Limited and earning interest on that and paying tax on that, what A Limited is doing, A Limited is opening one subsidiary in what? In a tax haven, and giving the money to that subsidiary, and that subsidiary is giving loan to C Limited in India. So they are diverting the funds indirectly to India through a tax haven. Whether GAR will apply or not? Yes, it's a clear case of tax avoidance. Therefore, GAR will apply in this particular case. I hope it is clear to all of you. Third, the assessee is a manufacturer. It wants to set up a unit in SEZ and claim 100% deduction under 10AA. Is GAR applicable? No, it's a case of tax planning. There is nothing wrong in that. You can open a unit in what SEZ and export the goods manufactured over there, and you can claim deduction under 10AA. There is nothing wrong in that. Okay. And the last but not least, it's a very good question on non-resident, which is about agent. Who can be called as an agent in India? So let me read the question first of all. The jurisdictional assessing officer of Mr. Albert. So Mr. Albert is a non-resident, wants to treat the following person as his agent. So now Mr. Albert is owning one residential house in Goa. Now Mr. Albert is selling this house to another person, Mr. D'Souza. Can Mr. D'Souza be treated as an agent? The answer is yes. As per section 163, if a non-resident is selling his property in India to another resident or to another non-resident, listen carefully. If a non-resident is selling his property in India to another resident or to another non-resident, then the buyer can be treated as what? His agent, and he will be responsible for all the tax liability, all the procedure requirement as the case may be. Similarly, point number 2, Mr. Albert employed Mr. Rakesh in 2023, and then Rakesh left the company in 2024. So can Rakesh be called as his agent? See, if any person is your employee, then that person can be called as an agent. But in this case, Mr. Rakesh cannot be called as an agent in 24-25 because Rakesh was employee in 23-24. Rakesh is not employee in 24-25. In 24-25, he left the company. You can check it over here. Therefore, Rakesh cannot be called as what? An agent on behalf of Mr. Albert. I hope it is clear to all of you. So this is what this paper is all about. Now let's move on to the next paper, that is May 2023. This will be our 6th paper, I guess. Yes, 6th paper. So very first question again over here is on total income. The first question over here is on total income. You are supposed to compute total income. That's it. No tax, nothing. You are not supposed to follow 115 BAA or BAB. So you will compute total income as per the normal provision. The assessee is a manufacturer. The net profit is 1 crore 25 lakh rupees. Now the very first adjustment over here is advertisement expenditure of 1.6 lakhs paid in cash. So you cannot pay more than 10,000 in cash. Now one more mistake you have done over here is you are paying excess money to your sister cousin. How much is the market value? The market value is 52,000. You are paying 1,60,000 to your sister concern. Therefore, you are making 2 mistakes. First of all, you are paying excess to your related party. Second, you are paying in cash also more than 10,000 rupees. Therefore, if both the sections 48.2 as well as 48.3 are applied at the same time, you are supposed to follow the order of the law. First, you will follow 48.2 and then you will follow 48.3. So in 48.2, you will disallow the excess amount first. What is the excess amount? 1,60,000 minus 52,000. This is an excess amount that will be disallowed, and the balance, if it is more than 10,000 rupees, that will be disallowed under 40A3. I hope it is clear to all of you. Now, you are doing some repairs to your plant and machinery. Now, this repair amounts to what? Replacement of some worn out part of the machinery. There is no increase in the capacity of the machinery. Therefore, it will be called as a revenue expense, and therefore it will be allowed as a reduction under section 31 because there is no additional increase in the capacity of the asset. Okay. Third one. The third one is something which we have done earlier also. Till last year, the company used to make a mistake of including the interest expense in the opening and the closing stock, and in the current year, the company has rectified that mistake. So if everything is rectified by the company, we don't have to give any effect for this particular adjustment because the company itself has rectified that mistake in the current year in their P&L. Next, one of their employees was on a business trip and he died over there. So employee was on business trip and he died over there, and therefore the company is voluntarily paying him some money. What? In the form of what? Gratuity of 2 lakh rupees. So that will also be allowed as deduction because the employee was on what? Was on a business trip. Okay. So it is your responsibility to take care of him, and in case he dies, therefore you have to pay what? Some gratuity to him. I hope it is clear to all of you. Next adjustment, you are incurring some capital expenditure for promoting family planning. Now remember, family planning expense is only allowed to companies, and that too, if it is a capital expenditure, it is allowed in 5 equal installments. Therefore, you are debiting entire 2 lakh rupees in the current year. Sorry, entire 1.8 lakhs in the current year. Therefore, 4/5 will be disallowed in the current year. Okay, only 1/5 will be allowed. Therefore, 4/5 you have to add back. Okay. Next, you are giving some retrenchment compensation to employees when you are closing one of the unit. Remember, always I have told you in the provision of 37(1) also, if you close one of the unit and then you retrench the employees and pay them retrenchment compensation, that is allowed as reduction. But if you close the entire company, if the entire company is closed, at that time if you give retrenchment compensation, that is not allowed as a deduction. Next one is you have taken some loan from a cooperative bank. What kind of loan? You have taken a trading loan, that is working capital loan. Now, the cooperative bank has waived your loan also, they have waived your interest also. Now, whatever principal they have waived now, whatever principal they have waived, that will be called as remission and cessation of trading liability. That will be considered to be your income and that will be taxable. So, do not reduce that particular thing. But whatever interest they have waived now, whatever interest, that will not be subject to your income. Why? The logic is very simple, because earlier interest was not allowed as an expense on accrual basis. So, now on waiver of the interest should not be taxable also. I hope it is clear to all of you. Next one, employees pension scheme. How much is allowed as a deduction to the employer? We have done earlier also. Up to 14% of the salary, basic salary plus DA in terms. It will be allowed up to 14% of basic salary plus DA in terms. You are paying 12% of basic salary in DA in terms. Therefore, entire amount will be allowed because you are paying less than the limit mentioned by the Government of India. Next one, mark to market loss is allowed as deduction under section 36 subsection 1 clause 18 clause 19, but only and only if it is from a settled derivative. If it is from an unsettled derivative, that will not be allowed as deduction. Therefore, you have to add back that also. Next one is a very routine adjustment. Provision for gratuity on actuary on the basis of actuarial valuation is disallowed under 48(7). But whatever provision, whatever gratuity you have actually paid of 2.75 lakhs, that will be allowed as a deduction to you. Okay. Next one, you have taken some loan from a private company in which you hold 16% voting power. So if I hold 10% or more voting power in a private company, that is a closely held company, and if that company gives me a loan, that amounts to deemed dividend. How much loan they have given me? They have given a loan of 4 lakh rupees, but deemed dividend cannot be more than accumulated profits. The accumulated profit is 1 lakh rupees. Therefore, the deemed dividend will also be how much? Will also be 1 lakh rupees only. I hope it is clear to all of you. Next one, the company has given iPhones to 5 distributors as what? As a business benefit, as a benefit of purchased in business. Now, the iPhone cost 60,000 each and 5 iPhones have been given. So, total of 3 lakh rupees gift has been given in business to somebody, but the company has not deducted TDS on that. So, company should have deducted TDS under 194R. We all know that 194R is applicable. If you give any benefit of purchased in business to anybody, to any resident person, then you have to deduct TDS under 194R at the rate of 10% in excess of 20,000 rupees if the threshold is 20,000 over there. Now, here the total is 3 lakh rupees. You have not deducted the TDS. Therefore, 30% of this amount will be what? Disallowed. And last but not least, you are paying some 3,50,000 to an electoral trust by RTGS. So that will be allowed as reduction under 80 GGB. I hope it is clear to all of you. So it was a very simple question, nothing great as such. Okay. Most of the adjustments were repetitive in nature. Now question number 2, it's a good question. The first part is a simple one. The second one is a beautiful one. The first part is a simple one. Mr. A is 34 years old. He is a salaried employee. Now he has furnished the following details. We are supposed to compute the total income of Mr. A. Assuming he has not opted for 115 BSc, it means he is following what? The old regime. He is not following 115 BSc. He is following the old regime. Now his salary is 23 lakh rupees. So from that he will get 50,000 standard deduction. Now business loss 4.5 lakh. Can I set off my business loss against salary income? No, you cannot. You have to carry forward the business loss. Next, short-term capital loss of 3,60,000. Can I set off my short-term capital loss against my salary income? Again, not possible. Capital gain loss can set off only against capital gains income. It cannot be set off against other income. So even this 3,60,000 you have to carry forward and set off. Okay. Till here it is very simple. The next one is also very simple. You are selling some virtual digital currency, that is virtual digital asset, VDA 115 BBH. 1,000 BIP coins you are selling. You are selling for 1,300 rupees. You purchase for 1,000 rupees and the transfer expense is about 2%. So the selling price is 1,300. Transfer expenses are not allowed in case of virtual digital asset. Therefore, this transfer expense is of no use, but the cost of acquisition will be allowed as reduction. So 1,300 is the selling price, 1,000 is the cost of acquisition. So 300 rupees into 1,000 coins will be subject to what? Tax. Now can I set off this for 4,50,000 or 3,60,000 against my virtual digital asset income? No. Virtual digital asset income are directly taxable at 30%. There is no benefit against the virtual digital asset income. I hope it is clear to all of you. So these two losses can neither be set off against salary. These two losses can neither be set off against virtual digital asset income. I hope it is clear to all of you. Now this question is a beautiful question. There are 3 partners in a partnership firm. L, M and N. It's a partnership firm which was formed in 1996. Now L retires from the firm on 27th of July 2024. So now if a partner retires from a firm, then 2 sections are applicable in that case. One is 9B and second is 45(4). Why? Because retirement of a partner amounts to what? It amounts to reconstitution of a firm. And in case of reconstitution of a firm, 2 sections are applicable. First 9B is applicable and then 45(4) is applicable. Now what is 9B? In 9B, how the firm will be, in both the sections, the firm will be liable to tax. Partners are not liable to tax. In 9B, what are you going to distribute in 9B? In 9B, I am going to distribute stock and trade and capital asset. And in 45(4), what will come? In 45(4), money will come and capital asset will come. But in the order of the law, first you have to follow 9B, and then only you have to follow 45.4. So first of all, as per 9B, what is the first thing that the firm is giving to the partner? The firm is giving to the partner cash payment of 1 lakh. Is cash covered under 9B? No, cash is covered under 45.4. It is not covered under 9B. Is stock in trade covered under 9B? Yes, stock in trade is covered under 9B. So what is the market value of the stock in trade? 2 lakh. That will become the sale consideration of the stock in trade. And what is the cost of the stock in trade? The purchase price of the stock in trade was 1,20,000 rupees. Therefore, 1,20,000 will be the purchase price. Therefore, 80,000 will be the profit, which is chargeable under PGBP as per 9B. Okay. On that, the firm will pay tax at the rate of 31.2%. Firm will pay tax under PGBP at 30% plus 4% says 31.2%. Now, is one more thing the firm is giving to the partner L, that is land at Kota. Is that also covered under 9B? The answer is yes. What is the market value of that land? It is 17 lakh rupees. Now, when this land is transferred, the land is transferred on 27th of July, which is on or after 23rd July. Therefore, indexation benefit will not be available in this case. Okay. Now, this is the 17 lakh rupees. What will be the cost of acquisition of the land? The land was purchased for 60 lakh rupees, but the FMV of land on 1/4/2001 was 1,10,000. Therefore, you can take the cost of acquisition as 1.1 lakh. Therefore, 15.9 lakhs will be LTCG, taxable in the hands of the firm, and the firm will pay tax at the rate of 12.5% plus 4% says that will amount to 13%. So, the firm under 9B has to pay tax on these two things. On PGBP, 31.2%, and on capital gains, because it is transferred on or after 23rd July, 13% tax. I hope it is clear to all of you till here. Now, coming to the next part. The next part is 45.4. Under 45.4, what is the capital gains? Capital gains is A is equal to B plus C minus D. What is B? B means whatever money you have received. B means what? Whatever money you have received. C means whatever market value of the asset you have received. What is the market value of the asset received by the partner? It is what market value of capital asset. In 45.4, stock and trade doesn't come. In 45.4, only money and capital asset comes. Okay. So money is 1 lakh. B, C is market value of the capital asset, that is 17 lakhs, minus what? We need to find out this. Minus the capital account balance. Now the capital account of the balance of the partner L is 20 lakh rupees. Now here you don't have to make a mistake. You cannot directly write 20 lakhs over here. You need to recompute the capital balance over here by finding the change in the book profit, and then that book profit has to be, accounting profit has to be transferred to all the three partners. So listen carefully. When the firm is transferring the assets, as per 9B, the firm is first of all transferring stock in trade. What is the market value of the stock in trade? 2 lakh. The firm is transferring at 2 lakh. What was the cost of the asset? It was 1,20,000. Therefore, 80,000 is the increase in the accounting profit. Okay. 80,000 is the increase in the accounting profit. Is there any increase in the accounting profit because of the land? The answer is no. Because the market value of the land is 17 lakh, and today the book value of the land is also 17 lakh. So there is no increase in the book profit because of the land. Okay. So only because of the stock in trade there is an increase in the book profit. Now, after that, the firm is paying two kind of taxes. One, 31.2% on 80,000, that amounts to 24,960. And second, on 15.9 lakhs, firm is paying 13% tax, that amounts to 206,700. So the profit is increasing by 18,000. But because of the taxes, the profit is reducing substantially. So ultimately, there is a loss of 1,51,660 rupees. Now, this will be divided among all the three partners. If I divide this among all the three partners, every partner will get 50,533 loss. So what is the existing capital of the partner L? 20 lakhs. And he has to bear the loss of 50,553. Therefore, this will amount to somewhere around 19 lakhs. And B plus C is 18 lakhs and D is 19 lakhs. So after this, the answer will come to negative. So remember, if as per 45.4, if the answer is coming negative, you have to take 0. So therefore, as per 45.4, the capital gains will come to what? It will come to 0 rupees. It will not be subject to tax. I hope it is clear to all of you. So this is what this beautiful question is all about. I hope it is clear to all of you. Let's move on to the next question. Mrs. AB Inc. is a foreign company which is entering into some agreement with an Indian company for a project which is set up in Gujarat in India. So a foreign company is entering into an agreement with Indian company for a project in Gujarat. Now, they are providing two types of services: offshore services, onshore services. Offshore means they are providing services from their own country, and onshore means they are providing services from India. They do not have any business connection in India, whether they are liable to tax in India. The answer is yes. This amounts to FTS. Okay. So, if a foreign company is entering into a contract with an Indian company for setting up a project in India, that is in Gujarat, and they are providing some drawing and design, and they are providing some installation of machinery, all of them are considered to be a fees for technical services. And for fees for for royalty, interest and fees for technical services, there is no need to first of all have a business connection in India. There is no need to have permanent establishment in India. There is no need to have any place of business in India. Apart from that, there is no need to come to India and provide service. If they provide services from outside India, then also it is deemed to accrue or rise in India. If they come to India and provide service, then also it is deemed to accrue or rise in India. Now for the offshore services, they are charging how much? They are charging 3 crore rupees. So this will be subject to tax. And for onshore services, they are charging 2 crore rupees, but that is also subject to tax. Okay. Now this 3 crore rupees, they are discharging through a bank account. They are putting in your bank account. So that will be subject to tax. And this 2 crore rupees, they are not giving you in the form of money. Instead of that, they are giving you 6% debenture. So it doesn't matter. I am providing you services. You are giving me debentures instead of money. That is also taxable. But here there is one more catch. On this debentures, there will be charge of interest also. That will also be taxable in the hands of the non-resident. Okay. So how much interest will be charged? 2 crore is the value of debenture into 6% is the rate of interest. You are issuing the debentures on 1st of September. So 7th month interest has to be charged over here. That will also be taxable under 915. So in all, the non-resident ABC INC will be liable for 3 income, 3 crore rupees for the offshore service, 2 crore rupees debentures for the onshore services, and interest on debentures also, which is accrued in India. I hope it is clear to all of you. Now let's move on to the next question. Next question is on charitable trust. Let's see over here. There is a charitable trust which has been made for the benefit of the public. Now they are giving some interest-free loans to the company's employees. Now the AO is saying that this is covered under section 13(3) as a specified person, and therefore I will withdraw your exemption. So the entire question is based on only one thing. Is employee of the trust also considered to be a specified person under section 13(3)? And the answer is no. Employees of the specified persons are not covered. Employees of the trust are not covered under the definition of specified person under section 13(3). Therefore, the contention of the assessing officer is not correct. The assessing officer is wrong. Okay. Next one is a very routine question. There is an educational institution with an annual receipt of 2.4 crore and there is an hospital with an annual receipt of 2.5 crore. Are they eligible for exemption without getting an approval? And the answer is yes, because their total receipt does not exceed 5 crore from education and hospital. If the total receipt is up to 5 crore rupees, there is no need to take any approval. You can enjoy the exemption without taking an approval also. I hope it is clear to all of you. Now in the next question, question number B, the ICI has taken two views over here. Let me read the question first. Mr. Rizvi is an Indian resident. Now what do I mean by Indian resident? There is nothing like Indian resident in this world. Either you need to be resident in India or you should be non-resident in India. There is no concept of resident, Indian resident. So he is 35 years old. He used to work in United States in some company. He used to work in some foreign country and he used to earn some 9,500 AEDs. Now due to his ailing mother, his mother was staying in India and she was not well. So he left the job, he came to India. So after 3 months, he left to the job, he shifted to India in the month of July. So in the April, May and June, he was in the foreign country and from July onwards, he came to India. Okay. Now he started his consultancy business in India. He also had a property in foreign country. So he let out that property from July onwards. Okay. So in foreign country, he was staying in some property. So when he came back to India on 1st of July, so from 1st July, he has let out the property. Now we need to find out his residential status first of all. Without finding out the residential status, we cannot answer anything. So if he comes to India permanently on 1st July 2024, obviously he is staying in India for more than 182 days. Therefore, 100% is resident. There is no doubt about whether he is resident or not. But we don't know the status of his past years. Now, if he stays in the past 10 years, 2 years, he is resident, and if last 7 years he is staying in India for 730 days, he will be ordinary. I don't have the data. So both the possibilities are correct. So ICI has assumed both the things. In one of the assumptions, the ICI has solved the question by assuming he is a resident and ordinary resident. In another assumption, they have assumed that it is not ordinary resident. If he becomes, first of all, ordinary resident, then what will be the treatment? If he becomes ordinary resident, then everything, world income will be taxable. First of all, 3 months salary will be taxable in India, whatever he has earned outside India. For ordinary resident, world income is taxable. 9-month house property income will also be taxable, which is letting out from July to March. Then business from consultancy in India, that will be taxable. Then fixed deposit in country will be taxable. Saving bank in India will be taxable. Dividend in India will be taxable. And then the foreign tax rate they have given you. You will also claim 80D, but only 25,000 rupees medical insurance will be allowed because you are not senior citizen. For your parents also, you will get only 25,000 because your parents are non-resident. 50,000 is allowed for resident senior citizen, not for non-residents. So for parents also, you will be getting 25,000 rupees deduction under 80D because you are following old regime. And then we have to compute your sum, and it's a normal question on DTAA. First of all, salary, take 50,000 standard deduction, then house property, take 30% standard deduction, then take all the incomes, take 80 TTA also for saving bank interest, and then 50,000 rupees under 80D. Then compute your income, it's a normal computation. Now, But now think like this. If you are resident and not ordinary resident, then which incomes are taxable? For not ordinary resident, only incomes which are accrued in India, which are received in India, or if the business is done outside India and controlled from India, then it is taxable. So in that case, very few incomes will be taxable. Salary from foreign country will not be taxable. House property from foreign country will not be taxable. Only business income from India will be taxable. Interest from country S will not be taxable. Yes, interest from SBI will be taxable. Dividend will be taxable. Okay, and then you will claim the deduction, and then you will compute the tax. So in the second assumption, when you take NOR, there is no question of double taxation, because double taxation is not happening only. So in the second assumption, there will be no question of relief under 91. Relief under 91 is not possible. Relief under 91 is possible if there is a double taxation. So if you make the first assumption, that is also correct. If you make the second assumption, that is also correct in this particular case. Given a choice, you should make the second assumption, because second assumption is easier to complete in the exam. I hope it is clear to all of you. Now, the next question is again a beautiful question. Mr. P provides some technical consultancy to various clients. Okay. Now, because Mr. P is providing some technical consultancy to various clients, listen carefully. On technical consultancy, TDS is how much? It is generally 2%. Okay, under 194J. But what is the pay doing? Suppose you are providing me some technical services. So I am supposed to deduct here 2% TDS of technical services under 194J. But you are doing what? You are going to the assessing officer. Pay is going to the assessing officer and obtaining a lower deduction certificate of only 1%, and you are giving me that. So you have given me that certificate, and now I should deduct TDS as per 1%. So I should deduct TDS as per 1%. Okay, but you have made one more mistake. You have not filed the return of the last 2 years, and your last year's TDS is 1 lakh rupees. Now remember, now the provisions of 206 AB will attract, not AA. It is wrongly written over here by me. It is 206 AB. So what is my revised rate? Revised rate is 1%. But if the last year TDS is 50,000 or more, and if you have not filed the last year return, then the deductor has to deduct the TDS at twice the rate or 5%, whichever is higher. So twice the rate. What is the revised rate? 1%. What is twice of 1? It is 2%, or compare with 5%, whichever is higher. So ultimately, I will deduct TDS at how much? I will deduct TDS at 5%. Okay. I hope it is clear to all of you. Similarly, here you are purchasing some house for 60 lakh rupees, and the stamp duty value of the house is 82 lakh rupees. So you will deduct TDS on how much? I will deduct TDS on actual consideration or stamp duty value, whichever is higher. So I will deduct TDS on 82 lakhs, 1%. That is under section 194 IA. I hope it is clear to all of you. So this was a simple question. Now, the next question is also a very simple question on transfer pricing. There is a company Shahi Private Limited, which is in India, and it is located in SEZ. So it is eligible for deduction under 10AA. It was set up in 2015. Now, the company is engaged in manufacturing of consumable goods. The manufacturing is wholly dependent on the raw material provided by Sumi Inc. So listen carefully. I am Shahi Private Limited, which is in India. Sumi Private Limited is Sumi Inc. is in Japan, and I am wholly dependent on Sumi Inc. So remember, if one entity is dependent on the raw material of another entity to the extent of 90% or more, then both of them are deemed to be associate enterprise. So by that logic, Shahi Private Limited and Sumi Inc. are deemed to be associate enterprises. Now, we need to find out what the arm's length price. Now, Shahi is importing goods of 30 crore rupees from Sumi. Okay, how much they are importing? 30 crore rupees from Sumi. Now, Sumi is charging how much? Sumi is charging 20% markup to us on cost, and to others they are charging only 10%. So Sumi is charging us more. They are taking more money from us. From others, they are taking less money. From us, they are taking more money. So what shall I do? First of all, I will find out my cost. 30 crore is the price at which I import from Sumi. Now, if Sumi is charging me 20% markup on cost, 20% markup on cost is 1/5 on cost, which is 1/6 on sales. Therefore, I will reduce the profit 1/6 from this. So on cost, if it is 1/5, therefore on sales it will be 1/6. So the profit will be 1/6 of 30 crore will be 5 crore. Therefore, my cost will be 25 crores. Now I will apply the normal GP margin on this. What is the normal GP margin? The normal GP margin which Sumi Inc. charges to everybody, that is 10%. So I will add 10% over here of my cost. So 10% of cost will come to 2.5 lakhs. Now I will see if there is any other difference between both of them. Yes, Shahi Private Limited was allowed to use the brand name of Sumi without any payment. The actual cost of the brand value is 90 lakhs. So Sumi is providing us some brand value, some brand name they are allowing us to use. For that also they will charge us how much? 0.9 lakh, that is 90 lakh rupees. 0.9 crore, that is 90 lakh rupees. So that also I will add over here. Okay, 0.9 crore, that is 90 lakhs. So that will amount to 28.4 lakhs. Okay, so this is my actual arm's length price, and the price at which I am purchasing the goods are 30 crores. Therefore, the difference between the two will be considered to be what? 1.6 lakh rupees. I hope it is clear to all of you. I hope it is clear to all of you. So this is the answer to the first part. Now, If the second part, if the TPO has enhanced the income by 2 crore rupees, suppose if the TPO enhanced your income by 2 crore rupees, are you eligible for deduction under 10AA for that 2 crore rupees? The answer is no. Remember, as per 92C subsection 4, if the arm's length price is increased by the assessing officer or TPO, then on that increased arm's current price, you cannot claim deduction under 10AA, nor you can claim what? You can claim deduction under Chapter 6A. Chapter 6A and 10AA will not be allowed on this 2 crore rupees. Last but not least, will Shahi Private Limited be liable for penalty for under-reporting on the basis of the report of transfer pricing? No, penalty will not be applicable. Remember, penalty is only applicable under 270A if the transactions are not reported under Form 3CEB under as per 92E. If the assessee is reporting the transaction in Form 3CEB, then the penalty under 270A will not be applicable on the assessee. I hope it is clear to all of you. Now the next question is based on some case laws over here. The first case law is based on TDS. The assessee has deducted the TDS but has paid the TDS slightly late. Like there has been some delay by 1 or 2 months, but everything has been paid before receiving the notice from the department. So try to understand the sequence of events. The assessee has deducted the TDS, has paid the TDS slightly late, but everything has been done before receiving the department's notice. Now the question is, can the department because of this reason prosecute the assessee? And the answer is no. The court has said that if the assessee has deducted on time but has paid slightly late, everything has been done properly before receiving the notice from the department, then the department has no right to impose prosecution on the assessee. Okay, I hope it is clear to all of you. Now the next question is on, does the ITAT has the power to rear the entire order? Suppose ITAT has passed an order and after a few months the ITAT is asking for the order from the assessee, and now the ITAT is changing the entire order completely, taking a different view. The ITAT cannot do that. The ITAT cannot review its own order. That is practically not possible. Yes, if there is some apparent mistake in the order, then the ITAT can definitely rectify that mistake, but the ITAT does not have the power to review its entire order and rear the entire order. Okay, I hope it is clear to all of you. Now the third one. Now this is a very important question over here. Very beautiful case law. So there was an assessee who has initiated some MAP proceeding at international level. What is MAP proceeding, sir? Mutual agreement proceeding at international level. So the assessee was creating some, assessee was having some problem with the foreign authority. So assessee has complained to the MAP proceeding. So the MAP proceeding is pending in case of assessee. Now the question over here is, if MAP proceeding is pending in your case, can the department impose interest under 201 by charging you, by telling you that you are an assessee in default? The assessee was saying that no, because already a MAP proceeding is pending. Why are you initiating a new proceeding against me to charge me, to tell me as an assessee in default? The court said that there is nothing wrong in that. These two are independent events. Going under MAP proceeding is a separate event, and charging interest under 201 by holding you as an assessee in default, that is a different event. You cannot mix both of them. Okay. Otherwise, everybody will do that only to get evade from the provisions of what? Provisions of 201, that is assessee in default. You will initiate one MAP proceeding. The moment you will initiate one MAP proceeding, will you be escaped from all other provisions of the income tax law? And the answer is a big no. I hope it is clear to all of you. Is it clear? Let's move on to the next question. The next question is based on the concept of significant economic presence covered under Section 9. Now remember, under Section 9, it is very clearly written that if a non-resident is purchasing some goods of 2 crore rupees or more from India, then it is amounting to what? Significant economic presence. Or if the non-resident has 3 lakh users in India, then also it amounts to significant economic presence. Okay, so based on that, the entire question is over here. Kiwi Inc. is a company based in USA which is engaged in manufacturing and selling of mobile phones. Okay, globally. It sells each mobile phone for $2,000. Now Alpha Inc., another company which is having some website and which is working like what? An e-commerce operator and also providing some advertisement services. Okay, now Kiwi Inc. has sold 80,000 mobile phones through Alpha Inc. First of all, 2% resident in India. Yes, this will amount to significant economic presence because it is sold through a foreign company but through a resident in India. So 15,000 mobile phones into $2,000, you can multiply that, and what is the rate of dollar? In the last line you can see it is 80 rupees. So this will be more than 2 crore rupees, and therefore this amounts to significant economic presence. Now the second one does not amount to significant economic presence because you are not selling to residents in India. Third one will also amount to significant economic presence because again you are selling to residents in India. The fourth one will not amount to significant economic presence because you are again not selling to residents in India. The fifth one will also not amount to significant economic presence because you are selling through a physical store in US. It is just like me going to United States and buying something. That does not mean that the income of that particular physical store will be chargeable to tax in India. No, it has to be sold through resident in India, not in United States. Okay. If you go to United States and buy something from there, that cannot be accrued in India. Okay. That cannot be taxable. Apart from that, they are also providing some advertisement services for publishing advertisement for targeting the Indian customer. So if you are giving some services of advertisement for targeting Indian customers, that will also be taxable in India. So GLC, Gamma LLC enters into a contract with Alpha NC for publishing an advertisement on website from and it paid 90,000 for targeting Indian customers. So if you are targeting Indian customer and earning advertisements out of income out of it, that will also be considered as business connection under 911 and that will also be taxable over here. I hope it is clear to all of you. And one last question over here is we need to answer whether the following transactions will be reported under SFT or not, statement of financial transaction. First of all, Mr. A has purchased 5 bank drafts of rupees 3 lakh each from his current account. Whether this will be reported in SFT? No. In SFT, fixed bank draft is reported only if of 10 lakh or more. It is reported only if it is purchased through cash. If it is purchased through current account, then it will not be reported. Similarly, Mr. Q has made 2 time deposits. One is of 7 lakh, another is a renewal of 5 lakh rupees. So if you make a time deposit of more than 10 lakh rupees, it is reported in SFT. But while computing the limit of 10 lakh rupees, you will not consider the renewal point. And therefore, this renewal of 5 lakh rupees will not be considered over here. Okay. I hope it is clear to all of you. So if I don't consider this renewal, the FD is only of 7 lakh rupees. And because it is less than 10 lakh, that will not be reported in the SFT. I hope it is clear to all of you. Third one, for credit card, which transactions are reported? If the entire credit card transaction of the entire year is more than 10 lakh rupees, it is reported. Or if the cash payment of the credit card bill is more than 1 lakh rupees, then also it is reported. Now, first you are paying cash bill of 19,500 for 4 months. So multiply that will amount to somewhere around 78,000 rupees. Then you are paying 13,300 for 3 months. That will also amount to somewhere around 40,000 rupees. So if I total the first and the third one, the cash payment of the entire year amounts to more than 1 lakh. Therefore, first and the third transaction will be reported in SFT. What about the second transaction? The second transaction you are paying through bank, that will not be reported in SFT because the overall transaction is not exceeding 10 lakh rupees. First and third is the cash transaction. The cash transaction is exceeding 1 lakh. Therefore, that will be reported. The second will not be reported. And last but not least, Mr. Z is purchasing some 2 lakh rupees in goods in cash from Aurora Designer. Aurora Designer is liable for audit. Now remember, if I am Aurora Designer and if I am liable for audit and if I, listen carefully, if I purchase something, see, if I sell something in cash to somebody and if I receive more than 2 lakh rupees, if I receive more than 2 lakh rupees from someone, then it is reported. In this case, it is exactly 2 lakh rupees. Therefore, it is not reported. Listen carefully. If I am doing tax audit and if I am selling you something and if I receive more than 2 lakh rupees in cash from you, then I have to report that in SFT. Now, in this case, it is exactly 2 lakh rupees in cash. Therefore, this transaction will not be reported in SFT. So, this is what this paper is all about. Let's go ahead with the next paper, that is November 2023 paper. The very first question again is on total income only. Now, what is exactly we are supposed to compute over here? We are supposed to compute total income and tax payable. We are not supposed to follow 115 BAA or BAB. Okay, we are supposed to follow as per the normal provision. So let's start. The assessee is a manufacturer assessee. Therefore, you will also be eligible for additional depreciation if you purchase a new plant and machinery. 79,50,000 is the profit. Depreciation as per books of accounts will be added back. Some old machinery has been destructed because of which there is a loss of 25 lakh rupees. So this will be added back. Because it is a capital loss, that is not allowed as a deduction, and the scrap value will be reduced from what? From the PGBP income it will be reduced and it will be adjusted in the WDB of the block of asset. Okay. Next one. Income tax assessment has been completed and there is a demand of 5,70,000 which includes surcharge and cess also. So don't worry, even surcharge and cess are disallowed. Disallow the entire amount including the surcharge and disallow nothing is allowed. Neither income tax is allowed, nor surcharge nor cess is allowed under the income tax law. Next one, you are receiving some power subsidy of 13 lakh rupees during the previous year. That power subsidy is with respect to electricity bill. Now this subsidy is pertaining to 23-24 but you are receiving it 24-25. So remember, power subsidy received from the central government or state government will be taxable in the year in which it is received. So it will be taxable in 24-25. Since it is already part of income, therefore it will be taxable as therefore it will be part of income. It was not included in the income of last year. So it was good that it was not included in the income of last year. Remember, the subsidy, power subsidy, etc. These subsidies are income in the year in which it is received. Okay. Next one, there is some interest on margin money. Now, what is that margin money? Pay attention, please. I want to take some business contract. For that purpose, I have gone to the bank. I have to give some bank guarantee to the bank. Now, for the purpose of giving the bank guarantee, I have to make some fixed deposit in the bank. So I made a fixed deposit in the bank. For which I will get bank guarantee, and with the help of that bank guarantee, I will take business contract. Now, on that fixed deposit, if I am earning some interest, that is not income from other source. That is my business income. Therefore, this interest on margin money deposited with the bank for obtaining bank guarantee to carry on business will be chargeable under PGBP, and it will not be an IFRS income. So let it be part of PGBP only. Next one, you are purchasing some raw material for in-house research of 14 lakh rupees, in which 2,75,000 is GST, on which ITC is not admissible. So if ITC is not admissible, you can claim the deduction of GST also. If ITC would have been admissible, then you would have not been able to claim the deduction of GST. So you claim the deduction of entire 14 lakh rupees. Next, you are paying 12 lakh rupees to a Chinese company who is providing some online digital transaction. That company does not have a P in India. Therefore, you should deduct equalization levy. You have not deducted equalization levy. Therefore, this 12 lakhs will be disallowed. Okay. Next one is a very important point. It has come earlier also, but I am giving you justification for the first and the last time over here. Dividend of 2,50,000 received from a foreign company. Now, an expense of 15,000 has been spent on this income, and it is not an interest expense. It is other than interest. See, first of all, I will reduce this 2,50,000 from PGBP, and I will show 2,50,750 in IFOS. Then I will add back this 15,000 rupees and PGBP, and then I will not take the deduction under IFOS, because in IFOS against dividend income there is only one expense which is allowed, and that is interest expense, and this is not an interest expense, therefore it will not be allowed. Now you will ask me one question, sir, why are you not grossing up this dividend? See what ICI has been doing. ICI has not been grossing up the dividend which is received from a foreign company. ICI has been grossing up the dividend only if it is received from a domestic company. So what is the reason? The reason is very simple. I'll let you know. If you receive a dividend from a domestic company, the domestic company will deduct TDS at the rate of 10% under section 194. Therefore, we will gross it up. But if we receive the dividend from a foreign company, we don't know the rates of that particular dividend TDS, because if a foreign company gives you dividend, then in that particular case, TDS under 195 is applicable. Then in that case, I don't know what is the TDS in that particular case, because that TDS will change from country to country, and therefore the TDS is not fixed in that case. Therefore, if you receive dividend, moral of the story is what you know. If you receive dividend from if it is written dividend is received from domestic company, you have to gross up. If it is written dividend is received from foreign company, don't gross up, because we are not sure about how much is the rate of TDS in that case. Okay. Next one. Interest of 20 lakh rupees. You are discharging your interest liability by issuing debenture. Is it allowed? Absolutely not allowed. You cannot convert your outstanding interest into a new loan or debenture or any other security. It is not allowed. That does not amount to actual payment. Therefore, that is disallowed under the income tax law. Depreciation as per income tax law, you can claim 32,50,000 deduction. Then you are purchasing some air compressor, new machinery on 1st of May. You can claim 15% normal depreciation, 20% additional depreciation. For pollution control equipment, you can claim 40% normal depreciation, 20% additional depreciation. Some assets are purchased after 30th October. Lorries for transportation, you can claim 7.5% because it is used for less than 180 days. Additional depreciation not allowed on motor vehicle. Okay, road transport vehicle, additional depreciation is not allowed. One last point, you have imported some machinery which is arrived in the Kolkata on 30th of March, but you have installed in the next year. Therefore, on this you will not get any depreciation. Now, the turnover of last year is 450 crore. Therefore, you will be eligible for 30% tax rate, not 25% tax rate. Okay, I hope it is clear to all of you. So this is what this first question is all about. It was a very simple question. Let's move on to the second question, which is on MAT. You need to compute the book profit and MAT over here. There is a domestic company engaged in manufacturing. The profit is 89 lakh rupees. Now we need to see which items will be added back, which items will be reduced, and which items will not be added back, which items will not be reduced. Okay. First, expenses in relation to 10AA do not add back. 10AA expenses and 10AA incomes are not added back or reduced in MAT. Next, depreciation you have to add back, and then you have to reduce the same amount. Why? Because in MAT we add back the depreciation and then we reduce other than revaluation. There is no revaluation in this question. Therefore, you will add back the same amount and you will reduce the same amount. Next, interest not paid is not added back under MAT. Penalty is not added back under MAT. Proposed dividend add back. Provision for income tax add back. Transfer to general reserve add back. Then ATIA expenses are also not added back in MAT. Then amount, next one is a very intelligent adjustment. Amount withdrawn from reserve created during 21-22. So if you withdraw any amount from reserve and credit to P&L, generally we reduce that, but in this case we are not going to reduce. The reason is because the book profit of 21-22 was not increased by such reserve. If book profit of earlier year is not increased, then you cannot reduce this. If book profit of earlier year was increased by this reserve, then we would have reduced from here. Okay. Next one, 10AA profit do not reduce. Next one, ATIA profit do not reduce. Deferred tax credit you can receive. After that, there is a book loss. There is a book loss of how much? 8.75 lakhs and there is an unobserved depreciation as per books of nil. Therefore, whichever is lower will be allowed. Therefore, 0 will be allowed. Whatever amount we will get, that will be your book profit. On that, apply 15% tax, 4% cess. Surcharge is not applicable because income is less than 1 crore. Therefore, do not apply surcharge. Okay. Next one is provision of section 44 BBA, that is non-resident engaged in operation of aircraft. So now, when this income is accrued in India and how much it is accrued in India and what is the deemed income in this case? See, if the flight is leaving India, then it is definitely taxable in India. Then it doesn't matter where the money is received. But if the flight is leaving from outside India, then it is only taxable if it is received in India. So if the flight is coming from outside India, then it will be taxable if it is received in India. If the flight is going from India, then it is always taxable irrespective of where it is received. How much is the deemed income? Deemed income is 5% in this case. Now, first transaction. Messrs Airlines, XY Airlines collected 90 lakh rupees for carriage of passengers and cargo from Delhi to New York and vice versa, of which 40 lakh was received in New York. 40 lakh was received in New York for carriage of passengers from New York to Delhi. So the flight is flying from New York and the money is also received in New York. So therefore this 40 lakh will not be subject to tax in India. Therefore out of 90, 40 is reduced. Only 50 lakh is taxable out of the first 90 lakh. Second transaction, it collected another 70 lakhs, out of which 30 lakhs were received again in New York from New York to Bombay. Again out of 70, 30 lakhs will not be subject to tax. So only 40 lakhs will be subject to tax. So therefore 90 lakhs, 5% deemed income. How 90 lakhs has arrived? This 50 lakhs and this 40 lakhs, total 90 lakhs, 5% will be deemed income. You have incurred some expenses of 170 lakhs. That is not allowed under 44 BBA. I hope it is clear to all of you. Let's go on to the next question. Next question, point number 2, in which we are supposed to make two assumptions. First, there is an NRI, there is a non-resident Indian who is subscribing some unlisted equity shares. Okay. So we need to assume that if he has purchased in foreign currency or if he has not purchased in foreign currency. If he has purchased in foreign currency, then the provisions of chapter 12A will apply, or the optional chapter will apply, and he will get exemption under 115F. So if he has purchased in foreign currency, see on the board two views. First view, if he has purchased in foreign currency, 115F will apply. If he has not purchased in foreign currency, 115F will not apply. Okay. Now let's compute his capital gains. He has sold for 9 lakhs. Expense on transfer is 15 lakhs. He has purchased for 6 lakh rupees. Okay. Therefore, his capital gains will be 9 lakhs. Pay attention please on the board. See here. Where it has gone, yeah. Yes, here 9 lakh is the sale consideration, 15,000 is the expense on transfer, and 85,000 will be the net consideration. Okay. Now 6 lakh rupees will be what? 6 lakh rupees will be his cost of acquisition, and 2,85,000 will be his capital gains. Now, if he wants to save this 2 lakh for 85,000 rupees, he has to invest the net consideration in the specified assets within 6 months. How much he has invested? He has invested only 3,50,000 rupees in the question. You can see he has invested within 6 months only 3,50,000 rupees. You can check over here. Within 6 months, he is investing in specified asset 3,50,000 rupees. Therefore, he will get proportionate exemption. How much proportionate exemption he will get? He will get the proportionate exemption as capital gains of 2,85,000 into invested amount in the specified asset within 6 months divided by net consideration. Therefore, this will be allowed as a deduction exemption under 115F. Now, the second view. If he does not purchase the asset in foreign currency, then 115F will not apply. If this 115F will not apply, the answer will be getting over here, and therefore your answer will be 2,85,000 rupees. Indexation will not be allowed here also because you are transferring after 23rd July. See, in chapter 12A, indexation is never allowed. But even if you don't follow the chapter 12A, indexation won't be allowed because from 23rd July 2024, indexation benefit are not allowed to any person except one resident, which I have told you earlier. I hope it is clear to all of you. Now let's move to the next question. Question number 3, which is on charitable trust. Generally, the question number 3 is on charitable trust only. You can understand the pattern of the paper also by looking at this past paper compilation. So there is a charitable trust which is registered under 12AB, which is engaged for preservation of forest. Okay. Now they have asked the following questions. First of all, they are following mercantile system of accounting, and 1 lakh rupees is an electricity expense for 24-25, but unfortunately they paid on 10th of April 2025. Now we all know that for a charitable trust, the deductions are allowed on payment basis. Whenever they will pay the amount, only then it is allowed as deduction. It is not allowed on accrual basis. So therefore, because the electricity expense is paid on 10th April 2025, this will be allowed as deduction in 25-26, not in 24-25. I hope it is clear to all of you. Now the next question is, there is a charitable trust which is earning some agriculture income of 12 lakh rupees. Is it eligible for exemption under section 10(1)? The answer is yes. As per section 11(7), the charitable trust is eligible for exemption under section 10(1) of agriculture income, they can enjoy the exemption of section 10(1). There is no harm in that. Next one, the charitable trust is earning a rental income of 3 lakh rupees, but it received only 2 lakh rupees up to 31st December 2024, and the balance amount is received in the next year. Now listen carefully. 3 lakh rupees is the total rental income, but we received only 2 lakh rupees. Balance is received in the next year. So when they will apply this particular money, they will apply this money in the year of receipt or the year following the receipt. So if they don't apply in the year following the receipt, then it will become deemed income of the year following receipt. I am talking about which amount? I am talking about this 1 lakh rupees. So this 1 lakh rupees will be applied in the year of receipt, that is 25-26, that is July 25-26, or year following the receipt. If it is not applied till 2026-27, then it will become deemed income of 26-27. Now the next question is something which has been repeated so many times. I am irritated with this question, that you have taken a loan and with the help of that loan you are incurring some expense. Not allowed. It is only allowed when you repay the loan. Without repaying the loan, it is not allowed as a deduction. I hope it is clear to all of you. Now the next question is a very simple question on DTAA. I am not wasting my time over here because it's a very straightforward question of DTAA, a very basic question of DTAA. So let's not waste time on that. Okay, let's go ahead with the next question, which is on what? Which is on TDS and TCS. So there is a person, Mr. Ron, who is taking a loan from his employer of 10 lakh rupees. Now why is taking a loan from employer? He is taking a loan from employer for sending money outside India for education of his son in Germany. So he is taking loan from India, from his employer, to send money outside India in Germany for education of his son. Okay. Now, how much money he has sent outside India? He has sent outside India 8,75,000 for university, towards the university in Germany for son's education on 1/10/2024. Now listen carefully. How much TCS will be applicable on this? Whether he will get the benefit of 0.5%? The answer is no. 0.5% TCS is applicable if you take a loan from a financial institution in India and then send for education outside India. Mr. Ron is not taking loan from a financial institution in India. He is taking loan from an employer. Therefore, he will get the benefit up to 7 lakh, no TCS, and above 7 lakh, 1,75,000 he has to pay TCS of 5%, not 0.5%. 0.5% is applicable to whom, which I have told you just now. Now, apart from that, he also remitted 4,75,000 for pursuing higher studies in Germany towards his out-of-pocket expenses. So, whether out-of-pocket expenses are also considered to be part of education, whether the scope of education includes out-of-pocket expenses also, the answer is yes. So, this out-of-pocket expense will also be subject to 5% TCS. So, the first 1,75,000 will be subject to 5% TCS, and then 4,75,000 will also be subject to 5% TCS. Okay, I hope it is clear to all of you. Next one, Mr. Mandeep is a manufacturer, and the turnover of Mr. Mandeep for the last year, that is 23-24, was 12 crore rupees. Okay, now he has purchased the house. He has purchased the house for what? For 5 crore rupees. So now, whether the TDS will be applicable in this case? Yes. If you are purchasing an immovable property of 50 lakh or more, you have to deduct TDS at the rate of 1% of the consideration or stamp duty value, whichever is higher. Okay. Now, apart from that, he also paid a commission of 12% brokerage for purchasing that house. So 12% of 5 crore comes to how much? It comes to 60 lakh rupees. Now, Mr. Mandeep's last year turnover is more than 10 crore, more than 1 crore rupees, and Mr. Mandeep is paying commission for personal purpose. TDS will be applicable under 194H. So under 194H, personal purpose is covered? Yes. Under 194H, personal purpose is covered. Therefore, you will deduct TDS at the rate of 2% with effect from 1st of October 2024. Before that, it was 5%. In 194C and 194J, personal purpose is not covered. But in 194H, definitely personal purpose is also covered. Therefore, deduct TDS under 194H only. Don't go under 194M. I hope it is clear, all of you. If you are not covered in 194C, H or J, then you have to follow the route of 194M. But in this case, you don't have to go to 194M. Next one, the Registrar General of High Court has made a fixed deposit in the bank, and the bank is giving them some interest. So on that, TDS is not applicable. Sir, what is this exactly? Generally, what happens? Suppose if I am a litigant, if I have filed a case in the court, and if I am depositing some security deposit with the court, so court takes that money and put that in the bank in the format of FD. Now the bank will give that interest on FD to the court only. So on that interest, the bank is not liable to deduct the TDS. That is what it is written over here. I hope it is clear to all of you. Now the next question is also a beautiful question of case law. The first one is a beautiful one. There was an assessee by the name called as Surajit. He filed his return on 21st of July and declared an income of 11,75,000. Now in his return, he claimed two exemptions. First, he claimed an exemption of PPF of 95,000 rupees, and then he claimed an exemption of long-term capital gains under section 1037. Both of them were disclosed in the exempt schedule of the income tax return. Okay, so he has filed the return, and in the return he has shown two income, one PPF exemption, one long-term capital gain exemption. But unfortunately, he failed to claim current year business loss in the income tax return of 4,50,000 rupees. So he did not claim the current year business loss of 4,50,000 in the income tax return. The income tax return went for processing, and while processing the income tax return, the system disallowed the two exemption which he has claimed. The system disallowed the PPF, the system disallowed the long-term capital gains, and intimation was sent to Mr. Sujit and demand notice was raised. Now, later on, he filed a revised return under 139.5, but he failed to e-verify the return. Now, once you file a return, you have to e-verify now within 30 days. He failed to do that. Now, what he is doing, he is going for rectification under 154, and the AO rejected the rectification. Is the AO correct? AO is partially correct, partially incorrect. Now, what is the mistake in the intimation? The mistake in the intimation is to not give exemption of these two items. These two items were claimed by him in the income tax return. Why have you rejected that? That should be allowed. But the AO, the 154 will not allow you to claim 4,50,000 because 4,50,000 was not claimed only in the income tax return. So the question of mistake does not arise only. What was the mistake in the intimation? That the intimation did not allow you the two exemptions which you have claimed, but something which you have not claimed only. How can you tell the department to rectify that? Therefore, the department will not rectify 4,50,000 rupees loss. They will rectify the above two, that is the exemptions. I hope it is clear to all of you. Next one, we all know that once you take a loan from any person, then you cannot repay the loan of 20,000 rupees or more by other than four modes. That is account pay check, account pay draft, ECS, and such other electronic mode. But what assessee has done? Assessee has made the payment by making a book entry. That is, I have to pay you something, you have to pay me something. Let's knock it off through a book entry. So the AO started saying that no, you are not paying by four modes. Therefore, I will charge penalty for you. You are violating the provisions of 269T. Therefore, the matter went to the court. The court said that the penalty under 269T, that is 271E, is imposed by Joint Commissioner, and the Joint Commissioner cannot impose the penalty without giving a reasonable opportunity of being heard to the assessee. And once a reasonable opportunity of being heard is given to the assessee, and if the assessee proves that the transaction is bona fide, then you cannot impose penalty just because the payment is not made by four modes, and just because the payment is made by what? Interbook transaction or by book entries. You cannot disallow that. I hope it is clear to all of you. The next question is also a beautiful question. The assessee was engaged in the business of leasing and hire of purchase capital equipment. So I am a leasing company. Okay. So now you are my customer. You came to me for buying, for taking something on lease. Say for example, you have came to me for taking a car on lease. Okay. Now, so I gave you a car on lease. Now to buy that car, I have taken a foreign currency loan. Okay. To buy that car, what I have done? I have taken a foreign currency loan. And whenever I am paying a foreign currency loan, at that time there is some foreign currency loss. So I am claiming that loss as a revenue expense in the PGBP. Now the AO is not allowing that. The AO is saying that you should capitalize that to the cost of asset and claim depreciation as per 43A. Now the court said that no, it should not be capitalized to the cost of asset. Taking loan is a separate transaction and giving asset on a lease is a separate independent transaction. Therefore, take this loss in what? In the P&L account only. No need to take this loss in what? In the asset and take depreciation on that. Do not do that. You cannot do that. You will do that only if both of them are interrelated to each other. Okay. These are not interrelated to each other. I hope it is clear to all of you. Next question is on equalization levy. There is a foreign company ABC Inc. which is in USA, which is engaged in providing what? Online advertisement service. ABC does not have a physical presence in India. ABC does not have a permanent establishment in India. Now that's what we want when we want to charge what? Equalization levy. Now Indian company is there, Raghu Limited. The Indian company is making a payment of 3 lakh rupees on 30th June for providing online advertisement services to ABC Inc. Now, the Raghu Limited remitted the equalization levy on 23rd of March. Now, listen carefully. You are making the payment on 30th June. So, you should pay the equalization levy by 7th of the following month. Now, you are paying on what? On 23rd of March. So, how much delay you have done? You have done a delay of 9 months. What is the equalization levy? On 3 lakh, 6% will come to 18,000 rupees. So, 18,000 is the equalization levy. 1% interest for 9 months. From 7th of April till 23rd of March. So you have done a delay of 9 months. So 9-month interest you have to pay. Now second transaction over here is you are also taking some online advertisement from Raghu Limited, is also taking some online advertisement from LMF Inc., a UK based company. Now that company has a permanent establishment in India and it is effectively connected to that PE. So if the non-resident has a permanent establishment in India and this amount and this online advertisement is effectively connected to that PE, then the question of equalization levy does not arise. In that case, we should deduct TDS under section 195 at the rates in force. In that case, see, equalization levy is applicable when the non-resident does not have a PE. If the non-resident has a PE, then we have to deduct TDS under section 195. I hope it is clear to all of you. And one last question is very simple question. Are the following persons liable to file the income tax return? See, Mr. A has incurred 2.4 lakh for his wife for travel to foreign country. Yes. If you incur more than 2 lakh rupees for foreign country travel for yourself or for any other person, you are supposed to file the income tax return. So in this case, Mr. A is liable to file the income tax return. Second, the total turnover of the business of Mr. B is 73 lakhs. Yes, he has to file the income tax return. If the turnover of your business is more than 10 lakh rupees, you are supposed, more than 60 lakh rupees, then you have to file the income tax return. And if the gross receipt of the profession is more than 10 lakh rupees, then also you are supposed to file the income tax return. And the last question over here is a theory question, nothing great as such, you can go through it once. So this is what this paper is all about. So let's go ahead with the next paper, that is May 2024. The very first question over here again is on total income. What exactly we want? Let's read from the last line. We are supposed to compute just total income. Do not follow 115 BAA or BAB. Don't compute tax also. Just find out the total income of the SSE. Now SSE is a private company. It is an Indian company. It is engaged in manufacturing of certain medicines and healthcare solution. The profit is 95 lakhs and the very first item over here is depreciation. So you will add back the depreciation as per the Companies Act. Okay. Now the next one is a very important case law based on Sashun Chemicals. Now what has happened in this case, let me give you the background. There was a company and there is an employee and there was some fight between both of them regarding the bonus. And there was some debate which was going how much should be the bonus, etc. And therefore till the time the debate is not getting solved, till the time the fight is not getting solved, the company has made one trust and the company has deposited that particular amount of bonus in a trust account. And later on the matter got solved before the due date of filing of return and the company paid that particular amount to whom? To the employees before the due date of filing of return. So assessing officer did not allow that particular expenditure. So the matter went to the court and the court said that because the payment has been made before the due date of filing of return, it should be allowed. It doesn't matter whether it has been directly paid to the employee or it has been paid through a trust. The point is it has to be paid before the due date of filing of return. That has been done. Therefore, the expenditure should be allowed to the SSE. I hope it is clear to all of you. Next one, you are paying some amount for violating the law of Indian Medical Council Act. If you are violating Indian Medical Council Act and if you are paying some money, it's a penal in nature and therefore that will be disallowed under the income tax law. Next one, you are doing some delay in contract and for that you are paying 45,000 rupees for 5 months. Okay, 9,000 rupees for 5 months. Okay, so if you are doing delay in contract and if you are paying a penalty for that, that penalty is considered to be a compensatory penalty. That is not for breaking a law. It is not penal in nature. It is compensatory. Therefore, that will be allowed under the income tax law. Next one is a very routine adjustment. 100% holding subsidiary selling their assets to each other is absolutely exempt under section 47. Only two conditions have to be fulfilled. Both of them should be 100% holding subsidiary and the recipient has to be Indian company. Therefore, reduce this from the PGBP and show under capital gains as exempt income. Okay. Next one is also very simple, grandfathering clause. Whenever 31st Jan 2018 will come, you have to follow grandfathering clause. I'm not interested in the grandfathering clause over here. First of all, reduce 4.5 lakhs from PGBP and then compute 112A capital gains. Under what capital gains? Okay. Next one, you are giving some bank guarantee to the government in place of disputed tax liability. Whether you will get the deduction. First of all, the deduction of tax is allowed on payment basis. It is not on an accrual basis. Therefore, if you just give a bank guarantee instead of making the payment, that will not be allowed as deduction to you. Okay. Next one, you have taken some loan around 3 years back and on that there is an interest of 7.5 lakh rupees. You have deducted the interest in the month of March and you have deposited the interest by 14th of July. It is absolutely correct. You have to deduct in the same year and you have to deposit by due date of filing of return. If you fulfill these two conditions, the expenditure will be allowed to you. Okay. Next one, you have contributed 65,000 rupees to electoral trust by account paycheck. So that will be disallowed under PGBP and under 80 GGB under chapter 6A, you can claim that deduction. Okay. I hope it is clear to all of you. Now there are some additional informations over here. Now these are some very important and new information, new adjustments given over here. You have imported some machinery parts of 1200 pieces. How many pieces of machinery parts you have imported? 1200 pieces of machinery part you have imported, but unfortunately you have included that in the closing stock. So that is the biggest mistake you have done. You should have capitalized to the cost of machinery and you should have claimed normal depreciation and additional depreciation on that. But rather than doing that, you have included that in the closing stock. Now, because you have included that in the closing stock, obviously you would have included in the purchase also, because without including in the purchase, you cannot include in the closing stock. Therefore, this gets nullified. Don't worry about it. This automatically gets nullified. It is there on the debit side of P&L. It is there on the credit side of P&L. It gets nullified. Now, the only thing that you have to do is, how many pieces are there? 1200 pieces. What is the price of dollar? 25 rupees. When have you imported? On 15th of September. What is the rate on that date? 82.88. Therefore, whatever amount will come, 1200 pieces into $25 into 82.88, whatever amount will come, that you should have capitalized to the cost of machinery and claim normal and additional depreciation. So now claim normal depreciation and claim additional depreciation on that particular asset for the entire year because asset is put to use for more than 180 days. I hope it is clear to all of you. Now the depreciation charge in the statement of P&L account includes depreciation calculated on the following assets, and only these three assets are there in the what company's income tax purpose. Apart from this, there is no other asset for income tax purpose. So these three assets we have to claim depreciation. First of all, you are purchasing some firefighting equipment. That firefighting equipments were not used. 95,000 rupees is the amount of depreciation on the firefighting equipment. Will you be eligible for claiming depreciation? The answer is yes. Firefighting equipments are used passively, even though it is not actively used, but it is passively used. Now, unnecessarily, why you will open the firefighting equipment unless and until there is a fire? Now, so passive use is there of firefighting equipment. Therefore, 95,000 rupees you can claim as reduction. You have also installed a new machinery on 14th of May. You can claim 15% normal depreciation on that and 20% additional depreciation also on that particular machinery. Further, you have sold some machinery in 2017 for 35 lakh rupees. And you have purchased that same machinery for 65 lakh rupees in 2024. So remember, if you sell an asset and reacquire the same asset, then the actual cost of the asset as per explanation 4 to 43(1) is WDV at the time of original transfer or reacquisition price, whichever is lower. So what is the WDV at the time of original transfer? It was 35 lakhs. And what is the reacquisition price? It is 65 lakhs. Whichever is lower is 35 lakhs. So you will be eligible for depreciation on 35 lakhs, 15%. Additional depreciation won't be allowed because it is a second-hand machinery. Therefore, additional depreciation won't be allowed. After doing all these things, you will compute your total income. That's it. This is as simple as that. So it was a very, very simple question. So let's move on to the next question, question number 2, in which there are multiple questions. There are 3 questions in this particular question. The very first question is on capital gains. Miss Seema is there, age 56 years. She is a resident individual. She has purchased a residential property in 1994 for 45 lakh rupees. The fair market value of the property on 1/4/2001 is 1 crore 20 lakh. The stamp duty value on 1/4/2001 is 1 crore 2 lakhs. Okay. Now she has sold the property for how much? 15 crore 50 lakh. The stamp duty value of the property is 17 crore rupees. Now what will be the full value of consideration in case of Mr. Seema? Miss Seema, 15 crore 50 lakh is the consideration. Stamp duty value is 17 lakh rupees. So is the difference between both of them more than 110%? The answer is no. Now because the difference between both of them is not more than 110%, therefore you are going to take 15 crore 50 lakh as your sale consideration. Okay, this will be your sale consideration. Now what will be your cost of acquisition? See, the actual cost is 45 lakhs. You need to compare with that with the lower of stamp duty value on 1/4/2001 or FMV on 1/4/2001, whichever is lower. Therefore the lower between the two is 1 crore 2 lakhs. Now you will compare that with 45 lakhs, and whichever is higher, that will become your cost of acquisition. Therefore eventually the cost of acquisition will be 1 crore 2 lakh rupees. Okay, so this is how you are going to compute your capital gains. Now after that she has invested some amount. She has sold this residential property. Obviously this is long term. Now, after that, she has purchased one residential plot in Amritsar for 8 crore rupees on 18th of Feb. She also deposited 3 crore rupees in an capital gain account scheme. Okay, so total she has reinvested 11 crore rupees. But under section 54, we all know that she cannot get more than what? More than 10 crore rupees exemption. It is an amendment made by Finance Act 2023 that under section 54, you will get maximum exemption of 10 crore rupees, not more than that. So 8 crore plus 3 crore which she has reinvested to construct a new house, only 10 crore will be allowed as exemption. Now, there is one more catch over here which we need to understand. She has two options in this particular question as per Finance Act 2024. First, because she is a resident, she has purchased the property before 23rd July and she is selling the property after 23rd July. She has two options. First option, she can do indexation and take tax rate 20%, and she can ignore indexation and take tax 12.5%. So I have done the solution as per both the things, that if she does option 1, 20% under section 112, then she will get indexation also. Okay, and if she does not take 20%, she takes for goes for 12.5%, then there is no need to do indexation. Okay, directly we have to pay the tax. Okay, so you have both the options, whichever is more beneficial, you can go for that. Okay, the question does not ask about it, but I have done it so that you should have a better idea about what this new provision is all about. Okay, now the next question is based on one case law of Pradeep Kumar Malhotra. Now what has happened in this case law? There was a person, Mr. Manju Memon. He has 20% stake in a private company. So in a private company means in a closely held company, he has 20% stake. Okay. Now that shareholder, Mr. Manju Menon, has an immovable property which he has given on rent to the company. So I am a shareholder of a company, 20% shareholder. I am giving my property in rent to the company. Now I am allowing the company to use that property as a mortgage in the bank and take a loan. Okay. So the company is using that property as a collateral security to take a loan from the bank. Okay. Now, as against that, the company is also authorizing to give me interest-free loan of 20 lakh rupees. Now, is this 20 lakh rupees considered to be deemed dividend under section 222E? And the answer is no. Why? Because remember, I have told you in the class, in the case of Pradeep Kumar Malhotra, deemed dividend will under 222E will only include if the loan is given by the company to the shareholder and that loan is a gratuitous loan. Gratuitous loan means that loan is given out of gratitude. That loan has not given because the shareholder has given a favor to the company. So if the shareholder has given a favor to the company, and in return if the company gives the loan to the shareholder, those loans are not subject to deemed dividend under 222E. Now this loan is not a gratuitous loan. This loan is given by the company to the shareholder because the shareholder has given what? The property to the company, which the company is using as a collateral security. So this is not a gratitude. This is not out of gratitude. This is give and take relationship. So in case of give and take relationship, I give you something, you give me something. In that case, 222E is not applicable. I hope it is clear to all of you. Okay. Now the next question. Question number 3 is based on non-resident taxation. Miles Inc. is a company incorporated in US. They have their shareholders had meetings in India for 3 times. Now, what is the agenda of the meeting? For the first 2 meetings, they were in India to discuss the modification of the rights of the class of shareholders. And third time, they were in India to discuss about the sale of the company. Does it amount to poem? The answer is no. If the shareholders meet in India for discussing the modifications of the rights of the shares, or if they meet in India to discuss about the sale of the company, that does not amount to place of effective management. You are not interested in effectively managing the business. Rather, you are interested in closing the business by selling the company. Therefore, the poem is not in India, poem is outside India, therefore the company is non-resident. Now, because the company is non-resident, accordingly, you need to answer the question. The very first thing the assessee is earning is dividend is received 5,50,000 net of TDS on GDR. And GDR are purchased in foreign currency. So this will be subject to tax at the rate of 10.4% under 115 AC. Dividend from GDR is taxable at 10.4% under 115 AC, but you have to gross up this dividend because the amount is received, it is net of TDS. So because the tax rate is 10.4%, you have to gross up as per 89.6%. You have to say 5,50,000 is 89.6%. Therefore 100% is how much? Cross multiply and get the answer. Okay. Second one, fees for technical service received from Government of India 5,55,000. Again, this is also received. You need to gross up this. Okay. The Government of India utilized the services for a project carried out in Nepal. So suppose I am Government of India and you are what? You are Miles Inc. You are providing me some services which I am utilizing what? In Nepal. This is also taxable in India. Okay. So but you are utilizing in Nepal. For government, that criteria is not applicable that the services have to be utilized in India. That criteria is only applicable to residents. If I would have been resident instead of government, then the services should have been utilized in India. But for government, the services can be utilized across the world. If the government is paying some FTS, royalty or interest, that is always taxable. It doesn't matter where the services are utilized. So Nepal, they have given us to confuse. Okay. So first of all, this is one important thing. Second, we are assuming that there is an agreement between both of them, and therefore this will come under 115A. And that agreement is approved. First of all, is there a need for an agreement between both of them? Yes, there is a need for an agreement between both the party, but there is no need for approval. There is no need for approval. Why? Because if the government itself is receiving the services from non-resident, there is no need for approval. Who will give approval to them? I cannot give approval to myself. Now, approval is only required in case of whom? In case of resident payee. If the payee is the government, then there is no need for any kind of approval. Therefore, assuming that it comes under 115A, we need to gross up this also. So what is the tax rate under 115A? 20% tax, 4% tax, 20.8% will be the tax rate. So you will gross up at 79.2%. Gross up at 79.2% and then you will get the answer. Okay. I hope it is clear to all of you. So this is what this question is all about. Let's move on to question number 3, which is a question on charitable trust. There is a trust by the name called as Devyani Trust, registered under 12AB, and they are using the money of the trust for some illegal persons. First of all, they are giving 4,50,000 for the benefit of the trustee. So if you apply the 4 lakh, if you apply any amount for the benefit of the trustee, will be chargeable to tax as per section 115 BBI. In this question, we need to find out the specified income which is liable to tax under 115 BBI at the rate of 30%. That's what we are supposed to tax compute over here. Then they are giving rupees 2,50,000 to the benefit of Mr. Sujan Dave, who has donated 3,75,000 rupees. Now, if any person donates to the trust more than 50,000 rupees in a financial year, that person is called to be a substantial contributor. And if the trust pass on the benefits to that same substantial contributor, that is not allowed under the income tax law, and therefore that will also be subject to what? This 2,50,000 will also be subject to what? Will also be subject to specified income. Third one, in the last year you have utilized, you have accumulated some money of 2,50,000 rupees, and in the for some purpose, generally you have been allowed now, you can accumulate the money for 5 years and then you can apply for the specified purpose within 5 years. Okay, so you have accumulated some money in the last year and you have claimed exemption. Now in the current year you have made a mistake by giving that as a donation to another person. You cannot do that. This is violation of section 11 subsection 2. So this 2,50,000 will also be subject to what? Will also be subject to income tax under 115 BBI. So all the 3 points which I have circled, those 3 points will be subject to 115 BBI 30% tax. I hope it is clear to all of you. Next one. there was a trust which was incorporated in 2023. Now, in that year, the trust was incorporated with an object of relief of poor, and in that year, the trust failed to file an provisional application. So, the trust failed to file an application for provisional registration. Now, in the current year, the trust wants to file the final registration directly. Can the trust do so? The answer is yes. Provisional application is only applicable in the year in which the trust is formed for the very first time. For example, if the trust is started in the current year, then in the current year, if you want to file an application, you have to file a provisional registration. But if there is an old trust, the activities are old, and now if you want to file what a registration, you can directly go for final registration. So if a trust which was formed in 2023, now in 2025 goes for a registration, they can directly go for a final registration. There is no need for a provisional registration in that case. Now, the next question is a very simple DTAA question. I'm not getting into that. Very, very, very simple. We have done much better question on that. You can go through this question very easily. It's a very, very, very straightforward question. There is nothing great in this. Next question is on TDS. Let me talk about that. What is this question all about? First of all, if a hotel, if a restaurant takes some service charge from you, tips from you, and give it to the what? Waiters. Give it to the employees. Is that subject to TDS? We have done it in the chapter of TDS that is not subject to TDS as per the ITC hotel. There is no employer-employee relationship with respect to that particular thing. Okay. With respect to that tip, if the customer will give the tip, the company will give the tip to the waiter. If the customer will not give the tip, then the company will not give the tip. The company is not obligated to give the tip. Okay. In its employment agreement. Therefore, whatever service charge we pay to the hotels or restaurants, and in exchange, the hotel give it to the what? To the waiters, that is not subject to TDS under 192. I hope it is clear to all of you. Next one, there is an individual, Mr. Lalit, whose last year's turnover is 1.5 crore rupees. Okay. Now, he has paid 5 lakh rupees by check, 5 lakh rupees by check to a contractor for construction of factory building. So under which section he will deduct TDS? He will deduct TDS under 194C. I am an individual. My last year business turnover is more than 1 crore rupees and I am paying more than 30,000 rupees. For what? For contract, and the contract is also not personal. If it would have been personal, then 194C would have not been applicable. So this is not personal contract. This is a factory building. This is a business contract. Therefore, TDS will be applicable in this case under 194C. Okay. I hope it is clear to all of you. Now, you are making the payment to an individual contractor. Therefore, you will deduct TDS at the rate of 1% under 194C. If it would have been other than individual HUF, then the TDS would have been 2%. Next, he is also making further some more payments. Now, he is also making monthly payment of 16,000 rupees for office rent. And he's also making 5,500 rupees for use of furniture. So this will come under 194I. If you take on rent what? Office, or if you take on rent building, land, plant, machinery, furniture, that comes under 194I. Here also you have to check the last year turnover. Is the last year turnover more than 1 crore? The answer is yes. Therefore 194I is applicable. Now 16,000 into 12 plus 5,500 into 12. You have to check aggregate of both of them, and then you have to check whether 2,40,000 is crossing or not. If after aggregating both of them, if 2,40,000 is crossing, you have to deduct the TDS, which is definitely crossing. The aggregate of both of them is amounting to 2,58,000. 10% of that you have to deduct TDS. Okay. Sir, for furniture also it is 10%? Yes. For plant, machinery and equipment, it is 2%. For land, building and furniture, it is what? It is 10%. I hope it is clear to all of you. Next one, there is a partnership firm who is selling some product through what? Through an e-commerce operator. So the e-commerce operator will deduct TDS. How much they are selling? They are selling 4,90,000 through online sales. The e-commerce operator will deduct TDS at the rate of 0.1%. 0.1%. Sir, why 0.1%? It was 1%. No. From 1st October 2024, the rate has been reduced to 0.1%. Now, so whatever partnership firm is selling through e-commerce operator, the e-commerce operator will deduct TDS at the rate of 0.1% on the gross sales amount, including the commission portion. He will deduct TDS on the gross amount, not on the net amount, including the commission portion. Plus, in case of some transaction, the customers have directly paid to what? To the partnership firm, directly to the seller. Whether the e-commerce operator is liable to deduct TDS on this direct amount also, the answer is yes. The e-commerce operator is liable to deduct TDS on the direct amount also. It is very clearly written in 194O that if the customer directly pays to the seller, it is deemed to be credited by the e-commerce operator, and the e-commerce operator is liable to deduct TDS on this 60,000 rupees also. I hope it is clear to all of you. Let's move on to the next question, which is on transfer pricing and which is on the concept of NJA. There is a company by the name called as Yalin Limited, which is located in country X and it is located in NJA. Now we all know that if you do any transaction with a person located in NJA, if I do any transaction with a person located in notified jurisdictional area, then it is deemed to be associate enterprise. It is deemed to be international transaction. We have to apply all the provisions of the transfer pricing over here. So now, Armo Limited is selling some goods to Yalin Limited. Therefore, both of them are deemed to be associated enterprise. You are selling for how much? 11.75 crore. Now, Armo is selling the similar goods to others, that is to other third party at 13 crore rupees. So, your arm's length price will start from 13 crore rupees. You will start with uncontrolled price. Now, you will not start with the price at which you sell to what associate enterprise. You always start with the price which you sell to your unrelated party. So, to unrelated party, you are selling at 13 crore, and then you have to make two adjustments over here. Two functional adjustment. One is of insurance and freight, and another is of what? One is of insurance and freight over here, and another is of what? After sale service. Very, very simple to adjustment. If you do that, your arm's length price comes to 12.56. Your actual price is 11.75. The differential amount will be added back to your income statement. Okay, I hope it is clear to all of you. So it is a very, very, very simple question. Now the next question is a very, very beautiful question on some very, very important case laws. One by one we are going to decode all of them. So there is an assessee who has taken some engine on lease from a German company. That German company has no permanent establishment in India. That German company does not have a PAN in India, and the Indian company has deducted TDS at the rate of 10% as per the provisions of DTAA. Now, the assessing officer is saying that because the German company does not have a PAN in India, you should deduct TDS at the rate of 10% or 20% for not giving the PAN, 10% as per DTAA, or 20% for not giving the PAN, whichever is higher. The SRC said that 20% criteria is not applicable on DTAA rates. That is only applicable on the income tax rate. Is the SRC officer correct, or is the SRC correct? Who is correct? And the answer is the SRC is correct. The 20% criteria is not applicable on the DTAA rates. It is only applicable on the income tax rate. Therefore, if in the DTAA something is written like if it is taxable, if a particular income is taxable at 10%, then whether the other person is giving PAN or not, it doesn't matter. You cannot tax more than 10% in that case, even if the other person is not furnishing the PAN, because it is not possible to charge tax more than what is written in the DTAA. Or it is not possible to charge surcharge and cess also on the DTAA rate. Forget about PAN rates of 20%. Therefore, no need to deduct TDS at higher rate in absence of PAN. It was held in the case of Air India Limited. So Air India Limited will deduct TDS only at 10%, even though the non-resident is not giving the PAN. I hope it is clear to all of you. Now the next case law is very beautiful case law. The assessing officer has passed an order of assessment in which the assessee committed the mistake of reducing the depreciation instead of adding the depreciation. So instead of reducing, the assessee has made a mistake, not AO has not made the mistake. Instead of reducing the depreciation of 10 lakh rupees, instead of adding the depreciation of 10 lakh rupees, you have reduced the depreciation of 10 lakh rupees. Okay, instead of adding, you have reduced 10 lakh. It means you have taken double deduction. You have to add back 10 lakh rupees. Now rather than adding 10 lakh, you are reducing 10 lakh. It means you are taking double benefit, now 20 lakh rupees deduction. Now the AO did not correct this mistake in his order. The AO did not find this mistake in the order. Okay, now later on the assessee went to appeal to the CIT appeal on some other issue, not this issue, some other issue they went to appeal. The matter went to the CIT appeal, and the CIT appeal passed the order. Okay, now after that, the AO thereafter passed an order under 154 in which he rectified the double deduction of depreciation committed in the order on 20th of November 2019. Now listen carefully. There are three events over here. What is the first event? The assessee, the AO has passed an order. AO has passed an order under what? Under the regular assessment. In that, the AO has not rectified the mistake which has been done by the assessee. Later on, the assessee went to appeal, and in the appeal was on some other matter. Okay, and the appeal was decided on 28th of June. Later on, the AO realized that, oh, I have made some mistake. I have not identified that mistake. So now he wants to rectify under section 154. Now the time limit for rectification under 154 is 4 years from the end of the financial year in which the order sought to be rectified is passed. Now, from where to count the 4 years? Whether should I count the 4 years from the original assessment order, or whether should I count the 4 years from what? From the CIT appeal order. Now that depends upon two different case laws. There are two different case laws in your study material. One is Tony Electronics or Hind Wire Industry Limited. Second is Elegantron Finance Limited or ICICI Bank Limited. As per Tony Electronics Limited, the 4 year time limit will be counted from the subsequent order. That is from 20th June 2024. Then in that case, 4 years time limit has not expired. Therefore, you can make an application. But as per Elegantron Finance Limited, the 4 years time limit will count from the original order. And if you count from the original order, then the 4 years time limit has expired. And in that case, you cannot rectify. The ICI has given both the answers, and both the answers are correct according to ICI. You can write either of them, whichever you feel comfortable. You can write, you may not write both of them. You can write one of them in detail and another you can write a note that alternatively we can do this also to give better idea to the institute that I know both the answers. Okay. Now one last question over here in this particular question, question number 5, that there is a private company, domestic company who has failed to pay some TDS. It has deducted the TDS on time, but it has failed to pay the TDS on time. Okay. Now the commissioner has sent a notice for what? Penalty under 271C. So now can the penalty under 271C can be imposed for late payment? The answer is no. 271C is only for failure to deduct TDS. It is not applicable for failure to pay the TDS. Therefore, if the assessee has failed to pay the TDS but not failed to deduct the TDS, you cannot impose penalty under 271C. 271C is not possible. Okay. I hope it is clear to all of you. Let's move on to this last question, question number 6. Now from here onwards, from May 2024, new course was introduced in your syllabus. So if from new course onwards, last question generally they ask on one question on the last question. In last question there will be multiple parts, but one of the question will be on tax audit. So do tax audit chapter very precisely. What are you supposed to do in tax audit? Do all the case studies of tax audit which are given in your study material, which is covered by us in our question bank properly. Plus do all the case studies of tax audit from the last two RTPs, May 24, November 24, and May 25. Plus May 25 MTP, November 24 MTP, May 24 MTP, and the last this attempt exam paper. That's it. This much case studies, all the case studies which are given in the RTP, MTP exam paper and also in your study material, you have to do all of them precisely. If you do all of them precisely, one of the question will be coming out of them only. Okay. Now, what is happening in this particular question? We need to find out whether the chartered accountant is guilty or not under the Chartered Accountant Act 1949. There was a travel company, the Club U Travels Private Limited, engaged in the business of travel agency, has remitted substantial amount outside India. Okay. Now, the tax department collected the documents from the bank, which include Form 315 CB also by the chartered accountant, list of passenger, copy of their passport, date of travel, and on inquiry from the passengers and verifying that they really traveled or what. So they come to know that they did not travel. The passenger also denied that there was no such transaction. Okay. The income tax department concluded that the remittance was done for some wrong reasons. False invoices were there. So in short, the remittance done by the company says that this we are remitting for our passengers. But when income tax department questions the passenger denied the transaction, and therefore it is a false remittance. It is not a genuine remittance. It is not remitted for the real reason. It is remitted for some other reason. Okay. Now, the chartered accountant has given 78 certificates in Form 15 CB. So when the chartered accountant was asked that what have you done? Have you not checked the things properly? He said that I have done the KYC documents. I was not a statutory auditor, so I did not examine the books of accounts. Okay. So he is giving all these reasons now. So what is the duty of the chartered accountant over here? The duty of the chartered accountant over here is to give Form 15 CB. If he is giving Form 15 CB, he has some moral responsibility. Responsibility number one, he has to examine the books of accounts. Secondly, he has to check whether the applicable TDS rate has been deducted or not, whether the applicable TDS has been deducted at proper rate or not. He has to verify the agreement between both the parties. He has not done all those things. He has only done one thing. He has verified the KYC. Therefore, the chartered accountant is deemed to be guilty. He is doing a gross negligence. He is not performing his duty properly, and therefore, as per Clause 7 and Clause 8 of Part 1 of Second Schedule, he will be deemed to be guilty under the CA Act 1949. I hope it is clear to all of you. The same case study is there in your study material also. We have discussed this case study earlier. Okay. Now, specify with reason whether the following acts can be considered as tax planning, management or evasion. So, Mr. D has a fixed deposit in SBI in his name amounting to 50 lakh. Now, he gifted this 50 lakh to his son. His son is attaining 18 years. Okay. Now, what is the purpose of gifting this 50 lakh rupees? See, I have a FD of 50 lakh rupees. Now, if I earn interest on that, I'll be liable to tax. So, I'm gifting that FD to my major son, not to my minor son. So, is this tax evasion? The answer is no. There is no tax evasion in this. Is this tax planning? Yes, it is a tax planning. It is allowed. Sir, why it is allowed? It is allowed. There is no provision to club such things. Yes, if I would have given to my minor son, then the interest would have been clubbed. Okay, I am not giving it to minor son. If I give some gift as a gift to my major son, then whatever income he will earn, that will be his income. That will be not clubbed in my hands. Okay, so you can do that with your major son, but don't do that with your minor son. If you do that with your minor son, that income will be clubbed in your hands only. Okay, next one. Next one is Mr. Ram's annual income is 49.5 lakh rupees. Now he is supposed to receive 6 lakh rupees commission from a company. So he is telling the company that don't give me 6 lakh rupees, give that 6 lakh rupees to my wife account. Why? Because he knows that the moment the income crosses 50 lakh rupees, he will be liable for a surcharge of 10%. So he is telling the company, don't give me 6 lakh rupees, you transfer to my wife account. It is a clear case of tax evasion. You cannot transfer your income in your wife account. Okay. If you do that, it is a clear case of tax evasion. You will be liable for tax, interest and penalty. I hope it is clear to all of you. Now, last question over here is on board for advance ruling. Here the ICI has taken two views. I will tell you both the views. First of all, there is a non-resident foreign company which is entering into a contract with several Indian companies for doing something. Okay. And they have made an application for board for advance ruling. Okay. So there is one non-resident company, say they are entering into a contract with 10 Indian companies. So they have made an application to the board for advance ruling for tax liability of this transaction. Now, out of the 10 Indian companies, one of the Indian company has also given an application to the assessing officer for determination of question of law. Now, there is one condition in board for advance ruling, that your board for advance ruling will be rejected if your case is already pending in front of Income Tax Authority, ITAT, High Court or Supreme Court. So if your case is already pending, then your application will be rejected. So now here the question is, whose case is pending? So there are two views taken over here. If the applicant's case is pending, one option is, if the applicant's case is pending in front of Income Tax Department, it will be rejected. Is the applicant's case pending? No, no. The application is given by whom? The application is given by the Indian company. The application is not given by the non-resident to the assessing officer. The application is given by the Indian company. So if the applicant's case is pending, If the applicant's case is pending, then the non-resident cannot go. So in the first view, we are assuming that it is not the applicant's case, it is somebody else's case is pending. Therefore, the applicant can go for what? The applicant can go for BFAR. The second option is if anybody's case is pending in front of AO. If anybody's case, is anybody's case pending in front of AO? The answer is yes. Anybody will include the Indian company also. Anybody will include the applicant also. If anybody's case is pending in front of the AO, then you cannot go for board for advance ruling. So in the second assumption, you cannot go for board for advance ruling. I hope it is clear to all of you. So this is what this beautiful paper is all about. So let's go ahead towards one last paper in front of us, that is the November 2024. It is not 25, sorry. How can I give a paper for November 2025? It is November 2024 paper. So let us start with the discussion of this ninth and the last paper. After this, we will be done with 9 RTP in full English for you all and 9 past paper in full English for you all. Total 18 papers have done. I will be also uploading one more video on around 8 MTPs. I think so that will be much more than sufficient for you all during the exams. 26 papers. Okay, 8 or 10. I am just confused on that whether I should upload 8 or 10 papers. You guys comment below and let me know how many papers I should upload. Okay, so let us start with the 9th paper now in our discussion in full English for you all. Now, the very first question over here, obviously on total income, we are supposed to compute total income and tax liability as per the regular provision, and the turnover of last to last year is 450 crore. Therefore, the tax rate will be 30%. Okay. After we are done with the calculation, we should also do calculation as per the concessional tax rates 115BAA, and then we need to find out which regime is more beneficial. The regular regime is more beneficial or the special regime is more beneficial. Now, right now I am not interested in 115BAA. First, I will solve the question as per the normal provision. Okay, let us start. So assessee is a company, resident company. It was set up in 2010. It is a manufacturing assessee. The profit is 75 lakh. Depreciation you will add back. Okay. Next, dividend you have received of 5 lakh rupees from Arnold INC. So whatever dividend you have received, you will first of all reduce that and you will show that under IFOS, and the interest expense on that dividend of 1,50,000 that you will add back over here, and under the IFOS you will get deduction of interest expense against dividend up to 20% of the gross dividend. So the dividend will be 5 lakh rupees under IFOS and 20% of the dividend will come to 1 lakh rupees. Therefore your net dividend taxable under IFOS will be 4 lakh. Remember, against dividend there is only one expense which is allowed, that is interest expense, and that to up to 20% of what? Your gross dividend. So first of all you will reduce dividend, you will add back the interest expense, show under IFOS this particular income. Okay. Next one, you have incurred some 5 lakh rupees, you have contributed some 5 lakh rupees to the state housing board for construction of tenements for your workers. Tenements is nothing but a temporary house for your workers. So you are constructing some temporary house for your workers. For that you have paid 5 lakh rupees to the state government body. Now the ownership is with the state government body. You do not have the ownership, so you are not the owner. Therefore this expenditure will be considered to be as a revenue expense, and that will be allowed as a reduction under PGBP because workers are important for the company. Okay. Next one, there is a creditor who has waived your loan, who have waived your credit, and that amount is already credited to the P&L account. So because so if a creditor remits any liability, then it is your deemed income. Now because in this question they have already credited that to the P&L, no effect has to be given. If they would have not credited to the P&L, we would have added to the PGBP income. Okay, I hope it is clear to all of you. Next one is, there is a debenture of 5 years. Now on that you are paying some upfront discount. Interest is paid during the year of 5 lakh rupees. The assessee has taken deduction of 1/5 in the current year. The assessee has not taken the entire deduction in the current year. Now the entire liability has arisen in the current year. Therefore the law says that there is also a court judgment, high court judgment on this, that if there is an upfront discount interest paid by the company on debenture, and if the entire amount is paid by the company, the liability has arisen, you have to take the entire deduction today itself. The company has taken only 1/5 deduction, that is company has taken only 1 lakh out of 5 lakhs. But you have to take the full deduction. Therefore take the balance 4 lakh deduction in the current year itself, reduce 4 lakhs from your PGBP income. Okay, I hope it is clear to all of you. Next one is, the assessee is engaged in building of developing and building rental houses under 80 IBA. From that the assessee has earned a profit of 20 lakh rupees. So 20 lakh rupees will be eligible for deduction under 80 IBA because you are covered under 80 IBA, and 80 IBA you get deduction of 100% of your profits. Apart from that, the assessee also earned 10 lakh rupees from construction of housing project, but now this has not been constructed by the assessee. It has been done through a work contract. Okay, so this will not be eligible for 80 IBA. One more condition is important for 80 IBA. The project has to be approved till 31st March 2022, which is very much approved till 31st March 2022. The project is approved during financial year 21-22. Therefore, if it is approved after 31st March 2022, the deduction under 80 IBA is not eligible. Now, because the project is approved till 31st 31st March 2022, you are eligible for 80 IBA. Therefore, what is the total profit from this housing project? 30 lakhs. Out of that, you are only eligible for 20 lakhs under 80 IBA. The work contract is not eligible for 80 IBA. Okay. So 30 lakhs you will show under PGBP, and then 20 lakhs you will show under Chapter 6A as deduction under 80 IBA. Next one, you have purchased the land in 2010 for 5 lakhs, which was compulsorily acquired in 2018, and the original compensation was 10 lakh was awarded, and in the current year the government has given you an additional compensation. So in the current year, the original compensation would have been taxable in the year in which original compensation would have been received. The enhanced compensation will be taxed today. So enhanced compensation is 8 lakh. What is the cost of acquisition of enhanced compensation? Generally it is nil. Therefore this 8 lakh rupees will be subject to 20% tax. Or why 20% tax? Because the transfer has been made before 23rd July 2024. Therefore it will be subject to what? 20% tax. Okay. Next, income tax depreciation you can reduce over here. Next, you have purchased the machinery for 20 lakh rupees in 2020 and insured against it for fire, etc. Then the company, then there was a fire which was broken in September 2023, and the machinery was damaged, and the insurance company paid you 22 lakh rupees. Okay. So now you are supposed to compute the block is ceased to exist now. This was the only asset in the block. Therefore, your block is ceasing to exist. Therefore, now you are going to find out what? Now you are going to find out the WDV of the block of asset, and then you will compare with the insurance money, and the differential amount will be considered to be short-term or long-term capital gain. So you have purchased the machinery in 2020. So from 2020 to 2020 to 23, you have to claim depreciation, and therefore in the first year you will claim normal depreciation and additional depreciation also, and in the second year you will only claim normal depreciation. So your WDV comes to 9.39 lakhs, and therefore your sale consideration is 22 lakhs. The differential amount will be subject to short-term capital gains, which will be subject to 30% tax. Okay. And last but not least, the company declares a dividend of 6 lakh rupees to its shareholders during the year on 31st of August 2024. That is 1 month before the due date of filing of return. The company is declaring the dividend. Therefore, under ATM, you will get deduction of dividend received compared with dividend paid, whichever is lower. How much is the dividend income in the IFOS? 4 lakh rupees. 4 lakh rupees is the dividend income in the IFOS, correct? We have done this calculation over here. And how much is dividend distributed? 6 lakh. Therefore, you will get deduction of 4 lakh rupees under ATM. And then you will compute tax as per the regular regime. And then you will compute tax as per the 115BAA. Sir, why 115BAA? Why not 115BAB? Because the company was set up in 2010. Therefore, 115BAB is not possible. For 115BAB, the company should be set up on or after 1st October 2019. Therefore, 115BAA is applicable over here. Now, because 115BAA is applicable, now we need to recompute the income. The only thing that will change over here is you have to add back 80 IBA income. 80 IBA income will be added, 80 IBA deduction will be added back, and then you will get the income as per 115BAA. That's it. 80M is not added back in 115BAA. 80M is allowed under 115BAA. Then compute your tax on long-term capital gains 22%, and on other incomes it will be subject to 22% tax, 10% surcharge, 4% cess. Then compare whichever is more beneficial. You go according to that. Okay. I hope it is clear to all of you. Let's move on to the next question. The next question is a beautiful question, 10-mark question on slum sale. There is a company, Salsi Limited, which is having multiple units, textile unit, chemical unit. It is planning to sell its chemical unit as a going concern for how much? 242 lakhs. Therefore, we need to find out what the full value of consideration of the chemical unit, and then we need to find out the net worth of the chemical unit, which will become the cost of acquisition. Now, while computing the full value of consideration, you have to apply Rule 11 UAE, and in that you are supposed to compute two full value of consideration. First is FMV1 and second is FMV2. First is FMV1, FMV2, whichever is higher, that will be your full value of consideration, and then we will compute the cost of acquisition, which will be the net worth. So FMV1, what is FMV1? FMV1 is the FMV of the asset transferred. So whatever asset you are transferring of the chemical unit, you need to find out the FMV of that as per Rule 11 UAE. So let's compute the FMV1 first. First of all, we are transferring land. For land, you will take the stamp duty value as per Rule 11 UAE. So for land, you will take 62 lakh. For building also, you will take stamp duty value, but in the question, stamp duty value is not given. So for building, you will take book value because stamp duty value is not given. Okay. For machinery, you will take book value as per FMV1. Right now, I am computing only FMV1, FMV1, FMV1. Okay. Now, for license and franchise, which is an intangible asset, you will take book value only. For equity shares, you will take market value. The market value is 42 per share, and there are 1 lakh shares in equity shares. You can check over here. So 1 lakh into 42 will come to 42 lakh rupees. Okay. Now what is left after that? Inventories, you will take book value only. For inventories, you will take book value, and for creditors also, you will take book value only. Okay. Now all the assets have been done as far as FMV1 is considered. FMV1 is over. Now FMV2. What is FMV2? FMV2 is nothing but whatever you are receiving. What are you receiving as a consideration? We are receiving 242 lakhs as a consideration. That's it. So this will become FMV2. Therefore FMV1 or FMV2, whichever is higher, that will become your full value of consideration. Now we will determine what? Cost of acquisition. How to determine cost of acquisition? Cost of acquisition of chemical unit will become your net worth. Okay. And how to determine the net worth? Net worth is nothing but aggregate of all the assets of chemical unit minus aggregate of all the liabilities of the chemical unit. That will be considered to be what? The net worth of the chemical unit. So for that, again, for land, what will you do? For land, you will take the book value now. While computing the net worth, you will not take stamp duty value, you will take the book value. Okay. For building and machinery, you will take the income tax WDV. For depreciable asset, you have to take income tax WDV, which is same as the balance sheet value. So you will take from the balance sheet the income tax WDV. For license and franchise, again, for depreciable asset, you will take income tax WDV. So for this, you need to compute the income tax WDV. You have purchased the license and franchise in 2022. So 2022, you purchase for how much? You purchase for 23 lakh rupees. So you have to reduce depreciation of 1 year. After that, you will get the WDV as per income tax law that you have to take. For inventory, you have to take the same value, that is the book value. For equity shares also, you have to take the book value only, whatever is given in the balance sheet. And for creditors also, you have to take the book value, whatever is given in the balance sheet. You will get the net worth, and after that, you compute the capital gains, whether it is long term or short term. That depends upon the period of holding. It was purchased in 2020, and it was sold when? It was sold in 2023. Just a second. The chemical unit was established in 2020. Therefore, this will be considered to be what? Just a second. This will be considered to be long-term capital gains since the unit is held for what? More than 36 months. Okay. Now remember always that in Finance Act 2024, the period of holding has reduced to 24 months from 36 months. But for slum sale, the government has not changed the limit. For slum sale, the limit is still 36 months only. I hope you all remember that. Okay. The next question is on section 44C. If a foreign company has a branch in India, if a non-resident has a branch in India, and if they allocate some expenses in India, then how much deduction will be allowed to the Indian branch? We are supposed to compute how much deduction will be allowed to Indian branch, and then we are supposed to compute the total income of the Indian branch also. For that, we need to compute the adjusted total income of that Indian branch. How to compute the adjusted total income? We have to take the total income plus add few things. Okay, we have to add few things. What all things will be added back to compute adjusted total income? That I will let you know. And then you have to take 5% of the adjusted total income or actual amount allocated to the Indian branch. Whichever is lower, that will be allowed as deduction. So first we will compute the adjusted total income. There was a loss of 28 lakh rupees to the Indian branch. So you will start with negative 28 lakhs. Then is depreciation added back while computing adjusted total income? No. Depreciation is not added back. Is unabsorbed depreciation added back? Yes. Is short-term capital loss added back? Yes. You have to follow the provisions given under 44C, please. I'm not doing anything new. I'm doing whatever is given under 44C. Then you have paid some voluntary retirement scheme of 12 lakhs, but only 1/5 is allowed. Therefore, 4/5 you have to add back. Okay. How much you have to add back? 4/5. Speculative business loss, all losses have to be added back. Deduction to chapter 6A have to be added back. And then head office expenses also have to be added back. After doing all those things, your adjusted total income is coming positive. So don't need to check all these things. If your adjusted total income would have come negative, then we would have taken average of these 3 years, and then we would have taken 5% of that. When we take average of the last 3 years, only if the adjusted total income of the current year is negative. Now, because the adjusted total income of the current year is positive, you don't have to do average and all in this particular case. Okay. I hope it is clear to all of you. Now. After that, you will get the adjusted total income, take 5% of that. Whatever is that, compare with what? Actual head office expense with 165 lakh, whichever is lower, that will be allowed as deduction. Now compute the total income. While computing the total income, start with 28 lakhs loss. While computing the total income, will you get the deduction of depreciation? Yes. So do not add back. Will you get the deduction of unabsorbed depreciation? Yes. So do not add back. Will you get the deduction of short-term capital loss? No. Why? Because short-term capital loss cannot set off against PGBP income. Will you get the deduction of 12 lakh rupees? No. Only 1/5 will be allowed. Therefore, add back 4/5. Will you get the deduction of speculative business loss? No, because speculative business loss cannot set off against normal business. Will you get the deduction of chapter 6A? Yes. So do not add back this. Will you get the deduction of head office expense? Not this one. Add back this one and reduce the actual amount which is allowed. That is 5% of the adjusted total income. That will be reduced. Okay. After that, whatever amount will come, that will be considered to be what? That will be considered to your income. I hope it is clear to all of you. Is it clear? Now let's move on to the next question. Question number 3. There are multiple questions in this. The first question over here is on electoral trust. There is an electoral trust which was set up in April 2023. This is the first year of the setup. First year of the electoral trust, and the total voluntary contribution received by the trust is 600 lakhs, and it spent 5 lakh rupees on the management of its affairs. Okay. Now we all know that for electoral trust, if they want to make, they want to take exemption, then they have to distribute 95% of the total donation in the current year. Okay. So out of the amount of 600, if 90% is donated to different political parties, entire 600 lakhs will be exempt. Okay. Now what is the question over here? The question is, what is the amount of surplus that can be distributed by the electoral trust to a registered political party? See how much the electoral trust has received. It has received 500 lakhs. It has received 600 lakhs. Okay. Now it has incurred how much in the form of what? In the form of management of affairs, 5 lakh rupees. How much it is allowed to incur in the form of management of affairs? Remember, there is a provision on that. You can incur 5% of your total donation or 5 lakh rupees in first year, and in subsequent year it is 3 lakh. For first year it is 5 lakh, for subsequent year it is 3 lakh. This is the first year, so we are taking 5 lakhs. So whichever is lower. So 5, how much you can spend on the management of affairs, that is also, there is also a cap on that. So 5% of the total contribution or 5 lakh rupees, whichever is lower in first year, and second year 5% of total contribution or 3 lakh rupees, whichever is lower from second year onwards. This is the first year, so we are taking 5 lakh rupees. Therefore, you can distribute what? You can distribute 600 minus 5 lakhs, that is 595 lakhs. So you can, the distributable surplus is 595 lakhs. Now, if I distribute 595 lakhs, will I be eligible for exemption? Definitely, because you have to distribute only 95% of your 600. So 95% of 600 comes to 570 lakhs. Now, and your distributable surplus is 595 lakhs. So if you distribute 595 lakhs, you will be eligible for the exemption. Now, one last thing is given over here. Will your answer change is if out of 100 lakhs, if out of 600 lakhs, 100 lakhs are received from individuals who are not citizen of India. Remember, as per Rule 17 CA, an electoral trust is not allowed to accept donations from not a citizen of India. They are allowed to accept donations only from Indian citizen. If they accept donation from other than Indian citizen, that will be not eligible for exemption. So if they accept donation from other than Indian citizen, then the exemption under section 13B will not be allowed to the electoral trust. I hope it is clear to all of you. Now the next question has come 100 times. I am irritated with this question. There is an organization which is running a school and a hospital, and the aggregate received from both of them is more than 5 crore rupees. Will they be eligible to exemption without approval? The answer is no. If the aggregate received from school and from hospital is up to 5 crore rupees, there is no need for approval. If it is more than 5 crore rupees, you need to take an approval from the Commissioner of Income Tax. I hope it is clear to all of you. Third question over here is, can a trust claim exemption under 1023(6) and under 1046 simultaneously at the same time? The answer is no. A trust has to forgo one of them, cannot claim exemption under 1023C also and 1046 also simultaneously at the same time. That is not allowed. Okay. The next question is a very simple question on DTAA, so I'm not wasting time on that. It's a very routine question. You can go through it and you can complete in 2 seconds. Okay. There's nothing great in that. I'm moving ahead with the next question. Question number 4, which is on TDS. Listen carefully. Now, this is a good question on TDS. There are some very good questions put by the institute on TDS over here. The very first question is, there is an individual who has purchased an urban land in 2014. Now, the government has compulsorily acquired that land in 2022. And the government paid a compensation of 2,40,000 rupees to Mr. Bhuvan on 10th of April 2023. And then later on, the government paid an enhanced compensation of 50,000 rupees to Mr. Bhuvan on 10th of December 2023. Is TDS liable to be deducted by the government? The answer is yes. Because the aggregate compensation is more than 2,50,000 rupees. See, for government compensation on compulsory acquisition, TDS is applicable under section 194LA, and under 194LA, TDS is deductible on what amount? In excess of 2 lakh. If the threshold crosses 2,50,000 rupees, then only it is applicable. So in this case, the aggregate amount is exceeding 2,50,000 rupees. Therefore, TDS will be applicable at the rate of 10% on 2.9 lakh rupees. And in this section in 194LA, TDS is deducted on payment basis, not on credit basis. Okay. Now, the next question is also a beautiful question. On 1st October 2023, Mr. Aman was transferring some money outside India, 9 lakh rupees for overseas tour package and program. Now, we all know that if you transfer some money for overseas tour package and program, for first 7 lakh, it is 5%, and above 7 lakh, that is on balance above 7 lakh, that is on 2 lakh rupees, there will be a TCS of 20% as per section 206C subsection 1G. So first 7 lakh, it is 5%, and above 7 lakh, it is 20%. Okay. But now here there is a problem. The problem is the buyer has not filed the return for the last 2 years, and the buyer's TCS for the last year is 51,000 rupees. So therefore, if the buyer has not filed the return for the last 2 years and the buyer's TCS is 51,000 rupees in the last year, then the provisions of 206CCB will apply, not CCA. CCA is for TDS, CCB will apply. And in that case, you have to deduct the TDS, you have to collect the TCS at twice the rate or 5%, whichever is higher, but that cannot be more than 20%. Maximum it is 20%. So in this case, on this 5 lakh rupees, twice the rate is 10% or 5%, whichever is higher. So on this 5%, the rate will become automatically 10%. And on this 20%, the rate cannot become 40% because maximum 20% will be applied. The tax rate cannot be more than 20% in this case. I hope it is clear to all of you. So 5% will become 10%, but 20% will remain 20% only. I hope it is clear to all of you. Now the third one is also a beautiful question on what? online gaming TDS. So remember, for gaming, online gaming TDS, when the TDS is applicable at two times. When you withdraw from the account of online game, at that time it is applicable 30% TDS, and the second time when it is applicable on the closing balance. So we need to understand the entire scenario, how much money was there in the opening balance, how much he has deposited, how much he has withdrawn, how much is the closing balance, all those things we need to understand. So this is a Dream 11 account. Mr. Z is a user of Dream 11. He has a credit balance, 10,000 rupees is the opening balance. Then he deposited 1 lakh rupees in the account, okay? And then he earned 30 lakh rupees from the online game. Now during the previous year, there was also some bonus given. On the bonus, the income tax is not applicable. Bonus is not subject to income tax, okay? So forget about bonus. Just remember what? How much was deposited? 10,000 was there in the account already. 1 lakh was deposited. 30 lakh was earned. And then on 1st of Feb 2024, 25 lakh was withdrawn. So this is the first time when TDS will be applicable. Now will the TDS be applicable on what? On 25 lakh rupees directly? No. For that the government has given the method of determining the net winning. What is the method of determining of net winning? Whatever amount is withdrawn, that is 25 lakh rupees, minus bracket of whatever is the opening balance plus whatever is amount deposited. How much is the opening balance? 10,000. How much is the amount deposited? 1 lakh. That will be reduced from what? 25 lakh rupees. Therefore, the net winning will come to 23.9 lakh rupees, 30% tax. On this 30% tax has to be paid on 1st of Feb 2024. On this date, it has to be paid. Okay. Now, there is a balance of 6,60,000 on 31st March 2024. So, am I supposed to directly deduct TDS on 6,60,000? No, 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 no. At the end of the year, you have to do calculation. How? Whatever amount is withdrawn during the year plus whatever is the closing balance. You will add both of them. And then you will compare with whatever you have deposited in the current year plus whatever was there in the opening balance plus whatever tax you have paid earlier. Otherwise, there will be duplication of tax. So, whatever tax you have paid earlier, you have paid tax on 23.9 lakhs earlier. So, you will reduce that much. So, after that, whatever amount comes, that will be subject to what? 30% tax. I hope it is clear to all of you. Next question is a very, very simple question on transfer pricing, nothing great as such. There is a company by the name called as Surya Limited, which is an Indian company, and there is a foreign company by the name called as Sun Inc. Now, the Surya is guaranteeing 20% of the total borrowings of Sun Inc. So, Surya is guaranteeing more than or equal to 10% of the total borrowings of Sun Inc. Therefore, Surya and Sun are deemed to be a source enterprise. Now, Surya is importing some goods of 60 crores rupees from Sun Inc. How much? 60 crore rupees. So we are purchasing some goods of 60 crore rupees or 60 lakh rupees, whatever it is. Okay. Don't get into crores and lakhs. The amount is important, not the denomination. So 60 lakhs or 60 crore, whatever it is. So Surya is importing how much? 60 lakh rupees goods from whom? From its associate enterprise. Surya and Sun are associate enterprise that we have already determined. So Surya is importing goods of 60 lakh rupees from its associate enterprise. Now, the associate enterprise is charging how much markup? It is charging 25% markup to us, whereas to others they charge only 20% markup. To us they are charging more markup. It means we are paying more to Surya Inc. and to others they are charging less. The others are paying less to Surya Inc. So first of all, we need to reduce this markup. 25% on cost, 25% on sales will become 20% on cost. Okay. Therefore, this will become what? This will become what? This will become 12 lakhs rupees. So I have reduced 12 lakhs rupees over here. So 20%, 25% where they are charging markup to us. So I have to find out what is the markup on sales. 25% on cost is 20% on sales. So therefore on sales it is how much? On sales it is 1/5. Okay. Again I am saying if it is 25% on cost, it means it is 1/4 on cost. So therefore I want on sales because I have the sales figure now. So how much will be on sales? It will be 1/5 on sales. So I will reduce 1/5 of the cost. So that will become 48 lakhs. Then I have to adjust two things over here. What? Surya Inc. is providing me two more services. He is giving me 1 month extra credit. So whatever 1 month extra credit is giving me, that I have to add back over here. Plus Surya Inc. is also charging me for some brand value. So I have to add the brand value also. And after that, I have to do what? I have to add my normal markup. My normal markup is 20%. And then I have to compare with my arm's length price. Okay. I hope it is clear to all of you. So the rule is very simple. First, you will take the purchase price. From that, you will reduce the markup which Surya is charging. Then you will add your normal markup, that is 20%. Then you will add brand value, extra cost which I have to pay to Surya. Then you will add the extra 1 month credit which Surya is providing you. That also you have to add back. And then you will get your arm's length price. Okay. Now, last but not least, there are some additional questions over here. What is the due date for Surya for furnishing audit report? So the due date is 31st October 2024, 25, whatever it is. It is 31st October. 1 month prior to the due date of filing of return, you have to submit Form 3CB under Section 92E. What is the amount of penalty leviable if Surya fails to furnish the report under 92E? So if you don't furnish the report under 92E, there is a penalty of 1 lakh rupees under Section 271 BA. I hope it is clear to all of you. Is it clear? Please tell me. Let's go ahead with the next question. Beautiful question. There was Mr. Balram Kumar who was questioned by the police department because he was having 1 kg of gold ornament. Okay. that was seized by the police and it was given to the income tax department. The income tax department valued the gold. It was valuing around 63.3 lakhs. The assessee did not raise any objection. So what is happening in the first paragraph? There was a gold of 63.3 lakh rupees which was found to be in with Mr. Balram Kumar. The income tax department has raised question on that and the income tax department wants to tax that. The assessee is not raising any objection on that. Now later on during the assessment proceeding, the AO was not satisfied with the explanation given by the assessee and therefore the AO charged income tax on this 63.3 lakh rupees. How much income tax? As per section 115 BBE, because it is unexplained jewelry, bullion, etc. will be subject to 78% tax. 78% tax comes to 49.37 lakhs, including cess and surcharge, whatever it is. Plus 12.35 lakhs he was also charging against you an interest. Okay, an interest of 12.35 lakhs was charging. Listen to the amount very carefully. The tax is how much? 49.37 lakhs and the interest is 12.35 lakhs. Then the assessee filed an appeal to the Commissioner of Income Tax Appeal against this order. That assessee was saying, no, this is wrong tax. Matter went to the CIT appeal and the CIT appeal deleted the matter and the assessee was won. The assessee won the case. Now the department wants to appeal to ITAT. So now there is a monetary limit if department wants to appeal to an ITAT. Remember, what is the monetary limit as per section 268? The monetary limit is your tax effect should exceed 50 lakh rupees. Now, which has been very recently amended to 60 lakh rupees. Earlier it was 50 lakh rupees, but it has been very recently increased to 60 lakh rupees. This answer we will give as per 50 lakh only, but in the exam, if the question comes, you have to give as per 60 lakh rupees. Okay, be very careful about it. Now, the question is, what do I mean by tax effect? Will tax effect include both tax and interest? If it includes both tax and interest, then the limit is crossing, then the department can appeal. But if the tax effect does not include interest, then you cannot appeal, then the department cannot appeal. Therefore, for that we need to have a fine reading of the income tax law under section 268. Law under 268 says that tax excludes interest. It only includes tax, including surcharge and cess. So you should not take interest in the calculation of the monetary limit given by the law. So the monetary limit which you are going to take, 50 lakhs or 60 lakhs now, should not include what? Interest. So without interest, the limit is below 50 lakhs. Therefore, the department cannot appeal to what? ITAT. I hope it is clear to all of you. Next one, due to the nature, complexity and the volume of the accounts during the assessment proceeding, the AO has issued direction for inventory valuation. Now, the AO has given an inventory valuation. The AO has the power to give inventory valuation or AO has the power to give what? Special audit direction under section 142A. We all know that. The relevant approval has been taken and the company was given an opportunity of being heard. Now, the real problem starts from here. The AO wants to appoint a chartered accountant. Will a chartered accountant do a inventory valuation? The answer is no. Inventory valuation will be done by a cost accountant and not chartered accountant. Okay, this is the first mistake done by the assessing officer. Second, the AO fixed the fees for valuation at 1 lakh rupees. That is also wrong. The fixed fees will be fixed by the Commissioner of Income Tax. Okay, it will not be fixed by the assessing officer. And the AO asked the CA to raise the bill for valuation report directly to the company. That is also wrong. The bill will not be paid. The remuneration and all the incidental charges will be paid by the central government. So 3 mistakes done by the assessing officer. First, inventory valuation will be done by the cost accountant, not chartered accountant. Second, the fees will be decided by the Commissioner of Income Tax as per the rules made by the income tax law. Okay. Third, the fees will be borne by the central government and not by the assessee. Okay, I hope it is clear to all of you. Now, last question over here, which is very simple question. 100 times it has come. There is a cellular company, there is a telephone company which is giving some SIM card or recharge coupon to its agents. So the agents are selling. So 1000 rupees recharge coupon they will sell to the agent at a discounted price, say 900 rupees. So the difference of 100 rupees, whether that commission, that all depends upon if there is a principal agent relationship. If there is a principal agent relationship, then that is subject to TDS. If there is a principal relationship, then there is not subject to TDS. So in this case, if we read the case law, we came to know that there is a principal relationship. Therefore, in this case, there is no need to deduct any TDS. Okay. So this is a case law which has been coming again and again multiple times. So I don't think so again it will repeat it in the May 25 or September 25 or Jan 26. So they will not repeat the same case law again for the next few attempts at least. Now the next question is a simple case law, a simple theory question. You can do that at your end. I'm not interested in discussing theory over here. Okay, something which is very straightforward, which you have to read it from the book. You can do it yourself. Okay. Now the next question is based on again tax audit. I have told you earlier also that from May 2024 onwards, last question will be a tax audit question. Which question? Last question will be your tax audit question. Okay. Now question number 6. There is a domestic company engaged in developing and operating a solid waste management system, filed its return of income on 30th September, claiming deduction under 80IA. So assessee is claiming deduction under 80IA. Now to claim deduction under 80IA, the assessee has to take a form 15 CCB issued by the chartered accountant. Okay. So the chartered accountant has to check whether all the conditions of 80IA has been fulfilled or not, and accordingly the chartered accountant will issue the certificate. Okay. Now later on the chartered accountant came to know the time limit of 10 years of 80IA is expired. Okay. So while signing the report, he was not aware that the time limit is expired. But later on, the chartered accountant came to know that the time limit of 10 years has expired. So what is the responsibility of the chartered accountant in such case? The moral responsibility of the chartered accountant would be to tell the assessee that file a revised return, and the chartered accountant should withdraw its report. These are the two things he should do. He did these two things. He told the assessee to file a revised return, disallowing the deduction under 80IA, and he said that I am withdrawing my report under 10 CCB. Now the department is saying no, the chartered accountant is guilty, etc. No, the chartered accountant is not guilty. A CA will be guilty if he does not exercise due diligence or grossly negligence. In this case, the CA is not grossly negligent. Whenever he came to know, he took a relevant action. He withdrew the report. He changed the PNL. He told the assessee to file a revised return and pay the tax. So the chartered accountant in this case is not guilty. I hope it is clear to all of you. Okay, you have to just write down in few words. Don't stretch it unnecessarily to a great extent. Next question. We are planning to acquire 5 JCB machine, but we are under a dilemma whether to acquire or whether to lease, whichever is more beneficial, we will go for that. So whether the department will apply GAR on this? No, it's a tax planning. No? Whether to acquire a machine or whether to take a machine on lease, it is my personal choice. There is nothing wrong in that. Whatever is more beneficial for me, I will do that. Therefore, it is a case of tax planning, and whatever is a case of tax planning, on that the government cannot impose GAR. GAR is imposed on tax avoidances, not tax planning cases. Similarly, next case also, it's a beautiful case which is called as tax harvesting. There is an assessee by the name called as Mr. Dhaval, aged 45 years. He has made an investment in an equity shares, and he has made a short-term capital gains of 110 lakh rupees on 20th of March 2024. Now he's trying to play very smart over here. He was holding another 1000 equity shares which was purchased at 500, and on 31st March the market value of the share went down to 200. So what he did, he sold all of them at losses. Now whatever losses he has incurred, he has tried to set off against this capital gains of 10 lakh rupees, and then he repurchased them again on what? On 31st March on 1st April 2024. This is known as tax harvesting. So if there is a stock which is on loss, you purchased at 500, but now the market value is 200. You sell that stock. And repurchase that stock. Okay. Because of that, what will happen? Whatever you have sold, you will be able to book a loss on that, and that loss can be set off against your other capital gains income. Okay. So this is nothing wrong in that. As of now, there is no provision under income tax law to stop such things. It's a case of tax planning. In future, there might be a provision according to me. That's what maximum people are doing these days. So the government might bring a provision to stop such kind of things in future. But as of now, there is nothing like that. Therefore, no GAR will apply on this. And finally, the last question out of the 9 papers which we have discussed in this particular beautiful compilation. ABC Limited is an Indian company. It makes an application to board for advance ruling in relation to tax liability of a non-resident. So can a resident make an application for non-resident in respect of transactions that we are going to enter with non-resident? The answer is yes. Now the value of the transaction is 250 crores. So there are multiple questions which are asked over here. How many copies of application need to be filed? You need to file 4 copies, which is called as quadruplicate. 4 copies have to be filed. Okay. What would be the fees? So if the transaction value is between 100 crore to 300 crore, then the fees is 5 lakh rupees. So in this case, you have to pay a fee of 5 lakh rupees. Then what is the remedy available to applicant if the board rejects the application? So this we have done multiple times earlier also. The remedies available is you have to file an appeal to High Court within 60 days from the date of receipt of order. In case of genuine cases, you will get 30 days extension also. I hope it is clear to all of you. So this is what this paper is all about, and this is what my commitment towards my dearest students of full English who wants to learn direct tax in full English from me is all about. See, I could have done one thing for you all, that I could have recorded the things in Hindi and I could have told you that there is an option of auto dubbing. Listen to that in English, but that will not serve the purpose, tell me. I'm telling you honestly, auto dubbing will not serve the purpose. The way I will be explaining in my own way, auto dubbing will not be able to do that. So I am taking this extra effort. I'm not saying that I'm taking extra effort for you all. I can say the extra effort I am taking for Hindi students also. All of them are equal to me. Sometimes I can say that I'm taking extra effort for my Hindi student. Sometimes I can say extra effort I'm taking for my English student. I'm not saying that I'm doing any favor by making a separate video for you all. Absolutely no. It is my duty and it is my honor. I feel very happy that I'm able to serve you all. Especially language cannot become a barrier for my students. If language is becoming a barrier, my knowledge is of no use. For that purpose, if I have to record one thing twice, I will do it. If I have to record one thing thrice, 4 times, 5 times, I will do that also. But I don't know these many languages. I only know Hindi and I only know English. And I don't know any other language. Okay. So I have tried my best to compile this for you all. Believe me. At the end, if you are feeling hopeless, if you are feeling that nothing can be done in direct tax, believe me, just do the 9 RTP compilation, 9 past paper compilation and the MTP compilation. Believe me, if you do this properly, you will be easily able to score exemption. Your 80% paper will definitely come out of this only. The ICI does not have any scope beyond this. ICI does not have any scope beyond this. Max to max, they will put some amendments in these questions. And amendments we all have done very precisely on YouTube also, in our class also. We can start with our wonderful session on 8 MTPs, including the latest MTPs of May 2025, relevant for your exams. Now this MTP is relevant for May 25, September 25, and also for Jan 26. And before this, we have already done with what? We have done with 9 RTPs. We have done with 9 past papers for you all in full English. And now we are going ahead with 8 MTPs today, which will be absolutely in full English, relevant for your May 25, September 25, and Jan 26. And in all, after this session, we will be completing 26 papers, which is something which is impossible. As a student, you cannot think about, you cannot imagine about revising 26 papers in around a span of 8 to 9 hours. It is impossible. But we have tried our best to make this possible. Okay. So without wasting any further time, shall we start with our first MTP today? That is MTP Series 1, November 2023. You might be knowing that in every attempt, there are 2 series of MTPs. So November 23, May 24, November 24, and May 25. These are the 4 MTPs we are going to do. In every MTP, in every attempt, there are 2 series. So in all, there will be 8 MTPs. Okay. So let us start with our first question. I will take a break after every MTP. I'll complete one MTP and then I will take a break of 1 or 2 minutes only. So first MTP series, November 2023, question number 1. Let's read the last line. Always read the last line of the question. First of all, the last line says compute total income and tax liability. You are not supposed to compute minimum alternate tax. You are not supposed to compute as per 115BAA. It means you are supposed to compute as per the normal provision. Asasi is a manufacturer. It was set up in 2013. The profit and loss account says a net profit of 750 lakh rupees. The depreciation as per books of accounts is 52 lakhs. So you have to add back this depreciation. Okay. Next, you are receiving some power concession, tariff concession from Maharashtra state government. So remember, if you receive any concession from any state government or central government, that is an income as per section 22418. Therefore, let it be part of the income. Okay. Next one, you are paying some 18 lakh rupees as an estimated amount with a reasonable certainty as a periodical wage revision, which you do in every 3 years. So after every 3 years, you do periodical wage revisions of your workers and you make some provision for that. So that is fair enough. That is allowed as a deduction. There is nothing wrong in that. Then you have received dividend from foreign company, that is 12 lakh rupees. You have to reduce from here and you have to show under IFRS. Remember, when you receive dividend from foreign company, you do not gross up. But when you receive dividend from a domestic company, you have to gross up with the TDS. Okay. Be very careful with that, which I have told you in the past paper also. Next, there is some destruction of machine and there is a loss of 17 lakh rupees. So you will add back this loss and there is a scrap value on that particular machine of 3 lakh rupees. So you will reduce this from here and you will adjust in the WDV of the block of asset. But unfortunately, in this question, the WDV of the block of asset is not given to us. So ignore that. Okay. Next, provision for gratuity is always disallowed as per section 40A7. But whatever gratuity you have actually paid, that will be allowed under the income tax law. Okay. Next, you are doing some advertisement in a brochure of a political party. So that is disallowed under PGBP. So disallow under PGBP, but under 80 GGB, that is allowed as a deduction to an Indian company as a donation. Okay. Next one, there is some long-term capital gain of 3 lakh rupees on equity shares on which STT is paid at the time of purchase and sale. Therefore, it's a classic case of 112A. Therefore, reduce from here, show under capital gains. Now 1.25 lakhs will be exempt. Now assume that it is transferred on or after 23rd July. Therefore, it is 12.5%. Now in the question, date of transfer is not given. So I am assuming it is transferred on or after 23rd July. Therefore, I am taking 12.5% as the tax. Okay. Normal depreciation is 71 lakh rupees. The question says that ignore scrap value. So we are ignoring the scrap value because we don't have the WDV of the block of asset. Next adjustment, you have collected some GST of 8 lakh rupees from customer and then you have paid the GST on time. So you collected, you paid, so everything is squared off. Okay. Then you filed a case with the GST department that to the High Court, and the High Court gave you a refund of 3 lakh rupees. Now, if the High Court gives you a refund of 3 lakh rupees, what is your obligation? Your obligation is to give it to the customer back. Now you are only giving 2 lakh rupees to the customer back. Therefore, 1 lakh rupees lying in the current liability. It is your obligation to give it to the customer back. So add back to the PGBP income. Whenever you will give it to the customer, at that time you can take the deduction. I hope it is clear to all of you. And last, that's it. This is what this question is all about. Nothing great as such. The turnover of the last year of the company is 450 crore. Therefore, the tax rate will be 30% of this particular question. Okay. I hope it is clear to all of you. Now I am going ahead with the next question. It's a beautiful question. Beautiful question. Mark this down question. This is one of the best question of this MTP. Question number 2. It's a non-resident taxation question and it covers 4 different aspects in this particular question. First of all, let me read the question first of all for you all. Charles is a non-resident, is a German citizen and he's working in a German company. Okay. Now, so Charles is a non-resident, he's a German citizen and he's working in a German company. Now he's coming to India for some work. For how many days? He's visiting India for some official work for 85 days. So his company has sent to him India for some 85 days and the company has a PE in India and that expense is borne by the Indian PE. Okay. Now, for the time being, he was in India, he was paid 28 lakh rupees as salary. Okay. Now, whether this salary will be taxable or not, we are supposed to compute what? We are supposed to compute total income taxable in India of Mr. Charles. Okay. Ignoring the DTAA between India and Germany, we are supposed to compute the total income chargeable to tax in the hands of Mr. Charles in India. So, Charles is a foreign citizen. He is a non-resident. He is coming to India. He is working in a German company, foreign company. He is coming to India for around 85 days. Sir, his salary will be exempt. We have seen some exemption under section 10(6). No. We have seen some exemption under section 10(6) like this. But his salary, Mr. Charles' salary will not be exempt. Why? Because the condition for exemption was the foreign company should not do any trade or business in India and the foreign company should not claim that as an expense in India, should not charge that salary of 28 lakh rupees as an expense in India. Now, in this case, the foreign company is having a business in India because they are having a permanent establishment in India. That itself justifies that the foreign company has a business in India. At the same time, the foreign company is charging that expense in India. Therefore, this 28 lakh rupees will be taxable in the hands of Mr. Charles. Therefore, Mr. Charles will be liable to pay tax on this 28 lakh rupees. Yes, he can definitely claim what? 50,000 rupees standard deduction if he follows old regime, and if he follows new regime, then he can claim 75,000 standard deduction. I hope it is clear to all of you. Next one. The second income which is earned by the non-resident. Charles is holding some 1200 shares of an Indian company which was purchased in 2017 at 15 rupees per share. These shares were purchased in foreign currency. Okay. Now he is selling all these shares. Okay. He sold all the shares on 23rd of June 2024. So now non-resident is purchasing the shares of Indian company in foreign currency. So you have to apply the first proviso to section 48. You have to convert you have to apply rule 115A. What will you do? First of all, you will convert the sale consideration and expense on transfer into foreign currency. Then you will convert the cost of acquisition into foreign currency. And then you will convert the capital gains again back into Indian currency. So what rate we will take? For converting the sale consideration and expense on transfer, you will take average of TTBR and TTSR on the date of transfer. For converting the cost of acquisition into Indian rupees into foreign currency, you will take average of TTBR and TTSR on the date of purchase. And then when you convert back into rupees, when you convert back the foreign currency long-term capital gains into rupees, then you will take only TTBR, not average. When you reconvert into rupees, you will take only TTBR on the date of transfer. I hope it is clear to all of you. All those things are given over here. You can take the data from here. The third thing which the Charles has done. The Charles is holding some 2000 shares in a foreign company. That is a foreign German company. Now, in which he acquired 145 rupees 2020. AG follows April to March as a financial account. Now, Charles is a non-resident. That AG Aarish GmbH is also a non-resident. So Charles is selling the shares of a foreign company. Now that will be only accrued in one case if it falls under Vodafone case. When the shares of Aarish GmbH derive its value substantially from asset located in India. And what do I mean by the shares of a foreign company derive its value substantially from asset located in India? When the shares of when the total asset in India of Aarish GmbH is at least 10 crore rupees. It is more than 10 crore rupees and it is at least 50% of the total assets. Okay. So in this case, the Charles will be liable to tax in India only under one circumstance. If Aarish GmbH shares derive its value substantially from asset located in India. For that, the first condition is the Indian asset has to be more than 10 crore rupees. Now, how much is the Indian asset? The properties held in India is only 8 crore rupees. This condition is violated. Therefore, the shares of Aarish GmbH does not derive its value substantially from asset located in India. Therefore, the income of Charles is not subject to tax in India. I hope it is clear to all of you. And the last and the fourth thing, the dividend from Aarish GmbH, dividend from foreign company, generally it is not taxable, but because it is received in India, this will be taxable in the hands of what? In the hands of Charles. I hope it is clear to all of you. So this was a beautiful question. Okay, beautiful question. Next question number 3 has two parts. Part number 1 is a theory question which talks about the authority for advance ruling has the power of compelling production of books of accounts. Is it true or not? Yes. The authority for advance ruling has all the powers covered under section 131, which is generally given to the income tax authority while issuing a summons. That is the power to inspect and discover, the power to compel production of books of accounts, which is mentioned over here, the power to enforce attendance, the power to issue commission. So the authority for advance ruling has all the powers which is generally given under the summons. Okay. So the same is the case over here. You can write all the 4 points over here. The next one is a question on equalization levy under 165A, which is removed by the Finance Act 2024 and also removed by the ICI from the syllabus. Therefore, 165A equalization questions we are not going to do. Okay. I hope it is clear to all of you. Next one is a TDS question. Let's talk about the TDS applicability over here. We need to answer whether the TDS will be deducted or not. If yes, at what rate? If yes, if yes, at what rate? And if yes, then we have to deduct at what time? What is the timing? On the credit or payment, whichever is earlier, or at the time of payment, etc., etc., etc. First one, Indian company pays gross salary. How much gross salary? 7,30,000 to a general manager. Apart from that, the Indian company also pays non-monetary perquisites of 1,20,000. The manager is not opting for the 115 BAC. It means manager is opting for what? Manager is opting for old regime. Therefore, the old regime total income will come to how much? 8,50,000 is the salary, 50,000 standard deduction. The company will deduct TDS on 8 lakh rupees. When the company will deduct the TDS, the company will deduct the TDS on payment. Now, what is the rate of TDS? The rate of TDS is a slab rate as per the old regime. Okay. I hope it is clear to all of you. Next one, a notified infrastructure debt fund, which is exempt under section 1047, is paying an interest of 5 lakh rupees. So how much TDS will be deducted? The TDS will be deducted under 194 LB at 5% plus 4%, which comes to 5.2%. Okay. Similarly, the expense deduction will not be allowed under the income tax law. 194 LB 1158 does not allow the deduction of expense. Therefore, the TDS will be deducted directly on how much? Directly on 5 lakh rupees. Plus. There is one more question in this. What will be your answer if the non-resident is located in NJ? If the non-resident is located in NJ, then you will not deduct TDS at 5.2%. Then you will deduct TDS at 30% plus 4%. That is 31.2%. I hope it is clear to all of you. Next one, which is talking about, which I have told you in the class also. Suppose I tell you to make a shirt. Now you will ask me one question. Who will provide the material? I said that I will provide the material or my associated enterprise will provide the material. So if I will provide the material or if my associated entity provide the material, then what will happen? Then in that case, I have to deduct the TDS because then you are providing me service. Now in this also there are two views. First of all, if you give the breakup in the invoice, this much is for the material, this much is for the service, then I will deduct TDS on the service portion. But if you don't give the breakup, then I have to deduct TDS on the entire amount. Check it please. I hope it is clear to all of you. Next one, you are making some payment of 5 lakh rupees to a former Indian cricketer. So Indian cricketer for commentary in cricket match. So if you are giving some commentary or some payment to a commentator, then the commentator is nothing but a professional. Therefore, the TDS will be deducted under 194J at the rate of 10%. Okay. I hope it is clear. Next one is a very, very good question on section 263. What is section 263? Section 263 gives the power to the Commissioner of Income Tax to revise the order passed by the assessing officer. Generally, assessing officer pass the order. Now later on, if the commissioner feels that, if the commissioner is of the opinion that the order passed by the AO is erroneous or prejudicial to the interest of revenue, then the commissioner has the power to revise that order. So for that purpose, the commissioner issued a notice to what? To the assessing officer. Okay. Now later on, and the proceeding was initiated. Later on, there was a survey on the assessee. Okay. Now after the survey, the commissioner is issuing second notice to the assessing officer. So, and the content of the second notice is different from the content of the first notice. Therefore, the question is, can the commissioner issue a second notice where the content of the second notice is different from the content of the first notice? And the answer is no. The court said that the commissioner cannot do so. Okay. Next question. The Director General of Income Tax is in possession of certain cash, unaccounted cash. Now, by issuing an order under section 131, he is asking for seizure. Can he give an order of seizure under section 131? No. 131 is not for seizure. 131 is for summon. Therefore, if he wants to do seizure, then he has to pass a warrant under section 132. That power is not given under 131. That power is given under section 132 under search and seizure. Okay. With the help of 131, you can only do what? Summon. You can ask for inspection, discovery, etc. The four things which I have told you in previous question. Next question is a very, very, very simple question on DTAA. So I'm not going to do this question. It's a very simple question. We have done a similar question earlier. So let's not waste time on this. Okay. Let's go ahead with the last question of this particular MTP. This is a good question. There is an NBFC NBFC is depositing some money from its customer. So whether the 269SS and 269T provisions are applicable to NBFC, the answer is absolutely yes. 269SS and 269T provisions are not applicable to banking industry, are not applicable to post office, are not applicable to home, are not applicable to say cooperative bank, but it is definitely applicable to NBFCs. Okay. Now this NBFC is receiving first 15,000 rupees on 1st May by bearer check. So that is allowed. Up to below 20,000 if you receive by other than account pay check, account pay draft, ECS and such other electronic mode, that is allowed. Okay. So it is 15,000 rupees now. Now next time you need to be very careful. Next time when you receive a cash, the aggregate amount should not be more than 20,000 rupees. So when you receive first time 15,000 rupees by bearer check, that is allowed because it is below 20,000. Now next time when you receive 15,000 rupees again on 30th June in cash, now you are gone. Now 269SS will attract because the aggregate amount which we have received now in cash and the outstanding amount earlier, both of them should also not be more than what? 20,000 rupees. So the how much we are receiving second time? 15,000. And what is the outstanding on the date of receiving cash loan? It was another 15,000. Therefore, the aggregate amount should not be more than equal to 20,000. Therefore, here 269SS will attract. Similarly, while repaying also we have to check under 269T. When we are repaying and if there is already a 20,000 rupees outstanding, we cannot pay a single rupee in cash. Okay. Now here, just check it please. Now you are making a repayment of 16,500 and bearer check. Do you already have a 20,000 or more outstanding in the name of that person? Yes, we have a 30,000 outstanding in the name of that person. Therefore, now you cannot repay a single rupee in cash. Therefore, this 16,000 rupee 500 paid will be subject to 269T and you will be liable for a penalty under 271E, which will be imposed by the Joint Commissioner. And under 269SS, the penalty will be imposed under 271D again by the Joint Commissioner. Now, last when you are repaying 15,500, what is the outstanding at that time? The outstanding at that time was 15,500 only. So that you can pay in what? That you can pay in cash. Okay, I hope it is clear to all of you. So here 269T will not attract. So this is what your first MTP is all about. Let's go ahead with the next question, next MTP. So let's go ahead with the next MTP, MTP series 2 November 2023. Now the very first question over here is on partnership firm. Now let me read the last line what they want. They want total income under the normal provision. They don't want AMT. Okay. Under the normal provision they don't want AMT, just compute total income as per the normal provision. Therefore, in case of a partnership firm, what is the first thing that we compute? That is the first thing that we compute is the book profit. Okay. Always try to compute the book profit first. What is book profit? Book profit for computing the remuneration as per section 40B. And what is book profit? Book profit is nothing but PGBP income only. You compute PGBP income and add back what? Add back your remuneration if debited to PNL. Be very careful. If debited to PNL, you have to add back the remuneration. Okay. I hope it is clear to all of you. Now pay attention please, all of you. Let's start with the computation of book profit. What is book profit, sir? 80 lakhs is your net profit. Now, in that, I will first of all add back interest on capital 13%. So only 12% is allowed. Therefore, 1% I will add back. Okay, 1% add back. Loan taken from partner 15%. Only 12% is allowed. Therefore, 3% interest on loan I will add back. Okay. Interest on fixed deposit out of surplus fund 35,000. I will reduce from here and I will show under what? I will show under IFOS. Okay. Then depreciation as per books of accounts I will add back. Now, the next adjustment is a very, very beautiful adjustment. In 2020, you have purchased a building. The WDV of the building today is 36.45 and you sold that building for 90 lakh rupees. Okay. Now, so you are selling the building for 90 lakh rupees and that was the only asset in the block. So now you are selling the entire block. Therefore, short-term capital gain will arise. Correct. Now, what is the sale consideration of the block of the building? 90 lakhs. And what is the WDV? 36.45. Therefore, whatever is the differential amount, that will be subject to short-term capital gains because that is the only asset in the block. And because you are selling the only asset in the block, your block has become ceased to exist. Therefore, you will be liable for short-term capital gains. Therefore, this amount will be subject to what? Tax. So, what is the first effect? 90 minus 36, whatever it comes to 53.55. First of all, reduce that from PGBP because it is written in the question that it is credited in the PNL. Reduce that from PGBP and show that under capital gains. Now, when did you sell this? You sold on 10th of October. Now, within 6 months from the date of transfer, see, you have invested in the bonds specified in NHAI. How much? On 5th of April 2025, you have invested 60 lakh rupees. Okay. Even though the bonds were issued later, but the date on which you invested is more important than the date on which the bonds were issued. The bonds were issued when, that is not relevant. The date on which you have invested in the bond, that is relevant. So just try to understand from 10th of October 2024 to the date of investment 5th of April 2025. Are we investing within 6 months? The answer is yes. The answer is yes, we are investing within 6 months. Therefore, you will get 50 lakh exemption from here. Okay. From the short-term capital gains. From the short-term capital gains of building, you will get 50 lakh rupees exemption because maximum 50 lakh is only allowed under 54EC. Now you will have one question in your mind. Sir, that is a block of asset, na? That is short-term capital gain. How can you claim short-term capital gains against 54 EC? 54 EC is only for long-term. It's wrong. 54 EC does not specify the nature of gain. 54 EC talks about the nature of asset. If the asset is long-term, then 54 EC is allowed. It irrespective of whether the nature of gain is long-term or short-term. Okay, that is what it is written in the case of Ace Builders Limited. Did you all remember this case or not? Please comment and say me. Next one. I hope it is clear too. So ultimate treatment is 90 minus 36.45 FCCG minus 50 lakh rupees will be your ultimate capital gains on you will pay tax. Okay. Next one. There are only two working partners. And there are you are paying 20,000 rupees per month to them. Remuneration is not debited to P&L. So because it is not debited to P&L, you don't have to add back. Okay, because if it would have been debited, we would have added back. Correct. It is not debited. Nah, that's good. Nah, that's well and good. If it would have been debited to the P&L, we would have added back to compute the book profit. Next. Point number B I will do at the end. First, I want to compute the book profit. Okay. The depreciation as per income tax 14,000. You can take the deduction. WDV of the motor car which was purchased in 2020. Now remember, if you have purchased a motor car from 23rd of August 2019 to 31st of March 2020, then you get a depreciation of extra 15%. So 15 plus 15 will come to how much? Will come to 30%. You will get 30% depreciation over here. Cost of mobile phones you have purchased in the current year in the month of October. It is used for less than 180 days. Therefore, you will take 50% of 15%. That is 7.5%. Okay. And last, now you will compute your what? Book profit. Now, after computing the book profit, you will get what? You will get your total book profit and then you will get the maximum remuneration. The book profit is 25,79,150. On first 6 lakhs, it is 90% and on balance, it is 60%. Therefore, the ultimate amount is going to come 17,27,490 is the maximum remuneration that the firm can allow, but actual remuneration is very low. It is 20,000 rupees per partner to only two working partners. Therefore, that will be 20,000 rupees per partner, 2 partners into 12, that will be 4,80,000. Therefore, you will get maximum deduction of only 4,80,000 rupees. I hope it is clear to all of you. At last, what you are going to do? You are going to claim the deduction under 10AA because you have applied for what? You have taken the approval before 31st March 2020. So remember, generally if you start a unit after 31st March 2021, deduction under 10AA is not available because the deduction expired on 31st March 2020. But in this case, because of COVID, I have told you in the class, if you have taken the letter of approval till 31st March 2020, then you can start the unit up to 31st March 2021 also. So in this case, the associate has taken the approval till 31st March 2020 and it has started the unit in before 31st March 2021. Therefore, it is eligible for deduction under 10AA also. The profit is 7.5 lakhs. Into what? Into export turnover, which is 40 lakhs, divided by total turnover, which is 120 lakhs. That will be subject to deduction. This is the 5th year of the business. Therefore, the assessee will be eligible for 100% deduction. I hope it is clear to all of you. Next question. Next question is question number 3. Question number 2. It's a printing mistake. Okay. So don't see the number over here. Okay. Now this question is on exit tax. There's a trust which is on 31st Jan 2025. Now what has happened in this trust? The trust has made an application for registration in 2014. It got the registration in 2014 in July. It made the application in April. It got the registration in July. Okay. Now the registration got cancelled on 31st of Jan 2025. Therefore the trust will be liable for exit tax. For exit tax, we need to compute the accredited income of the trust, and on that we are going to apply what? We are going to apply MMR, that is 34.944% tax. Okay. So what is accredited income? For accredited income, you have to take all the assets of the trust minus all the liabilities of the trust. The very first asset is land. Am I going to take this in the accredited income? The answer is no. Why? Because this is purchased in 2011. Any asset which is purchased and any liability which is incurred before the registration should not be taken in the accredited income. Now, because this asset is purchased before the registration of 2014, therefore don't take this. Okay. For land and building purchased in 2018, yes, you will take that. For that, what value you will take? We will take market value or stamp duty value, whichever is higher. They have given us market value as how much? Market value 1,000 lakh. Stamp duty value 1050. Therefore, take whichever is higher, that is 1050. Next. For equity shares listed, you will take what? You will take average of highest and the lowest price in the stock market. So you will take average of 1099, 1051 divided by 2. That will be the into 2000 shares. That will be the market value. That will be the value under what? For the equity shares. For next. For bank, you will take the balance sheet value, book value. For bank, you will take the balance sheet value. For cash in hand, you will take the balance sheet value. For creditor, for TDS, you will not take. Taxes are not taken in accredited income. And last but not least, for creditors, it is 335, but out of which 30 is contingent. You can see over here, it is contingent. It is provided on estimated basis for which no bills are received. Therefore, 30 rupees you will not take. Therefore, only 305 rupees you will take in the creditor. And then you will compute your accredited income. And on that, you will apply 34.944% tax. And that will be your tax, exit tax. Okay. I hope it is clear to all of you. Next question. is on what? Next question is on section 44C. There is a foreign company or a non-resident who has a branch in India. So how much head office expense they can claim in India? Okay. How much head office expense they can allocate in India? They can take as per 44C. It is 5% of adjusted total income or amount allocated to the Indian branch, whichever is lower. So whatever amount is allocated to the Indian branch by the head office or 5% of the adjusted total income, whichever is lower, that will be allowed as deduction. So let's see how to compute the adjusted total income. They have given us the net profit, which is after the following thing. So why we need to add few things. Will we add the current year depreciation? No. Will we add the unabsorbed depreciation? Yes. For that you need to know the provisions of 44C. I am just saying out of what is written in the law. Okay. So the current year depreciation is not added back. Unabsorbed depreciation is added back. Will you add the capital expenditure of family planning? Yes, capital expenditure of family planning is added back. Revenue expenditure of family planning is not added back. Okay. Next, scientific research. No, scientific research is not added back. Brought forward losses. Yes, you have to add back. Chapter 6A. Yes, you have to add back. Head office expenses. Yes, you have to add back. Add back all these things to 28 lakh rupees and then take 5% of that. And after that, compare with the actual head office expense allocated to India, that is 120 lakhs. Whichever is lower will be allowed as deduction. I hope it is clear to all of you. Let's move ahead with the next question. Question number 4, which is on what? Which is a very, very simple question on board for advanced ruling. So there is an assessee who has applied to board for advanced ruling and the board for advanced ruling has passed an order. Now the question is the order binding on the applicant? The answer is no. It is not binding. You have an option to file an appeal to High Court within 60 days from the date of receipt of an order. And in genuine cases, you will also get an extension of another 30 days. If you show a reasonable cause, you will get an extension of 30 days. So moral of the story, it is not binding on anybody. Okay. Next one, there is an Indian public sector company who wants to go for advanced ruling, but their case is already pending before ITAT. Can they go for advanced ruling? The answer is yes. Generally, if your case is pending in front of income tax authority or ITAT or court, you cannot go for advanced ruling. But for public sector undertaking, there is an exception where it is said that in case of a public sector undertaking, they can go to ITAT even if their case is what? If their case is pending in front of income tax authority or ITAT. So in this case, the public sector company can go for what? Advanced ruling. I hope it is clear to all of you. Next question, question number 5. Part A is a theory portion. You can see that question. Part B is a beautiful question. So let me explain that very beautifully to you all. It's a beautiful question. Part B, it's a very, very important question. At least 4 to 5 times they have asked this particular question in the exam. So you have to be very careful. Mark down this particular thing in your book. It's a very important question. There is an assessee by the name called as Toll Limited. Toll Limited is in India, be very careful. And Tick Limited is in Australia. And both of them are associate enterprise because Tick Limited holds 30% equity shares in Toll Limited. Therefore, both of them are deemed to be what? Both of sound is not coming. Who says? Hello, 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 hello. It's coming. Issue at your end, Gaurav. So, Toll Limited and Tick Limited are what? Are associate enterprise. Now, Toll Limited is providing some services to Toll Limited is providing some services to Tick Limited, and we need to find out what the arm's length price as per what? As per the cost plus method. Now, what is the first step in the cost plus method? The first step in the cost plus method is what is the direct and indirect cost with respect to the services provided to what? Associate enterprise. So whatever services I am providing to Tick Limited, what is the direct and indirect cost of that? The direct and indirect cost of that is 3,50,000 rupees. That is the first step that we need to find out. What is the second step? The second step is to find out the normal GP margin on cost. The normal GP margin with unrelated party, the third party, that is the uncontrolled transaction, that is the comparable, is 40%. Now, we need to compare our transaction with the third party transaction, and then we need to see the difference between the two functional differences, and then we need to adjust the functional differences in what? In this GP margin. Remember, in cost plus method, you adjust the GP margin. You do not adjust the price. You adjust the GP margin and the revised GP margin will be added on the cost. Okay. That will give you the arm's length price. Therefore, in this case, there are 4 differences between our price and the price of the third party. So this is the normal GP margin. Now we need to adjust on this. Okay. Now, Toll Limited, all the 4 adjustments are beautiful adjustments. Toll Limited derives technological support from Tick Limited. Okay. So when I provide services to my associate enterprise, they also give me some services. Okay. There is no such support from the GN Limited. So the third party does not give me any support. So my associate enterprise, when I provide him some services, they also give me some services. But the third party does not provide me any services. So I should charge more to my associate enterprise or less to my associate enterprise? Obviously less, because when I provide services to my associate enterprise, they also give me something in return now. So therefore I have to charge less to them. How much less? That amounts to normally 15% of normal GP. What is normal GP? It is 40%. So 15% of 40% comes to 6%. So I have to reduce my GP margin by 6%. So 40% I will reduce by 6%. That will come to 34%. Okay. Second adjustment. investment. Now, as a TIC Limited gives business in large volume. So TIC Limited, my associate enterprise, gives me business in large volume. Therefore, I am giving him quantity discount, which I am not giving to third party. Okay, third party I am not giving any discount. So if the third party I am not giving any discount, then obviously to third party I will charge more, and there will be more GP margin. And to my associate enterprise I will charge less because I am giving discount. So there will be less GP margin. So this also have to reduce. That is also 10% of normal GP. 10% of normal GP comes to 4%. So that also will be reduced from here. So that will come to how much? That will come to now 30%. 40 minus 6 minus 4. Now we have reached till 30%. Okay. Third one. In rendering services to TIC Limited, TOL Limited neither runs any risk nor runs any nor incurs any marketing cost. On the other hand, when services are given to G&T, they are assumed to have risk and costs which are associated with marketing function, which is estimated 20% normal GP, which amounts to 8%. So remember, when I provide services to third party, there is lot of risk. There is lot of marketing. Therefore, if there is higher rate, there has to be higher return. But when I provide services to my associate enterprise, there is no risk. If there is no risk, then my profit in case of my GP margin in case of my associate enterprise has to be lower. Therefore, I am going from higher GP to lower GP, because when I provide services to my associate, a third party, there is a higher risk. Higher risk means higher profit. When I provide services to my associate enterprise, there is a lower risk. Lower risk means lower profit. Therefore, I have to reduce against 8% over here. How did I get 8%? 20% of normal GP, that is 20% of 40% comes to 8%. So I will reduce 8% over here. And the last one, TOL Limited offered 1 month credit to TIC Limited. So now when I provide services to my associate enterprise, I give 1 month credit. To others, I don't give any credit. So if I give credit to my associate enterprise, will I charge more profit or less profit? I will charge more profit. I will also ask for the credit now, which I am giving extra cost of credit, I will recover from you. Therefore, I will add back over here. Okay. So here I am going to not reduce, here I am going to add back. So after that, 5% of normal GP, that comes to 2%. So 2% I will add back. Whatever the arm's length GP will come, that will be the arm's length GP. That I will add on what? On 3,50,000 rupees, and therefore I will get what? I will get my arm's length price. I hope it is clear to all of you. Let's start with the next MTP. MTP series 1, May 2024. Now it's a beautiful question. Sheetal Limited is a listed company. It has a books of accounts separately maintained for different unit. Its head office maintain books of accounts. Let me read the last line of the Sheetal Limited. We are supposed to compute total income of Sheetal Limited and optimum tax liability. Okay. Assume the company has not yet opted for concessional tax regime. You must give the reason, blah, 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 blah. So, see. It's a very good question. There are multiple calculations that we are supposed to do over here. First of all, listen carefully. Sheetal Limited is what? Sheetal Limited, we need to compute the total income, tax liability, but optimum tax liability. So, we need to make 3 calculations over here. First, we will compute tax as per the normal regime, and then we will compute tax as per book profit. Check. They have also given us book profit over here. Okay, math. Okay, so when we compute the tax as per normal regime, we will compute normal tax and book profit, whichever is higher, that will be our first tax. Then we will check whether the assessee is eligible for 115BAA or BAB, whatever is more beneficial to the assessee, whatever is applicable to the assessee, we will compute tax as per the special regime. Okay, first normal regime. In normal regime, we will make 2 calculations, normal and MAT, and in special regime, we will make 1 calculation, 115BAA or BAB, and then we will see where the tax is coming lower. That is the best option. Okay, is it clear to everyone? So first we are computing the sum as per the normal regime. Okay, now the assessee is engaged in 4 different businesses. For them, they keep separate books of accounts. Okay, the first business is of chemical manufacturing unit in Jaipur. Okay, the net profit is 300 lakhs. Now they have entered into an agreement for use of know-how from a renowned scientist, for which they have paid a royalty of 40 lakh rupees. Okay, so royalty is allowed as reduction, but they have made a mistake. On 10 lakh rupees, they failed to deduct the TDS. And but they failed to deduct the TDS on 10 lakh rupees. But the payee has paid the tax. The payee has admitted the royalty income. The payee has filed the return. So in that case, what will happen? Nothing will happen. Still the expense will be disallowed only. Na? See, if I do not deduct your TDS, but if you include that in your income, and if you pay the tax, and if you file the return, then in that case, the government says that the payer is not an assessee in default, but the expense will be definitely disallowed in the current year, and in the next year, I will get the deduction. But in the current year, I have to disallow the expense. Therefore, 30% of the expense will be disallowed, assuming that we are paying it to the resident. Okay, I hope it is clear to all of you. Next one is. You are paying 33,60,000 rupees as what? As employees notified pension scheme, which amounts to 15% of basic salary plus DN terms. Now remember, only 14% of basic salary in DN terms will be allowed. 15% will not be allowed. Therefore, you have to add back 1%. Okay, 1% will be added back. This will complete your first income. Okay. Second, furniture manufacturing in Pune. You have a furniture manufacturing in Pune. Let's compute the income of this business. The net profit is 90 lakhs. The company has bought a trademark of 25 lakh rupees on 1st June. So that is not allowed as a deduction. That is allowed as a depreciation. So add back 25 lakhs and claim 25% depreciation on that. Then 3 lakh rupees you have paid as an interest to a non-resident Indian. The TDS was deducted in March and it was paid in May. So it is absolutely fine. You are deducting the TDS in the same year and you are paying before the due date of filing of return. So therefore this is allowed. There is nothing to be disallowed over here. Next, you are paying 7 lakh rupees as taxes on non-monetary perquisite of the employee. It is very specifically disallowed under section 40A5. Taxes on non-monetary perquisites of employees are disallowed under PGBP. So you will add back this. Okay. I hope it is clear to all of you. Let's move ahead with the third business. Fertilizer producing unit in Narmada. Remember, if you are engaged in production of fertilizer, then you are eligible for section 35AD deduction. So this is a special section. Okay. So if you are engaged in fertilizer, you are eligible for 35AD deduction. Now what is the profit? The net profit of the assessee is 220 lakhs, but this is after depreciation on building and plant and machinery. Now if you are claiming 35AD deduction, then you will not get deduction of depreciation, additional depreciation. So first of all, 220 lakh is the profit of the assessee. Add back both the depreciation. Add back both the depreciation and then claim the deduction of building and plant and machinery directly 100%. Land you will not get deduction. Okay. Building 2.5 crore you can claim deduction and plant and machinery 3 crore you can claim deduction. Whatever loss will come over here, that loss you cannot set off against other business because 35AD loss can set off only against 35AD business. It cannot set off against other businesses. Okay. So this you have to carry forward and carry forward. I hope it is clear to all of you. Next one, warehousing facility of storage of edible oil. Whether storage of edible oil is also covered under 35AD? The answer is no. Edible oils are not covered under 35AD. Okay. Only agricultural product and sugar is covered under 35AD. So this is the normal business. Okay. So what is the profit over here? Your profit is 70 lakh rupees without deducting depreciation. So claim depreciation on plant and machinery. On building you claim 10%. On plant and machinery you claim 5%. You claim depreciation and go ahead. Okay. So now this we have done all the four business. Now there are some additional information you have which has been given to you. The company mobilized capital during the year 24-25 by public issue of the shares. The money was kept in the bank pending allotment of share. The interest income from the said bank is credited to general. So absolutely correct. So if you have received share application money from the shareholder and if you have put that money in the bank, on that you are earning some interest, then that is not considered to be IFO's income. Okay, there is a high court judgment on that. Rama Multitech, I don't remember the exact name of the case law. That is not considered to be an IFO's income. That has to be credited to the PNL or general reserve. The company has done correctly. Okay. Next, the company has also received 56 lakhs as dividend. So that will go under IFO's. And the company has distributed 40 lakh as dividend. So that company can claim as a deduction under ATM because whichever is lower, dividend received or dividend distributed, whichever is lower, that can be claimed as a deduction under ATM. Okay. Now, the turnover of the company of last year is 390 crore. Therefore, the company will be subject to 25% tax plus surcharge if applicable. I don't know the exact total income. If the total income exceeds the limit, then you have to apply surcharge also. So that will complete your first tax. Okay. Now we will compute the book profit. Book profit they have directly given us 520 lakhs. So on 520 lakhs, we will directly compute tax. How much? 15% MAT. 7% surcharge because the book profit is more than 1 crore rupees and 4% cess. Okay. Therefore, this will be subject to second tax. Now compare both the tax. Whichever is higher, this will be your first tax. Okay. Now we will go with the special tax regime because we need to find out the optimum tax liability. So we need to find out the special tax regime also. Sir, what is which special tax regime assessees will follow? Assessee will follow 115BAA. BAB is not possible. Sir, why BAB is not possible? BAB is possible only for those assessees who are engaged in what? Who are engaged first of all in only one manufacturing business. All those who are engaged in multiple businesses are not eligible for 115BAB. 115BAB is only available if you are engaged in manufacturing business. Secondly, 115BAB is available only in the first year of the business. This is, you have not taken in the first year of business 115BAB. So in the second year, you cannot take 115BAB. Therefore, you can go for 115BAA. Sir, in 115BAA, how the things will change? Only 35AD deduction will be disallowed to you. Okay. Don't take 35AD deduction. Okay. 35AD deduction will not be allowed to you. Okay. In place of that, sir, what can I do? In place of 35AD deduction, what you can do is you can claim depreciation. That is this depreciation you can claim. That's it. Apart from that, everything will be same. And the tax rate will be 22% tax, 10% surcharge, 4% cess. I hope it is clear to all of you. So this was a very, very, very good question. Beautiful question it was. The next question is also a beautiful question. This is one of the best MTPs. One of the best MTPs out of all the MTPs is this one. Now let's see. ABC Private Limited is there, which is converted into LLP. So if a private limited is converted into an LLP, say on 1st of October 2024, then the provisions of section 47(13)B are applicable. Okay. Provision of section 47(13)(b) are applicable. Now we need to give the implication of the following items. Business loss. What will happen with the business loss? Yes, the LLP can carry forward the business loss for another 8 years. Okay, treatment number 1. Next, what will happen with the written down value of the asset? Now, plant and machinery 15%. Market value ignored. Take the WDV. Take the WDV of the plant and machinery 14 lakhs into 15%. This 2,10,000 depreciation will be apportioned between both of them. Between the company and the LLP on the basis of number of days the assets are used by both of them. Okay. Third, plant and machinery 75 lakhs, 3580 deduction claim. For this, the actual cost in the hands of the LLP will be 0. Because any asset on which deduction under 3580 is claimed, the actual cost of that asset is 0, 0, 0. Even in case of conversion from a company to LLP, even the LLP cannot claim depreciation on that particular asset on which the company has taken deduction under 3580. Be very careful. It is written under explanation 13 to section 43(1). Next one, for building same thing. Both of them will claim depreciation. Okay, 40 lakhs. Don't take the market value. You have to take WDV in the hands of the preceding entity. That will be considered to be the actual cost in your hands. Take 40 lakhs into 10%, 4 lakhs, apportion between both of them. Okay. Now, whatever depreciation is claimed by the company, reduce that from the WDV, and the balance WDV will be given to the LLP, and the LLP in the future years will claim depreciation on that amount. Okay. Next one. The LLP has the company has purchased the land for 80 lakh rupees. The market value of the land is 120 lakhs. So that market value will 80 lakh rupees will become the cost in the hands of the LLP. The cost to the previous owner will become the cost, because as per section 49, where an asset is received by an LLP from a private company, in case of conversion, then the cost in the hands of the LLP will be the cost to the previous owner. Whatever is the cost in the hands of the previous owner, that will become the cost in the hands of the LLP. Okay. Next one, VRS expenses of 28 lakh rupees incurred in 22-23. So VRS is allowed in 5 equal years. So in the current year, entirely the LLP will claim. Entirely LLP will claim. Okay. Last 2 years, company was claiming. In future year, also LLP will claim. In the current year, entirely LLP will claim. Don't bifurcate based on number of days. VRS expenses are not divided based on number of days. Okay. MAT credit is not allowed to carry forward. Not allowed to carry forward. Unabsorbed depreciation you can carry forward for infinite number of years. Okay, that is allowed. Now the next question is a very simple question of DTAA. I'm not interested in that. We have done a similar question earlier. You can check it. Very simple. It's a lollipop question. You can go through it once. Okay, I'm not much interested in that. I'm going ahead with the next question. Okay, it's a beautiful MTP. Next question is on charitable trust. There is a charitable trust by the name called as Satwich Charitable Trust. They are selling one building for 4.2 lakhs. Therefore, selling price is 4.2 lakhs. What is the purchase price? The purchase price was 2.2 lakhs. Therefore, capital gains is 2 lakh rupees. Now, if a charitable trust wants to save this capital gains, they have one section, section 11, subsection 1A. What are they supposed to do? They are supposed to reinvest this net consideration into another asset. So, if they reinvest this if they reinvest this consideration, not for 2 crore, not 2 lakhs, it is 4.2 lakhs. If they reinvest the consideration that is 4.2 lakhs, then entire 2 lakhs rupees will be exempt. But if they invest less than 4.2 lakhs, then proportionate will be exempt. But they are investing how much? They are investing 3 lakh rupees. Then how much will be exempt? Cost of new asset minus cost of old asset. What is cost of new asset? 3 lakhs. What is cost of old asset? 2 lakhs. This much will be exempt. Okay. So this much will be exempt. 2.2 lakhs. I'll just write down over here. Just a second. Pencil is not working. Cost of new asset 3 lakhs minus cost of old asset 2.2 lakhs. 80,000 will be exempt. Okay, that's what I am exempting over here, and the balance amount will be subject to tax. Again, I am saying if they want to exempt entire 2 lakhs rupees, then they have to invest the entire 4.2 lakhs. If they would have invested entire 4.2 lakhs in fixed deposit, then nothing would have been taxable over here. I hope it is clear to all of you. Next one. There is a religious trust as well as charitable trust, both, combination of both. They are maintaining 2 separate donation boxes. Now they are receiving anonymous donation. Some amount is received in temple, some amount is received in charitable purpose for school. So whether 115 BBC will be applicable or not. See, I have told you, if a charitable trust is both charitable and religious trust, and if they maintain 2 separate donation boxes, then the amount received in the charitable donation box, that is in the temple, that will not be subject to 115 BBC, but the amount received in the school donation box, that will be subject to 115 BBC. Okay, I hope it is clear to all of you. Next one is a question on electoral trust, which they have also asked in what? In the past paper also. We have done this particular question in May 2024 paper, but again I am doing it for you all because it is an important question. Okay, so there is an electoral trust which was formed in 2023. Last year it was formed, and this is the second year. 2024-25 is the second year. Now, the total contribution received is 420 lakh, and the surplus of last year is 18 lakh rupees. And the trust is incurring 8 lakh rupees for managing its affairs. Okay. So we need to find out what is the distributable surplus. See, there is a provision under 13B which says that in the first year a trust can distribute how much? 5% of the voluntary contribution. Okay. Or 5 lakh rupees, whichever is lower. 5% of the voluntary contribution or 5 lakh rupees, whichever is lower. In the second year, it is 5% or 3 lakh, whichever is lower. Okay. So we are into the second year. We are not into the first year. The first year has gone. The first year was 23. This is 24. So we can only contribute how much? 3 lakh rupees maximum as a distributor. As we can only incur maximum 3 lakh rupees to manage the affairs of the trust. Okay. So how much you are incurring to manage the affairs of the trust? 8 lakh rupees. You are not allowed to do that. You are allowed to do only 3 lakh rupees. Therefore, total how much money you have? 420 plus 18. That comes to 430. Out of which, how much you are allowed to maximum incur for managing the affairs of the trust? Only 3 lakh rupees. Therefore, the distributable surplus is 435 lakhs. Okay. That is the answer. Now, we need to check one more thing. We need to also claim exemption. To claim exemption, we need to check that whatever amount we have received in the current year plus whatever amount we have received in the last year, aggregate of both of them, 95% has to be distributed. So 95% of 438 comes to 416.1. So therefore that is okay. So if I distribute 435 rupees, it's okay. It is within the limit. It is within the limit of the managing of affairs also, and it is above the limit of what? 95% also. It cannot go below 95%. Now, if it goes below 95%, then you will lose the exemption. So it has to be above 95% also, and it has to be limit as per the managing the affairs expenses also. I hope it is clear to all of you. Next one is a very simple question on transfer pricing. Trax INC is a foreign company. Is an Indian company. Olive INC is a foreign company. One entity guarantees another 12% of the total borrowing. So if one entity guarantees another entity 10% or more of the total borrowing, then both of them are deemed to be associate enterprise. Therefore, both of them are deemed to be associate enterprise. Now, second part says that suppose the assessing officer has made a primary adjustment of previous year 22-23 on 31st March 2024 and it is accepted by Trax and INC. So, what are the implications? So, if on 31st March 2024, AO has done a primary adjustment of 310 lakhs, which is more than 1 crore rupees. Therefore, it is the obligation of the assessee to bring back that money in India within 90 days from the date on which the order was passed by the assessing officer. So, the assessee has to bring back that money 310 lakhs to India within 90 days from 31st March 2024. If the assessee does not do that, then what will happen? What will happen if the assessee does not do this? If the assessee does not do this, then secondary adjustment will apply. How secondary adjustment will be applied? We need to compute the tax. We need to compute the interest on 310 lakhs. What will be the interest? You will take SBI's MCLR 9% plus 3.25% and you will compute the interest for the entire year. Okay. From 1st April to 31st March 2025. One more option you have. You have one more option that you pay one-time additional tax of 20.9664. If you pay that, you will be relieved from the next year. Okay. From the date of payment of that tax, you will be relieved. Okay. After that, no secondary adjustment will be imposed on you. It's a very big paper. Next one. And it's a very dangerous paper also. Next one. Question number 4. There is a company who is doing a business. Check here. Trading business. And the last year turnover of the company is how much? 70 crore rupees. Now this company accepts from the customer only cash, check, credit card, debit card. They do not accept any other mode of payment. They only accept these 4 modes of payment. Can they do so? The answer is no. There is a section 269 SU and the penalty under 271 DB which says that if you are doing a business and if your last year turnover is more than 50 crore rupees, listen carefully. If you are doing a business and if your last year turnover is more than 50 crore rupees, then in that particular case, you have to keep the prescribed mode of payment in your business. And if you don't keep the prescribed mode of payment like Bheem UPI, RuPay debit card, then the QR code, etc., then there will be a penalty of 5,000 rupees per day till the time you don't install those mode of payment in your business. I hope it is clear to all of you. Next one, there is a tax assessment on Mr. Raghav which was completed on 25th of December and the tax due was 28 lakh rupees. Now the question is, from which all places the AO can recover this? The AO can recover from whatever assets belong to Mr. Raghav or whatever assets Mr. Raghav has given to somebody else and whose income is clubbed in the hands of Mr. Raghav. Be very careful. Whatever assets belong to Mr. Raghav, the AO can recover from them, and whatever assets the Raghav has given to somebody for which the income is clubbed in the hands of Raghav, the department can club, the department can recover from there also. First of all, Raghav has a bank deposit with Canara Bank, so from here the department can recover obviously. Raghav has a receivable that is debtors, so the department can recover from the debtors also. Now the third one is important. Raghav has gifted a land to his major son. So whether a land which is gifted to a major son, whether the income of that land is also clubbed in the hands of the father? The answer is no. Only the income of minor is clubbed in the hand of father. Income of major son is not clubbed in the hands of father. Therefore, this particular amount cannot be recovered by the department. Next, you are giving some diamond necklace to your son's wife. Whether that will also be clubbed? The answer is yes. If you give anything to your son's wife, that is clubbed under the income tax provision under section 60 to 65. You can go and revisit your CA inter books. When you give something to your son's wife, that is also clubbed in the hands of father-in-law or mother-in-law. So this the department can recover. Okay, diamond necklace. And last, Raghav has a residential apartment in Australia. Definitely the department can recover from there also. Okay, I hope it is clear to all of you. The next question is a beautiful question of Vodafone case law. Vodafone case law. So to explain this particular question, I have made one small chart below. You can just try to understand this chart first. Okay, there is an Indian company and Flix Inc. is a foreign company which holds 100% in the Indian company. Okay, Flix Inc. is a foreign company and Angelo is a non-resident, James is a non-resident. Both of them holds 50% in the Flix Inc. Now, Angelo holds 50%, James holds 50%. They are selling the shares of Flix Inc. Whether the shares sold by Angelo and James of Flix Inc., whether they will be deemed to accrue or rise in India, whether the shares of Flix Inc. sold, whether that will be chargeable to tax in India. That will be depending upon only one factor. If the shares of Flix Inc. derive its value substantially from asset located in India, if the shares of a foreign company derive its value substantially from Vodafone case law, if the shares of Flix Inc. derive its value substantially from asset located in India, then it is deemed to accrue or rise in India. So what do I mean by substantially from asset located in India? Two conditions have to be fulfilled by Flix Inc. First, the Indian assets of Flix Inc. has to be more than 10 crore rupees. Second, the Indian assets of the Flix Inc. has to be at least 50% of the total assets. If these two conditions are fulfilled by Flix Inc., the shares of Flix Inc. are deemed to accrue or rise in India. Then whether Angelo sells, James sells, the income will be accrued in India. So on which date we are supposed to check this 10 crore and 50%? You are supposed to check this 10 crore and 50% on a specified date. So what is specified date? The specified date can be generally two dates. It can be the last balance sheet date or it can be the date of transfer. What is the date of transfer? The date of transfer is 1st June. What is the last balance sheet date? The last balance sheet date of Flix Inc. is 31st December. Be very careful. Be very careful. The last balance sheet date or date of transfer. Generally, you should take last balance sheet date. That should be the date, specified date. But if the difference in the book value from the last balance sheet date and the date of transfer is more than 15%, then you should take the specified date as date of transfer. So first of all, we will see the book value on the last balance sheet date. The book value on the last balance sheet date is 1000 crores. Now, you should also check the book value on the date of transfer. The book value on the date of transfer is 1300 crore. Is the difference between the two more than 15%? Yes. Then you cannot take the balance sheet date as the specified date. Then you have to take 1st June date of transfer as specified date. If the difference would have been less than 15%, then I would have taken 31st December as my specified date. But in this case, the difference between the last balance sheet date and the date of transfer, the book value of the asset is more than 15%. Therefore, you will take the value on that is the specified date will be 1st June 2023. And now on 1st June 2023, you will check whether the fair market value of the asset while computing the value of 10 crore or 50%. Now you will not check book value. Now you will check the fair market value of the asset without reduction of liability. So now you will check whether the Indian assets. So first you have to find out the specified date. So for finding out specified date, take always book value, and once specified date is found, then you will find out what the 10 crore or and 50% is computed is properly fulfilled or not. So let's check now. We have computed the specified date. The specified date is 1st June 2024. That is the date of transfer because the difference is more than 15%. So now, what is the Indian asset? The Indian asset is 600 crore. You can check over here. And what is the total asset? So therefore, is the Indian asset more than 10 crore? The answer is yes. It is 600 crore. And what is the percentage of Indian assets as compared to the total asset? It is 600 crore divided by total assets of Flix Inc. is 1100 crore. Therefore, that is 54.45. Therefore, both the conditions are fulfilled on specified date. Therefore, the income of Flix Inc. The Flix Inc. derive its value derive its value substantially from asset located in India. Therefore, the shares which are held by James and Angelo, if they sell the share, that will be deemed to accrue or arise in India. I hope it is clear to all of you. It is a beautiful question. And one last question I guess over here is this one. Shall I read this question? Please tell me. There is one there are two categories. There are two small questions over here. We need to find out whether GAR will be applied or not. First case, there is an assessee who has two units. One is in SEZ, one is in non-SEZ. Now, the non-SEZ unit is doing what? The non-SEZ unit is doing manufacturing and SEZ unit is doing only packing. Again, I am saying SEZ unit is doing only packing. Therefore, will it be eligible for what? Will it be eligible for deduction? No, it's a clear case of tax evasion, and because it's a clear case of tax evasion, therefore GAR will not apply. GAR does not apply if there is a tax evasion. GAR does not apply if there is a tax planning. GAR does not apply if there is a specific anti-avoidance rule. GAR applies if there is a tax avoidance. Okay, so this is a clear case of tax evasion, therefore GAR will not apply. Second case, there is an Indian company which has two units. How many units? Two units. Now, one is in SEZ, one is in non-SEZ. Now they are trying to transfer the goods within themselves at a higher price, lower price, and trying to manipulate the deduction. It's a specific case of domestic transfer pricing. So here, specific anti-avoidance rule is applicable. We all know that if one unit is eligible for ATIA, ATIB, ATIC and 10AA, and another unit is not eligible for ATIA, ATIB, 10AA, and if they do any transactions between themselves, then that is subject to what? Domestic transfer pricing. But there is one condition, that the aggregate amount of transaction should exceed how much? 20 crore rupees. Only then domestic transfer pricing is applicable. Otherwise, domestic transfer pricing is not applicable. Next one is a question on tax audit. So be very careful with this question. It's a beautiful question. There is a firm who has employed 30 new employees with a salary of 24,500, and that is paid by an account paycheck. In addition, the firm is also contributing 10% to the employer contribution, and the firm is paying transport allowance of 3,500 paid in cash. Okay, the gross total income of the firm includes PGBP income of 75 lakh rupees. Now, the firm has claimed deduction of 26 lakhs 46,000, that is 30 employees, 24,500 into 12 under 80 JJAA. The chartered accountant has also given a form under a report under form 10DA that the deduction is correctly computed. Okay, now the question over here is, the deduction under 80 JJAA is available if the emolument is what? If the emolument is up to 25,000 rupees. So now, what does emolument include? Emolument includes everything that is paid to a employee. First of all, it will include salary. Will it also include employer contribution to provident fund? No, that will not include employer contribution to provident fund because that is specifically excluded. Third, will it include transport allowance? Definitely transport allowance will also be included. The chartered accountant has not considered transport allowances over here because it is paid in cash. How does it matter whether it is paid in cash or not? It doesn't matter. Whether it is paid in cash or whether it is not paid in cash, you have to consider both of them. And if I consider both of them, 24,500 plus 3,500, it amounts to 28,000. And if the emolument exceeds 25,000 rupees, you are not eligible for 80 JJAA. Therefore, in this case, the chartered accountant is guilty. The chartered accountant is guilty under part 1 of second schedule, and he will be facing the consequences from the ICAS disciplinary committee. Okay, I hope it is clear to all of you. And one last question over here is, which is similar to what we have done earlier, that there is a company which has gone to board for advance ruling, and the advance ruling has given its ruling. Is it binding? Absolutely, it is not binding. We have done this just now, half an hour before. It is not binding. It is not mandatory. You can go and file an appeal in High Court within 60 days from the date of receipt of order. And in case of genuine cases, you will also get an extension of 30 days. I hope it is clear to all of you. So this is what this beautiful MTP is all about. Let's go ahead with MTP Series 2 May 2024. Question number one, we are supposed to compute total income, tax liability in a most beneficial manner. Again, they are asking us to compute tax liability in a most beneficial manner. Again, we are supposed to make 3 calculations. First, normal calculation, then 115 JB book profit. Then we need to compute as per 115 BAA or 115 BAB as the case may be. So first I am computing as per the normal provision. So this is a domestic company. Which is engaged in manufacturing. It was set up in 2023. Okay, just now it has been set up. Now the profit is 1 crore 47 lakh. Depreciation you will add back. Then lump sum consideration for obtaining design and know-how, you will add back this, and then you will take 12.5% depreciation, 50% depreciation on intangible asset. That is 12.5 because the asset is used for less than 180 days. Okay. Next, you are purchasing something from your related party. Then at 96 lakhs, whereas the market value is 82 lakhs. Therefore, the differential amount will be added back as what? Excess amount. Okay. Next is a very important adjustment. You are receiving cash subsidy of 15 lakh rupees from the state government for new new plant and machinery. So if you are receiving a subsidy, grant or reimbursement for fixed asset, you have to reduce from the block of asset. So you have to reduce that first of all from PGBP income. It is not an income. And then you will reduce from the machinery. The value of machinery you can see over here is 75 lakh. So I will reduce this subsidy from the 75 lakh rupees. I hope it is clear to all of you. Next one, bonus issue. If you are incur some expenses to issue bonus shares, that is allowed as deduction. But if you incur some expenses to issue right share, that is not allowed as deduction. Next one, short-term capital gains on transfer of capital asset being equity shares on which STT is paid. So you will reduce from here. You will show under capital gains 111A 20% tax, assuming it is transferred on or after 23rd July. If it is transferred before 23rd July, then it will be subject to 15% tax. Depreciation, you can claim 36 lakhs as deduction, which is as per the income tax law. Then you are selling some unlisted shares for how much? For 22 lakh rupees. You have purchased the unlisted share for how much? 12 lakh rupees. Now you have purchased in this year only, so it is a short-term capital gains, and short-term capital gains of 10 lakhs will be taxed at normal rate, because this is not a 111A short-term capital gain. This is the normal short-term capital gains. And last but not least, you are purchasing a machine of 75 lakh rupees on which you are paying 10 lakh rupees by bearer check, so that will not be subject to depreciation. Therefore, you have to reduce that from the actual cost. Therefore, eventually your actual cost will be only 50 lakh rupees. On that you will claim 15% normal depreciation and 20% additional depreciation. Now you will compute your tax as per the normal provision. How much tax you will take? You will take 25% tax, sir. Why 25% tax? Because this is the first year of business, and in case of first year of business, your last to last year turnover is 0 rupees now. Therefore, you have to take 25% depreciation. You don't have any other option. Okay, then apply surcharge if applicable and cess. Now you compute the book profit as per MAT. The book profit is 320 lakhs. So take 15% tax, 7% surcharge because the book profit is more than 1 crore, and 4% cess. Okay, I hope it is clear to all of you. Now you compute what? As per 115 BAA or BAB. Which section is applicable? See, 115 BAB you can take over here. Why, sir? Why? Because this is a domestic company and this is engaged in manufacturing, and this is the first year of business, and your business has to be commenced between 1st October 2019 to 31st March 2024. So you are commencing in this year, and this is also this is also your first year of business. So you can claim 115 BAB. In 115 BAB, how much tax will be imposed? How much tax? On your manufacturing income, you will be paying tax at the rate of 15% tax. Okay. On your short-term capital gains of this short-term capital gains 111A, you will pay 20% tax. This short-term capital gains, which is taxed generally at normal rate, on this you will pay 22% tax. Okay. And then you will apply 10% surcharge and 4% cess. And in 115 BAB, there is only one difference. You will add additional depreciation. There is no other difference between the normal provision and 115 BAB. Just the additional depreciation which you are claiming now on this machinery of 50 lakh rupees, you have to add back that additional depreciation. I hope it is clear to all of you. Now, there are a lot of things which are repeated over here. So whatever is repeated, I am not going to do that with you all, because and only something which is 100% repeated, only that I am going to ignore. Even if one of the adjustment is same, I am going to do it with you all. Believe me. Even if one of the adjustment is same, now I will do it with you all. If the question paper, if the question is exactly similar, so I will not do that. See, these two questions we have already done in past papers or in past RTP. Check it please if you want. We have already done these questions, both of them. This is based on trust. Same question we have done earlier. Okay, so it doesn't make sense to repeat that once again. Okay, I'm going ahead with the next question. Now this is a beautiful question once again. Beautiful question on DTAA. I told you, if there is some new question which comes on DTAA, I will definitely solve it you all. Now, Mr. Sarthak is an Indian citizen. He is 51 years old. He left India for the first time on 1st April 2021. Now, due to some unavoidable reason, unavoidable circumstances, he returned back to India on 1st of June 2024 permanently. So, what is his residential status? See, on 1st June 2024, he is coming to India permanently. So, therefore, he is definitely staying in India for 182 days. Therefore, he is resident. Now, he left India in 2021. So, therefore, in the last 10 years, he is definitely resident in 2 years. In the last 7 years also, he will fulfill 730 days condition. Therefore, 100% is resident and ordinary resident. Therefore, world income is taxable for Mr. Sarthak. Okay. I hope it is clear to all of you. Now, what is the first income that Mr. Sarthak will be computing? So, world income is taxable for Sarthak. First, Sarthak has a residential property in what? In country Y, from which he earns a rent of $3,200. Okay. So now on this $3,200, we have to convert that into rupees. How will you convert a foreign income into Indian income? for converting the house property income into Indian income or any foreign income into Indian income, you have to follow rule 115. So as per rule 115, if I want to convert this $32,000 into Indian rupees, I have to take TTBR on the last day of the financial year, and the last day of the financial year is 31st March 2025, and the TTBR is 75. So I will do 32,000 into 75, that will be 24 lakh. On that I will take 30% standard deduction, and this will be my house property income. I hope it is clear to all of you. Now next, what is the next income? The next income is 6,20,000 business income in India, that is in rupees, directly write down. Next is dividend received from an Indian company. Now dividend received from an Indian company, you have to gross up. You have to gross up by taking at 2,25,000 is 90%, so 100% is how much? Gross up and show that. And then last but not least, 13,500 is interest on saving bank, so that will be IFRS income. On that you can claim 80 TTA deduction you can claim. Mr. Sarthak is shifting out of default regime, therefore Mr. Sarthak is following old regime, therefore you can claim 80 TTA over here. I hope it is clear to all of you. After that you compute the tax normally, and after computing the tax you find out the average rate in India. Therefore the tax over here is coming to 6,01,692, and the total income is 25,53,601,692 into 100. This will be our average rate in India, 23.56. The real game starts from here onwards. Now we need to find out the average tax rate in India. What is the average tax rate in India? The average tax rate in India is 25%, but is eligible for 9,000 rupees exemption limit in the foreign country. Okay, so let's see what is the tax he has paid in the foreign country. So 32,000 is the total income in the foreign country, on which he will get 9,000 exemption. Therefore he will be paying tax only on $23,000. 20% on $23,000 come to 4,600. Therefore the average rate in foreign country is 4,600 is the tax, and the income is 32,000. Therefore the average rate in foreign country is 14.375. Okay, I hope it is clear to all of you. 14.375 is the average rate. So therefore whichever is lower, that you will apply on doubly taxed income. What is doubly taxed income? Doubly taxed income is 16,80,000. So on 16,18,000 you will apply 14.375%, and therefore that amount will be subject to relief, and that much you will reduce from what? Your section 91 relief. I hope it is clear to all of you. So it was a beautiful question on DTAA. Let's go ahead with the next question. Question number 3, which is on TDS and TCS. The first question over here is Mr. Amit is purchasing some scrap from Mr. Bharat. No. If Bharat is selling scrap, then Bharat should collect TCS under 206C subsection 1 subsection 1 subsection 1. Yes, but Amit is saying that I will be using this scrap for manufacturing, and he is giving a declaration to Bharat. So if you are giving that declaration to the seller, if the buyer is giving a declaration to the seller that I will be using it for what? I will be using it for what? Manufacturing, and I will not be using for what? Trading purpose. Then the seller will not collect TCS. But in that case, if the Amit's last year turnover is more than 10 crore rupees, then the Amit is liable to deduct TDS under 194Q. Remember or not? So if the seller is exempted from TCS, but if the buyer's last year turnover is more than 10 crore rupees, then the buyer will be liable to deduct TDS under 194Q. In this case, the last year turnover of Amit is more than 10 crore. Therefore, Amit will deduct TDS under 194Q. I hope it is clear to all of you. Next question is on real estate development. So I have a building, I gave you the building, you are a developer, and in return you are giving me some money. So whatever money you are paying to me on the date of agreement, monetary portion, you will give me two things. First you will give me money, and then you will give me share in the project in future. Now I am not interested in the share in the project for TDS purpose. I am interested in the money which you have given me. You have given me 6.5 crore rupees. So on 6.5 crore rupees, the builder will deduct TDS of the resident owner at the rate of 10% under 194 IC on the date of payment or date of credit, whichever is earlier. So on 6.5 crore, builder will deduct my TDS. Okay, I hope it is clear to all of you. Next one, there are two transactions in point number 3. First of all, the state government of Madhya Pradesh is giving a lease of coal mine. So I am state government of Madhya Pradesh. I am giving you what? A coal mine on lease. So if I am giving you a coal mine on lease, then I am supposed to, the Madhya Pradesh government will collect TCS from you at the rate of 2% under section 206C subsection 1C. Okay. So first of all, this transaction I will collect TCS at the rate of 2% on 206C1C on leasing transaction. Then you are extracting coal out of it, and then you are selling the coal to different people. So then the person who is selling the coal by extracting the coal, on sale of coal, I will collect TCS. Who will collect TCS? The seller, Maple Company. Now the government will not collect TCS. Government is not selling the coal. Government is giving only lease mine. So now Maple INC, Maple Company Limited will collect TCS under 206C subsection 1 at the rate of 1%. TCS on 1 crore rupees. I hope it is clear to all of you. Now the next question, in this we have done some of the question earlier, like I'll tell you. This question we have done earlier. This question we have done earlier. So I'm not repeating that. The first question we have not done earlier, so I am doing that. Okay. So there is a company which is incorporated in country M. It holds 1200 shares in PS Limited in Indian company since 2016. Now they have done some wrong things over here. Now whether the GAR will be applicable or not? No, GAR will not apply. Why, sir? GAR does not apply to any transaction which has taken place on or before 1st of April 2017, because the provision of GAR came on 1st April 2017. Therefore, the transactions which are conducted before 1st April 2017, on that GAR will not be applicable. Therefore, GAR will not apply on this case. Now, this question we have done earlier, 100%. You can go and check the past paper. This question also we have done earlier in MTP, RTP earlier, 100%. I am giving reference also. Same as question number 6 of May 2024 paper. Okay, same question. You can go and check. This is the same question we have done in the tax audit earlier. Now, I am going ahead with the next question. There is a partnership firm. Now, this partnership firm is asking whether it is required to get the books of accounts audited. See, when a person is required to get the books of accounts audited, if it is doing a business, especially if it is engaged in the business of trading, business. When the turnover is more than 1 crore rupees, you are supposed to get the books of accounts audited. But for some people, it is 10 crore rupees. Who are those fortunate people for whom it is 10 crore rupees? If your cash receipt is up to 5% of total receipt and your cash payment is up to 5% of total payment. Now, let's see the cash receipt and cash payment of this entity. The cash receipt of this entity is 19 lakhs and the total receipt is 4 crore 50 lakhs, 56 lakhs. So 19 divided by 456 come to 4.16. This condition is fulfilled. Second, what is the cash payment? Cash payment is 380. And what is the aggregate payment? Aggregate is 238. So 3.8 divided by 238 will come to 1.597. This condition is also fulfilled. Therefore, they are eligible they will be exempted from tax audit up to the turnover of 10 crore rupees, and the turnover of the associate is 2 crore 78 lakhs. Therefore, it is not eligible for what? It is not eligible for tax audit. And the next question also we have done earlier, just some time before, that if you are an Indian public sector company and if your case is pending in front of ITAT, can you go for what? Can you go for vote for advance ruling? The answer is yes. If your case is pending, in case of PSU, there is an exemption. Okay. I hope it is clear to all of you. So this is what this paper is all about. Is it clear, all of you? So let's go ahead with the next MTP series 1, November 2024. Very first question over here is, there is an individual who is doing a business whose last year turnover is 3.2 crore rupees. Now he is making some payment for repair of residential house of 3 lakh rupees. Whether 194C will apply? 194C does not apply for residential purpose. Whether 194M will apply? 194M will also not apply, because for application of 194M, your aggregate payment of the entire year should be more than 50 lakh rupees. Therefore, 194M is also not applicable in this case. Next, you are also paying 75,000 rupees to commission to Mr. Varun for business purpose. Whether 194H will apply? The answer is yes. The deductor, the payer is an individual. The last year business turnover is more than 1 crore rupees and you are paying more than 15,000 rupees commission. Therefore, TDS will be applicable over here at the rate of 2% from 1st October till 30th September. It was how much? It was 5%. From 1st October, it is 2%. Okay. I hope it is clear to all of you. Now, next one, you are taking a building on sublease. Along with that, you are also taking some machinery is also on sublease. Okay. Machinery also on lease. Okay. You are taking a business on, you are taking a building on lease. You are also taking a machinery on lease. So rental TDS is deducted under 194I. So when you see the limit of 194I 2,40,000, you take aggregate limit of both of them. Is the aggregate limit of building, plant, machinery, furniture, etc. exceeding 2,40,000? If yes, you have to deduct the TDS. So you are paying 20,000 rupees per month from 1st September for 7 months. That amounts to 1,40,000. And then you are paying from October 18,000 rupees per month for 6 months. That amounts to 1,08,000. The aggregate of both is going to be 2,48,000. Therefore, the TDS has to be deducted. Because for 194I, you have to check the aggregate limit of all of them, whether it exceeds 2,40,000 or not. Okay. Now, on building, you will deduct 10% TDS. On machinery, you will deduct how much? 2% TDS. Okay. I hope it is clear to all of you. Next one is a beautiful question. Beautiful question it is. Mr. Sarthak is a resident in India, aged 58 years. Okay. Now, he has an impressive mutual fund portfolio. Very, very good mutual fund portfolio, more portfolio of crores of rupees. Now, he redeemed his entire mutual fund and bought a villa in Gurugram. Now, remember, if you are selling your assets and if there is a long-term capital asset and if you are buying a house, then you are eligible for section 54F, correct? So, this is a classic case of 54F. You are selling your mutual funds. But if there is a long-term capital gains, then you are eligible for 54F. For short-term capital gains, you are not eligible for 54F. Now, you have 4 different kind of mutual funds. Out of which the first and the second fund are dead mutual funds. Sir, how did you come to know? You can read below. Fund 1 and 2 are investing 30% only in equity. So, if there is less than 65% in equity, then it is a debt fund. Okay. If there is more than 65% is invested in the equity shares of domestic company, then it is an equity oriented fund. Now, in case of fund 3 and 4, you are investing 70% of the proceeds in the equity shares of domestic company. Therefore, fund 3 and 4 is equity oriented mutual fund. So, first and second is debt oriented mutual fund. Third and fourth is equity oriented mutual fund. Now let's start. First one you have purchased in 2021 April and you are selling in 24 August. It means you are selling after what? After 24 months. Therefore, it is long term. Okay. So let's compute this. 1 crore 40 lakhs is the sale consideration. The cost of acquisition is 120 lakhs. This is long-term capital gains. Sir, how it is long-term capital gains? Is it not short-term capital gains? Debt-oriented mutual funds are always short-term. No, it's not like that. It is only applicable. Section 50AA is not applicable in first case. Why, sir? In first case, section 50AA is not applicable. Not applicable. Why? Because that is only applicable if the debt mutual funds are purchased, are issued on or after 1st April 2023. Now, this mutual fund is issued on 2021. Therefore, to this mutual fund, 50AA is not applicable. So, this will be long-term capital gains. I hope it is clear to all of you. Okay. Second one is purchased in 2024 and sold in 2024 within 12 months. Therefore, it is a short-term capital gains. 50 minus 46. This will be subject to 4 lakh rupees short-term capital gains. This will not be subject to exemption also. This will be subject to exemption under 54F. Okay. Now, the third one and the fourth one is equity oriented fund. The third one is purchased in December 23 and sold in September 23. It is sold within 12 months. Therefore, it is short-term capital gains. Therefore, this is also short-term capital gains subject to 111A tax. Okay. Tax they are not asking. They are just asking the capital gains. And the fourth one is purchased in 2022, sold in 2024. Therefore, this is long-term capital gains. Here 50AA is not applicable because this is equity oriented fund, and therefore this will be subject to what? This will be subject to what? Exemption under section 54F. So first one will be subject to exemption under 54F. The fourth one will be subject to exemption under 54F. Second and third will not be subject to, because second and third are short-term capital gains. First and fourth are long-term capital gains. Now. How much is the capital gains in first one? 20 lakhs. What is the capital gains in fourth one? 10 lakhs. What is the total long-term capital gains? 30 lakhs. Now, if I want to save 30 lakhs, how much I am supposed to invest as per 54F? You know, I have to invest the entire consideration. 1 crore 40, 1 crore 20. Therefore, if I want to save this 10 plus 20, that is 30 lakhs. I need to invest 140 plus 120, that is 260. But how much I am investing? I am investing only 2 crore rupees. Therefore, proportionate exemption I am going to get. I am not going to get full exemption. Okay. Now, let's see how much proportionate exemption. First fund, this fund, let's take full exemption in this fund and we will take proportionate in the previous one. So, 10 lakhs into what? Into 1 crore 20, that is the amount invested. I am exhausting the entire amount over here divided by net consideration. In the second capital gains, I am only exhausting the balance amount. So out of 2 crore, if I am exhausting 120 here itself, in the second case, I can exhaust 80 lakh rupees and the balance will be subject to tax. Okay. I hope it is clear to all of you. So this is what this question is all about. It was a beautiful question. Next question, the assessee received a draft order from the assessing officer as per 144C. Sir, what is 144C? 144C is a special section applicable to certain non-residents, foreign company and all those assessees for whom transfer pricing is applicable. Okay. So for them, the AO passed a draft order first and then the draft order is given to assessee and then the assessee has an option. Assessee has an option to accept the draft order or to object the draft order to DRP. If it objects to DRP, then the matter will go to DRP. If it accepts, then the AO will pass the order and then the assessee can go for appeal. So the question is it mandatory to go for DRP? The answer is no. Assessee has both the option. If the AO has given you the draft order, first option, you can go and object to DRP. Okay. Second option, you don't object to DRP, you accept that draft order and then you can go and appeal to CIT appeal. Both the options are available with you. It is not mandatory to what? Go for DRP. Okay. I hope it is clear to all of you. This is what it is written in this question. Next question is also a very, very small question, a beautiful question. Search was conducted and some gold bars were seized by the department. Okay. So department has done search at your premise. Some gold bars were seized from your place and now the assessee voluntarily goes and discloses the things and tells the assessing officer, see, you sell the gold bar and whatever is your tax liability, take the tax and give me the gold bar. It cannot happen like that. There is a provision in the law. You cannot go randomly and ask the department to sell the gold bar and take the tax liability and give me the remaining gold bar. It's not like that. The department does not work like that. See, first of all, there is a provision in the law which says that if during the course of search, if the department has seized something, you have an option that within 30 days from the end of the month, you can go to the department, explain the nature and the source of the particular item, and then the department will take the existing liability and will return back the remaining assets to you within 120 days from the date of search. This is the first thing. If you don't do this, then you have to wait for the assessment to complete. You cannot go in between and ask for the department to compute the tax and take the tax and take the gold and recover from the gold and give you the remaining gold. It is not possible. The only option is now to wait for the assessment to complete, let the liability be determined, and only then the assessing officer will return you the gold. Okay, I hope it is clear to all of you. Next question is a very simple question on equalization levy. There is an assessee and NI Limited, an Indian company. It wants to do some advertisement. So it is taking some advertisement services from a New York based company which does not have a permanent establishment in India, and you are paying 10 lakh rupees to that particular company. So if a foreign company who does not have a P in India and the Indian company is making the payment of more than 1 lakh rupees for online advertisement, then the Indian company should deduct equalization levy and pay the equalization levy at the rate of 6% by 7th of the following month. And if it does not do that, it will be liable for interest penalty. And if it does deduct and pay, then the foreign company will be exempt under section 1050. Apart from that, if the Indian company does not deduct the equalization levy and pay equalization levy, then the expense of 10 lakh rupees will also be disallowed under PGBP. I hope it is clear to all of you. Now there are two persons over here. Aryan and Aditya are two individuals. They are resident in India. Both of them are earning a salary of 13 lakh rupees. Now Aditya has paid an interest of 2,20,000 rupees on self-occupied property. Aryan has paid 25,000 rupees under Mediclaim, which is eligible under ATD. And Aditya has also contributed political party donation. Now we are supposed to compute which option is better for both of them. See, it is very simple. If you compute as per new regime, then you will get 13 lakhs minus 75,000 rupees standard deduction, and then you will compute the tax. Nothing will be allowed. House property deduction will not be allowed. ATD, Mediclaim will not be allowed under new regime. ATC, PPF will also not. Political party donation will also not be allowed if you follow the new regime. 13 lakhs minus 75,000, 12 lakh 25,000 compute tax on that as per the new regime. Second option, you can claim all the deductions, but in the old regime, your standard deduction of of salary will be only 50,000. It will not be 75,000, and then the respective person can claim house property deduction. It's SOP interest of 2 lakh rupees, not 2 lakh 20. ATD you can claim 24,000, and donation to political party 1 lakh 50,000. You can claim that also, and check with whichever is more beneficial. You can go for that option. Okay, I hope it is clear to all of you. Next question is a very simple question on transfer pricing. TI Limited has sold some goods to a person located in NJ. Now remember, whenever an Indian entity who sells any goods to, who enters into a transaction with a person located in NJ, then both of them are deemed to be associated enterprise. If an Indian entity enters into a transaction with a person located in NJ, it is deemed to be associated enterprise. You are selling to them at how much? 9.5 crore rupees. Therefore, the transaction between the Indian entity and the person located in NJ is international transaction. Transfer pricing is applicable. Now, you need to find out the comparable. To others, you sell at 10.5 crore and 11 crore. So, you have two arm's length price. So, compute two arm's length price. To others, you sell at 10.5 crore, 11 crore. So, you have two comparables. Okay. On that, you have to adjust two functional differences. One is of freight and insurance, another is of after sale support. After that, you will get two arm's length price. Now, because the number of arm's length price are less than 6, you will take arithmetic mean of both of them, and then you will compare with 9.5 crore, and whatever is the difference, you will add back. Generally, you check the difference has to be more than 3%. But in case of NJ, you don't get the benefit of that 3% tolerance limit also is not available to an NJ person. Okay. Even if there is a difference of 1 rupee, that will be added back in the arm's length price. I hope it is clear to all of you. So this is what this MTP is all about. So let's go ahead with the next MTP, MTP series 2, November 2024. This is our 6th MTP. There is a associate whose name is SJ Industries Limited. If you read the last line, we are supposed to compute total income. We are supposed to compute total income as per normal provision. Do not follow 115 BAA and all. Okay. Just compute total income as per the normal provision. Let's start. Associate is engaged in production and marketing. The profit is 72 lakh rupees. The depreciation as per income, as per Companies Act, is 24 lakhs. So you will add back that. Then next one is interest on short payment of advance tax. So advance tax is nothing but your income tax only. So on income tax, whatever interest you pay, that is disallowed under the income tax law. Next one, in your opening and closing stock, you are mistakenly including what? Borrowing cost, etc. in opening and closing stock. So in opening stock, if you are writing wrongly 9,50,000, so add back that. In closing stock, you are taking wrongly 7 lakh rupees, so reduce that from the credit side of the P&L. Next one, you are paying 41,000 rupees in cash. The breakup of that is as follows. 22,000 rupees you are paying to the producer of dairy farming, that is allowed as per rule 6DD. If you pay in cash to a dairy farmer, it is allowed as per rule 6DD, but 19,000 paid in cash towards printing and stationery, that is not allowed. More than 10,000 rupees you cannot pay in cash as per section 48(3). Next is 3,50,000 you are paying to contractor on which TDS is not deducted, so this will be disallowed. 30% will be disallowed under the income tax law because you are not deducting the TDS. Okay. Next, you have incurred 35,000 rupees towards expense earning from transfer of carbon credit. Remember, transfer of carbon credit income is taxable at 10% under 115 BBG, and expense incurred on that is not allowed as a deduction under the income tax law. Therefore, this will be disallowed. Contribution to electoral trust paid by check will be allowed, so you will disallow under PGBP and you will claim deduction under 80 GGB. Okay. Next, advertisement in a brochure of a political party, you will disallow under section 37(2)B under PGBP, but under chapter 6 under 80 GGB you can claim. Okay. Next. Interest on term loan taken from cooperative bank not paid. So whatever interest you have not paid, that will be disallowed because interest from a cooperative bank is only allowed if it is paid as per 43B. Now because it is not paid, it is disallowed. Okay. Next one, pension of 1,50,000. Pension is allowed up to 14% of the salary. If you read the last line of the question, the salary and DA in terms of the company as per 80 CCD is 10 lakh rupees. Therefore, 14% will be allowed of 10 lakh. That is 1,40,000 will be allowed. Therefore, 10,000 will be disallowed in this particular case. Next one, you are receiving some unrealized rent of earlier years. Now, unrealized rent received will be taxable in the year in which it is received. Now, that will also be subject to 30% standard deduction. Now, this point, hopeless point, they should not put. First of all, they remove house property from the syllabus. Yes or no? Now, one student is asking, you are not feeling sleepy or not? No, I don't sleep till 3 or 4 o'clock. I sleep at 4 o'clock in the morning every day. That is my routine. Okay. I don't know why I don't get sleep only. Because of the stress or something. Because I don't know because of what. Coming to this, you can see in my eyes that there is no sleep. Okay. Even though it is almost 12 o'clock now. Now listen carefully, coming to the point. Unrealized rent, whenever it is received, it is taxable subject to 30% deduction. Institute has removed house property from the syllabus. Still they are putting such kind of adjustment, hopeless people. Next one, dividend from foreign company. Reduce from here and show under IFRS. Dividend is IFRS income. Next one is a very intelligent adjustment. You have purchased, you have imported some machinery. On that there is a forex loss, okay, on payment. So whatever gain or loss is there on import of machinery on the date of payment is adjusted in the WDV of the asset. So this 3 lakh rupees you will adjust in the WDV of the asset. So WDV of the asset will be 95 lakhs is the cost of the asset. And because it is a gain, you will reduce. If it would have been loss, I would have added. Because it is a gain, I will reduce. Therefore, my cost will be 92 lakhs. On this 92 lakhs, I will claim additional depreciation and normal depreciation. But both of them 50% because the machinery is put to use on 15 December. So on 92 lakhs, I will claim normal depreciation 7.5, additional depreciation 10%. Okay. Next, interest from bank FD 10% TDS, net of TDS. Here I will reduce 135 and under IFRS I will show full 1,50,000 by grossing it up. Okay. Next, income tax depreciation 28 lakhs I will claim deduction. Next, last year I have taken a deduction of 35,000 rupees on accrual basis, but in the current year I made the payment in cash. That is wrong. So that is added to the income, that is deemed income. So in the last year, if you have claimed some expense on accrual basis, and in the current year, if you make the payment in cash, that is deemed to be income under section 48(3)(a). Last year audit fees I have not deducted the TDS, but in the current year I have deducted the TDS and paid. So therefore in the current year I will get the deduction of audit fees. Yes or no? In the last year audit fees would have been disallowed to the extent of 30%. So in the current year I will get 30% deduction. Next year, next question, income from transfer of carbon credit. So transfer of carbon credit will be considered, it is already included in the net profit. So the ICI says that you can either show as an IFRS or you can either show as a PGBP income. It doesn't matter. Anyways, the tax will be same only. It is subject to 10% tax. So you can, if you want to show as an IFRS, then reduce from PGBP, show under IFRS. If you don't want to show as a PGBP, then show as a PGBP income, do not reduce. Okay. That's it. This is what this question is all about. I hope it is clear to all of you. Now, after this, most of the things in this paper are repeated. Most of the things. I'll tell you, I have given the reference also. First of all, this is a very simple DTAA question. We have done a similar question earlier. I'm not interested in this. Now, the next question is a good question. I need to see that. This not in the MTP, sorry, in the next MTP. In the May 2025 MTP, most of the things are repeated. Now, this is a good question. Let's see. Question number 3 on transfer pricing. Shall I start? Pay attention. STP Limited is an Indian company and Fixed Limited is a foreign company. And we have taken a loan of 60 crore rupees, out of which the STP is giving a guarantee of, Fixed Limited is giving a guarantee of 9 crore. Okay. So I am STP Limited in India, Fixed Limited is outside India, and I have taken a total borrowing of 60 crore rupees, out of which 9 crore guarantee is given by foreign company. So 9 crore divided by 60, that is greater than 10%. Therefore, if one entity gives the guarantee of more than 10% to another entity, more than equal to 10% to another entity, then both of them are deemed to be associate enterprise. Okay. So out of my total borrowing of 60 crores, 90 lakhs guarantee is given by what? Is given by my associate enterprise. Therefore, we both are associate enterprise. Now listen carefully. What is STP is doing? Listen carefully. STP is selling some cotton bed sheets at how much? It is selling at 2,200 to its associate enterprise, whereas to others it is selling at 2,300. So to my associate enterprise, I am selling at a cheaper price. To others, I am selling at higher price, that is 2,300. Therefore, I will start with what? I will start with my comparable price, that is 2,300. And now I will just see what is the functional difference between both of them. That's it. So to third party, we sell at 2,300. So that will be the base point. From that amount, we are going to start the discussion. Now, what is the functional difference between both of them? There is only one functional difference. The terms of the trades for other dealers was to make payment within 1 month. So STP gives 1 month credit to others, whereas to our associate enterprise, it gives a credit of 3 months. So should I charge more or less to my associate enterprise? I should charge more because I am giving 2 months extra credit. Yes. To others, to third party, I am giving 1 month credit. To my associate enterprise, I am giving 3 months credit. So 2 months extra cost of capital I have to recover from you now. Therefore, I have to add back 2 months extra cost of capital. How will I get that? 2,300 into 2 by 12, extra 2 months extra cost of capital, 2 months extra opportunity I am going to take, opportunity loss I am going to recover from you. Into what? What is the rate of opportunity loss over here? Is 12%. Okay. So that I will add back, and that will give me what? My arm's length price. And then you have to compare with your actual price. Your actual price is how much? 2,200. And then you see how much is the difference. You have to add it back. And then we have to comment the same thing, that if the above transfer pricing is added suo motu by the SSE, then within how many times you have to bring back that money? That's the same old story you have to write about the secondary adjustment. I'll say it once again for you all. That is, if it is added suo motu by the SSE, then you have to bring back that money to India within 90 days from the due date of filing of return. If you don't bring back that money to India within 90 days from the due date of filing of return, then you have to charge interest as secondary adjustment. For that, you have to take SBI's MCLR on the first day of the previous year plus 3.25%. Now, one more option is there for you. That is, you can pay 20.966 for additional tax, and then you will be relieved from what? From secondary adjustment. I hope it is clear to all of you. Next one is a very simple question on TDS. You went to a bank, you are an LLP. Kite & Company is an LLP. You went to a bank and you have withdrawn 68 lakh rupees from first of all. And then you again withdraw 58 lakh rupees. You regularly file the income tax return. Okay. So if you regularly file the income tax return, then the bank will deduct TDS. If you withdraw more than 1 crore rupees in the entire year, on the excess amount, they will deduct 2% TDS. How much you are deducting? How much you are withdrawing? 126 lakhs. What is the excess amount? 26 lakhs. So on 26 lakhs, bank will deduct TDS at the rate of 2%. Now you will ask me one question. Sir, you are withdrawing for the purpose of buying agricultural produce from the farmer now. Sir, there is some exemption on that. There is no exemption on that. The exemption is not for this. The exemption is only available if Kite & Company is a commission agent. If he is a commission agent as per APMC market, if he is a commission agent and then if he withdraws from the bank to make payment to the farmers, only then he is exempted from TDS. Otherwise, normal assessee is not exempted from TDS for buying agricultural product. Okay, I hope it is clear to all of you. Next one, a non-resident individual is subscribing some capital gain bonds issued by Power Finance Corporation, and the Power Finance Corporation is giving interest of 98,000 rupees. So that is subject to tax. TDS will be deducted under section 195. I hope it is clear to all of you. Next one is a question. It's a beautiful question on what? It's a beautiful question on limitation of interest 94B. That is 30% of EBITDA, interest in excess of 30% of EBITDA, or amount of interest paid or payable to associate enterprise, whichever is lower will be disallowed. First of all, we need to prove whether the two entities are associate enterprise or not. XYZ Limited is Indian entity. Okay. Now it is taking loan from L&T and Company. Okay. Now SAM Limited holds 36% shares in XYZ Limited. Now listen carefully. Therefore, SAM and XYZ are associate enterprise. Correct? Yes, both of them are associate. Now the loan is given by L&T. Loan is given by L&T, and SAM is giving guarantee for the same. Check. So therefore, this interest will come under what? Limitation of interest. Why? Listen carefully. That if loan is given to me by third party, And if my associate enterprise loan is given to me by third party, who is third party? L&T. L&T is third party who is giving me loan, and my associate enterprise is giving guarantee. Sam is giving guarantee to L&T. Therefore, this is called as deemed dead. This is also subject to limitation of interest. Now, they have given us data of 2 years, 23-24, 24-25. First of all, we will compute for 23-24. For that, we need EBITDA. What is EBITDA? Earnings before interest, tax, depreciation, amortization. Now, this profit 2030. From that, I will reduce employee benefit expenses, that is salary, etc. I will get EBITDA, correct? Because I want a profit before interest, before depreciation, before tax now. So I will not reduce these things now, correct? So if I reduce 390, I will get EBITDA. Okay. Now I will compute the disallowance. What is disallowance? Interest, check on the board. Interest minus 30% of EBITDA, compare with interest payable, whichever is lower, that will be disallowed, and the balance interest will be allowed to you. Okay. This is as simple as that. Now the real catch is in the second year. Whatever interest is disallowed in the current year, as per this formula, that will be added to this interest. That is 389 next year. And next year EBITDA 30%. Whatever amounts come within the 30%, that will be allowed subject to this interest. For example, suppose the interest disallowed in the first year is 11 rupees. So I will add this 11 to this 389. Therefore, this will become 400. So in the second year, I am eligible to claim deduction up to 400 rupees. Now, in the second year, if the 30% of EBITDA comes to 390, then I can claim 389 of current year and 1 rupees of last year. In the second year, if the eligible amounts come to 30% comes to 400, then I can claim full 400, 389 plus 11 rupees. I hope it is clear to all of you. This is how you are going to compute the 94B limitation of interest. Okay. Now, let's go ahead with the next question. Yes, next question is on tax audit. There is a company by the name called as TMP Limited. It is engaged in transportation of building material, and it made payment for hiring some dumpers for the same. Okay. So it is engaged in some transportation material. So therefore, for that purpose, they need some dumpers, trucks, etc. So they made some payment for the hiring of dumpers. They did not deduct TDS under 194I because they were saying that we are not using any plant and machinery over here. Therefore, we will not deduct TDS. Now the auditor has a different view. The auditor says that you should deduct TDS under 194C because it is in the nature of contract. See, the question over here is, the assessee is saying something else and the auditor is saying something else. In that case, what is the responsibility of the auditor? The responsibility of the auditor is, first of all, is to report under clause 34A, that is on TDS reporting, and clause 21B, that is on disallowance if you do not deduct the TDS. First of all, you have to report in both the cases. Okay. TDS reporting, clause 34A. What is written in clause 34A? Name of the deductee, timing of deduction, when it is deducted, when it is paid, when it is supposed to be paid, delay, number of days delay in deduction, etc. With all those columnar details you have to give in 34A. In 21B, you are supposed to write down how much is disallowed if you are not deducted the TDS. Now, the law says that if there is a difference in opinion between the tax auditor and the assessee, the auditor has to write both the views. Okay. The auditor has to report that there is a difference in opinion between assessee and the auditor. If he does not report the difference in opinion, then he is guilty under second schedule and he will be accordingly punished. I hope it is clear to all of you. Next question. SD Pharmaceutical Company, which is formed in 2001-2002, has purchased a new plant and machinery of 12 lakhs. The total income of the assessee is 22 lakhs before allowing additional depreciation. Okay. The turnover of last year is 338 crores. Now we are supposed to compute the tax of the assessee in the most beneficial manner. In the most beneficial manner, we are supposed to compute. See, there are two options. First, compute as per normal provision. As per normal provision, what is the total income? 22 lakhs. Will I get additional depreciation in normal provision? Yes, take additional depreciation on this 12 lakh rupees because you are a manufacturer, you are a pharmaceutical company, you are engaged in manufacturing, etc. Okay. You can take what? Additional depreciation. And on that, you will apply 25% tax. Why? Because the turnover of last year is less than 400 crore, 25% tax, and then apply 4% tax. This is first option. Second, you can go for special provision also. Which one, sir? 115 BAA or BAB? BAB is not possible. See, BAB is not possible because the company is not new. It's an old company, na. BAB is only possible if it's a company, if the company is new and it is incorporated between 2019 to 2024. BAB is not possible. Only 115 BAA is possible. If we compute BAA, then you have to directly take 22 lakhs. Additional depreciation will not be allowed on this 12 lakh rupees. On 22 lakhs, directly take 22% tax, 10% surcharge, 4% cess, and then whatever amount will come, that will be your final answer. Okay, I hope it is clear to all of you. Now the next question also we have done earlier, you can check it if you want. You can see all the adjustments we have done earlier in the past RTP at least twice. Okay. I hope it is clear to all of you. So this is what this MTP is all about. We have completed successfully 6 MTPs so far. So let's go ahead with the next one. MTP series 1 May 2025. Okay. Now this is the most hopeless MTP that ICI can ever make. Okay. Now see how they have copied the things. You will come to know. You are supposed to compute total income. As per the normal provision, don't follow 115BAA, don't follow 115BAB. Ignore MAT also. Don't follow all those things. Okay, just follow the normal provision. Narmada Limited engage in manufacturing. The profit is 350 lakhs. You are paying 1 lakh rupees to the independent directors without deducting the TDS. So you should deduct TDS under 194J because you are making the payment to the directors for board meeting. You are not deducting the TDS. Therefore, 30% will be disallowed under section 40A1A. Next, opening stock and closing stock both are overvalued by 10%. Now, if opening stock is overvalued, it is 200. Though it is overvalued means it is 110%. So therefore, 10% is how much cross multiply and add back that because you are overvaluing your debit side. So add back that. Even closing stock is overvalued. So reduce that. Okay. Closing stock is overvalued. 255 lakhs is 110%. 10% is how much? So on the P&L credit side is overvalued. So reduce that. Okay. I hope it is clear to all of you. Next one, depreciation as per books of accounts, you will add back. Next one, 9 lakh rupees you are paying to National Laboratory, that is allowed under section 35 2AA under the old regime. Under 115BAA and BAB it is not allowed, but here it is allowed. Now GST you have not paid, you have paid late on 27 December, that is after the due date of filing of return, therefore this is disallowed. Okay. You are purchasing goods of 63 lakh rupees from your associate enterprise, from your related party at a higher price. The market value is 58 lakhs, you are purchasing at 63, therefore 5 lakh rupees will be disallowed. Okay. You are as per 48.2, 5 lakh rupees will be added back. Now you are making cash payment of 5 lakh rupees, not allowed. If the supplier is demanding cash payment, so you will pay cash or what? This is disallowed as per 48.3. Then you are making 40,000 rupees to hire a lorry. That is also disallowed. For hiring a lorry, you have a higher limit up to 35,000 rupees, but 40,000 is not allowed. Second payment you are making of 35,000 rupees, that will be allowed because for road transporter you can make the payment up to 35,000 rupees in cash. 52,000 not allowed. Okay, so 5 lakh disallowed, 40,000 also disallowed, 52,000 also disallowed, but 35,000 will be allowed. Then same adjustment, legal expenses for issuing bonus shares will be allowed. Legal expenses for issuing right shares will not be allowed. Donation to political party will be disallowed here, but you can claim deduction under chapter 680 GGB. Okay. Normal depreciation you can claim 62 lakhs. And then you are recovering some bad debts of 2 lakh rupees which was claimed as deduction earlier. So recovery of bad debts which was claimed as deduction is deemed income, but you are not giving that effect in the books of accounts. So add back this 2 lakh rupees. Okay. As per section 41 subsection 4. Then your turnover of last year is 390 crore. Therefore, you will be subject to 25% tax. I hope it is clear to all of you. Is it clear? Now, your ICAI, your beloved ICAI, which has a budget of crores of rupees to Board of Studies to make MTPs for students. Right? See, such kind of hopeless question they have made. Yes. All the adjustments were repeated. Now forget about adjustment, entire questions are repeated now. See, this question we have already done. Check it. In RTP May 2023 question number 5. I am giving the reference directly so that you should not blame me. That you don't want to solve, you are saying anything. I am not saying anything. See, RTP May 2025 you can open and check question number 5. Okay. Okay. Same question it is. Same. So they have not put any efforts. Put the same question, copy it from there, and they have changed the dates and put that. Now, the next question is a beautiful question. One of the best questions that you can ever have in the entire DTAA chapter. One of the best questions of DTAA. Shall I? Let's start. Lokesh is a 50-year-old person. He is working in a company in India since 2019. He derived income from multiple places. Okay. Therefore, his world income will be taxable because he stays in India only. Okay. First of all, he is earning a salary of 23 lakh rupees before standard deduction. Now, Lokesh is following which regime? Pays tax under default regime. Therefore, Lokesh will be following default regime. Therefore, he will get 75,000 standard deduction here. Okay. So, he is following new regime, new regime, not old regime. So, 23 lakhs minus 75,000 will be the salary income. Then he is paying 1,80,000 for SOP. Self-occupied property deductions are not allowed under new regime. This will be not be allowed. So this 1,80,000 will not be allowed under new regime. In old regime, self-occupied property interest is allowed. Next, income from bank deposit, IFOS 1,60,000 you can take. These are his Indian incomes. Now he has some foreign income also. He is also earning some income from country A. He is earning 25,000 from business income from country A. 25,000 from business income from country A. 25,000 from country A. 25,000 from business income 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 So I will convert that into rupees as per TTBR on the last day of the financial year. Then the TTBR on the last day of the financial year is 71 rupees. So I will convert this $25,000 into 71 rupees. Okay. Then he is earning some house property income from foreign country. This will also I will convert as per TTBR on the last day of the financial year as per rule 115. Then I will take 450 rupees. What? 450 rupees standard deduction. In foreign country it is not allowed, but in India it is allowed now. So I will take 450 deduction of what? Municipal tax. Then I will take 30% standard deduction. And then whatever amount will come, that I will convert into what? That I will convert into a TTBR on the last day of the financial year. Next income is also earning dividend. Now for dividend you have to take TTBR of the last day of the preceding month, not last day of the financial year. So you are earning dividend in March, so you will take TTBR of 28th Feb 2025. Okay, I hope it is clear. So you will convert that as per that rate. And for short-term capital gains, $5,000. For that also you are supposed to take TTBR on the last day of the preceding month, not last day of the financial year as per rule 115. So for this $5,000 on short-term capital gains, I will take TTBR on 28th Feb 2025. After this, I will get what? I will get my total income. Okay. No deduction, no chapter 6 and nothing is allowed under the new regime. Now, after that, I will compute tax. I will compute tax. Listen carefully. I will compute tax as per the new regime. Okay. Now, I am computing the tax payable in India. Listen carefully now. And then I need to compute the average rate. Now, how will I get the answer? See. What all things will come in my total income? First of all, 23 lakh minus 75,000, 2375, that I will take. SOP I cannot take. When I convert house property income, it comes to 2,01,285 rupees. These are all in rupees. Huh? Business income comes to 1775. STCG comes to 3 lakh 50 and dividend comes to 7 lakhs. Okay. This is my Indian income. Now the average rate comes to 27.76%. When I take the total tax, you can go and see the solution. When I take the total tax divided by total income, my average rate comes to 27.767. Now how much relief I will get? I will get the relief of tax payable in India on doubly tax income or tax payable in foreign country of doubly tax income, whichever is lower. What is tax payable in India? On house property is a doubly tax income, business is a doubly tax income, short-term capital gain is a doubly tax income, dividend is a doubly tax income. Salary is not doubly tax, that is only taxed in India. So these four incomes are doubly tax income and this is the Indian average rate. So this will be the first tax. Okay. Now what is the tax payable in foreign country? For that I need to find out the foreign income. First of all, I am earning $25,000 from business. Then I am earning $4,500 from house property. Now I will not reduce 450 because in foreign country I am not paying tax on 450 because I am not getting deduction in 450. In foreign country I am paying tax on $4,500. In India I am getting deduction of 450 rupees. In foreign country I am not getting deduction of 450. Then $10,000 of dividend and $5,000 of short-term capital gains. This is the total income which I have earned in foreign country. On this I am going to pay 20% tax in foreign country as it is mentioned over here. Now this tax I am paying on which date? I am paying on 25th of May. Now I have to convert this into rupees. How will I convert this into rupees? I will apply rule 128 now. To convert the foreign tax into Indian tax. To convert the foreign tax into Indian rupees, I have to take TTBR on the last day of the preceding month. So now this is paid on 25th of May. Whatever tax will come on 44,500, that is going to be around 44,500 into 20%. You can do it 8,900 rupees, something around that, $8,900. Whatever tax will come, that tax I am going to pay in the month of March to May 2025. So I will convert that into rupees as per TTBR of the preceding month. That is as per 30th April. So I will convert this as per 30th April and whatever tax will come, that will become my second tax. And then I will compare first and second, whichever is lower, that will be allowed as a relief. So it's a beautiful question on DTAA. Okay. So you have to do this question. It's a beautiful question. They can repeat this. Okay. Now the next question is something which we have done earlier, actually speaking. But if you want, I will do it again for you all. We have done this question. Check it, please. There is a trust Feed People Limited. It gets merged with another trust on 1st April, which is not eligible for 12AB. So what will happen? Exit tax will apply. If a trust which is eligible for 12AB is getting merged with another trust which is not eligible for 12AB, so you have to pay exit tax. Okay. Now, first of all, for land, what value you are going to take? Stamp duty value or market value, whichever is higher. Okay. Therefore, market value is higher. You will take market value. For equity shares, you are going to take average of highest and lowest price. For preference shares, you are going to take market value. Outside liability, you will take provision for tax, you will not take, and liability in respect of various bill payment also you will take in the total of liability. Then take all assets minus all liability, you will get what? Your net assets. You will get your accredited income. On that you apply 34.944% tax. Okay, I hope it is clear to all of you. Now the next question is also a very beautiful question. Okay, there are some minute points which I have told you in the class which you have to remember. Again, I will tell you today also. Fraction INC, it's a notified financial foreign institutional investor, which is an FII. We need to compute the total income of the FII and the tax liability of the FII as per 115 AD. As per what? As per 115 AD. Okay, so now pay attention. First of all, the FII is earning dividend income from Indian company, so that is subject to 20% tax as per 115 AD. Then the FII is earning interest on security, that is also subject to 20% tax on 16,70,000 rupees. Expenses are not allowed under 115 AD. 115 AD does not allow you the deduction of expenses. So don't take the deduction of expenses. I hope it is clear to all of you. Next one. This is very important. The associates purchased some bond in 2018. They are selling the bond in 2025. So they are selling for 58 lakh. They are purchased for 33 lakh, 15 lakhs long-term capital gains. Now this will be subject to 10% tax. Why, sir? This is not subject to 12.5%? No, this is the only place under the entire income tax law. Remember, in 115 AD, the normal long-term capital gains, the rate has not been increased to 12.5%. It is still 10%. Yes, 112 long-term capital gain has been increased to 12.5% under 115 AD, but the normal long-term capital gains has not been increased to 12.5%. So this will be subject to 10% tax. Now, the listed shares purchased in 2024 May and sold in February 2025. So it is a short-term capital gains. It is sold within 12 months. So it will be subject to 20% tax under 111A STCG. Unlisted shares purchased in 2024, sold in 2025, sold within 24 months. Therefore, the short-term capital gains under 115 AD are subject to flat 30% tax. Okay, flat 30% tax is applicable under 115 AD for short-term capital gains. I hope it is clear to all of you. Let's go ahead with the next question, which is on TDS. The first question over here is, you are buying some property in Chennai for 85 lakh rupees. So you should deduct TDS under 194 IA at the rate of 1% on actual consideration or stamp duty value, whichever is higher. In this question, stamp duty value is not given, so forget about that. Now, because the actual consideration is more than equal to 50 lakh rupees, you will deduct TDS at the rate of 1% on 85 lakh rupees. Next one, you are buying an urban plot of 49 lakhs. You will not be subject to TDS because the amount is less than 50 lakh rupees. You are buying a rural agricultural land of 55 lakhs. You will not be subject to what? You will not be subject to what? TDS. On urban plot, I am sorry. For urban plot, you will deduct TDS because the limit is 49,000, but the stamp duty value is for 54 lakhs. Therefore, you will deduct TDS at the rate of 1% on 54 lakhs. You will not consider the actual consideration, but you will see the stamp duty value of the urban plot, because whichever is higher is more than 50 lakh rupees. Therefore, you will deduct TDS at the rate of 1% on 54 lakhs. On this rural agricultural land, you will not deduct TDS. Okay, I hope it is clear to all of you. This notified infrastructure debt fund, same adjustment we have done earlier, if you remember, just some time before. Next, you are paying some landing and parking charges to Airport Authority of India. So if an airline company pays landing and parking charges to Airport Authority of India, that is subject to TDS under 194C and not 194I. That is subject to TDS under where? 194C and not under 194I. Okay. Next, you are an employee of central government who are receiving some arrears of salary. So now the question is, while deducting the TDS, whether this arrears of salary will also be deducted or the entire salary will be subject to tax. So this arrears of salary, you will get a rebate, you will get a relief under section 89 for this arrears of salary if you give form number 10E. Remember, I have mentioned all these things in your color book. If you go and check your color book, you will see form 10E you have to fill and give. I have also done one question in the question bank based on this form 10E in the chapter of TDS. You can go and check. This is the level of depth we have done in our class as far as your CA final exams are considered. So therefore, the TDS will be deducted after giving you a relief under section 89 as per section 89, and for that the assessee has to give to the government what? Form 10E, the declaration. Next question we have done earlier in RTP May 2024, question number 5. You can check the same question we have done earlier, so don't waste time on this. Okay, now next question is a beautiful question. There are some good questions over here. Yes, it's a big RTP. Yeah, it's a big MTP. Now, next question. Question number 5. Question number 5, subpoint A. Point A, subpoint A. Now, Income Tax Authority did not file an appeal in your case. Okay, now listen carefully. Suppose Income Tax Authority, there is an assessee by the name called as Bela. Now, Income Tax Department did not file an appeal in case of Bela. Why? Because it was not exceeding the tax effect. There is some tax effect now for department to file an appeal. Remember that in case of if you want to appeal to ITAT, then it has to be more than 60 lakh rupees, or High Court more than 2 crore, Supreme Court more than 5 crore. There is some tax effect now. So in the current year, suppose I have not filed an appeal against you because department has not filed an appeal against you because the tax effect is not more than 60 lakhs. Can you stop me to file an appeal in the next year? The answer is no. Can you stop my neighbor? Can you stop the department to file a case in case of your neighbor? Because in your case it was not filed, so in your neighbor's case also it should not be filed. Is it so? The answer is no. Remember, there is a provision by the number called as 268A, which talks about that this particular relaxation is given only for a particular year in case of a particular assessee. Now, in case of Bela, if the department is not appealing in the current year, that does not restrict the department to not appeal in the next year also. In the next year, department wants, they can appeal. My neighbor, if they want to appeal in the current year also, they can appeal. My neighbor cannot give a reference of Bela that in case of Bela you are not appealing. Why are you all appealing? In my case, you cannot give that reference. I hope it is clear to all of you. Is it clear? I hope it is clear to all of you. Now, next question is also a beautiful question. There is an assessing officer who filed a complaint against a firm. The firm did not file the return. Okay. Now, if you don't file the return and if there is a willful failure to file the return, then there can be a prosecution against you for 3 months, minimum 3 months. So if there is a willful failure to file the return, there can be prosecution which can be launched by the assessing officer against you. Now, in this case, you have not filed the income tax return. Okay. Now, the tax payable in your case was 70,000. You went to appeal. After you went to appeal, the appellate authority reduced the tax to 9,100 rupees. Listen carefully. You have not filed the return. The tax payable in your case was 70,000 rupees. You went to appeal. In the appellate authority reduced the tax payable to 9,100. Now listen the provision. If there is a willful failure to file the return, there can be prosecution. But for an assessee other than company, if the tax payable is less than 10,000 rupees, for an assessee other than company, which is the assessee is not a company, it is other than company, it is a firm. For an assessee other than company, if the tax payable is less than 10,000 rupees, then in that case prosecution cannot be launched. Therefore, in this case also prosecution cannot be launched on the assessee. I hope it is clear to all of you. Now the next question also exactly same question. RTP May 2025, black money law. Same question the ICI has copy pasted over here. You can check it over here. Same question, same copy paste. You can check it over here. This question is a theory question, so I am not interested in that. Now next 2-3 questions are good questions, so I am discussing them. Okay. First of all, the AO is doing survey at 9:30 p.m. First of all, can a AO do survey at 9:30 p.m.? Why not? Generally, AO cannot do survey after sunset, right? After sunset, he cannot enter your premise. But if your business hours is in night, he can do that. See, here the business hour is in 5 a.m. to 10 p.m. So if the business hours is from 5 a.m. in the morning to 10 p.m. in the evening, then the AO can definitely enter your place at 9:30 p.m. with the prior approval, obviously. Okay. Second thing, in the survey, can he take cash? No. In the survey, he does not have the power to seize the cash. For that, he need to go for search and seizure. Second, in the survey, can he take your books of accounts? Yes, he can take the books of accounts into his custody, but without recording the reasons, he cannot take. He need to record the reasons. Plus, if he wants to take the books of accounts for more than 15 days, then he have to take the approval from higher authority. Without taking the approval from higher authority, he cannot take. So first of all, he has to record the reasons. Recording the reason is mandatory. And if you want to take the books for more than 15 days, then you need to take the approval from higher authority. I hope it is clear to all of you. Next one. You need to answer whether this is tax planning or management. Very simple question. Nothing great as such. First of all, you are putting 1,50,000 in PPF. Obviously, this is tax planning. Investing in PPF is allowed as per ATC, as per income tax law. It is tax planning. There is nothing wrong in that. Okay. Next, you are purchasing some air conditioner and you are putting in director's home and you are claiming depreciation under the income tax law. This is tax evasion. You are purchasing air conditioner for whom? For director, na? Then why are you claiming depreciation under the income tax law? It's a tax evasion. Don't do this. Okay. Next one, there is a foreign national. Foreign national who is also a non-resident. Okay. Foreign hockey player who is also a non-resident. Therefore, 115 BBA will apply. 194E will apply. And whatever he will earn from playing, that will be subject to 20% tax. Whatever he will earn from writing an article about hockey, that will also be subject to 20% tax. Whatever he will earn from advertisement, that will also be subject to 20% tax. And whatever he will earn from lottery, that will be subject to 30% tax. So you need to net off, this is net of TDS, so lottery you have to gross up. 69,100 is, you have to gross it up with 30%. Okay, I hope it is clear to all of you. 31.2% you have to gross it up. Now, examine whether the above incomes are subject to deduction of TDS. Yes. The first two incomes will be subject to 20% TDS under 194E and the lottery income will be subject to TDS under 194B. Is he supposed to file the return? The answer is yes. Exemption from return is available when you earn only 115 BBA income. If you earn only 115 BBA income and if TDS is deducted, then you are not supposed to file the return. But apart from 115 BBA income, he is also earning lottery income. Therefore, he is liable to what? He is liable to file the income tax return. I hope it is clear to all of you. And one last question in this particular MTP is as follows. The non-resident has made an application for authority for advance ruling on 15th of June. Now on 21st of July 2024, it wants to withdraw the said application. Can it withdraw? See, there is a provision for withdrawal of application from board for advance ruling. That is, once you make an application, you can withdraw an application within 30 days from the date of application. Now, are you withdrawing within 30 days from the date of application? The answer is no. You are making an application on 15th of June. You are withdrawing after 30 days. But there is a AAR ruling on this which says that the AAR will allow you to withdraw the application even beyond 30 days if the circumstances so justify. So, in case of genuine case, you will be allowed to withdraw the application even after 30 days. By default, it is 30 days from the date of application. But if you can prove the reason why you were not able to come within 30 days, then they will allow beyond 30 days also. I hope it is clear to all of you. So this is what this MTP is all about. Is this clear? Please tell me. Now let's go ahead with the last MTP, MTP series 2, May 2025. Now many questions are repeated in this. The first question itself is completely repeated check. It is exactly the same question as RTP November 2022 question number 2. Exactly same question. Okay. Whether the PDF is available? Yes, it is already available in our Telegram channel. Join our Telegram channel, CA Aarish Khan. I'll put the link below in the comment box also. You can check it over there. Okay. This is exactly the same question which we have done earlier. Okay. Question number 2, exactly the same question we have done earlier. Exactly. Question number 3, exactly the same question. This one. This MTP is totally copied. I have told you now, May 25 MTPs are hopeless MTPs. ICI has not put any efforts for you all. Sorry. Okay. This is a very simple question we have done earlier. DTAA question. Same. This question we have done earlier. Till question number 3, everything is same. I am giving the reference. You can check it if you want. Or you are also reading now. You are also come to know that what we have done, what we have not done. I am not going to lie to you all obviously. Yes, this is a different question. Okay, so we are going to do this question. A charitable trust is there under 12AB which is earning the following incomes. First 14 lakh rupees from the property. So I will write that in the income statement. Then 6 lakh rupees as net income from business incidental to main objective, that I will write in the income statement. Then 9 lakh rupees from voluntary contribution, that I will write over it. Total 29 lakh rupees is the income, out of which 15% exemption the trust will get. I will take that ad hoc exemption of 15%. Now, there is some catch over here in this last line. The trust has applied 12.8 lakh rupees towards charitable trust, which includes repayment of loan of 4.8 lakhs. But the purpose for which you have taken the loan, you have claimed that purpose as an expenditure earlier in 2021. For example, in 2021, you have taken a loan of 4.8 lakh rupees for buying a land. And in 2021, you have claimed that land expenditure as a deduction. So will you get the deduction of repayment of loan again as deduction? The answer is no. Again, I am saying, say in 2021, you have taken a loan of 4.8 lakhs and you have purchased the land. While purchasing the land, you claim that as an application. So now in 2024-25, while repaying that loan for which you have already claimed as an application, will you get the deduction? The answer is no. The answer is no. Therefore, that I will reduce from 12.8 lakhs. So if I reduce from 12.8 lakhs, 4.8 lakhs, 8 lakhs will be allowed as what? A deduction. Now you will tell me, sir, when you take a loan and incur an expenditure, that is not allowed only now. It is allowed only on payment. That amendment came from Finance Act 2021. And this matter is of before 2021. That is the reason this issue will arise over here. I hope it is clear to all of you. Okay. So before 2021, before 31st March 2021, it was not like that yet that when you repay the loan only then it is allowed. No. At that time when you take a loan and incur the expenditure, it was allowed. And when you repay the loan, it was not allowed. But now the thing is opposite. Now from 2021, when you take a loan, incur an expenditure is not allowed. When you repay the loan in 5 years, then it is allowed. I hope it is clear to all of you. Okay. Now the next question also we have done completely. Check it please. We have done this question just now in MTP, one of the MTPs. Remember or not? 12% guarantee. Then you need to check the AO has passed an order on 31st of March. Then secondary adjustment, all same adjust, same question they have repeated over here. Okay. Now the next question is a good question on TDS. Generally, please tell me, the bank is supposed to deduct TDS of the customers if the payment of the interest is more than 40,000. And if the assessee is senior citizen, then in that case, the TDS, the interest payment has to be more than 50,000 rupees. Then the bank is liable to deduct the TDS under 194A. Now, please tell me one thing. All of you think I have told you this in the class also, that does the bank compute interest on a daily basis? The answer is yes. The bank compute interest on a daily basis, and whatever interest is computed, they credit to a separate account. Okay. They credit to a separate account, not to the customer account, to a separate account for their monitoring purpose. But interest is paid to the customer on what basis? On some interval basis, 3 months, 6 months, 1 year. Okay. So whatever amount is computed on a daily basis, is TDS applicable on that? The answer is no. TDS is not applicable on the amount which is computed by the bank on a daily basis. TDS will be applicable only when the amount will be credited to the customer's account. Whenever it is credited, at that time TDS will be applicable. That is what it is written over here. The assessing officer was disallowing the interest expenditure. 30% expenditure was disallowed by the assessing officer just because the assessee was computing the interest and crediting to a separate account for monitoring purpose. You cannot do that. Okay, it is not allowed to do that. The AO is wrong. Next one. Profit commission of 1 lakh is paid by reinsurance company to the insurance company. TDS is not applicable. Generally 194D. 194D says what? 194D talks about insurance commission, but that excludes reinsurance. Go and check. 194D does not include reinsurance. Therefore, profit commission will not be subject to TDS under 194D. Next one. Amrish, a part-time director, was paid an amount of 3,10,000 rupees in the nature of commission. Therefore, TDS will be deducted under 194J. Whatever commission you pay over and above salary to the director is subject to TDS under 194J. And for director, there is no limit also of 30,000. See, generally there is a limit of 30,000 to deduct TDS under 194J. But for directors, there is no limit of 30,000 also under 194J. I hope it is clear to all of you. Next one is a very simple question on what? Very simple question of equalization levy, which we have done earlier. There is an Indian company, there is a foreign company who does not have a P in India. That foreign company is giving us online advertisement service. We are making a payment of 20 lakh rupees. So deduct equalization levy 6. Same question we have done some time before. Same question, 6% deduct. Pay by 7th of the following month. If you do not deduct, do not pay, you will be liable for interest, you will be liable for penalty, and the expenditure of 20 lakhs will also be disallowed. If you deduct and pay, then the income will be exempt under section 1050 in the hands of the foreign company. Next one is a theory question which I have discussed with you all earlier. The board for advance ruling has the power of issuing commission. Yes, the board for advance ruling has the same powers which are mentioned under section 131. That is the power to issue summon. That is, I'll again say the 4 powers which are given under 131, the power to discover and inspect, the power to compel production of books of account, the power to enforce attendance, and the power to issue commission. These 4 powers are there with the board for advance ruling. Next one, we need to identify whether the following persons are liable to file the income tax return or not as per 139. So if there is a person whose turnover of business is 70 lakh rupees, is he liable to file the income tax return? The answer is yes. If you are doing a business and if your turnover is more than 60 lakh rupees, you are liable to file the income tax return. Next. If you are depositing 50 lakh rupees in your saving bank account, are you supposed to file the income tax return? The answer is yes. If any individual, HF, etc. are depositing 50 lakh rupees or more in saving bank account, you are supposed to file the income tax return. I hope it is clear to all of you. Next one is a very good point which we have done earlier also in the form of case law in RTP, not in MTP. That is, ITAD has passed an order. Now, after passing the order, can ITAD reappreciate the evidence produced during the proceedings of the appeal while hearing the rectification application? Listen carefully. ITAD has passed the order under section 254. Now, after a few months, the ITAD is calling for the rectification of the order because there is some apparent mistake. Now, while rectifying that apparent mistake, can ITAD reappreciate the entire matter once again? And the answer is no. The ITAD cannot have the power, does not have the power to review the order. The ITAD only has the power to rectify an apparent mistake. It cannot reappreciate the entire matter once again. Second, the High Court cannot interfere into the factual finding recorded by the lower authority or tribunal without any valid reason. Correct. That is also correct because the High Court does not have the power to get into the question of facts. The High Court only has the power to get into the question of law, because ITAT is the last fact finding authority. If any fact has to be raised above ITAT, that is not possible. ITAT will only, after ITAT, the High Court and Supreme Court will only take care of the issues which are substantial question of law. Therefore, High Court does not have the power to interfere into the fact which is already recorded by the tribunal or lower authority, especially when there is no valid reason only to interfere. Okay, I hope it is clear to all of you. Next one is a penalty which we are supposed to compute as per 270A. It is an Indian company and the turnover of last year is 350 crore. Therefore, the tax rate will be 25%. Do not follow any special regime. Follow the normal regime. Now, and the penalty is not on account of misreporting. Therefore, the penalty will be 50%. Now, when is the first time the penalty will be imposed? The penalty will be imposed when the assessment will be done under 143. So, how will you compute the underreported income? That is income assessed. That is 5 lakh loss minus income processed. That is 7,50,000 loss. So, that will come to 2.5 lakh positive. So, in case of loss, you have to directly compute the tax. Okay, directly compute tax on 2.5 lakh. On 2.5 lakhs, compute 25% tax and 4% cess, and whatever tax will come on that, apply 50% penalty. Now, second time when the penalty will be imposed under 147, that is income reassessed 4,50,000 minus income previously assessed negative 5 lakh. Therefore, underreported income will come to 9.5 lakhs. On 9.5 lakhs, you will directly apply 25% tax on 4% tax, because again it's a case of loss. In case of losses, you have to directly compute the tax for the purpose of computation of penalty, and then apply what? 50% penalty on your tax. Okay, and one last question. Not one last question, three more questions are there. Now, the next question is a theory question. You can go through this theory question as per your convenience whenever you want. Sixth question, we will come to this question. This question has 3 parts, and this is the last question of this MTP. Out of which, the first question we have done in our class, not in MTP RTP. So I am telling you, because there is a mistake done by ICAI over here. See what has happened in this question. A search was conducted under section 132 on 31st of October 2024, and the department has seized 25 lakh rupees cash. Now, the associate has submitted the application on 15th of December requesting to release the cash. Okay, now listen carefully. I have told you earlier also in one of the MTP today that suppose if a search is conducted today, then and the department has seized something, in this case the department has seized 25 lakh rupees cash, then the department will give you 30 days from the end of the month, 30 days from the end of the month to come and explain the nature and source, and then they will take the existing liability from 25 lakh rupees, and the balance they will give you within what? Within 120 days. Now, in this case, the assessee, the search was conducted on 31st October. So 30 days from the end of the month will expire on what? Will expire on 30th November. The assessee is going for application on what? 15 December. Honestly speaking, the assessee is late. But the ICAI has said that it is on time. I don't know why ICAI has said that it is on time, but it is a mistake. Okay, ICAI has made a mistake over here. The same question is there in their study material also, but in the study material they have written 27th of November. What they have written? 27th November. But here they have changed the date. In the process of changing the date to make a question, to try to make a question, a new question, they have made a mistake only in the question. Okay, therefore the correct answer of this particular question will be the assessee cannot go for what? For asking for release of the assets of 25 lakh rupees. The provision is not applicable in this particular case, but ICAI has given a different answer, which is a wrong answer according to me. Okay, now the next question is a beautiful question on GAR. There is a country X, there is a country X, which is a foreign country. There is a company X Limited in foreign country. There is India. There is Red Chilies Entertainment Limited in India. Now remember, there is a DTAA between India and country X, which says that if the foreign company has more than 10% stake in Indian entity, then it will be subject to tax in India. Okay, so if the foreign company has more than 10% stake in Indian entity, then it will be subject to tax in India. So what the foreign company is doing? It is trying to invest around 18-19% in India. But if it invests 18-19% in Red Chilies, then it will be subject to tax in India. So what are they doing? They are making 2 separate subsidiaries in country X by the name called as Lalit and by the name called as Mohan. And they are what? Telling Lalit to hold 9.95% and they are telling Mohan to hold 9.95%. Okay. Now because of which what will happen? Lalit is holding less than 10%. Mohan is also holding less than 10%. And therefore the investment in India of any of them, neither of X Limited, nor of Lalit, nor of Mohan, is more than 10%. Therefore, they will not be subject to tax in India. So, but this is a clear case of tax avoidance. Therefore, why? Because there is no commercial substance of making these two subsidiary. Is there any commercial substance of making these two subsidiary? The answer is no. You are making these two subsidiaries only to evade tax in India. Therefore, the assessing officer will negate the benefit of treaty and will not give you the benefit of treaty, and GAR will be applied on you in this particular case. And one last thing over here is a case of what poem? There is a foreign company, Mischief Limited, and 55% of its shares are held by Kaveri Private Limited, an Indian company. We need to find out whether this Mischief Limited is a resident or non-resident in India. For that, we need to check the ABOI test. If all the conditions of ABOI test are fulfilled, then the assessee is non-resident. What is the first condition of ABOI test? The passive income is less than equal to 50% of the total income. Now, what does passive income include? Income, first of all, is this passive income? Is this passive income? Income from trading operation? No, this is not passive income. Second, income from transactions where purchase are from associate enterprise and sales are from unrelated parties. Is this passive income? No, this is also not passive income. Passive income includes where both purchase and sales are from associate enterprise. That income will be called as a passive income. This is not passive income. Income from transaction where sales are to associate enterprise and purchase are from unrelated party. This is also not passive income. Where both purchase and sale are to or from associate enterprise, that is passive income. Therefore, this 5 lakhs and this 10 lakh is passive income, and interest, dividend, capital gain, royalty, and one more item, rental. These 5 incomes are always passive income. Therefore, this 20 lakhs and 15 lakhs is also passive income. Therefore, what is passive income? 10 plus 5, 15, 20 plus 15, total 50 lakh rupees, 50 crore is passive income. And what is your total income? Total all of them, you will get 110 crore. Therefore, your passive income is less than equal to 50% of total income. Now, what is the second condition? Your Indian assets should be less than 50% of total assets. So, take Indian assets 210. Take total assets 610. That is also less than 50% of total income. Next, what is your third condition? Your Indian employees should be less than equal to total employee 50% of total employees. Your Indian employees are 70. Your total employees are 160. So that is also less than 50% of total, less than 50% of the total employees. And your payroll expense for Indian employees or who are a resident in India should also be less than 50% of the total expenditure. So your Indian payroll expense is 8 crore and your total payroll expense is 20 crore. So this is also less than equal to less than 50%. So all the 4 conditions are fulfilled. Now ABOI test is passed. Now one last test. If majority of the board meetings are held outside India, the assessee is non-resident. So out of the 8 board meetings, only 3 are held in India and 5 are held in Maldives. Therefore, the 5th condition is also fulfilled. Therefore, the assessee can be called as what? The assessee can be called as non-resident. So this is what this MTP is all about, and this is where we have completed all the 8 MTPs in full English along with 9 RTPs, 9 past papers, total 26 papers for you all. Whatever I could have done from my side for you all in full English, I have done it. Okay. I hope you all have enjoyed this. If you have enjoyed this, I have one sincere request. You share this video with maximum of your friends to the extent possible. This much you can do it for me. Second, you please comment below that what is your experience in the comment box, not in the chat box, in the live lecture. As I am taking this live, not in the live chat, but in the comment box. Okay. So this took a lot of efforts from my side, okay, but I really love working hard for you all. It's not that I am taking full English lecture, so I am blaming myself. What is this? I have to take again. I enjoy this. I really enjoy taking it for you all separately in full English, because of which you guys are getting benefited. Nothing can be greater than that for me. Okay. So that's it from my side. Very soon I'll be coming with 1 or 2 more things. I will also revise capital gains for you all. If you are ready, we will revise capital gains fully live if you want in the next 3-4 days. If you want, we can do that also. Okay. Because if capital gains, if I revise, then most of the big topics we have done the revision. Okay. So take care all of you. Bye. See you soon with some more exciting videos.